I'm Hormuz Patakia. With me as always is Vamakshi Dhoria. Vamakshi, good morning. It was a good session yesterday and the bulls will look to build on to that momentum today.
Well, absolutely, Hormuz. Apart from the monsoon grey, the Monday blues, we did have a green looking screen, so that did bode well. But let's see what today's session holds out for us. Let's get started with the top headlines then. Asia Pacific markets opened mixed as investors continued to assess trade and tariff related developments. GIFT Nifty 2 indicates a flat start for the Indian market.
Oil prices are holding steady as market awaits clarity on OPEC Plus's next move with the meet planned on the 31st of May, while gold prices have declined after Donald Trump extended the tariff deadline on the European Union.
Market regulator SEBI seeks proposal from BSE and NSE on the finalization of expiry days by June 15th. SEBI has retained its stance to keep one expiry a week per exchange, falling either on Tuesday or Thursday.
Indigo promoter Rakesh Gangwal is likely to sell more than 3% stake in the company through block deals today. Sources are telling CNBC-TV18 that the floor price is at a 4% discount to yesterday's close, and Gangwal is hoping to raise more than 6,800 crore rupees.
Kochi and 10 other districts in Kerala remain under a red alert as heavy rains continue to wreak havoc. The IMD has warned of heavy rainfall with thunderstorms and gusty winds in Mumbai and neighbouring districts of Thane, Raigad and Ratnagiri.
Well, lack of cues coming in from the US because the markets were shut over there yesterday, but the Dow futures are trading with healthy gains as they were in yesterday's trading session as well. So mostly it's largely priced in, and the Asian markets too have opened up on a slightly subdued footing in today's trading session. The Hang Seng absolutely at the flat line, as is the Taiwanese index as well. So no significant directional movement that is coming in from the Asian markets. The Nikkei too is down 0.25%. The Kospi in South Korea is down 0.5%. So it's a largely subdued looking screen on the Asian markets as well, especially considering cues from the US were absent. If you pull up the GIFT Nifty as well, it'll give you an idea of what our markets are likely to start off with. And after a strong move on Friday, building onto that in yesterday's trading session, despite the fact that there is some resistance at higher levels, the implied open is also suggesting a similar sort of a start is what the Asian screen is also mirroring as well. But a strong futures market is what we are seeing on Wall Street as of now, Amakshi.
Well, absolutely. Hormuz, yesterday, of course, the US markets were closed, so it's important to look at what the futures are doing. The stock futures on Wall Street jumped on Monday night after US President Donald Trump said over the holiday weekend that he has agreed to delay tariffs of 50% on the European Union. The Dow Jones futures added nearly 1%, while the S&P 500 futures too added 1%. The Nasdaq 100 futures climbed a little more than 1%. But Hormuz, how did the European markets do then?
No, it was expected that they would rebound considering the fact that they fell on Friday after Donald Trump's tariff threats, and yesterday when he withdrew that threat, the European markets did well for themselves. The CAC was up 1%. The German DAX also was up almost 1.75%. All of the auto stocks that fell on a Friday's trading session, they were the ones that saw a rebound, including Stellantis, and all of those names trading anywhere with gains of 3 to 5%. The UK markets were shut for a public holiday, and the Pan-European Stock 600 also ending with gains of 1%, and all the sectors on that index closed in the positive territory. So that's all we have on the global market front. But how will all of these overnight cues impact our own markets? Our research team is now joining in with the trade setup, stocks that are likely to be in the news, and of course the setup on the FNO side of things as well. First up, Vinny joins in to get all the market cues we need to watch out for today. Vinny, a subdued start is in the offing, but the bulls will be confident that we are close to 25,000.
Hi, Hormuz. So good morning. In terms of what we're watching out for from the Indian markets today, positive momentum. Obviously, we are hoping that that continues. Yesterday also we saw an up move coming in. Nifty closed about 25,000 levels. The rise that we saw coming in for the Sensex as well, 455 points higher, ending at 82,176. And Nifty Bank, a bit of an underperformance versus the benchmark indices, but still closing on the positive footing, 174 points uptick that we saw coming in for Nifty Bank. Top sectoral gainers yesterday were auto as well as IT, which were buzzing away away in trade. And in terms of what we saw coming in from FII and DIIs, FIIs were buyers as well in yesterday's trading session. 135 crores is the buy coming in on the FI front, and DIIs bought around 1,745 crores. So that buying has continued from both FI as well as DII front. Now, what are we watching out for, or what is the factors that would impact the market today? Earnings reactions will come in for most of these stocks like Aurobindo Pharma, KEC International, Shilpa Medicare among some of the names. And there are earnings that are expected today like LIC, Hindustan Copper, NMDC among the important ones, which could see a bit of a specific move on the back of its earnings. Investors are also awaiting economic data we'll see coming in this evening in terms of from the Europe as well as the US side, so keep an eye out on that. Nifty implied open as of now is indicating a very muted start coming in for the market. It's flip-flopping slightly between the red and the green, so muted start is what we should watch out for.
Hoping for a muted start indeed. Vinny, thanks a lot for that. There are plenty of stocks to watch out for, earnings reactions, offer for sales, block deals, and Vamakshi will take us through all of that. Vamakshi.
Well, absolutely, Hormas. Today will be dominated by a lot of earnings and a lot of block deals. Let me first start off with Aurobindo Pharma. Revenue saw an uptick of almost 10%. This was more or less in line with what the street was anticipating. The margins have declined to 21.4%. This is below what the street was expecting, and the net profit too is rather flat at 902 odd crores. KEC saw a revenue growth of almost 10% in FY25 as a whole, as compared to its guidance of 12 to 14%. So they've missed the guidance as far as revenue is concerned. Margins came in at 7% for the whole year, which is at the lower end of their guided band of 7 to 7.5%, and the order book saw an uptick of almost 13%. PTC India is the next counter I'm watching out for. The margins here have contracted to 7 odd percent. The net profit though has seen a substantial jump to 343 crores, and this is because the net profit included a one-time gain on divestment of PTC Energy to ONGC Green. Shilpa Medicare is the next counter we're watching out for. Remember, in yesterday's trading session, the stock was surging higher. Margins have declined for the company to 23.2%. The net profit too is seeing a very sharp fall of almost 41%, given that there was an exceptional outflow of almost 28 crores. Schneider, on the other hand, revenue saw good uptick, 24% on a year-on-year basis. In fact, it is the highest growth that we've seen since the third quarter of FY24. The margins are down. The net profit, although has seen a very sharp jump, has come up to 55 crores, and that is because the base quarter has some tax adjusted related expenses. Sagility India is the next counter we're watching out for. Sagility BV is likely to sell up to 15% equity of the company via offer for sale. Keep an eye out on Indigo as well as PG Electroplast. There could be some selling pressure out here as well.
Indeed, we keep an eye out on all of that. Vamakshi, lots of stocks to keep an eye out for today. And lastly, Mangalam joins in with cues from the F&O space, counting down to monthly expiry. Mangalam, good morning to you. What's the F&O data indicating?
3 days to go. And if you look at the big move that we saw yesterday, Nifty was close around that 25,000 mark. The Nifty Bank also moved all the way up to closer to 56,000 before it saw a bit of a sell-off. The mid-cap index would tell you that their portfolios are feeling good. Two sectors that did well yesterday. The Nifty IT, maybe because of, the delay in tariffs on Europe. And then we had the Nifty FMCG index, early onset of monsoon, good going for rural economy and good expectations for urban economy as well. The India Wix was higher even as the market was higher, and that told you that there was supply at higher levels as well. So we're entirely not out of the woods. But more importantly, yesterday we had pointed out that maybe the FI volumes would be lower because of the US market being shut, and that's exactly what took place. 136 crore worth purchase, gross volume slightly lower. DIIs actually went ahead and bought about 1750 crores. But the FIs bought a little more in index futures. Yesterday the purchase was 565 crores. They added close to 6,000 long and added 3,000 short contracts. So the net longs actually increased. And that's actually something that is happening for the last 3 trading sessions. The chart comes up for you on the screen, and you would see from May 22nd to now, the longs have increased from 32% to 35%. And the net contracts have seen a decline of almost 5,000 contracts. But 25,000, that still remains the fulcrum. 25,000 call and the 25,000 put are most active ahead of expiry, both of them having a premium of roughly 200 rupees each. And that tells you that the option writers for this month's expiry expect a range on the lower end of 24,800 for the Nifty. That's where support comes in. At the higher end, the resistance comes in at 25,200. All of this is determined by the Nifty Bank, which is actually in a broader 1,000-point range. At 55,000, you have the 20-day moving average. And at 56,000, a little over 56,000, you have the all-time high coming in as well. The one stock I'm watching out for is Dixon Tech. It's out of F&O ban, so keep an eye out on that one.
Well, thank you so much for that, Mangalam. But moving on then, Rajiv Jain of GQG Partners' latest bets include HDFC Bank and Bharti Airtel with worth $2 billion and counting. Listen in to this conversation he had with my colleague Prashant on CNBC-TV18 Prime.
Yes, so HDFC Bank, we thought was going through a sort of integration transition period as such between the two, HDFC and HDFC Bank. So since last September or thereabouts, last quarter last year till first quarter, we put almost $2 billion in HDFC Bank. And Bharti we started buying early last year, and then we have doubled down again this year. We've added a little bit to some of the other names too, nothing meaningful, but they're like a few $100 million here and there, nothing meaningful. So these are the two big positions, the other ones we quite like. I mean, you have public information on that. So because we're still very bullish on the utilities/infra type assets, we still like real estate. So and what's interesting, we feel this time around is that seems like, and for good reason, the rally seems to be led far more by large cap than mid cap. Mid cap are fine, but the valuation is less supported than a large cap, and large caps are now transitioning from, they've digested last few years for different reasons. And a couple other names, by the way, we just started, we recently initiated, so we are active, we can't talk about those. Again, large cap. So we feel that the large cap space looks fairly interesting, actually.
Okay. And the way the portfolio here in India is constructed, it's still, I mean, the trust is still industrials, infrastructure. I mean, if you were to sort of look at it by weightage, would that be correct?
Yeah, so if you look at it, it's not exactly precise, but banks is a big exposure, as you know, with now 3, ICICI, HDFC, and State Bank of India, so all 3, they're pretty meaningful. And then you get the infrastructure/utilities, because one thing I found fascinating is that utilities globally tend to be defensive. For some reason, these stocks are less defensive. I mean, I don't know why, but they're less defensive in India, but they are far more predictable growth because the rollout is happening, and that's probably half of our book. When I say utilities, infra combined, and then you get then you get 2 staples. I mean, ITC and Patanjali,
right.
And then rest is sort of mixed match of some smaller positions.
Well, as we slip into a break, we're excited to unveil our brand new global business news channel, the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights into CNBC-TV18. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset and Global Lens at 8:30 p.m. Welcome back. You're watching Power Breakfast on CNBC TV18. Now, in a circular shared last evening, the Securities and Exchange Board has asked exchanges to apply for equity derivatives expiry by June 15th. SEBI stated that each exchange will be permitted only one benchmark index options contract to expire on either a Tuesday or a Thursday. Currently, the NSE has a weekly F&O expiry on Thursdays, while the BSE holds its expiry on Tuesdays. Well, moving on then, online investment platform Grow has filed confidential papers with market regulator SEBI for an initial public offering. Sources have told CNBC TV18 that the IPO size is likely to be between $700 million to $1 billion and will comprise a mix of fresh issue and offer for sale. The proceeds of the IPO will be invested in tech development and business expansion.
Well, now the new invoice management system under GST has irked India Inc. Now, sources are telling CNBC TV18 that the industry has flagged its concerns about additional compliance burden to the government. Now, Timsy Jaipuria is here with more on this. Timsy, what are your sources telling you?
Well, that's right. Sources have told CNBC TV18 that the new invoice management system, or the IMS, under the GST regime is causing additional compliance burden for the taxpayers. Industry, in a detailed representation, has mentioned that the new system design assumes auto-replication, reconciliation of transactions across GSTR forms, and considering that most companies' processes are through manual operations, the new system would not just mean additional infrastructure, a minimum requirement of a qualified CA, a 24-hour software and internet connection, and basic backbone, that is the IT backbone, which will be required, adding to the burden. Also, the representations outline that most companies use basic accounting software that don't allow auto-matching of sales, purchases, ITC transactions across GSTR forms. And as per the new invoice management system and the design, if it sees any mismatch or break in the transactions in the GSTR forms, it will raise a red flag, which will alert the GST and income tax authorities for action, and it could lead to companies and taxpayers getting not just a GST but income tax notice as well. That is for the transaction reconciliation mismatch due to the new invoice management system and design. Further discrepancies have been flagged by the industry due to the new IMS design system, which says that it compresses correction window, blocks ITC credit, and thus problems arising due to the new IMS design are adding to compliance burden, hitting working capital, along with the most harming impact, which is that the assumptions that will be made by the authorities during these mismatches, which will be noted, and it increases the risk of dual taxation. Now to be seen is how the government and the industry battle this out.
Timsy, thanks a lot for that update. Take a short break. On the other side, get you cues from the commodities market. Stay tuned. Welcome back. Now getting you the latest on the developments related to US President Donald Trump. Dia is joining in our special segment, Trump Watch.
President Donald Trump threatened to divert billions in grant dollars away from Harvard University and give those funds to trade schools across the U.S., escalating his clash with the institution. Trump said in a Truth Social post that he is considering taking $3 billion of grant money away, adding that it would be instead a great investment for the U.S., which he claims is badly needed. As trade tensions ease on one front, the European Union is signaling its willingness to fast-track talks with Washington. EU leaders said Monday they are prepared to accelerate negotiations with the United States in an effort to avoid a full-blown trade conflict, just days after Trump accused the bloc of dragging its feet and exploiting American interests. Moving on, North Korea has slammed US President Donald Trump's Golden Dome missile shield plan as a very dangerous threat that aims to weaponize space, state media reported Tuesday. And finally, in a move with symbolic significance, King Charles III arrived in Canada to open a new parliamentary session at the invitation of Prime Minister Mark Carney, a move designed in part to send a message to US President Donald Trump about the northern country's sovereignty. That's all for today. Now back to you.
Well, thank you so much for that, Dia. But, 2 days after hitting Kerala, ahead of schedule, the southwest monsoon marked an early arrival in Mumbai on Monday, the earliest recorded onset in the past 75 years. The IMD upgraded its forecast to red alert, warning of heavy rainfall with thunderstorms and winds in Mumbai, along with the neighboring districts of Thane, Raigad and Ratnagiri. Data from the BMC indicates Narman Point, Baikala and Kolaba recorded over 200 millimeters of rainfall between Sunday night and Monday morning. But that's all on the weather front. But what's happening in the world of commodities? We now have Manisha Gupta joining in with all the updates from the commodity space. Good morning, Manisha.
Morning, and thank you for that. I'll start with the crude oil prices, which are holding gains ahead of the OPEC and Allies meeting, which is on 31st of May. Apart from that, it also is about U.S. extending, as you've been mentioning, deadline for reciprocal tariffs of 50% on European Union. The U.S. president also has said that they are considering sanctions on Russia. That seems to be adding some premium to prices as well. And then there is a report from Baker Hughes which says that the operating oil rigs in U.S. have declined by 8 to 465. This is now the lowest since November 2021. So that seems to be adding some support as well. What has seen a decline, though, has been the gold prices after U.S. announced extension to the EU tariffs. Also, the markets are looking at some kind of a redemption in the U.S. Gold ETFs, which have seen a decline for the last 3 straight sessions now. But apart from that, everything else seems to be supporting gold, whether it is about the widening U.S. budget deficit, geopolitical tensions. The markets also are looking at decline in U.S. dollar index and a very strong Citi report which says that they have revised their short-term gold target to 3,500 yet again, and they're looking for gold to consolidate between 31 to 3,500 in the days to come.
Range-bound gold, but not cheap by any means. Manisha, thanks a lot for that. Now on to some international updates. Palestinian officials have confirmed that Hamas has agreed to the ceasefire proposal put forth by U.S. Special Envoy Steve Witkoff, paving the way for a possible end to the war with Israel. Now, the new proposal will see release of 10 hostages, 70 days of truce and partial withdrawal from the Gaza Strip. Now, a number of Palestinian prisoners will also be released by Israel. However, there was no immediate comment from Israel regarding the ceasefire proposal.
Newly crowned English champions Liverpool's title celebration came to a somber end as a car plows through France, leaving dozens injured. Merseyside police arrested a 53-year-old British man shortly afterwards. The incident left 27 people hospitalized and 2 seriously injured, but the police is not treating it as a terrorism-related incident. UK Prime Minister Keir Starmer offered sympathies, calling the scenes appalling, and said he was being updated about the events. Liverpool last won the Premier League title during the COVID-hit 2020 season when celebrations were not permitted due to lockdowns. The team said on X it was in direct contact with the police.
And with that, we call time on this edition of Power Breakfast from Amakshi, me and the team that put this show together. Thank you so much for watching, but don't go anywhere. Bazaar Morning Call on the other side to set you up for today's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Tuesday morning, we are coming to you as always from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me my colleague Surabhi and Nigel. Guys, morning.
Hi, morning folks. Slightly quieter because we don't have overnight US market action.
Yeah.
But then there's still plenty in the air when it comes to trade talks. There are lots of course, local news flow as well. So plenty that we have to go over today.
Well, that's right. And the rain has subsided as well. So that's pretty okay. I think last evening we were a bit worried about how we'll get home. And this morning, Prashant, I think one queue less to track. Other you get up, you have to look at the US markets. You know? Well, chill.
The kids were really looking forward to a rainy day.
Yeah.
That rained out, washed out, no school.
Yeah. But that didn't happen.
Okay, well, let's just quickly run you through what you need to know as you begin this new session. So no US, I mean, that's straight up the first point. Markets were shut because of, US markets were shut because of Memorial Day holiday. By the way, UK markets were shut as well. So in that sense, not very much by way of cues. By the way, US Treasury futures are trading in Asia this morning. The 10-year closed at 4.51, remember, on Friday. Action will only pick up, as we go into the latter hours of the day, as we get closer and closer to the European session. Volumes pick up, and of course, right before US and once US starts trading. But I think, and I'm just sort of putting this out up there because bond markets and bond yields at the long end have been rising. There's been this gathering pressure across the board, not just in the US and Japan, UK, etc. And that remains the focal point from an equities perspective as well. Fiscal credibility remains a major drag on long end US treasuries. With regards to that one big beautiful bill, as Trump has put it, the spending bill. So, tax cuts now, spending cuts later. It's the usual trickery, which I think we are seeing once again. A lot of people actually at the margin are disappointed because this was being seen as a bit of a test that Trump is going to be fiscally conservative, fiscally responsible. But who can sort of, I guess, resist the allure to spend away and sort of, let it be the other guy's problem to manage the budget. I think that's essentially what's playing out, but we'll have to give it some more time till this is actually this passes the Congress fully. Now, as I said, bond markets are the focus. Treasury has announced $183 billion worth of supply this week. So there are auctions on Tuesday, that is today, tonight, that is Wednesday and Thursday. And I said this yesterday as well, the 7-year paper is being issued, is being sold on Thursday, and I think that's the longer end of what we're going to see. And demand here will be important in that sense. Now, just one more bit of news flow. Germany last night, gave Ukraine the green light to strike deep inside Russian territory. This is significant because and the German chancellor essentially said there are absolutely no range limits anymore. Russia, of course, is calling this dangerous provocation. So you basically are talking about Ukraine using Western weapons, NATO-supplied weapons, German-supplied weapons, and other countries, and using those weapons to strike deep inside Russian territory. We're not looking at a ceasefire. Forget a ceasefire. We're looking at maybe escalation from here and no end to the war in sight. 2022 it started. We're in 2025, and there isn't very much which indicates that this is going to end anytime soon. Now, just to sort of tie in the levels here, news flow is limited. But yesterday, the Nifty continued its bullish momentum. We closed off the highs of the day, but 25,001. Nice round Shubh number. 25,001 was the final close, by the way, on the Nifty, as you can see. So we found support at the 20-day moving average. Immediate resistance is 25,116. We got very close to it, but just under 25,100 as of yesterday's high. Once that gets taken out, which I think it should, the next upside level is 23,310, which is the 78.6% retracement of the entire fall. And on the downside, 24,462, which is the recent low. And then the 20-day moving average comes in, which is 24,602. These are the two support levels on the downside. For the Nifty Bank, we could not close decisively above the high 55,695. So that remains the first level to take out, 55,695. And of course, I mean, once this gets taken out, I think we're looking at a retest of the all-time high on the Nifty Bank, not very much between where that number is and the all-time high. Support comes in at 54,576, which is the recent low, and the 20-day moving average, which is 54,995. So that's the picture as far as levels go on both the Nifty and the Nifty Bank. GIFT Nifty will give you a quick sense of how we are likely to start, and then we'll pick it up from there. It's absolutely flat, 15, 16 points lower on the GIFT Nifty. Surbhi.
Oh, well, absolutely. And actually, flat is the trend across most of the Asian markets. We don't have very clear directional moves across Asia. And the picture is fairly mixed. You have the Hong Kong Hang Seng, which is rebounding today because it was the down market yesterday. So there's some green out there. But then the mainland Chinese market is flat. The Nikkei is cooling off. So it's a little all over the place across Asia. US futures, however, last time I checked, were indicating a positive start. 1%. Remember, because tonight is when US markets will get to react to the fact that this 50% threat of tariffs has been pushed back as far as the EU is concerned. The currency markets are still very, very interesting. The dollar continues to hurtle down lower and lower. The dollar index is close to 1 month lows now. The last time we were at similar kind of levels, 98.20 thereabouts, was April. 21st of April was the low. So we're getting back to that level. The rupee has been strengthening, and I just want to mark this because yesterday was an important day for the dollar rupee. In intraday trades, it was actually going above the 85 handle as well, and the rupee is not alone. A lot of other Asian currencies have been strengthening. The yuan, for instance, yesterday hit a 7-month high. So the currency market action continues to be quite important. For us, of course, the Nifty at 25,000, that Shubh level, as Prashant calls it, 25,001. So let's see. It's consolidation, but the bias has been positive over Friday and yesterday as well. The flows picture, more domestic buying than foreign buying yesterday at a net level because foreign institutional investors bought net stocks. The buying was just about 140 crores. DIIs, as you can see, the number is there, northwards of 1,700 crores. Now, plenty of interesting local news flow, as I said. Number one, this whole war of the weekly expiries, it's getting more and more interesting because SEBI finally came out with its final policy on this. Till now, it was a consultation paper. And, the market regulator has indicated that weekly expiries will be limited to just 2 days of the week. And SEBI is going with Thursdays and Tuesdays. So all exchanges have to decide, pick one of these days. And then that's how the weekly expiry will happen. In fact, it's told exchanges to come forward with their independent proposals by the 15th of June and decide. And Bloomberg this morning was indicating that NSE will probably ask for the Nifty expiry to be on Tuesday. So let's see how this plays out. Watch for BSE as well and how the stock fares today in trade. Speaking of the F&O market action, there are new entrants as well. 361 Wealth Management, Amber Enterprises, K Fintech, and PG Electro. All these stocks get added to F&O. This is effective the 27th of June. So some interesting trading action expected there. And interesting block deal action as well expected today because our colleagues have been indicating that Indigo, that's the first one that could be on the radar. Rakesh Gangwal could be selling up to 3.4% stake. The floor price is about 5,175. The other one is PG Electroplast. And watch for PG because here promoters are likely to sell and they could be selling as much as 5.6% stake. So this is going to keep both of these stocks in very sharp focus. So lots of local news flow, lots of stock-specific action that should drive the day today. Nigel.
Well, that's right. In yesterday's trading session, as you all said, the Nifty managed to get to that Shubh level of around 25,000 odd mark. But it was without the FIs because the FIs were on a holiday. If you look at the gross participation yesterday, it was much lower than what we've seen on an average in May 2025 because the US market, UK market as well was shut. That's one probable reason out there. Now, yesterday's trading session, the Nifty went up, but the VIX as well moved up. Sometimes, that's a little bit of a caution, though I don't think it's that bad because the VIX is still very much at the lower end of the range, at around that 18-odd level. Not a cause of worry till it gets to the 20 to 23-odd mark, which we saw earlier in the series itself. Moving to what the rollover picture then, we have the monthly expiry that will play out. And the Nifty rollover actually is much higher than what we saw in the past series. On D-3, that is the expiry is 3 days away. If you take D-3 and you compare it with the previous series, this time around it's at around 50% odd. The last time around it was close to around 30%. So the Nifty rollovers are higher, while the Nifty Bank rollovers actually are relatively lower because this time it's at around 35%. The last time around it was around that 45% odd mark. So Nifty rollovers relatively higher. What do the FIs do? Well, they added more longs than short positions in the ratio of close to around 2 longs for every 1 short position. They continue to remain net short with close to around 65% of their positions on the short side. So that's come down a little bit from around that 68% odd mark. And in absolute terms, the FIs, they are net short with 50,000 contracts on the short side, while the clients are net long with close to around 50,000 contracts on the long side out there. Which brings us to the options data. Since we have that expiry that's going to be playing out in the next two or three trading sessions, the 25,000 call, 25,000 put, fairly active in trade yesterday. Same strike, you see writing on both these two, then it appears as a strategy at plays. It's known as a short straddle, where those traders, they are looking at writing both the strikes and pocketing the premium. In this case, it's around 400 rupees. So those that are moving with this strategy, they are looking at the 24,600 mark to hold out on the downside. And on the upside, 25,400. But in the near term, you've got some crucial levels. So going by the options data, the 24,800 mark for the day, you don't want this level to get breached. On the upside, this resistance level, that's the mark that I'm looking at, going by the options data and going by the call writing that we saw at around the 25,000 call or thereabouts. But the 20 DMA, that's important. That's a deeper, support level that we're looking at. The Nifty Bank, it's gradually making its way to around the 56,000 odd mark. Today could be the day that it goes ahead, tries to challenge that 56,000 mark and actually crosses above that mark. So we'll have to keep an eye out on that. The stock that I'm looking at for today is going to be Eternal. Yesterday as well, the stock got, pulled back a little bit. That's because, in fact, we did see the expectation that was there from the street with regard to the FTSE rebalance that was a little bit more severe. So yesterday it got hit by close to 4.5%. Today is when the FTSE rebalance takes place in the final hour of trade. So you'll expect passive selling of close to around $300 million approximately. The MSCI rebalance will be on Friday. So I'll keep an eye out on the stock. Remember, this is a bit of a blow for the stock in today's trading session. But at around 215, 220, that's a crucial support zone. $300 million of passive selling is what we look forward to.
All right, Nigel, thank you very much for that. So that's the setup and lots of interesting stuff to track in terms of those individual names as well. Ben Powell is with us, Chief Middle East and APAC Investment Strategist at BlackRock Investment Institute. Ben, great to have you with us here. Thank you for your time. We'll talk about the bond market in just a bit and whether that'll start to hurt equities. But I just want to start with this Russia-Ukraine thing. Trump has kind of made it clear that he's ready to talk to Russia even though they don't stop fighting. I mean, even without a ceasefire. And I think it's pretty clear that, Russia does not want to stop because they think they're winning. Now, this overnight news that Germany essentially allowing Ukraine to use their weapons to hit targets deep inside Russia. Is that a new phase of the war in that sense? I mean, forget a ceasefire. We're now probably looking at escalation.
Good morning. Great to be with you. Yes, we continue to be in a very difficult geopolitical environment. And I think this is another example of how the investment kind of landscape that we're all trying to navigate is completely different to where we were perhaps 5, 10, 15 years ago, where with hindsight, I guess we can say at least at the global level, these risks, be it kind of normal economic stuff of high volatile inflation, tariffs, or much more seriously, the geopolitical risk, including military risk, clearly have moved from being relatively benign back in that previous era to a much more disconcerting situation now, which is something investors are going to have to learn. I'm afraid we're going to have to learn to live with. The idea that we're going back to a kind of benign macroeconomic or geopolitical environment, I think is extremely unlikely. So as investors are kind of waiting for the clouds to totally clear, I actually don't think is really an option. We're just going to have to learn to live with this kind of backdrop and try and navigate it as best we can.
Ben, hi, great to have you on the show today. And that's one part of the problem. The other is obviously trade, right? And we still don't know. I mean, there are no final answers. It seems the deal with the Japanese could be progressing quite nicely, given the statements that have been coming out. With the EU, now this whole 50% threat is looming. What's your sense, Ben? I mean, and even as these deals get done, I mean, eventually tariffs are going to be much higher than where they were before this, U.S. president took office. Have the markets adequately priced the slowdown or the quote unquote recession? I mean, the ground economy is still doing very well in the U.S. is what we understand. Your thoughts?
Yes, so I think you made a very important point there en passant, which is there's many things we don't know, but I think we can clearly say if we look at the UK, which is the one kind of trade deal that's done and dusted, that nominally at least is a friendly nation to America, and even the UK got hit with a 10% tariff. So I think maybe one thing we can feel reasonably confident about is 10% is something like a best case. You know, again, if that's the kind of rate that the deep ally, historic ally going back decades, even centuries gets, I guess we can assume that's kind of a best case scenario looking forward, which to your point means even hopefully as we get a bit more clarity on the many dozens scores perhaps of these trade deals being worked out in real time, wherever we end up is going to be a totally different place from where we started, much higher. And what that means for us as investors, we think at BlackRock, BlackRock Investment Institute, is inflation will be structurally higher. It's arguably a bit strange, but for political reasons, and fair enough, politics is a real thing. Obviously, voters do what they want to do. But the consequence of this should be a kind of self-induced inefficiency. You know, we are deliberately injecting less efficiency into the trading system for political and maybe reasonable justification, but as a pure kind of economic outcome, making global trade less efficient, making it a bit clunkier, trying to move stuff away from where it's kind of cheapest to where you would prefer it to be, you know, with your friends or even at home.
But
Get it
Ben,
politically, but economically, it should mean higher inflation.
but got your point, Ben. But simple question: can markets keep marching higher despite the reality you just described?
Yes, I think so. So on the equity side, and clearly what we've seen in the last couple of weeks is the S&P US equities ripping higher, more than 20% higher. That's some people's definition of a bull market. So clearly, yes, equities can do fine, even with all of this going on in the backdrop, because of course these issues that you're raising are obviously extremely important and are going to continue to be so. But they're not the only game in town. And at least over the last several weeks, what we've seen is the AI, the artificial intelligence megaforce, has been sufficiently strong to be a big enough tailwind to offset even these very substantial headwinds. So yes, we at BlackRock continue to be overweight US equities. We fully understand there are many things to be concerned about. That's true and important. But there are also many things as equity holders that we like, and on balance, we think the tailwinds are stronger than the headwinds. That keeps us overweight US equities from here.
All right. Hi, Ben. Good morning. Good to hear that thought. And I think the last time we spoke as well, you did mention that valuations are still relatively attractive for the US markets and you'll continue to remain overweight US equities. Now, the point is that the dollar index actually has weakened. And normally that could see some kind of outflows, the kind of gush of money that we saw into the US equities. Do you think that could happen? And if that is the case, where does the money rush out to? Does it move to Europe or does it move to emerging markets, if in case you believe that could possibly happen because of the weakness we've seen on the dollar index?
Yeah, I mean, that's a fact, right? The dollar has weakened. That's true and important, and I think speaks to an important conversation that's going on in the market around US exceptionalism. Our view is the US is still an astonishingly, perhaps unique place on the planet, blending intellectual kind of capital, financial capital, and all of that. So that's still true and important. But to your point, I think there is a logical kind of consequence of this new, more fractured geopolitical order where we are going to look to diversify. Having all your eggs in one basket, even a beautiful basket like the US, feels a bit riskier given the volatility that we're seeing kind of all day, every day. So we would be looking to allocate carefully into other geographies, including selectively within emerging markets. So we want to be like picking our spots. Obviously, not all emerging markets are the same. So we would want to be cherry picking what we think are economies, sectors, markets which can benefit from these mega forces and do a better job, I guess, of being able to work through some of the headwinds.
All right, and Ben, India comes top of the list, or where do we feature?
We like India, yes. We think India is the right side a lot of these kind of huge tectonic shifts that we're seeing. So India, in terms of the geopolitics, where we started the conversation, clearly India is, of course, a kind of a continent-sized country and economy, and everyone wants to be friends with India. I think it's neck and neck at the moment, but potentially India's GDP will be overtaking Japan's relatively soon in the next few quarters. So India's heft, political importance, and I still think, if I can say so, what some of the foreigners still fail to understand is the amazing technological kind of productivity advances we've seen in India over the last years. That's not a news story, but it's kind of true and very important. So the combination of demographic growth, labor force growth, multiplied by ongoing productivity gains is a story we continue to like. So yes, India is definitely one of the emerging market equity index we would be favoring.
Absolutely. And of course, Ben, as I think many foreigners have pointed out, the diversity, right? I mean, the absolutely diverse group of companies, industries, businesses, not minerals focused or tech focused or this or that. I mean, it's everything in that sense. Thank you very much. Great speaking with you, Ben. Appreciate you joining us, and it's a pleasure having you here on CNBC TV18. Till the next time. Well, I think let's just quickly look at the GIFT Nifty and what that is doing before we go any further. And I think that is indicating an absolutely flattish kind of a start, about 20 odd points lower, 15 points, 16 points lower. Let me tell you what's lined up here over the next 2 hours or so in terms of interactions. So you'll hear from the management of KEC International, 8:35, Vimal Kejriwal talking about the fourth quarter numbers. 9 o'clock, Vishal Manchanda of Systematics Group speaks to us about Divi's laboratory supply agreement with a global pharma company. Aurobindo's fourth quarter earnings also in focus with him. Sridhar Sivaram of Veenam will be with us. He's a market master today. 9:30, we'll have the management of Jyoti CNC, outstanding performer in terms of the stock and of course business-wise as well. And we'll have Sakshi Gupta of HDFC Bank and Upasana Bharadwaj of Kotak Mahindra Bank will be speaking with us at 9:40. This is, of course, macros in focus, 9:50. Our special program will play out a snippet of our interview with Rajiv Jain of GQG Partners, the largest foreign investor in the country. Towards the end of the program, it's commodities in focus, and Manisha will be in conversation with Ole Hansen of Saxo Bank, and she talks to him about metals as dollar falls and tariff uncertainty continues to remain high.
Well, time to slip into a short break. On the other side, we'll go full throttle on all stocks in our special Top 10 segment. For the time being, I give you a sneak peek into the list. Peach Electro Plus, we have Oro Pharma, Schneider Electric, Shilpa Medicare. They'll be reacting to positive news flow. While you have Interglobe Aviation that will be reacting to negative news flow. Add to the list Agility, KC International, Brainbee Solution, Blue Dart, and Electra Green Tech. Take that break, come back, get into further detail on all of these names.
Welcome back. So as we've been telling you, cues across Asia are fairly mixed, which is why we're not getting a very clear directional indication, even from the implied open today. Markets are a little all over the place, very range-bound and a little directionless. Let's get the implied open up. Okay, about 13 to 14 points on the lower side. That's what we have. Lots of stocks as usual on our stock list. So let's straight away get to it with our team. Here's the CNBC-TV18 list of top stocks to watch for the day. Morning, guys, to all of you. Let's first start with, earnings later. But I think the block action could be very, very exciting today. Nimesh, good morning. Tell us more.
Morning, Sylvia. So 2 large blocks and 1 large OFS. So the fundraising spree continues. I'll start with Interglobe Aviation, much awaited block now finally happening. So the Ganwal family is selling another 3.4% stake in Interglobe today. The indicative price, the follow price, is at a 4.5% discount, which is 51.75. That's the indicative price. So 4.5% discount to yesterday's closing price. I understand the demand is quite strong, but the stock may open a little bit soft on the back of that large block. But the most important part is now there is a 150-day lockup. So the remaining 10% can't be sold for the next 150 days in Interglobe Aviation. So that's the first stock. The second stock is PG Electro Plus. Again, a large block. The promoter is selling nearly 5.6% stake via block deal. The deal size is close to 1170 crores. And again, there is a 4% discount to yesterday's closing price. And even there, I understand the demand is quite strong. Interestingly, even in PG, there is a 180-day lockup now for the promoter, so they can't sell further for the next 6 months. And the last one is Sagility. This is going to be interesting. A 15% OFS is what the parent is looking to do in Sagility. Of course, it's because of the minimum public float norm. So with this OFS, the stake will fall below 75. So the further supply won't come. But again, the floor price is at a 12.5% discount. So the stock may react a bit negatively to start with. The floor price is 38. Again, it's an OFS, so it'll get over 2 days. So 2 days for non-institutions, and for tomorrow, 2 days for institutions, and for tomorrow, it'll be for retail. So 3 large blocks, but the 2 important ones would be PG Electro Plus and Interglobe. And interestingly, PG is getting added to the FNO as well from the next series.
Interesting. It's raining blocks, Nimesh, huh?
Yeah, absolutely.
And the forecast is for cloudy skies and heavy rainfall, continued rainfall. Thank you very much, Nimesh, for that. Well, Aurobindo Pharma is the next one we're going to focus on. Ekta is here with details on the numbers. Ekta, morning.
Thanks for that. Well, largely an inline set of numbers, you'd say, for Aurobindo. So revenue growth was around 11% year-on-year, margins 21.4%, Street was anticipating 22%, and a profit which was a little below expectations, but it was flat on a year-on-year basis. Now, in terms of geographies, the US markets did well. So that, the company said, was driven by volume growth, stable pricing, new launches. It was up around 8.8% on a year-on-year basis in dollar terms, and versus estimates of around $430 to $432 million. So better than expectations. Europe also was okay. It was up around 17% on a year-on-year basis. The call is at 8:30 a.m. More details then.
Okay. All right. Thank you very much for that, Ekta. Let's go to Vivek now. KEC International came out with numbers. How do they look, Vivek? Morning.
Well, good morning. KEC International, after a very soft H1, H2 has been much better. And especially when you're looking at Q4, it's been a very strong execution that the company has managed to deliver in the last quarter of the year. But when you're looking at what the company guided to as far as the whole year was concerned, the company has managed to miss estimates by quite a large margin, especially when you're looking at the top line growth. They started off the year expecting close to 15% top line growth. They trimmed it down to 12 to 14%, but at the end of the year, they managed to do a 10% growth as far as the top line is concerned. But let's have a look at how exactly Q4 panned out, which is quite strong. Revenues higher by 11% on a year-on-year basis, EBITDA up 39%, so very strong execution. And when you're looking at margins on a year-on-year basis for Q4 comes in at 7.8 versus 6.3%. Profitability higher by 77%. Order book, that continues to remain quite robust. Almost 34,000 crores is where the order book stands at currently, and L1 plus the order book close to 40,000 crores. So order visibility too is quite strong. The only blip remains the miss as far as the top line growth is concerned, and margins, remember, the company had guided to almost 9 to 10% band that continues to elude most of the infra companies.
Thanks a lot for that, Vivek. In fact, we have the management will be joining shortly to detail their Q4 earnings and detail what's their plan with regard to FY26. Let's go to Mangalam, though. He's tracking Blue Dart as well as Brainbee Solutions. Mangalam, how are the numbers?
Well, operationally weak. For Blue Dart, the problem is that external environment is not very conducive. So 7% revenue growth is what the company has reported. The EBITDA has actually declined by about 5.5%, telling you that there's a margin compression of 200 basis points. And that's reflected in the net profit as well, which has fallen from 78 crores to about 55 crores. The company said that this year was shaped by geopolitical uncertainty, macroeconomic volatility, and sectoral challenges as well. they are cautiously optimistic, but there could be some red on that stock today. Brainbees, on the other hand, the revenues grew well, 15.8%, but the EBITDA, the reported EBITDA was down 52% and close to around 15 crores versus 33 crores. But if you add back the other income and the one-off expenses, as the company has claimed, the adjusted EBITDA has actually grown by about 20%. So we'll have to monitor how the street takes, that. The India business is doing well. India business has shown a revenue growth of 11.5% and EBITDA growth of 17.5%. The international business, that continues to face some challenges. Even though there has been a revenue growth of 11%, the losses continue to widen. And global bees as well, where the revenue's grown 33%, the losses have widened from 25 crores to 23 crores. So see some red on global bees or brain bees.
Okay, all right. Thanks a lot, Mangalam, for giving us details on both those two stocks. So we'll keep a track on that as well. But let's wind this down with Vamakshi, who's here to tell us about Schneider Electric. Morning, Vama.
Good morning, Nigel. The company had a good run this time around. When you look at the revenue, that saw an uptick of almost 24%. Revenue has come in at 587 crores. And in fact, this is the strongest year-on-year growth as far as revenue is concerned since Q3 of FY24. And keep in mind that the revenues have managed to stay close to that 600 crore quarterly run rate, over the last couple of quarters. When you look at the EBITDA, that has come in at 87 crores. While this is sharply low as compared to third quarter of course was exceptionally well for the company, but they managed to maintain that run rate of around 80 odd crores. EBITDA margins too have come off both on a year-on-year basis as well as sequentially to 14.8%, but nevertheless they do remain healthy. When you look at the net profit though, that has when you compare it to Q4 of FY24, it's seeing a very sharp uptick. The net profit has come in at 55 crores, and that is because in the base quarter, that is in the same quarter last year, there was some tax-related adjustments. Now, apart from this, the company has announced capex. They are enhancing capacity both at their Vadodara plant in switchgears and at their Kolkata plant in breakers. They are looking at an investment of somewhere around 200 crores, out of which 110 crores will be for Vadodara and 91 crores for Kolkata. This will be financed with a mix of internal accruals and debt, and they are expecting some good demand to come through, which is why they're making the capex. Overall, when you look at the numbers, I would say a good set, going with the green for Schneider.
All right, got that, Vamakshi. Thank you very much. So green for Schneider. On to Ekta once again. Shilpa Medicare. Ekta, tell us, how does it look?
Well, good numbers. Revenue was up around 13% in terms of the revenue. The profit was below estimates, but there was an exceptional this time round. The API business, the company says that the order book is healthy. It was a bit sluggish. Formulations, new product launches drove the growth there. But the major milestone, and that's the reason that you saw the stock higher in yesterday's trading session, is the out-licensing of its flagship product, which is the recombinant human albumin for EU, with a commercialization in partnership with Orient Corporation. So that's the reason you saw the stock much higher, because it's their flagship product. And that's probably the reason you could probably see follow-up buying today.
Okay, well, Ekta, thank you very much for that. Shilpa, of course, has been has come up very sharply from 600 to almost 900 kind of levels, very fast. Let's talk about Electra Green Tech now. Hormuz is here with the news flow around this one. Hormuz, take it away.
Morning, Prashant. And negative developments coming in around Electra Green Tech, because the Maharashtra Transport Minister Pratap Sarnaik yesterday wrote on his social media handle on X that he's instructed officials to cancel the electric bus order that was given to the company. Of course, he did not explicitly name the company, but it was for a 5,150 bus order for failure to adhering to delivery timelines. And he also mentioned that the company was also given a revised timeline to supply 1,000 buses by the 22nd of May, which has not happened, and the company has failed to deliver even a single bus during this period. Also, of course, there is no official announcement from the company's end as well, so we need to keep an eye out on that. By the way, back in July of 2023 is when Electra Green Tech was awarded this order in consortium with EV Trans for 5150 buses, which was valued at close to 10,000 crore rupees for a 12-year period. And Levy was supposed to procure the buses from Electra and deliver them over the next 24 months, which is by July of this year, and which has not happened, and as a result of which the contract has been ordered to be cancelled. And between July of 23 to February of 24, the stock of Electra Green Tech had more than doubled in value, and since then the stock has fallen almost 40% from its peak. So a negative development for Electra. Expect the stock to open in the red.
All right, Hormaz, got it. That's also on our list then. Thank you for that. Let's quickly recap the list of top stocks to watch then. The ones that have positive news flow are PG Electroplast, Aurobindo Pharma, Schneider Electric, and Shilpa Medicare. So just 4 names on the green side today. More on the downside. Let's recap them. Interglobe Aviation, Sagility, KC International, Brainbees Solution, Blue Dart, and Electra Green Tech. Okay, that's the equity list for the morning. Let's now take stock of what's happening with the commodity markets as well. We have Manisha Gupta joining in with the latest. Good morning, Manisha.
Morning, and thank you for that, Surbi. I'll start with the crude oil prices, where we have seen it holding gains ahead of the OPEC and allies meeting. That is on 31st of May, with an expectation that you would be looking at increase in production. But on the other side, we're looking at some support coming in as U.S. extended deadline for reciprocal tariffs of 50% on European Union. Also, U.S. President saying that they're considering sanctions on Russia seems to be adding some premium. And then the U.S. Operating oil rigs have declined by 8 rigs, and this is the lowest since November 2021, also supportive for the prices. So while crude oil prices is trading on a firmer note, we've seen gold prices slip after the U.S. extending EU tariffs to July 9. But gold seems to be taking a lot of support from the fact that the U.S. budget deficit is widening. The geopolitical tensions in Middle East and Ukraine just about continue. Investors also are waiting for the latest FOMC minutes. Well, that gets released tomorrow. But then the dollar index also trading at a 1-month lows. Russia's largest aerial attack so far on Ukraine also seems to be adding some premium to the market. And most importantly, there was a Citi report yesterday which says that they have revised their gold target higher to 3,500 yet again. And they expect the gold prices to trade within 3,100 to 3,500. So clearly keeping it on the higher side and absolutely above $3,000.
All right, Manisha, thank you very much for that. So that's gold in focus. We'll take a quick commercial break here. We're going to come back and focus on stocks with Amnish Agarwal of PL Capital. So some fundamental stock conversation coming up.
Investing.
Welcome back. You're tuned into Bazaar Morning Call. Well, let's welcome Amnish Agarwal, Director Institutional Research at PL Capital, who joins us on the show. Hi, Amnish. Thanks a lot for joining in. Amnish, it's raining blocks. Now we know why the mutual fund industry is sitting on a lot of cash, which is the highest that we have ever seen as a percentage or even in absolute terms, at around 7% or thereabouts. And in absolute terms, it's more than 2 lakh crore. That said, what's your view on a couple of these larger names? Like IndiGlobe Aviation, we understand the promoter entity wanted to sell some stake. Now, source-based information that's coming in is indicating that actually the promoter entity is upsizing the size of the block. But that's been a stock that's, any kind of supply has been gobbled. Your view on the stock?
See, hi Nigel. Interglobe Aviation actually has been doing quite well. If you look at, say, last particularly say few quarters, the numbers have been good. It is operating at, say, around 86% utilization, and now the crude prices are also benign. So that is also going to benefit. And moreover, the kind of market share it is having in the Indian market, which is one of the fastest growing market globally, that makes Interglobe Aviation currently sitting in a very sweet spot, at least in the near to medium term is concerned. Now, I think the promoters have been selling the stake, and it is something which is not new. But every time I think you can say the stock is being lapped up by institutions. If you look at last couple of years, the stock has also got re-rated. It used to earlier trade at 6 to 7 times EV to EBITDA, but now that has gone into a double digit of around, say, 11 times odd. But looking at the prospects of travel, tourism, and the aviation sector in India over the medium term, we remain constructive on this name.
And SpiceJet doesn't deserve a look in. Interglobe is what you're positive on, but you would not look at SpiceJet?
You see, SpiceJet is more like, time and again, it has been raising the funding, but somehow the expected turnaround is not happening. And that is where then the investors' patience also goes out. Now, given the prospects, one would have expected that SpiceJet should turn around at some point of time, but somehow I think they are not able to gobble up the kind of efficiencies which are requiring. So I think it is better to stay with the leader rather than to continue, you can say, expecting a turnaround in a name which has not happened in the near to medium term.
Okay. All right, Amnish, got that point. Stay on. We have lots of other questions for you as well. But earnings season, so let's quickly get to a management conversation as well. KC International is the company on the radar right now. The company reported a pretty good performance for the fourth quarter. It was a better end to what was otherwise, let's say, a muted year. Perhaps one can call it that. The company, of course, is talking about its order book growing forward, going ahead. Let's discuss this. We have Mr. Vimal Kejriwal, MD and CEO at KC International, joining in. Great to have you back on the show, sir. Good to be talking again. So Q4 ends on a high. Like I said, the year otherwise, I mean, the market is obviously saying that you've not been able to meet your lower guidance, whether it's on, the margin. I think you'd guided for margins 7 to 7.5%. You're at the lower end as the year ends, about 7. And top line growth 12 to 14%, but you did about 10 odd %. So now, sir, let's talk about this, because the commentary, what we've got from the press release, etc., is looking very strong. You're talking about the T&D segment doing better, money being released by state governments, so maybe the water business starts doing better, rail, etc. So let's talk about the top line growth and the order book growth that you see ahead this year.
Morning, Surbhi. Thanks for having me. I think I'll just take a minute on your earlier comment. Basically, after the Q3, we had down our margins to 7%. And growth, yes. I think the basic issue which we have faced in Q4 has been the shortfall in the payments and water. We were expecting that the water business would, the payments would be released by the governments and we would be able to, sort of execute those orders. We have now started receiving monies and we have started executing the projects. So that has led to a slightly lower growth. Instead of 12, we have ended up at 11%, and for the year 10%, etc. And similar margins also at the end of Q3, we had switched over to 7 because of this only. Water is a more profitable business. So I think that's where the margins are and the top line is slightly lower. Although to me, they are a record high for the company as a whole.
But FY26 now, sir, that's fair. But I mean, like I said, it's ended on a very optimistic note the previous year. FY26. Now let's talk about the order book. There's a large L1 pipeline. How much do you see coming to you? And of course, revenue.
Just one thing, Mr. Kejriwal, sorry, just to finish that point on margins. So where do you see margins at FY26?
So Q4, we ended up at 7.8. And for next year, we are now talking about 8 to 8.5%.
Which is 8 to 8.5% this year, FY26, the financial year we're in.
FY26, yes.
Okay. Glad to clarify that. Go on, sir. To the point of orders, L1, etc., what Surbhi was asking.
Yeah, sure. So I think this year we had an order intake of slightly lesser than 25,000 crores, of which almost more than 70% was in T&D. Almost 18,000 crores came in from T&D, rest coming from civil and railways and cables, etc. We have an order book plus L1 right now of around 40,000 crores. This year already we have declared orders of more than 2,000. So with that, I don't think we are looking at a growth which would be less than 15% for the year. Margins I've already talked about.
15% revenue growth for this year. Got that, sir. We've noted that. Also, this improvement in the margin profile from 7.8% in fourth quarter, you're talking about almost 100 basis points improvement by the time the full year ends, this current year. What will drive it? Will the mix change? Give us a little more color on both the revenue growth and the margin growth. What will drive it?
So clearly the mix will change slightly with the railways coming down. Last year also railways came down from 3,000 crores to 2,000 crores and we expect it to continue at 2,000 crores, whereas our overall top line will grow by 15%. Transmission, as I said, was 70% of our order intake and I think it's around 60% of our order book. So we expect that within the businesses, the revenue share of transmission will grow up and I think it's more profitable than all other businesses. So that's one basic reason. Second is we expect that the civil margins also will start inching towards 8% or something. So both these factors would help us in improving the margins. I think the other thing which we need to keep in mind is that our interest costs have been coming down. For the quarter, we were at 2.5% of the revenue. So when you look at the PBT and PAT, our PBT and PAT have grown by more than 60%. So I think more than EBITDA, we start looking at that. There we expect a much higher growth.
Okay, all right. Mr. Kejriwal, I take that point on board. In fact, your net working capital days as well has come down by around 12 days. Will it hover around this vicinity of around 120 days or do you want to guide for a higher number? If you could give us some clarity on that front. Yeah. And as you said, your net debt as well, I'm looking at it, including acceptances, that's come down, I think, from around 5,000 crores, it's come down to around 4,500 crores. Does it stabilize at these numbers? Working capital and net debt. Please go ahead.
So Nigel, on the working capital, from December, we're down by 1,000 crores. From last March, we're down by 500 crores. And we expect it to go down further by another 500 crores this year, despite the 15% growth in the top line, which we are talking about. So I think we are very comfortable with what's happening on the net debt side and on the interest side. In fact, our interest for the year is at 3% of revenue, 2.5 for the quarter. And we are hoping that we'll be able to maintain 2.5 for the whole year.
Okay, all right, 2.5% interest cost as a percentage of sales. And the working capital days, around 120 days?
No, it will come down by at least 10 days.
Another 10 days, so around 110 days, 110, 112 days is what we could work with. Got that, Mr. Kejriwal. Just a quick question, there is these legacy issues on a couple of aspects. If I look at water, if I look at railways as well, do you think bulk of it now is behind us and things will only get better from here on?
So water is not a legacy issue. There were new orders which we got 2 years back. We still have an order book of almost 2,000 crores, profitable orders. I think it's just waiting for funding from the government. We have orders in 2 states, MP and Orissa. Funding has started flowing in. So I think hopefully this year we are targeting almost, I'll say, 12 to 1,500 crores of revenue from water. So water is not a worry in the sense of profitability. It's been a worry in terms of revenue, etc. Railways has been a problem, I think, but we are now almost at the end of the tunnel. We have closed most of the orders and hopefully we should be able to get out of all those issues by this year end.
Okay, and T&D side, it seems you all have got quite a lot of strength. According to your analysis, in India at least, the business has looked up. That is one part of the business has looked up. Have you gained market share?
I don't think I'll say we have gained market share, but what is happening is that the quality of the order intake and the margins are going up because the order sizes are going up. And they are becoming much more complex. So I'll not say market share, but I think overall the top line and the margins have grown.
Mr. Kejriwal, nice touch there on railways, end of the tunnel or light at the end of the tunnel. Just a quick point in terms of water. Will you, like railways, will you go slow now? On railways, you've gone slow. You've told us that over the last many quarters we've spoken. Will you do the same with water if new orders come? Because this is all B2G, right? So the government has to release payment and that can go sometimes, it can be out of whack.
So Prashant, water was never a problem. I'll tell you honestly, till the last year, till before the elections, parliamentary elections, we were getting water I think water payment was one of the best we had from government. You raise a bill on 27th and 31st, you used to get the payment. I think somewhere something happened and the allocation to water went down. So what we are looking at is a state by state, like today MP is paying reasonably well. So to depend upon which state and what the payment track record is, and then we will decide. We are not aggressive on it, let me put it this way. But we are looking at, with the experience we have gained, we are looking at taking up some projects on the international side.
I'm glad you mentioned that, sir. I was just coming to the
just
international.
one thing.
Okay.
What exactly do you do, Mr. Kejriwal, with in terms of the segment, water?
So basically, we are in what they call Jal Se Nal Tak. So it's basically putting up intake wells, filtering the water, and taking them to the end user.
This must be a pretty. It's obviously very large allocations in the budget, flagship program, etc. Could you give us a sense of how? I mean, every year, what's the amount spent really?
I think the last budget allocation was around 65 or 70,000 crores. I think the problem, Prashant, what is happening is typically 50% comes from the state, 50% comes from the center. I think that's where the mismatch happens. Sort of who will fund the money first? That's where I think the problem is happening. It's getting sorted out. It was sorted out earlier. Somewhere last year it got into trouble. Hopefully it should get resolved.
Got that. You also mentioned that you will be looking at water projects in the international markets, and that was my question. Overall, sir, finally give us a color on the mix between the share of India revenue, overseas revenue, across businesses. I mean, T&D, you've been always very big and bullish on the Middle East markets. What's happening there? This year, how are you expecting the international business to perform? And of course, water, like you just mentioned.
So T&D typically is around 70% of our T&D business is from international and 30% is from India. But overall, if you look at the overall ratio, it's the other way around because we still don't do railways and civil and all others outside. So if you look at the overall level, it would be 70 India, 30 international. But T&D is the other way around. That's the way the ratios are. And I think what is happening on the T&D side, our major areas continue to be Middle East, whether it is UAE, whether it's Saudi, Oman, Kuwait. I think we are doing very well. We have a large order book in those areas.
All right, Mr. Kejriwal, we'll leave it there, sir. Thank you very much for coming on first here on CNBC-TV18 and speaking to us about FY26 across business segments. Good luck, sir. We'll take a quick commercial break here. We're going to come back. Technical trades and focus. Sudarshan Sukhani and Chandan Tapari are going to be with us with what they want you to do in terms of specific trades. Stay tuned. Okay, welcome back. 9 minutes to go for the market pre-open to kick off. And let's get in Sudarshan Sukhani and Chandan Taparia, who are with us with what they want you to do in terms of specific trades. Gentlemen, great to have both of you here. Sudarshan, let's start with you. It's a flattish start, and in that sense, a neutral, clean start, neither here nor there. What's the path of least resistance, Sudarshan? Higher?
Yeah, good morning. Well, the Nifty is at a very interesting place. It's been moving in a trading range between, let's say, 24,500 and 25,000. Now it's pushing against that 25,000 resistance. If and when it crosses that resistance, we can expect a 400 to 500 point rally in the Nifty. Now, Prashant, it's anybody's guess. I mean, suddenly something can happen. But given the current tendency of the market to move higher, I would expect a breakout on the upside and a reasonable move eventually towards 25,500. With this view, my suggestion is if you are long, stay long, expect some intraday volatility. That is part of the process. You can't avoid it. If you are not long, you should be long if the Nifty is trading above 25,000 for any decent intraday period of time. So be on the long side of the market. A breakout could see very interesting levels on the higher side.
Okay, be on the long side. That's the call that's coming in from Sudarshan. Let's go across to Chandan. Chandan, what about you?
Good morning, Nigel. Thanks for having me. So market setup is positive and the levels are gradually shifting higher. We have noticed that higher base is clearly visible and the put-call ratio is holding well above 1 marks. We have noticed that India VIX has seen surge because the call unwinding started to happen at 25,000 strike and the fresh put writing is being placed at 25,000. Which is giving an early sign that market has potential to hold much higher than 25,000 marks. We are in monthly expiry and expiry on expiry basis, the Nifty index is up by around 3% and volume weightage average for the entire series is at 24,600 and we are 400 points higher than the VWIC, which clearly indicates that bulls are driving and they are having the grip on the market, and because of that, till it holds about 24,850, we are expecting this rally to extend towards 25,200 to 25,400. So suggestion is buy any small decline or play the breakout. Market has potential to rally by 300 to 500 ahead of its monthly expiry led by short covering and the call unwinding and the put writing activities.
Okay, you're both sounding fairly optimistic on prospects of the Nifty. Well, Sudarshan, you go first on the stock calls. What all is on your radar?
Well, again, it's a mix of large caps, small caps, mid caps, but all on the buy side. Nestle is a buying opportunity. I've talked about how FMCG is giving buy signals repeatedly. Stop under 2,400. Hind Unilever, Hindustan Lever is also a buy with a stop under 23.44. Manappuram from the NBFC space looks interesting, worth buying into, a stop under 225. And Torrent Power is a buy with a stop under 1,394. Wait for small dips and go long.
I've got that. Chandan, what about you?
Yeah, so I have two names from Capital Goods, L&T and BHEL, and one from the pharma. So to start with L&T, the stock has given a breakout from its pole and flag pattern on the lower time frame. In fact, holding well, given a consolidation breakout of last 10 trading session, making higher highs, higher lows on the weekly chart, which indicates overall bullish sentiment. We have seen surge in the trading volume as well as the open interest activity, which suggests momentum could continue. So with support of 35.70, we are expecting L&T to head towards 3,800 marks. Talking about BHEL, trend is intact. Breakout is already visible. The stock has managed to hold about 255. Open interest activity are indicating bullish strength. So with support of 256, we are expecting a rally towards 273. Last trading area, that is buy on divi slip. We have seen a major breakout in the counter. It has managed to give a decisive hold above 6,600 marks, and that level could act as an immediate support to drive the next leg of rally. So one can buy divi slip with support of 6,600, and this has potential to rally to our 7,000 plus marks.
All right, got that. Thank you very much, Chandan and Sudarshan. Appreciate both of you coming on with those trading ideas. More soon, a little later. 4 minutes away from the pre-open session. Let's just quickly take a quick commercial break here. We're going to be back with, of course, rates. Vishal Manchand of Systematics Group will also be with us to talk about the pharmaceutical space, Divi's, Aurobindo, and more. Stay tuned.
Welcome back. Well, Amnish Agarwal is still with us. Amnish, we heard the discussion we had with KEC International. Last year was a bit of a softish year, though for this year they're guiding that things will be better. Revenue growth in mid-teens, margins improving by around 50 basis points, and the net working capital days after improving by around 12 days, will improve by another 10 days, which means that, that overall borrowing as well remains under check. What's your view on the stock?
You see, we are constructive. We have an accumulate rating on this name. And the main thing is last year, many of the businesses were not doing well. But I think the growth there is expected to revive. That is one. The second is that in this industry in particular, what is more important is how you manage the working capital. And the improvement in the working capital particularly is positive because free cash generation in some of these TLT companies and some of the other businesses which they are conducting. So that is something which is very important. So I think looking at these two aspects, although the numbers have been, I would say, not that great, but the future is reasonably optimistic.
All right. Amnish, what about Eternal, erstwhile Zomato? What's the view out there? This is a big week actually because there are two rebalances that will take place. FTSE takes place today and we have MSCI that takes place on Friday. The stock is at around 225. I think the rebalance announcement with regard to FTSE was a bit of a shock. That's why the stock ended lower. However, the stock, there is a big DI holding in the company and there are a lot of active mutual funds that hold the stock which are sitting on a lot of cash, which could support the stock going ahead. Your view at around 225 rupees?
See, fundamentally, it is in some sort of I would say, range-bound situation because the industry is going through lots of ups and downs. There is immense competition which has cropped up more on the quick commerce side in the past 2-3 quarters. And looking at the kind of, you can say, players which are now entering this space, expanding, I think there is very limited visibility as far as quick commerce is concerned, at least for the near term. Now, the current softening of the stock price has happened more because of the technical factor, because the foreign holding in the company is now below 50%, so it has gone out of some indices, etc. So I believe that while there could be some, you can say, interest to lap up the stock at the current correction, but at the same time, if you look at say next 2-3 quarters, I think numbers are not going to be anything exciting, at least in the near to medium term. While in the long term, I think we need to be clear that you can say that things could turn out to be better, but at least in the near to medium term, I think the stock should be range bound between say maybe 200, 230, 240 levels.
Got that. By the way, let's just look at BEML if we can. Was a big 16-17% gainer yesterday by close. Let's see where that is starting. About 0.5% higher. A few of these names, right? NetWeb was a big winner, 6-7%. These have all been running up lately. Phenolix Pipe was another one. Actually, a lot of the pipe makers, Astral, Phenolix, etc., they all were higher in trade yesterday. I think Nimesh was talking about that on D Street Chatter yesterday. Shilpa Medicare, and I think we'll talk about Shilpa with our pharma analyst in a bit from now. Gillette reported numbers during the closing last hour. Gillette will come up on your screen. Again, it ended about 8-9% higher. Camlin Fine was a stock which there were I think 2 brokerage notes. We highlighted this yesterday. Camlin Fine 16% higher in terms of where it closed. And IT Decementation. Another one is Cosmo First. Completely bombed out name, but just look at what has happened over the last, I think, 5, 6, 7 trading sessions now. Cosmo First has basically done 10% on trot for the last several sessions. So many names here. Anything strikes a chord, Amnish? Anything you track out of the names I mentioned?
Yeah, you see, BML, which you talked about, is one name which we tracked. And this company actually is sitting on a lot of orders. And the problem last year was that the execution of the orders was not there. Now, if the execution comes into play, and the fact that this year, I think the execution more from the, you can say, armed forces will also be better. I think this is one stock which one, you can say, need to watch out for.
Need to watch out for BEML in that sense. Balkrishna Industries, any thoughts? I mean, was down sharply after numbers. Amnish?
No Prashant.
Okay, no real comment. Anything you like out of the hospital space? Again, I mean, it's a space which has done very well. The latest addition to the entire move higher has been HCG, the cancer specialty hospital. After the financial investor changed hands, I mean, the stock's done very well. Yesterday was down, though, a little bit of profit booking. What's your pick out of the space?
The space has been doing very well. It's more like, you can say, one of the very structural themes which we have been pushing from last couple of years at least. Because here you can see the margins of most of the players are improving. ARPOB is good, and particularly this HCG, because the KKR I think now has acquired stake in the company, and there's a lot of scope to improve the efficiencies over there. So that is one name which might struck chord in the coming times. But if you look at, say, among the existing players, I think Max is a very structural play, good margins, good profitability, lot of capacity which is coming in terms of, say, you can say the bad addition which is happening over there. In addition to it, we are also positive on Aster DM, because Aster is also again undergoing consolidation. Once Quality Care gets subsumed into this will be the third largest player, trades at say 20-25% to some of the other large names. So I think these are the two stocks, and then your Rainbow is also there. So I think the space looks very exciting, and it is only, I would say, where the efficiency comes, the growth comes, and I think all the good stocks eventually, wherever the valuation scopes are there, they can trade anywhere between 30, 23, 25 times EBITDA. And one can continue, you can say, holding some of these names for the, I would say, next 2-3 years, because still there's a lot of room to make money.
Okay. All right, Amnish, got that point. Thank you very much for being with us. Great to get all the perspective from you on those stocks that we've discussed. Well, let's now put the spotlight on the pharma space. And as we do that, I'm just quickly taking stock of the Nifty in the pre-open as well. Pre-open's just started, so let's see. Right now, it's showing a 90-point cut, but it should settle. This is what we have at first glance at this point in time. Some of the stocks where the block action is expected, they're in focus. Agility, for instance, down about 5% in pre-open. The Interglobe and the others will come up as well. Some of the pharma stocks are actually doing very well in the pre-open space. Dr. Reddy's, for instance, about 0.7% higher. Sun Pharma, Cipla. Pharma names are the green space in the market today. So good time to bring in our next guest. Of course, we've had a slew of earnings coming in as well. Aurobindo reported, Sun Pharma came out just a few weeks back. Divi's has signed a pact for a supply of long-term agreement with the global pharma company. So talk about all these developments. Vishal Manchanda, who analyzes this sector at Systematics Group, is with us. Vishal, thanks very much for joining in. Let me start with the broad question first. So the earnings season has been very mixed. I remember Sun Pharma fell quite a bit the day the numbers came, and then it recovered because the US performance was subpar. And the global specialty business also, I think numbers were missing expectations in the fourth quarter, but the commentary seemed to be better. You tell us, what are the key hits for you at the end of Q4?
I think broadly, if I look at the sector, we haven't seen a very large outperformance across companies. Broadly, I think, so what's not gone right for the sector is probably the US piece has not shaped up the way we would have expected during the quarter. India was expected to grow between 8 to 12%. And I think now a significant majority of the companies are on the lower end of the growth range rather than the upper end of the growth range. So I think a very few companies are able to deliver double-digit growth in Indian pharma space. So I think there's a slowdown here in the IPM category. US probably is a bit slow because Revlimid didn't shape up the way we were expecting for the quarter. It's because there is some pricing pressure that's happened on the product. And we know that it's a large contributor to earnings. So overall, I think it's more of the pharma space hasn't done well as per expectations.
Got your point. I'm just going through some of the calls that you have, Vishal. You still have a buy on Sun Pharma, and then you have a hold on lots of stocks in Indoco, Zydus Life. I think Mankind is also a hold. Let's talk about the big blue chip pharma names first. You like Sun Pharma? Do you like anything else? What would you advise? What's a buy? Looking at the next 12 months at least.
So I think I would look at Sun and Cipla as structural stories in the sector, while Sun being a better, Sun being kind of longer term, there is more visibility around Sun in terms of the medium to long term growth. And that's largely because of the specialty platform that they've been able to build and kind of differentiate themselves from the other pharma companies in the large cap space. Cipla, probably I prefer Cipla because of the lower US dependence. So they have only 30% of sales coming from the US generics. And we also see a pipeline visibility that's there. So the US earnings probably can still grow from where they are. While for the sector, I think the earnings contribution from the US is on a high base, and probably we'll probably be seeing the earnings from US being either low single digit growth or low single digit decline. And I think I would rather look at a low single digit decline. That's where I am on the.
Got it. Vishal, let's talk about a few other individual names, right? Shilpa Medicare, big run up lately. Off the lows, there was news flow end of last week. How do you assess prospects for this one and valuations as well?
So I think Shilpa is one company. We'll have to kind of, there are so many triggers out there, so many triggers in the form of product launches. And all of these product launches are differentiated. Probably they're the only ones for those products on the market. They are also building a very strong CDMO platform. They have relationship with large innovator companies. They'll soon be initiating commercial supplies for a breakthrough oncology API. I think there are 7 or 8 triggers on the product side, basically, that can kind of transform their earnings and EBITDA trajectory over the next 2-3 years. And I think the longer term growth trigger for Shilpa Medicare is their albumin initiative. So they're developing a recombinant version of albumin, which should shape their growth from FY28 and probably long term growth for the company. Only thing is, execution is something we'll have to wait and watch in the next 2 years, whether commercial execution happens the way we would want it to.
Okay. Another very small company, I don't know if you track it, is Panacea Biotech on the vaccine side.
Right.
Anything happening there? Because there's that hexavalent vaccine, right, which they developed, 6-in-1.
Yes.
And I think Serum was making that vaccine for them, and I think, I don't know if there's been any cutback, because Yuan, etc., were big buyers of that. At least there was stock of millions of doses which will be required. Anything latest here in that sense?
Yeah. I haven't come across any major development, except that they are also doing a dengue vaccine, and we should see data maybe in the next 1 or 2 years on the dengue vaccine. I think if that clicks, that can be a game changer for Panacea Biotech. And as a company, I think they keep looking at niche opportunities, and I think they have capabilities. They have done things in the past which not many companies have been able to do.
In the small cap, 30-second answer, Vishal, in the small cap pharma space, what are your picks?
So like Orchid Pharma there.
Okay, Orchid. Got that. So next one, we'll focus our conversation on Orchid, Vishal. Thank you very much for joining us. Good speaking with you, and it's a pleasure having you here on CNBC-TV18. 9:10, 9:12 actually, so a little behind schedule. So let's get the calls out of the way. Sudarshan, what do you have?
Well, it's Manappuram. Consider buying Manappuram with a stop under 225.
Okay, Manappuram with a stop under 225, 230 at the end of the pre-open session, 9:12. Let's get the standout brokerage notes out of the way as well. Nimesh has been pouring through them. Nimesh, what do you have?
Hi, Prashant. So today's standout is on Varun Beverages. Interestingly, the stock has been under pressure of late on back of selling pressure and a bit of competition as well. But Goldman has put out a note. They have initiated coverage in the stock with a buy rating and a target price of 600. They believe that Varun Beverages, has multiple drivers for the stock to outperform from here on. In fact, they see a big market share gain as well in few fast segments like energy drink and hydration. The key concern for a lot of investors was the competition from Campa-Cola, but Goldman believes that their analysis suggests no big disruptive impact on Varun Beverages. In fact, they see a big opportunity in the international market where the South Africa business can turn around over the next 3-4 years, and the profitability is likely to go up according to the Goldman note. In fact, they expect the EBITDA margins to improve from 10% to 17% in the international business. The stock trades at 40 times, which is below the median, and hence initiating buy on Varun Beverages with a target price of 600 from Goldman Sachs.
Okay, Varun Beverages definitely on the radar. I'm just checking how it's doing as of now in the pre-open, about 2% higher. By the way, KEC is up about 3.5% as well after that management commentary, where it is sounding far more optimistic on FY26. But Nimesh, I'm looking at all these stocks, the blocks that you alerted us on. Okay. Anyway, just to talk about them, Sagility 5% lower, PG Electroplast 1.5% lower. At this point in time, and Interglobe is about 3% lower as well. These are the three big blocks that we're watching on for today.
Absolutely, and the look at the indices as well, right? I mean, I think we are starting slightly lower in terms of the open, 45 odd points lower on the Nifty. Yeah, I mean, the blocks, of course, right there at the top of the list, really. Aurobindo is, I think, slightly lower as well. KEC, you heard the guidance from the management earlier. By the way, KEC was one of the big winners yesterday. So it's up 3% again this morning, about $30 on it. There is Brainbee Solution, Blue Dart, some of the fourth quarter earnings, right? Schneider Electric is another one. And they'll come up on your screen as well. 1% down on this one. Blue Dart will come up. And then Schneider perhaps as well. Electra Green Tech is another smaller one. Maharashtra government has cancelled e-bus tender, and Hormuz was telling us about that. So all that in terms of specific stocks coming up, but we'll look at the indices as we begin this session right now. So 24,966 is where the Nifty is at, 0.14% lower. The Nifty Bank is down about 0.19. So it's mildly lower. Small cap index is up 0.1, and the mid cap index will come up on your screens. That is unchanged, almost unchanged. 57,040 on the Nifty small cap index is what you have. Just take a look at the Nifty heat map as it should come up on your screen next to give you a quick sense of where we are starting. So it should be pretty mixed. Actually, 4 or 5 names are higher and everything else is starting in the red. But I don't think there's any large move in any case. Eternal is down at one end of the spectrum. It was, of course, down 4-5% yesterday as well. By far the biggest loser of the Nifty. Surabhi.
Now, the KC is the one that's really flying away, up 5.5%. Remember, they're talking about margins also going up to almost 8.5% this year with a 15% top-line growth. That's on the mid-cap newsmaker side, but on the overall large-cap screen, it's a little bit of pharma. Dr. Reddy is actually not too much also. The Shriram Finance, which is on the upside. Market slipping, by the way. The market suddenly down 90 points. So it's getting a little volatile. The bias is negative. What's pulling it down? Let's take a look at it. Tech is definitely pulling things lower. Infosys, TCS, these are the stocks on the lower side. There's HDFC Bank, Reliance, Axis Bank, lots of the heavyweights lower. ITC is lower. 100 points down. Mid-cap index slightly negative. Bank Nifty is slightly lower as well. So it's turning out to be a bit of a weak start now. HDFC Bank also on the lower side. The thing is that there are no big counterweights on the upside. It's a bit of a full sell down. BEL, IndusInd Bank, Hindalco. That's it. Pharma is not really able to firefight. So for the time being, there's profit taking. I guess, Nigel, that's what one would also expect. Markets rallied. We touched that 25,000 psychological level yesterday. This morning on the large cap screen, some profit being taken.
Well, that's right. But the broader markets, actually, there are plenty of winners. Let's pull up a few actually up for you in the screen. Cosmo first continues its good run. The street suspects there's going to be a shortage because one of the competitors had a fire at their unit. But the way the stock is moving, I don't know whether it's warranted to that extent. For this month, the stock is up close to 80%. That's Cosmo first. Big up move is what we're seeing on that one. Electra Green Tech, because of that ordered cancellation, we have that stock that's down close to around 6%. BSE has come in for some mild profit taking. We're waiting to hear about the final verdict with regard to who gets which expiry day. But for the time being, the stock is down close to under 1%. Bajaj Healthcare from the broader markets, it's come in for some big profit taking. Came out with a set of numbers. The street has read it. That is a bit of a disappointing set of numbers. But that's down close to around 5%. That's one of the top losers. On the flip side, you have a few stocks that are gaining. Venus Remedies, the stock is up 10%. Bayer Crop, that stock as well is higher in trade today. It's up close to around 7%. So big move out there. Akums Drugs, that's the other one that in fact is sitting with solid gains in today's trading session. So big up move is what we're seeing even on that particular name. Akums Drugs now up close to around 5% as we speak. And I think KEC, the one that we spoke about earlier, that one is up close to around 4.5%. DAM Capital as well, by the way, the stock after hitting a low, I think, of around 210 rupees, it's bounced back 30% in this month. It's up close to around 3.5%, one of the top winners. Yes,
sorry, I missed whether you mentioned GE Vernova.
No.
Look at that stock, 9% again today after a 10% circuit yesterday. Ooh. That's a big move post numbers.
I mean, rockets all across, right? And lots and lots of big gains. So 22.55 on that one coming through. By the way, defense, I'm seeing some shade of defense names all coming back together. BEML is up 3, Garden Reach is up 3, Bharat Defense is up 3. I think Apollo Micro is up 3.5%. Yeah, I think there is a shade of defense which is doing well. And this is, by the way, all within the top 10 volume-led gains, which is coming through at this point in time. Nigel mentioned Cosmo first. I've been looking at this last few days. Bombed out name, and so many people I know who've held on to that name and sort of sold in frustration. And suddenly, I think there's some shortage of BOPET. Because of a fire at a competitor, I think that's essentially what the chatter is about. We'll try and actually reach out to the management, because this is, from 550 to 1100, very, very quickly, in basically 6 or 7 trading sessions. It's just been, one way in that sense. Acom's drug is up about 4% or so, 606. And I think we mentioned Bayer, which is up about 10% or so as well. By the way, market breadth is, evenly kind of spread out, equal number of gainers and losers as well. More names in a bit from now. Well, let's talk about markets in some more detail. Sridhar Sivaram is Investment Director at Enam Holdings, and he's with us here in our studios. Sridhar, great to have you with us here. Thank you very much. It's been a while. So good to speak with you. Where do you and your team stand, Sridhar, now with the markets come up so fast, vigorously and furiously?
So our broad view is that this is a year where we're going to see these ups and downs. It's going to be more a sideways. It could be range bound. So when the markets go up, you'll feel like you've missed out, and then you'll get an opportunity when markets come off. And there'll be so many news flows that we are going to get. We already got so much, and we are going to get so much more. And I think more globally than domestically. So if you ask me, you have to look at bond yields in the US, in Japan. I mean, when were we talking about bond yields in equity markets? But that's the reality, that you have to watch them very carefully. They can have a massive impact on global equity markets. So I would say that global macro is looking a bit more questionable. Surprisingly, Indian macro is looking very good.
Very, very good. And it's happening also fast, right? By the time you get ready to do something in one direction, it's done. I mean, and then you're looking. So it's better at the top end now, Sridhar, you think? This range that you're talking about, up and down.
But it's very difficult, Prashant, to say what is the top end, what is the bottom end. It's better to look at stocks that you like and figure out a price which is you're more comfortable with. At least for us, it's easier that way because we don't have a benchmark, we don't have a competition. So it's easier for me to say all this. I'm sure it's not the same for others. Where if you're getting so much cash into your fund, you don't have a choice but to,
So when you were talking about a range, you were talking about indices.
Yeah, in the index. But then index is composition of where the stock prices are, right? Correct. So so you'd look at the index and you feel there's a range. I mean, there's only that much the market can go up. If earnings don't support, plus you need global macro to support. You can't have that India goes one way and the rest of the world doesn't support.
So let me ask the same question slightly differently. It started to get a drift. Simple question is, minus the flows, whether local or global, X of the flows, do you get the sense when you hear corporate commentary, when you look at the earnings profile, when you look at on-ground visibility, do you get the sense that this market at a broad level has a lot more steam to go higher? No.
Simple answer.
Simple answer is no.
Yeah.
So, okay, let's drill down a little deeper then. So, for a market like this, which is not going to have this overall gush of, momentum, how should one approach it? Which are the pockets to look at? What should investors be doing over the next 12 months?
I'll tell you what is good for the market, how I see the market in the, say, next 9 months, 12 months. So, we are entering a phase, I would say a golden phase of inflation. I mean, next 9 months, we could see average of 2.5–3% inflation.
In India?
In India, I'm saying.
Whoa.
RBI is going to significantly bring down the inflation forecast when they announce their policy on June 5th. When they announce, obviously, there'll be more credibility, but we are entering a phase. So what will happen is we could see a 50 basis points rate cut in June itself. I mean, these are, my and our predictions. We could go wrong, but based on the numbers that we are seeing, this is how we are seeing. We need support globally. If Fed doesn't cut interest rates, there's only that much that India can cut. if we get support globally, we could see 100 basis points of rate cut, which basically means that we are currently seeing a slowdown in consumption. We're seeing a slowdown in credit growth. All of that could change because with the lower interest rates, imagine if mortgage rates were to come back to the heydays of 7.5%, demand for real estate can go up. So I think a lot of things will fall into place. So currently we have an issue where demand for credit is poor, consumption is poor. But if these numbers were to play out over the next 9 months, and we'll know a lot by June 5th when RBI will also come out and give their numbers.
You think it's warranted? I mean that's a really very clear call that you're taking. 50 basis points in June, maybe 100 basis points over the course of the next 12 months. You think those kind of rate cuts are warranted, and you're expecting them?
I think it is warranted because our growth is slow, and we are not going to get these type of inflation numbers. I mean, the last time we saw such inflation numbers was, I think, in 2018-19. We could see some months inflation below 2%. So we are actually entering a phase which is very good for us.
Golden phase.
Yeah, I mean, if the RBI, and we have a governor now who's pro-business, also pro-liquidity, because that was the other concern. So if you see, some experts believe that the 25 basis points rate cut has already happened because that's where the call rates are. They are below the repo rates. So we could see very, proactive measures from the Reserve Bank, backed by very solid data. So if the inflation is below 3%, there's no reason for you not to cut rates. The question is, what is the differential that you're comfortable between our 10-year and the US 10-year? We're already at the lowest that we've seen in the last 15 years. So I think that's the challenge. So if you ask me, as I said, the global macro is looking challenging. Indian macro is looking extremely good. We could be in a golden phase, at least for the next 9 months in terms of inflation, which is what people look at. I mean, and inflation directly affects stock markets. If this plays out well, then what I'm saying that in the next 6 months or 9 months could be a consolidation phase, which can then build into the next bull market. I mean, earnings have to follow through. So you take baby steps right now and build your portfolio for what comes in the next 9 months.
All right. What about the breadth of the market? You know, the small cap in universe had gone bonkers actually earlier, stocks flying around, and then it cooled off. However, we have seen a lot of the small caps, broader market stocks may not be best in quality, but they have bounced back. How much of that froth that was there in the market, how much of that has cleared out? Or do you believe there's still a lot in the market that needs to clear out?
No, I think a lot has cleared out. I mean, the frenzy that we had seen sometime, late last year, a lot of that has cleared out. Obviously, there'll be some pockets here and there which will still have some froth, but I think a large part is cleared out. If earnings follow through, I mean, for small caps, you need strong earnings. You don't pay 30, 40 multiple if they don't have, similar earnings growth.
Yeah.
And if earnings don't catch up, then they will correct on their own. Plus, the liquidity has been very strong for them. I think eventually everything boils down to earnings.
All
So
right.
if your strong earnings and the visibility is good, they can sustain. And we've seen, many darlings of the market collapse because of poor earnings.
Okay.
So I think that's how I would put it. It's becoming a very stock-specific, bottom-up market. If you ask me sectors, I'll really struggle because you can't really find sector winners right now, but you will find a lot of stock-specific opportunities.
All right. What are we talking about darling? The darling has been gold, right? And we have to talk about that. What's the probability we see a big pullback on gold from here on? And
Yeah.
I know what you're going to say with regard to you need to buy gold at every level in a staggered manner.
No, so actually, first I want to clarify some of the myths on gold, because I've seen, a lot of people are talking about gold that, now 20-year, 15-year gold is matching the Sensex returns. And the general, commentary I heard here is that it's because of the last 2 years that the gold is matching it. People forget, because there's a recency bias, that the best period for gold was 2004 to 2011. There was a 7-year period when gold gave a CAGR of 25%, when Sensex gave a CAGR during the same period for 12%. So that was the best period of gold. Then gold has had continuous returns, small, but it has continued. And then we had last 2 years, which have been very good. I think the same will happen, that when you get strong returns in gold for a few years, you'll see some moderation in returns. We've had a 50% jump if you take the last 1 year. Can't have 50% returns in gold every year. So it'll moderate for a while, but I'm still very bullish on gold, only because of the fact that if central banks across the world are having a very loose monetary policy, QE in some form or the others continuing, we'll see that reflection in either Bitcoin or gold. I don't understand Bitcoin, so I prefer gold.
I take your advice very seriously. As a percentage of your portfolio, how much would you recommend?
10% is my view. Different people will have different views.
I think Nigel is more. Huh?
I've been following, yes, Sridhar. I mean, for the last few years, my daughter's 4.5, 5. So every year, a little bit, and I always say, thank you, sir.
Sridhar, come back to stocks. And,
sure.
And what's the... Give us some...
Yeah, so you mentioned one of the stocks today which was hitting upper circuits. We are very bullish on the power equipment space. So if you see, it's a global theme actually. So if you see, India will possibly double its solar and possibly double its wind. We may add 60, 70 gigawatts of even thermal. When you get so much of power which comes into the system, it has to be evacuated. So I think the entire value chain will play out. Some of the stocks are very expensive, so you have to play out, you have to figure out which one you prefer. But you get a lot of opportunities. In bad markets, you get some of these stocks.
We had one opportunity. I was just looking at Hitachi,
Yes.
for example.
Yeah, you had...
I think from 16,000 went down to 9,000.
You look at the entire power equipment space, they collapsed sometime in March.
Correct.
You could have bought any of them 30-40% below where it is today. So I think it's as I said in the beginning, that you have to figure out what is the best price you want to buy certain stocks. And this year you will get multiple opportunities. That's how I look at it.
So okay, power is one. Let's dive a little deeper, because I am very keen on, as you said, build the base for the next phase. So what else?
So
Where else should
others
positions be
is
built?
financialization of savings.
Okay.
So if you think our markets will give 15% CAGR returns, say over a longer period, obviously it's cyclical, you cannot predict on a year-to-year basis. And you think that at least 10% volume growth, then the mutual funds and the wealth advisors, if you plot them ahead, say if you look at them for today's earnings, it will look expensive. But if you plot, say, 5 years ahead, then it starts to look interesting, that they can compound, say, over at least 20% on a 5-year basis. Obviously, there will be cyclical years where you don't get earnings. So financialization of savings obviously is a theme that looks interesting.
On that, so that's the more capital market related plays. But
exactly.
So, but on finance, and you mentioned that with the RBI cuts, credit growth should revive. Yeah. I hear a big debate in the market now, Sridhar, between whether the best is over for the larger banks. They simply can't grow at that pace. Don't expect HDFC Bank to keep doing what it did over the past decade. Do you agree with that, A? And if yes, then what are the alternatives? Where else? I mean, what are the kind of lenders should one be investing in?
Yeah, so I think I broadly agree. And the other thing is that unlike past periods when we had rate cuts, now it is different because at least 30 to 40% of the loans are linked to MCLR. So as soon as there is a rate cut, your NIMs immediately take a hit. Whereas in the past, it wasn't as much. So the hit on the NIM was far lesser. So if RBI was to play according to what I'm saying, then we could see NIM impact in the next 2 quarters. In fact, most banks that I've met in the last few days have sort of indicated, even without this assumption of a 50 basis points, then at least 25 is anyway going to come, that you will have NIM impact in the next 2 quarters. But I think the market is broadly prepared for that because if you get volume growth and if your credit quality starts to improve, because we've seen a cycle of poor credit quality in the last 6 months, and if that were to improve, especially with the large cap banks, you could see, mid-teens earnings growth. But I would agree that's what you can expect from large banks. I mean, if your book size or your loan book size is 20 lakh, 30 lakh crores, there's only that much you can grow when the macro is not supporting. But if the credit growth were to come back, then a lot of things will fall into place.
Sridhar, you want to leave us with one name? With full disclosure.
Like, give us 2.
Maza to tabhi aayega.
No names at all. I mean,
Well
not
tried,
in my
tried.
last 30 years I've given out a name, so I don't think that changes.
Because I mean, you guys are there is so many niche opportunities. Right? We talk about the bigger sectors, but the meat is in the smaller
hidden gems, as
niche
they're
areas,
called.
right?
Prashant, all that glitters is gold. Prashant is saying 10%, no, 25% of his portfolio.
Gold is a easy one.
Gold has beaten Sensex for 20 years. See, Nigel has listened to what I was saying. So what does you're not expecting more than 15% returns, right? On a CAGR basis.
Yeah, absolutely.
Gold has
Be very
given you a
Why
name.
bother so much? Itna dimag lagane ka kyun? That's the sense.
Don't go with
Should be your husband's message that later this evening you will be gifted some fuel. All right. Thanks a lot, Sridhar, for joining in and giving us all of those details. Well, time to move on then, and let's welcome our next management on the show, Jyoti CNC. That's the next management. It showed actually a good set of numbers in the past year. The past year on the whole as well, the growth has been good, but the pleasant surprise came on the margin parameter. Let's welcome Mr. Jadeja, the Chairman and Managing Director at Jyoti CNC. Hi, Mr. Jadeja. Good morning. Thanks a lot for joining in. Well, a super year, right? When you grow by 35% or thereabouts, some would argue they were expecting a 40 to 50% growth. Keep that aside. FY26, what kind of a revenue growth are you looking at? And this margin number, you were telling us 25 to 27% is the aspiration. You did 30% in Q4. Sustainable?
Good morning and thank you very much. Yes, it was a wonderful year, and this year also we are maintaining the same momentum on FY26. We'll be on a range bound on a similar margin and the growth trajectory there.
Okay, growth. So growth in this vicinity of around 35-40%, and margins?
So growth is now based on our execution capabilities, and basically the way we have a robust order book are there, the way we will, let's say, improve our efficiency will grow furthermore, and margin we will be on a similar range in between 25 to 27.
All right, so you're being conservative, and just to clear the doubt, on growth it will be 35%, right? Or more than that?
I say that now today we have a capacity is going to be constrained, and new capacities are add-on. There are upper sides are possible if the capacity comes early into use of that.
Okay, all right. I got that. Mr. Jadeja, good morning. Prashant here. Now, the growth in revenues is not flowing into cash flows. Cash generated from operations are negative at 16 and a half odd crores. Could you tell us why is that, and when do you become cash flow positive?
Basically, now we are just growing on a larger machines trajectory on aerospace and defense, and all the now pipelines and everything will be pulled. So I think this will be turnaround, and we are looking in FY26 to be very positive cash flow over there.
Positive cash flow.
Can you give some more sense on that, Mr. Jadeja? By when does this cash flow turn positive? Which quarter? And also, just a sense on the top line growth itself. I mean, to what extent do you augment your capacity? Because I think a lot of analysts are pointing out that capacity constraints were one of the reasons behind growth perhaps being a little lower than what your potential is. So just a number on the capacity addition, and by when do you turn cash flow positive?
Yeah. So first of all, about the capacity, let's say we have just in the last third quarter, our capacity has reached to a 6,000 machine. And it means close to 1,500 machines in a quarter, and we have closed this in the last quarter is close to 90% of that. But in the total, let's say we have built it 4,100 close to the machine, so we can grow by 35 to 40%, not beyond that. We have another let's say capacity expansion is going on from 6,000 machines to 16,000 machines. That will be ready in the next June over here.
Next June. All right.
Cash flow positive, we are looking to be in the third quarter, it will be completely cash flow.
Okay, 35 to 40% top line growth this year and cash flow positive by Q3, right? Got that.
All right, one more matrix, sir, that we track, I think, is the throughput per machine. I think you had indicated that that was gradually moving up as well. If I have the numbers correctly, it was at around 27 lakh and it had moved to around 30 lakh. What is the last updated number, and where is this number headed?
So this year we have closed up to 44.5 lakhs.
40?
44.5.
45.5. And this trajectory will keep improving because a couple of years ago it was less than 30 lakhs. Now you're telling us it is at around 44.5 lakhs. Will it continue to move up?
So it will be in a range of 40 to 50.
40 to 50 lakhs. All right.
It will be in a 40 to 50.
40, 50. All right. You know, you've mentioned in the past, EMS and semiconductor, that's a big opportunity out there. If I got it correctly, it's still mid-single digits as a percentage of the mix. But I had asked you the last time as well, was there an inquiry from Apple with regard to a big order? Any progress on that front, or have you got that order?
Basically, it's purely a confidential parameter. I have last time also I told you that I'm not.
But you can give us some color, sir, some hint. You know, you could. I mean, since you're so bullish about the space as well.
So we are doing very well over there, and entire not only the one company. We are in electronic manufacturing. We have great opportunities, and particularly in right now this tariff situation, a lot of manufacturing is shifting over here. And the inquiry level is also been increased very much over there.
So EMS as a percentage of the mix, what can it go to? And the big customer that we're talking about, will it get closed out in this year?
So we will see in a double digit in this year.
Double digit EMS. That means you know, that big customer will be part of the order book at least.
Already they are all let's say
already part of it.
It's a part of that, but we are going to be in the execution side also. We'll look more than 10% over there.
This is a Mr. Jadeja. This is a mobile phone company.
Let's say this is very variety of component manufacturing being done on our machine.
I see. Right. No. So this is in EMS. You've got. Just to get that, just to finish that point off, you've got one big client there, or you got several for now.
We have many clients out there.
Okay, okay, all right. We'll maybe talk. We'll talk more about this when you want to. Could you give us a sense of where else you're seeing opportunities? Which other end user industries there is buoyancy as far as demand is concerned?
Right now, in entire manufacturing sector, let's say today we are seeing more in a general engineering, and particularly even for EV manufacture components and everything also has been increased. Largely, we are seeing still to be aerospace and defense. And seeing in a geopolitical situation there, even the Europe also, entire Europe is investing after 40 years, and our bases are there in Europe. So we are looking to be a more let's say end user industries are aerospace, defense, and general engineering there.
Okay. You have manufacturing in Europe.
We have a base in France. We have our subsidiary company Huron. It's a base in France there.
Okay. And actually, have you heard more inquiries from European companies? For
already started. All the inquiries have been started. Germany is investing. France is investing. Italy and all European countries are investing there in a defense.
You know, the general sense is most of this demand for defense for Europe will be met by US companies, US defense contractors. Is that assumption correct, or you think Asia, India, where local defense manufacturing is also being given a lot of push, will benefit as well? It's a broader question.
Yeah, right now it's all areas are pushing towards to that. Let's say India also is like that. China also has been like that, and Europe and US is always to be there. But now Europe is getting more and more into these areas.
Okay. All right. So on the working capital days, we had discussed this the last time as well. That was stretched. I think it was 330 days. But you had said that gradually you're going to be bringing this down. What was in the last year, what did it come down to? And I think ultimately you were talking about 170 days. By when?
So this year we have, let's say in March 25, we have reached to 180 days. So it's what we were discussing 1 year back to be 330 to 230. And this year we have closed it 180 days there now.
180 days, and there's scope for improvement?
So we are looking to be around 160 to 170 in this year.
Okay, all right. You also mentioned on Huron, that the new facility will be coming I think, getting commissioned in the coming month, if I'm not mistaken, and that adds a good amount of revenue potential. So what kind of revenues did that do in the last year? What kind of revenue will it do in this year?
So basically, there we did close to 27 to 28 million euro, and the facility is going to be ready in this end of this quarter, and works will start. So we will see in the next 3 to 4 quarters, we will have a more jump we are able to see into France there. The total capacity we have now reached up to 80 million, and we will augment this capacity utilization will reach within 2 to 3 years to reach the full capacity utilization.
Okay, I think Huran did last year, I think around 250 crores of revenues with around 8 crores of PAT. For this year, in rupees, what will it go deliver?
So we are looking to be, let's say this, the facility will come to us in a June, July to be put to use that. So we are there also, we are looking to be around 35 to in between 50% of a growth rate over.
35 to 50%. All right. So you'll be approximately at around 350 crores plus from this facility. Right? Ballpark correct?
You are nearby.
Okay. All right. Final question before we let you go. EMS, ultimately, since there's such a big potential, I think the last year it was a little bit muted. This year you're telling us it'll go to double digits, but ultimately the plan is to get it to 20-25% of the mix, right?
I says 10% plus.
10% for this year, but ultimately the
More
plan...
than 10. It says more than 10. Let's say based on that, all the companies are also coming over here and making their own infrastructures. Once their infrastructure ready, our returns will come there to put the machines on. So you will see in the next year and all will be a very quick on that.
All right, Mr. Jadeja, we will leave it on that note. Thank you very much for joining in. That's Jyoti CNC with the projections for this year. Stocks holding up. That's not what you can say for the large part of the market. We need to pay attention to what's been going on because now this is a deeper slide. The index is down almost 0.7%. That's almost now nearing a 200-point drop. By the way, the color across most Asian markets has also changed. The markets that were positive, Hong Kong was the one market that was positive. That's also lower. So suddenly, it's just a overall, mood is on the sell side. The bank Nifty is leading the declines with a cut of about 0.7% right now. But it's not just the bank Nifty. I mean, it's a wide sell-off. So Reliance, Infosys, L&T, plus the big banks, everything is down. It's that kind of a morning. Let's see if the buyers come in. But right now, it's a decline pretty much all across.
So we Trump tweets, 50%. No, it's not going to be 50%. It's going to be 30%. Then let's do 50. So it's like step forward, two back, and kind of sort of that kind of a thing. But generally, broadly, of course, I mean the rate of travel has been, the direction of travel has been up.
Forward.
Slow sometimes, faster sometimes, and has been very, very fast over the last 4-5 weeks. So you got a bit of a cut now. So 24,800 on the Nifty. We'll take a quick commercial break here. Macros in focus. Sakshi Gupta of HDFC Bank and Upasana Bharadwaj of Kotak Bank will be with us to talk about the macros and RBI's recent dividend bonanza for the government of India. Stay tuned.
Welcome back. Continuing to track the market, which is now looking at a cut of about 1%, but its macros in focus now. Two separate issues to tackle here. One is, of course, the RBI dividend, which came through last week, and it's a large dividend payout once again, 2.69 lakh crore rupees. That's how much the Reserve Bank of India will be transferring to the government for the fiscal year. Now, this is about 27% higher than what the RBI had transferred to the government in FY24. Not just that, remember that next week, is the monetary policy. The MPC meeting happens and the announcement is all set for, I think, the 6th of June, which is next Friday, basically. So let's talk about all the macro developments now. Sakshi Gupta, VP and Senior Economist at HDFC Bank, as well as Upasana Bharadwaj, Chief Economist at Kotak Mahindra Bank, are with us. Ladies, great to have you. Thanks very much for joining in. So let's tackle the dividend piece first. Upasana, so, you know, what do your numbers say? The fact that the dividend is higher than last year, it's not as high as what the street was estimating. Estimates were floating of around 3 lakh crores, 3.5 lakh crores. But given what it is, what is the kind of fiscal headroom it opens up for the government, and where do you think the money could be spent?
So here we need to keep into account two things. One, in the beginning of the year, we had also highlighted then that the direct tax collections seem a little optimistic in terms of growth because the income tax cuts were announced. And despite that, the income tax growth was estimated to be around 14.4% on a Y-on-Y basis. So we were already looking at a possible shortfall there. At the same time, the corporate tax collections too look on the higher side, which are budgeted. So we do see almost close to 1 lakh crore worth of shortfall on the direct taxes. Now, to counter that, this 60,000 crore approximately, which is the higher than budgeted number on the dividend, is a good cushion that has come about for the government. At the same time, the excise duty hikes that happened some time ago, that too will be providing some cushion to offset the direct tax shortfall. So I think right now there is no extra headroom which is created. It is actually balancing the risks which were being generated on the fiscal side, especially in a relatively slowing economy. Where the tax shortfall could have increased much more.
Got that.
Yeah.
Okay, let me just ask Upasana if she broadly concurs with this. Upasana, your thoughts? Sakshi, your thought, what Upasana is indicating is that this basically just provides a cushion to counter the direct tax shortfall.
Yeah, I, kind of agree with that view. With this higher dividend announced, I wouldn't, be tempted to change my fiscal deficit, forecast for the year. I think the broad, issue is that the budget had kind of assumed a 10% nominal GDP growth. But, with how inflation has been moving and the fact that real GDP growth is also, kind of expected to be lower this year, nominal GDP growth could come in, between 9.5%, which does present this downside risk to, the tax collection, growth that was assumed in the budget, what Upasana kind of referred to. So at this stage, I think given this, I wouldn't necessarily expect, a huge increase in spending because of this dividend transfer, or, alternatively assume that the fiscal deficit could be lower than what the target currently is.
Okay, so, before we talk about policy, which is all set for next week, just wanted to get your sense. There was a lot of buzz out there, or I think just general anticipation that because of what's been happening at the border, the defense budget could be perhaps increased, or maybe additional borrowing to shore up the whole replenishment demand. Very quick thoughts, ladies, from both of you on this front. So from what you're saying, the RBI cushion clearly cannot be used. It's not sufficient to increase defense spending in any way. But would you expect any other arithmetic or permutation and combination around this at all? Just quick thoughts on defense, and then we'll move on to the policy. Upasana?
Definitely there's talk about this, and there is a high probability that happens. Now, the question is, if it doesn't really happen through the course of the full year, then maybe the necessity of increase will not be as much. Basically, it will spill over into the next year's requirement as well. So we will see higher spending even into the next year. That is one. Secondly, there could be prioritization of spending. So it's not necessary yet that all spending is done across all segments. We might see reprioritization, and some defense spending increase could be offset by cuts in some other segments. So it's not yet a given. We are just in the beginning of the year, and I don't see too much of a risk of a fiscal slippage here at this point in time. Defense spending could increase, but it could come at the cost of some other reduced spending on other categories.
Okay. All right. And, your thoughts, Sakshi? Same question. Do you expect, first of all, slightly higher allocation to defense? And if yes, then where will the money come from?
I mean, it is a possibility that there could be an increase in spending on defense, and not just for FY26, but maybe this is the start of a shift in how much we are allocating to, defense capital expenditure, particularly over the medium term. Right? For this year's fiscal math, I think it is too early to kind of discern whether this would mean any fiscal slippage. Because as I highlighted earlier, there are just too many moving parts at this stage. I mean, we'll have to also see how GST collections, for instance, pan out. Are they higher than what the government had estimated? Because that's one space in the whole tax, basket, which has shown continuous, momentum. So, I mean, I think at this stage, I wouldn't necessarily take this as a threat to the fiscal deficit target. I think we'll have to just wait and watch for how things progress over the coming months.
Okay, so now let's talk about policy, which is all set for next week. Just before you joined us, we actually had a market expert talking about how he feels this is a golden age, perhaps for inflation in India, because the numbers have been trending lower. And some of the estimates are saying maybe in June itself, I mean, we could see, he was saying he expects 50 basis points. But your thoughts on what next from the RBI in terms of whether any additional liquidity measures, rate cuts? Sakshi?
So, my expectation is that the RBI is going to cut the policy rate, but it's going to be by 25 basis points. I do not expect a 50 basis point cut. I don't think that there is a need for the RBI to be that aggressive in this policy. I think it is true that inflation has been trending down, but at the same time, I think at least for the next 2 or 3 months, we'll have to very cautiously look at the monsoon progress and what is happening in terms of the distribution of rainfall, because that can be very precarious and you can get spikes or volatility on vegetables, etc. So I think the RBI perhaps will be a little, will kind of pace out its rate cuts. On liquidity, I do not expect them to come out with any new announcements. I think the RBI has already been very active in terms of supplying liquidity to the banking system. And I think that is something that they will kind of continue doing. I would estimate system liquidity to remain comfortably in surplus over the coming months.
Okay. All right. So 25 basis points and nothing new on liquidity, considering it seems to be fairly ample at this point. That's the view from HDFC Bank. Upasana, final thoughts. RBI next week, what are you expecting?
I would broadly agree. We're looking at 25 basis of a rate cut. Just to note that the dividend has increased the core durable liquidity and it's expected to continue to keep the core liquidity closer to 5 to 6 lakh crore. Now, that, of course, takes time to filter back once government starts spending aggressively back into the system. But having said that, at this point in time, we overall look at the banking system liquidity also more or less anchoring around 1% of NDTL on a surplus side. Now, which also means that there's no need really for RBI to do anything on the liquidity front. At this point, we expect 25 basis of rate cut. Probably monsoons will be important. So while for the Kharif crops, everything looks good because of early monsoon arrival. But of course, there will be some kind of disruption happening for the standing crops. So we will have to be watchful on that front. But having said that, I think overall, the trajectory for inflation looks very comfortable this year. We are looking at an average of 3.5%, and H1 is looking more averaging around 3%. Even if some kind of disruptions happen, I think it could still, have a 30-40 basis upside. Then, too, it is at sub 4%. So I think there is headroom for RBI to go ahead with rate cuts. Of course, they may want to pause in one meeting post the June policy and then look at the options open in the subsequent policies.
Okay. All right. Thank you very much, both, for being here with us. Important thoughts, and it sets us up very nicely for the policy next week. Sakshi and Upasana, thanks for joining in. Have a good day, both of you. Okay, that's a view on the macros, all set for rate cuts next week. The market, by the way, is in a different mood, not feeling too great. Perhaps it's just profit taking, but the cut is now over 200 points. Mid-caps relatively better off. The mid-cap index cut right now is a 0.25%. Let's actually get in our technical expert. Soni Patnaik of JM Financial Services is joining in. Soni, good to have you on. Buy the dip, or what to do now with this kind of a morning decline?
Hi, good morning, Surbhi. Thank you for having me on your show. I think there's this very strong tug of war between bears and bulls around the 25,000 mark. Plus minus 50 points can be kept. As of now, the call writers seem to be dominating that level. So as long as 25,100 bare minimum is not taken out, fresh upside seems quite difficult. Also, India VIX seems to be rising quite high. It is above 18 and a half right now. It's just indicating that uncertainty in market direction is what is driving the trend right now. Any break or close below 24,750 in Nifty, you can see further profit booking towards 24,500. The idea would be to approach the markets with a cautious note and stay light on long positions as long as the resistance of 25,100 is not taken out. However, stock specific strategy seems to be telling a different story. We can see fresh longs adding up in multiple sectors and stocks, which seems to be driving individually, irrespective of how the indices are performing. So as of now, the idea would be to stay light on indices and focus more on stocks.
And any names, Soni?
Good morning, Prashant. Certainly. So our official buy recommendation has come in from one of the metal space, which is SAIL. So the idea in SAIL is to buy on declines towards 126 and 125. One can actually accumulate it on those declines, keeping a stop loss of 116.5. And look for a positional target towards 140. It is sustaining above its major moving averages, so I think any declines seen towards its support levels towards 125 can act as a good support levels from where a bounce back is expected. The second official recommendation is buy in Oil India. So Oil India is just approaching its 200 DEMA. Once it crosses above a 430, 431 level, it can test higher levels towards 445 and 450. So one can buy in Oil India with a stop loss of 420 and a positional targets of 445 to 450.
All right. Soni, thank you very much for that. Really appreciate it. So those are individual trades coming through as well. Now, on our new show, The Global Reset on CNBC-TV18 Prime, I caught up with Rajiv Jain of GQG Partners. Rajiv and GQG are the largest foreign institutional investors in India with upwards of $24 billion in assets under management. We spoke about a range of issues. Rajiv, for example, believes markets are complacent in the face of changes which he described as once in decades. He explained why non-tariff barriers are the real hurdle when looking at US-China and US-EU trade talks as well. According to him, India is part of the solution in Trump's ambition to rewire global manufacturing. He remains bullish on India and spoke about the $2 billion he's put to work in new stock purchases he's made in 2025 here in India so far. Listen.
First of all, there was no deal. It was, as the Treasury Secretary said, they had good discussions, okay? This is not even a framework. I think it was just basically sort of lowering the initial foray of tariffs. So if you look at, for example, the US, at this point, the tariff is 50%. Why? Because the 20% from the prior term. So obviously that's in the prices, but there's 30% on top of that. And China's agreed to go to 10. Okay, so that's the first part. But it is not really a deal at all. I think both have said, particularly the US side has said that this was a good start to lower the temperature a little bit. And even with the US, UK, by the way, that was again a framework. It is not a deal. I mean, as you know, trade negotiations typically take a long time. And this is not even a term sheet, which both have agreed to. This is a very broad framework. And I think that from a business perspective still remains very, very unclear. Should we, if you're a business manufacturing, let's say in China, I want to move to whether India, Vietnam, what have you, or back to US, now the tariff, is it going back to 0 or is it going back to 100% or not going? I think the amount of uncertainty from a business perspective still remains fairly high. So we don't believe there's a deal at all.
I mean, not even a MOU in that sense. Not even a framework deal, essentially. And absolutely, you think, China remains the number one, if I can call it that, target, which needs course correction according to Trump and his administration. That very much remains the objective?
So look, I think there's obviously a long discussion, but if I have to summarize, the real crux of, and there was a document released by the White House a few days before the quote-unquote Liberation Day, where they went into detail for every country, what are the real issues in which are impacting U.S. exports or trade. and they talked at length about non-tariff barriers. So I think even if China, and Chinese tariffs are actually not very high, they are like mid to high single digits, so they can easily go to zero. The real issue, non-tariff barriers. The problem is China started with this Made in China policy 2015, which identified certain key industries, okay, which they would support with incentives, subsidies, and so on and so forth. And now they are leader in the numbers I've seen in more than half of those already. That thing, by the way, is not going to change because those are essentially a lot of non-tariff barriers. For example, technology transfer. China, I don't believe, would ever agree to not sort of having this forceful technology transfer, which was negotiated in the last term also. So non-tariff barrier is the real crux of it. In fact, if you look at, I'll give you one small data point, that Switzerland does not have any tariff on U.S. goods, but we have put 30% tariff and now 10% tariff on Switzerland too. The question is, Switzerland doesn't have a tariff. Why tariff? And I think that what that tells you is that the idea is to bring jobs back. We feel the underlying desire, and there's a good reason for that, because look, industrial base has been hollowed out over the last 30 plus years, and the idea is to bring jobs back. And if that's the case, then Switzerland has very low taxes, right? So a number of large corporates have moved their headquarters to Switzerland to save taxes. So I think it's a whole combination of tariff, non-tariff, taxes to make US more competitive, which is why I feel that China will not remove non-tariff barriers. Both sides are buying time. We shall see what happens in 60, 90 days.
Point taken. So in that context, Rajiv, what is your sense? So China and US, from what I'm hearing, are not kissing and making up. China plus one is an important theme for many countries, right? I mean, countries like Vietnam, Cambodia, etc., benefited during Trump 1.0. India hopes to benefit this time around. Where does that China plus one kind of theme play around in your mind? How do you think about that?
See, if you look at Vietnam, Vietnam obviously is playing the same playbook that has worked very well for East Asia in general. So Japan was the first one after the Second World War, then Korea, Taiwan, Singapore, Malaysia to a little bit till late 90s, early 2000s, till China came along, and obviously China, and India and Vietnam more recently. I think India is slightly different. While India is trying to get the manufacturing side, and I think they have succeeded in a quite remarkable manner. By the way, it's quite remarkable how fast they've been able to, with the right policy mix, to attract manufacturing base, because that helped China tremendously to incentivize and attract these large, sophisticated manufacturers. I do feel that India is part of the solution from a U.S. context. Particularly if you look at Vietnam, Vietnam has kind of become they do a lot on their own, but it's also become a transshipment hub, which the U.S. trade representative talked about a number of times, which is why we feel that Vietnam would not be sort of scot-free because it is a big transshipment hub. And hence if you look at the 46% that was announced, was higher than a lot of other countries. Second thing is Vietnam also a big current account surplus. So our framework is as following. We feel that we have to look at countries that have that don't have huge current account surpluses. Countries that have huge surpluses with the US are far more vulnerable. And Vietnam fits the bill, so does Korea and Taiwan. India doesn't have a huge surplus, which means it also shows that it's a huge domestic economy. So we feel from our vantage point, India should be a net beneficiary. There'll be hiccups. There'll be 2 steps forward, 1 step back. But I think direction is clear. India would be on the positive side. Actually, Brazil would be, and Indonesia would be too, versus, let's say, Vietnam or others.
Let's just come to the U.S., Rajiv, which is, of course, your sort of largest, where your largest investments are. We've seen a massive sort of move from the lows. Where do you stand with your views with regards to U.S. assets? We got a brief period where people were really worried about this big sell-off in U.S. assets. I mean, everything was getting sold, bonds and stocks. That's changed a little bit now. There was talk of U.S. unexceptionalism. I'm not sure if exceptionalism is back in the, but what's your sense, Rajiv?
Well, I think the U.S. exceptionalism, the discussion of that was frankly, in my opinion, kind of based on the stock price movement rather than anything else, because the US remains the hub for innovation. There's no question about it. I mean, there's not much of innovation in Europe. And even when it comes to some of the, like China, for example, the cutting edge innovation is not really there. I mean, DeepSeek came 2 years after the OpenAI in US. So I think from a US asset perspective, few important sort of contextual issues in our opinion. If you look at the global trade surplus of these Asian countries, I mean, China has $1 trillion plus. They cannot recycle that. There are two ways: either you recycle that in US, or you have to basically sort of recycle back in China. You can't do that anywhere else. So I think a lot of these countries, if you look at Europe, where can they recycle? The currencies will go through the roof if they sort of truly bringing back as such. Gold is a tiny market, so we feel the US assets, from a global perspective, there's really no choice. You cannot recycle trillions of dollars anywhere else. Okay, the depth of the markets, etc., it doesn't exist anywhere else. So we feel that the whole discussion, people not invest in the US, I think is not very factual based. However, I think the rest of the markets, from a pure investing in equity markets, etc., perspective, valuations in US are on a higher side compared to its own history, compared to where interest rates are, more importantly, than where have been. For example, if you go back to when Trump came to power in 2017, US was around 17 times earnings, S&P was 17 times earnings, with the bond yields around 2%. But now bond yields are 4.5%, and S&P is almost 23, 24 times earnings, depending on the estimates. That's hardly a bargain, and particularly the gravitational pull of higher bond yields is pretty meaningful. So we feel that it is a time to be a little bit cautious. But valuations in non-US world are attractive, and if US doesn't do well, the capital will go into other places where the growth outlook is still okay. And India again actually looks fairly attractive, along with some of the some selective European and other emerging market countries too.
But it's not a sell US assets kind of a thing. It's basically recalibration, which happens all the time in phases. I mean, something becomes too hot, too expensive, and money finds more attractive places to go into, which with steady growth prospects, etc. That's the kind of thing you're talking about. Nothing.
Exactly.
Got it.
Because I think I'll give you another data point. I mean, India has been one of the best performing markets within emerging markets over the last decade.
Yes.
Foreigners have hardly been involved. Okay. And multiples, if you look at broad sort of index over the last 6, 7 years, multiples have not expanded that much. Some obviously stock by stock, some have gone up and some have gone down. But if you look at broad indices, they've been rebalancing and so on and so forth. But the multiples have not gone up dramatically. So why has the market done well? Well, because the corporate earnings have been good. So we feel that at the end of the day, corporate earnings matter. And if the corporate earnings are coming through and the valuation is sensible, I think you should get rewarded. And in that context, US looks a little bit expensive. Europe does look a little bit cheaper, but you're also assuming in that the Europe will probably not do well if there's a true global recession, because a lot of those industries are cyclical, right? Banks, industrials. So when you look at valuations, I think you have to look in context of how dependable the earnings stream would be if there's a true recession.
This calendar year put in about $2 billion new money to work in India, right?
Yes. Yes.
And just to sort of for our viewers, you've bought into Bharti in a big way. I think that's a newer bet, Rajiv. And I think one name which we discussed in a very different context the last time we spoke, HDFC Bank. I remember you telling me that you've been, you held that stock for years. I mean, long back, and then of course you didn't own it for a long period of time. You didn't have it last year. This is in that sense a new addition. You want to talk to us about that, Rajiv?
Yes. So HDFC Bank, we thought was going through a sort of integration transition period as such between the two, HDFC and HDFC Bank. So since last September or thereabouts, last quarter last year till first quarter, we put almost $2 billion in HDFC Bank. And Bharti we started buying early last year, and then we've doubled down again this year. We've added a little bit to some of the other names too. Nothing meaningful, but they're like a few $100 million here and there. Nothing meaningful. So these are the two big positions. The other ones we quite like. I mean, you have public information on that. So because we're still very bullish on the utility/infra type assets, we still like real estate. So And what's interesting, we feel this time around, is that seems like, and for good reason, the rally seems to be led far more by large cap than mid cap. Mid cap are fine, but the valuation is less supported than a large cap, and large caps are now transitioning from, they've digested, last few years for different reasons. And a couple other names, by the way, we just started, we recently initiated, so we were active, we can't talk about those. Again, large cap. So we feel that the large cap space looks fairly interesting, actually.
And the way the portfolio here in India is constructed, it's still, I mean, the trust is still industrials, infrastructure. I mean, if you were to sort of look at it by weightage, would that be correct?
Yeah, so if you look at it, it's not exactly precise, but banks is a big exposure, as you know, with now 3, ICICI, HDFC, and State Bank of India, so all 3, they are pretty meaningful. And then you get the infrastructure / utilities, because one thing I found fascinating is that utilities globally tend to be defensive. For some reason, these stocks are less defensive. I mean, I don't know why, but they're less defensive in India, but they are far more predictable growth because the rollout is happening. And that's probably half of our book. When I say utilities, infra combined. And then you get then you get 2 staples. I mean, ITC and Patanjali, right. And then rest is sort of, mixed match of some smaller positions.
Okay, 250 points lower on the Nifty, so 24,757 is where we are at. Now, rate gain is a stock that we want to focus on. Rima is standing by. The results, of course, came through, but we have the guidance now, which the market, of course, does not like. Rima, tell us more.
Indeed. So the company's conference call was yesterday, and they're guiding for a 6 to 8% revenue growth for FY26. This is sharply lower than the 12.5% growth that they had in the prior years. And before that, the company was growing at 50-60%. So this is the lowest revenue growth since FY21, its listing. Secondly, even the margin guidance, 15 to 17%, is a sharp drop-off compared to the 21.5% margins that they had in the prior year. And the company said this is on account of increased marketing expenditure to expand into APAC and Middle East. Now, analysts believe what to watch will be any sort of M&A action. The company has been scouting for M&A. So far, they've held back, citing very high valuations. But now analysts believe that considering the growth is slowing down for the company and they have cash of 1290 crore rupees, perhaps an acquisition is going to be imminent. And that's going to be the next trigger to watch. Today, Phillip Capital has downgraded the stock to neutral. Back to you.
Okay, all right, Rima, thank you very much for that. 8.5% lower. That's a large cut coming through. We'll take a quick commercial break here. We're coming back. Manisha Gupta will be speaking with Ole Hansen, head of commodity strategy at Saxo Bank, on the outlook for metals this year. Stay tuned. Coming up.
Welcome back, and joining us on the show now is Ole Hansen. He's head of commodity strategy at Saxo Bank. Ole, hi, thank you so much for joining in. And we want to talk about the global metals sector. And it seems there's a lot of confusion there. On one side, we did see prices gain after China stimulus measures, also US and China deferring their tariffs as well. But then when you look at supplies, inventories, they have been on the higher side as well. What is your sense on the overall metal as a sector for the rest of 2025 now?
Well, my overall sense is really that the themes that prevailed before this whole tariff war and shenanigans related to that started. But we were seeing an outlook for tightening supply of some of the key metals, especially those for the electrification, given what's happening right now, especially in China. And I think that will continue. But in the short term, the market simply just don't know what foot to stand on, simply because we still don't know the full impact of these tariffs and how they will impact some of the major economies, especially obviously in China, but also the US economy. And that has left us kind of listless here, range bound and struggling to find direction. in addition to that, if you look at a key metal like copper, we still have the premium between New York and London ebbing and flowing. It recently hit a high of around 16%. It just dropped down to around 7-8%, and now it's moving back above 10%. And that's really creating most of the volatility we're seeing in the copper market for now. So generally, I would say the words best to describe the markets right now is confused.
Well, it clearly has been that. But when it comes to copper especially, and since you spoke about that, while yes, electrification is an area where we are looking at a lot of copper demand. But on the other side, the International Copper Study Group also has forecasted copper surplus in this year and in 2026 as well. How have you analyzed those numbers?
Well, that is obviously an interesting development. But I think just overall, if we see how the say the Chinese economy, how they're becoming more and more electrified, we will see that trend continue in the coming years. So I'm probably a little bit hesitant to jump to that same conclusion. Obviously, I'm not the expert compared to these forecasts, but I think generally we have seen how copper throughout the last year, despite some of the worries that related to the setback in China to the property market, the copper has actually held up very well. And it does indicate to me that the underlying demand remains strong. Inventory levels right now are being shifted from the rest of the world to the US ahead of tariffs. That copper is going to create a surplus in the US, but tightness elsewhere, which I think will also help underpin prices. So I'm still optimistic in terms of prices in the coming years, simply because miners need higher prices in order to feel incentivized to continue to increase production, which we believe is still the base case for the coming years.
So $10,000 a ton is what the miners need to mine out more copper, and $12,000 is what you said as well. Moving away from copper and coming for gold then, and I do remember your forecast of $3,500 announced by the end of this year, which we've seen already happen in the first quarter of this year. How would you look at the gold prices from here, let's say, for the next 6 to 12 months?
I would have to say higher, simply because the demand from central banks is ongoing. That will continue. And the fiscal debt concerns in the US, if anything, has only been strengthened recently. We saw the spike in long-end bond yields last week, and we have to remember right now, rising yields is poisonous for the US economy. So where the normal behavior in the market was rising yields would be negative for gold, we're actually seeing that as a positive. So I think the combination alone of central bank demand and worries about the fiscal debt situation will be enough to underpin demand for gold in the coming months. So right now we reached our year target at 3,500. So we're not that aggressively bullish at these levels. But I do note that the last month we've had a correction which was very healthy. We're seeing it seems like we are starting to roll over a bit now that the market is pointing higher once again, and that leaves the door open for higher prices. But I think at this point in time, we probably need a trigger because a lot of you can kind of say gold-friendly news has been priced in. So we need a trigger to occur somewhere to move that needle a bit. That potentially could be a stagflationary scenario in the US becoming more apparent as we move deep into the year, and we start to see the negative impact on the economy from the trade war. So that potentially, to me, could be the next trigger that gives us an additional push to the upside.
One of the triggers for the gold prices to go higher could be the decline in US dollar index. We've seen it come down all the way from 114 to almost 98 at these levels. It's trading at a one-month lows right now. Do you see further decline in dollar index? Because that absolutely could be a trigger into buying many of these commodities.
It just looks like the trajectory for the dollar points to lower. It hasn't really got many friends. A lot of people would like to see it, including Trump, would like to see it lower, but obviously in an organized and well-functioning manner. Not we have a panic style situation, but the world as we see it right now points to the need for a weaker dollar in the coming months and years, and I think that will happen over time. We just recently saw how there was a quick move in the opposite direction, and that's clearly what will happen when the bets against the dollar becomes as one-sided as they have been for a while, with an overwhelming speculative interest to be short, that does create these periods of volatility. But I think overall the direction for the dollar is towards lower prices in the coming years.
Since we are talking prices and directions, what's also your sense for the silver prices? Because while the industrial demand has been good, we're also looking at a deficit for a fifth straight year. But would you say that much needed impetus for the silver prices to run up from here or break out is still missing?
If gold can stay here around this close to the 3,500 level, I see no reason why we should not have a go towards 40 later on. But we need some clarity on some of the factors you just mentioned yourself. And once we get that, I see no reason why silver can't do some outperformance once again, relatively to gold with a ratio around 100. It's historically quite high. So silver at this point in time, I would say, looks relatively cheap. But we need the trigger. We need some economic. We need to see the economic outlook stabilize, and when that happened, then I would still be looking for silver to move up towards the $40 level.
Well, as we wind down this conversation, a final question on Indian demand for gold. And while we do see concerns with China and US and within Asian markets, though, India really seems to be shining quite bright. And the kind of demand outlook and growth that we're looking at is quite on the positive side. What has been your sense on Indian demand for metals?
Well, India is a country that's going places. In Europe, it's Poland, but in Asia, in your part of the world, most certainly India. And increased wealth and given metals as a historical, how it's used historically by individuals, then if we are seeing increased wealth generation, then metals will be part of that story. So with that in mind, I see no reason why we will not continue to see robust demand from India. And if we add to that China, then we have some really strong engines that could drive prices forward in the coming years.
All right. Well, that point is well taken. So a confused metal market in the global sense, but for the Indian markets, the demand growth is quite on the stronger side. A buy strategy continuing for gold and silver as well. And the dollar could see a further decline there. All as always, thank you so much for joining us here at CNBC India. And with that, it's a wrap on Bazaar. Chartbusters is coming up next.
Interglobe Aviation slips in today's trading session, down over 2% after 5.8% equity changes hands in a block deal worth nearly 12,000 crore rupees. Sources tell CNBC-TV18 that the Gangwal family has sold stake in the company.
RateGain dips close to 8% as the growth and the margin guidance for FY26 disappoints. They project to grow in the vicinity of around 6 to around 8% and is likely to result in RateGain's weakest growth year since listing in December 2021.
Blue Dart down 4.5% following a weak fourth quarter where profit falls nearly 30%. Margins contract 200 basis points as geopolitical and macro uncertainties weigh on the business.
Maharashtra seemed as though is higher in trade on the back of a steady showing in the fourth quarter. The company saw 17% revenue growth while profits jumped 11% on a year-on-year basis.
Electra Green down by almost 6% as the Maharashtra government has cancelled the company's e-bus tender worth nearly 10,000 crore rupees as it fails to supply 5150 leased electric buses within the stipulated timeline.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as we speak, well, the markets are a little under pressure. The Nifty is down 200 points. The Nifty Bank is well down close to around 400 points. The breadth of the market is marginally favouring the number of stocks that are declining. But I think it's par for the course after the kind of rally that we've seen, Mangalam.
Absolutely. We're giving up what we saw in terms of gains yesterday, and 24,800 to 25,200 has been the broad range for the frontline index. The mid-cap index giving up a bit of gains in today's trading session as well. But in terms of absolute declines, it's not as much as the frontline indices, and that gives bulls hope that maybe at lower levels there would be some sort of support. But a lot of individual stocks are on our radar. APJ Surendra Park Hotels reported a steady set of fourth quarter numbers just in line with the hospitality industry. Its profits grew nearly 45% year-on-year, further aided by lower finance costs. As the management had told us earlier, they become debt-free. Vijay Diwan, the managing director, joins us back again to discuss their fourth quarter numbers. Thanks a lot, Mr. Diwan, for joining in. Always a pleasure speaking with you. This time around a little less so because you haven't uploaded your presentation. The conference call is tomorrow for the analysts, so I'm sure a lot of them have tuned in to listen into what data that you have to give to us today. So let's start with the basic numbers. If you could give us the internals of the fourth quarter when it comes to occupancy, RevPAR and the average room rate, how does that compare with the same time last year? If you could give us those basic numbers first.
Okay, firstly, I'm delighted to be back on your channels. And to start with, 24-25 has been a standout year for our company in terms of growth, progress, and success, largely made possible for the commitment and dedication of our teams. And we are absolutely thrilled to announce our first ever dividend of 50%. This is a milestone event in the history of our company and is a reflection of our growth momentum and our commitment to share our business with those who actually believe in us. The fourth quarter results have been truly outstanding. We have had a growth of 16% on the top line, and the EBITDA in the fourth quarter has grown by...
Right. We know the reported numbers. We're asking you about the internals, if you could give us those details.
Okay, so in terms of the key highlights of the quarter four is that we have been able to retain our occupancy leadership. We are market leaders in occupancy. We have India's leading occupancy of 92%. And both our RevPAR as well as ARRs, that is the average room rate, has actually grown by 13%. So this is in line. In fact, we have exceeded expectations in terms of our performance in both ARR as well as RevPAR. And we are very optimistic in terms of our future outlook. And we are very confident of actually delivering in terms of double-digit growth in the year ahead.
All right. Hi, Mr. Diwan. Good morning. Good to speak to you as always. Nigel on this side. Give us three basic numbers. One is, how many rooms are you looking to add in FY26? What kind of occupancy do you target for the company on the whole? And the outlook on the ARR. Three numbers for FY26.
So firstly, currently we have roughly about, we have 35 hotels totaling to about 2,500 keys. And we added about 194 keys during the course of this year. And this year has been very significant because we opened two Palace Hotel, the Ranbas Palace at Patiala, which is Rally and Chateau Hotel now. And we've opened a 15-room Lotus Palace Hotel at Chettila. Along with this, we also opened hotels in Prayagraj as well as in Digha. So 194 keys were added during the course of the year. Going forward, we plan to add about 250 keys. The most significant is that during the course of the year, we have signed a binding MOU for the acquisition of zillion hotels and resorts at Mumbai, at Juhu in Mumbai. And this hotel is going to be converted into a glamorous and fashionable boutique hotel of 80 rooms with a very significant rooftop bar. And we feel this deal has been concluded. This MOU has been signed. It's a binding MOU. It is being signed as an acquisition cost for acquiring 90% of the stake of Zillion Hotels and Resorts at a cost of 209 crores. And this hotel is expected to open by July of next year. And we should be able to increase our EBITDA during FY27, this opening itself by about 20 to 25 crores. To answer your other question in terms of our ARR growth and occupancy, for the last 10 years, the park has always recorded, except for the 2 COVID years, we have always recorded 90% plus occupancy, and we will continue to deliver that. In terms of ARR, as far as RevPAR growth is concerned, I'm very, very confident to deliver double-digit growth going forward, because all the factors for the hospitality industry at the moment are absolutely positive in terms of passenger growth of airlines, which is expected to grow by 10%. And likewise, in terms of demand and supply, there is a huge shortage of rooms in the country.
So what does that do to your margins? Because your ARRs grow by double digit, your occupancy stays stable at 90%. Costs are largely fixed, but you are still investing in opening new hotels, new restaurants, and new bars as well. So all things put together, what are you expecting in terms of margins? What kind of improvement?
Margin improvement is definitely expected in the range of 100 to 200 basis points as we go forward, because it's largely going to happen because of high ARR in the Palace hotels, which is going to make a significant difference to our bottom line.
So if I look at your numbers, you're saying that you will add 250 keys to the keys that you have right now. So that's about 8 to 10% addition in terms of rooms. Your occupancies are the same. And then there is double-digit ARR. So can we expect revenue growth of around 18 to 20% in this year? Is that a realistic target or more than that?
It's very, to be very precise, I think it'll be double-digit growth and it'll be in the high teens. It's very difficult to say whether it's going to be 16% or 18%, but it'll definitely be in the high teens. And this is despite the fact that there have been disruption in business because of geopolitical tension with our neighbor in the month of May. And despite that, we are still very confident of delivering double-digit growth in Q1 as well.
And how many Flurys and someplace else is that you open this year?
Flurys is really very dear to us. We have crossed the 100 mark in terms of Flurys. And we have very recently opened at Gangtok, and we are about to open in Darjeeling. And we remain committed to open about 40 to 50 outlets of Flurys every year. Flurys has seen remarkable growth in this quarter. Top line has grown by 37%. On a YTD basis, Flurys growth has been 34%. And we expect this growth momentum of Flurys to continue as we enter the city of Delhi and further consolidate our position in Mumbai from about 16 outlets to about 20 outlets by the end of the next quarter.
Thanks a lot, Mr. Diwan, for joining in. Wish you good luck for all the openings and Flurys in particular as well. And I'll one of these days take Nigel out to the Mumbai Flurries as well, because that's what we can afford. It's a cafe, some nice pastries, and maybe some croissants as well, Nigel.
Thank you, Mangalam. It's great, and Nigel, it's always great to talk to you. Thank you so much.
All right. I was hoping Mangalam had another plan in mind, but he's talking about coffee and chocolate and all. Okay, we'll go for that. Rather go for a malt, but yeah, all right.
Can't afford any of the malls that he's held at someplace else or the Palace Hotels, Nigel. So let's move.
We are actually serving alcohol in our outlet in Colaba. So we can expect that in BKC as well.
Let's do it.
All right, then that's what it is. Thanks a lot, Mr. Dewan, for joining in. With that, we'll take a short break. On the other side, we have the management of Northern Arc Capital joining in to discuss their fourth quarter numbers. Stay with us.
Welcome back. Well, a lot of these defense-related names actually are doing pretty well in today's trading session. And one such stock is Reliance Infra. Actually, it came out with a good set of numbers. However, the stock came in for profit-taking yesterday. Today as well, it opened up in the red, but Reliance Infra should come up for you on the screen. Big up move is what we're seeing, and volumes are massive for the first 90 minutes of trade. So keep an eye out on that particular name. But let's focus on Northern Arc Capital. They reported a strong sequential as well as a year-on-year net interest income growth in the fourth quarter. However, provisions rose, credit costs as well ticked a little bit higher. To help us out with the way ahead, we're joined by Mr. Ashish Mehrotra, the Managing Director and the Chief Executive Officer at the company. Hi Ashish, good morning. Good to see you in. Thanks a lot for joining in. Well, tell us, for FY26, what plans do you have for the company? What kind of dispersals are you looking at? What kind of AUM growth are you looking at?
Hey, thank you very much. Delighted to be here. If you look at it whole of last year, you saw we witnessed about 23% growth in our gross transaction volume. Our assets under management grew by 16%, predominantly driven by big focus of growth towards lending to MSME and consumers. Our forecasted, what we're looking at as this thing stabilizes, is to grow our business by about 22 to 25% for FY26. We will taking a rather cautious but optimistic stance as the market evolves over a period of time. Obviously, there are some bit of headwinds in MFI markets where we've consciously dialed down our exposure to less than 1,100 crores. So that just speaks, that's less than 10% of our balance sheet. So we are in a good spot.
All right, so you are, scaling down some of your exposure to the MFI space. Just a couple of questions, on the outlook. While you see a 22 to 25% growth in your AUM, what is, likely to drive this in terms of sectors? And secondly, retail as a percentage or direct to customer as a percentage of your loan has increased from what, 19% to about 52%. How much is that likely to be next year?
I think we expect to take it upward of 60% over a period of time, and directionally our objective is to take it to upward of 70% over the next 2 to 3 years, and that will show an expansion in our NIMs. At the same time, continue to grow our credit solution business, which is pretty unique to what we do. Our ability to originate large amount of credit, place it in the market, underwrite it, process it, sell it to the institutional investors, to domestic investors who wants to participate in the high quality fixed income papers, invest from our asset management, from our AIF and PMS, essentially from a funds business, and support it from balance sheet. And that creates a unique fee franchise for us, and which is essentially a kicker on the numbers which we have. If you look at it sequentially over a period of time, that contributes anywhere between 80 to 90 basis point on our NIMs.
So if you could give us a sense of, every percentage increase in your D2C, how much does that improve your NIMs or how much does that improve your profitability by? So then, we'd understand that if this goes up from 52% to 60%, what is the corresponding improvement in the NIMs?
I think the way to look at it, you should see an expansion in NIM from about to about 200 basis point over a period of time as we continue to expand and build the direct-to-customer business. And that's predominantly focused towards building the secured book, addressing the needs of small businesses. We have close to 70 branches. We intend to expand that sequentially. So further build the direct-to-customer business around consumer. We address work through a bunch of partnerships, both financial institutions and non-financial institutions, essentially addressing the needs and have the ability to process large quantum of credit. I think we are pretty confident as we think shaping up to see the growth in these two sectors. If you look at last year, that's the primary driver of growth. That business actually grew by about 30% year on year, while we consciously degrew our MFI exposure down to 27%.
Okay, all right. Let's talk about a little bit of the asset quality then, Ashish. Tell us about the credit cost that spiked up, and what's the outlook on asset quality for FY26?
I think the way to look at it, so asset quality, our GNPA and NNPA remained fairly well within the range point what it has been. Your credit cost has gone to about 300 basis points. That includes two one-timers. We did a management overlay of about close to 70 crores as part of provisioning. And the second, which is today also got covered in the paper, is the accounting adjustment on the default loss guarantee, which we thought it's prudent enough while the regulator gave us time to adjust it, to take it in one go. If you remove that, you see 60 basis point reduction from 300 basis point to about 240. And if you adjust both of them, you are predominantly in line with what probably 210 basis point, which is probably the best numbers if one looks at it.
And that is what is likely to continue as well, right? Can you give us guidance for NIMs, GNPA and credit costs for the next year?
I think as Sensex, we should be able to be range bound around 240 to 250 basis point. As we grow our direct to customer business, it will come with marginally higher credit costs, but at the same time, it will have a compensating significantly higher NIM. And I think that will provide much needed tailwinds for the business.
Take that point. Thank you so much for joining in, and always a pleasure speaking with you. Wish you good luck for FY26 as we speak. With that, let's get you some ideas for profit from our colleagues at Money Control Pro. Khushbu Rai Gupta joins in with the stock that she's tracking. Khushbu.
In today's idea for profit, we have Aditya Birla Capital. The stock has outperformed the market led by consistent growth and the merger of Aditya Birla Finance Limited with the parent company effective April 2025. If we look at the recent performance of the company, despite the growth recalibration in the high-risk unsecured business, the company has achieved healthy growth in the March quarter.
After the merger, the company aspires to double its NBFC loan book size in the next 3 years, led by a greater focus on the high-growth MSME business and an increased focus on personal and consumer loans growth. The sweating of the existing branches and increasing contribution from digital channels will remain key growth levers for the NBFC business. The merger will also act as a performance booster on account of operational efficiencies and more cross-selling opportunities. Apart from the greater financial strength and direct access to capital, the amalgamation has also enhanced the stock valuation due to the elimination of the holding company discount. However, we feel that any future valuation re-rating will be dependent on the sustained risk-adjusted growth for the company.
All right, Khushbu, thanks a lot for that. Well, time to slip into a short break. We'll get you more on the markets and on stock-specific action on the other side.
Welcome back. Even as the frontline index is down by about 200 points on the Nifty, the broader markets are doing well. And some of these numbers that came in during the weekend are getting continuously rewarded. Translate Lighting is one of them. Was up 5% in yesterday's trading session. Good numbers came in. And this morning opened absolutely flat and currently has moved to the high point of trade with a gain of about 5%. In the last two trading sessions itself, the stock has clocked double-digit in terms of gains. We're talking about, good gainers. Credit Access is the other one which has clocked in double-digit gains in this week at the last couple of trading sessions. And most of that has come by in today's trading session itself, up around 8.5%. And then from the F&O pack as well, we have a couple of these stocks doing well. We have PI Industries, which has moved higher. Supreme Industries has moved higher. And we have Godrej Properties too, which has recovered from the lows, leaving the mid-cap index lower by just 0.1%. So that index has actually improved. with the advance decline also moving a little more in favor of advances, 1,130 stocks now in the green. With that, we will wrap up on this edition of Chartbusters. Thank you so much for watching. From Nigel, me, the entire team, thank you for watching. You have Trading Hour that comes up next.
Good morning and welcome to Tuesday's Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Hormus Fatakia, and it's a subdued Tuesday morning. The Nifty, Sensex down close to about 0.9%. The Nifty is at that 24,773. The Sensex is at 81,400 after declining nearly about 800 points. And for the last couple of days, we've pretty much been in this trading range. It's 25,000, 25,100 on the way up. And on the way down, it's 24,600, which is where our 20-day moving average also lies. So yesterday, markets moved up. Today, we've retreated a tad bit. So more than 200 points gone on the Nifty as we speak.
Speaking of the Nifty, we'll be looking for some supports at lower levels. When we had that dip last week, we had convincingly managed to defend that 24,500 mark on the downside. So that is one level that the bulls will be eyeing as of now and would be aiming for some recovery from lower levels. Mind you, today is the monthly expiry of the Sensex contracts as well. So that could result in some more volatility in the second half of the trading session. So we need to keep that in mind as well. The broader markets, though, have seen some recovery from the lower levels, be it the mid-cap index and be it the small-cap index as well. The mid-cap index has now almost turned into the green. It opened higher, then fell to the lows of the day, now heading back into the green. The small-cap index had a brief dip into the red, but still holding on to gains above the flat line as we speak. So good going for the broader markets as of now. But of course, there are a lot of earnings reactions in today's session. Bear Crop is one of them. Strong earnings performance, 10.5% higher for that stock, remains the top gainer on the Nifty 500. Schneider Electric is the other one, 8% higher on that stock as well. So good going for a lot of these MNC names that have done well for themselves. And GE Vernova was up 10% in yesterday's session, building on to those gains, another 6% higher in today's session as well. But starting off with some more earnings reactions on the show, then PTC India, and that stock is under pressure following its fourth quarter results, and the profits were higher on account of an exceptional gain which came as a result of divestment of their wholly owned subsidiary PTC Energy to ONGC Green. The margins, though, remain flat. Now Manoj Jawahar, who is the chairman and managing director of the company, he is joining us on the show to discuss the road ahead for the company. Mr. Jawahar, good morning, sir. Thank you for joining in. I'd like to first start off by asking you about your consolidated top line, sir, for the fourth quarter. It saw a decline. What do you attribute that to, and what are the growth targets that you have penciled in for FY26 on both the revenue as well as the margin front?
Good morning, Harmesh. Good morning, Rima. Number one, our top line, it may look as if we have, it has come down, but for us, the top line does not matter like that. For us, the margin on the trading matters. So, because the top line goes up or down as per the vagaries of the weather. Since the weather has been benign, the prices on the stock, on the markets, energy markets were low. So our top line might look like as if that we have slipped, but basically we have grown our operating income by 17%. So 17% is a good number given the market situation and dynamics, and we hope to continue this momentum.
Mr. Jawahar, morning. This is Rima here. What would the numbers look like if you adjusted for the divestment of PTC Energy India, your renewable arm? So if you strip that out, then what would the numbers look like? And then if you could tell us about the realization, because you're saying that's the metric that really matters.
Yeah, so if we remove the extraordinary item also, then our operating income has grown by 17%, which is a good number, I would say. Our total MU sold volume has increased by 11%. Our operating margin has also grown by 11%. There is a little bit of dip in the surcharge income, but that surcharge also, dip in surcharge income indicates better management of outstanding position against the debtors. So I think that is a good number, not a bad number.
Okay, so can you give us some guidance on volumes and on realizations, your core your core margins for FY26?
Actually, we aim to achieve at least 10% growth over the previous number. We have been able to close this year by around 83 billion units. So we would like to achieve at least 10% growth in the margin in next year also. This year we have been able to achieve 11% growth.
Mr. Jawahar, if you could split for us the market growth as well, where it comes to short-term or the bilaterals. Now, is the industry seeing a shift towards the bilateral segment? And if so, is it impacting volumes in the short term?
You see, actually, the short-term market also consists of power traded on the stock, on the power exchanges as well as the bilateral trade. So, bilateral trade also includes short-term trading. But yes, the margin and the market is definitely shifting more towards the exchanges, particularly in the short-term realm. Long-term and medium-term definitely remains bilateral affairs.
Sir, it's been 2.5 years since that report discussion paper on market coupling was released. Where are we on that right now? What is the latest update that you can share? And are we likely to hear any final guidelines on this?
Actually, I mean, that is a matter of policy, and a call has to be taken by the government and the regulatory authorities in this space. We have been advocating market coupling for a long period, and the obvious reason is that there should be, I mean, some competition in the power exchange business, and that will lead to consolidation of the market. It will avoid the fragmentation. It will, I mean, lead to one country, one market, one price of electricity, and a host of other benefits. But really, I cannot comment as to when the government would be able to take a call.
Mr. Jhawar, your revenues from the HPX stood at around about 6.5 crores in the third quarter. What are the trends that you have seen in the fourth quarter, and what do you expect that to be in the new year as well? And if you could shed some light on that.
You see, actually, Hindustan Power Exchange is a power exchange. It has been struggling to get the volumes in the RTM segment and the day-ahead market segment, which is the collective segment. The reason are obvious that the incumbent exchange would always have an edge over any other competitive environment. So other two exchanges have been struggling to get volumes in this collective segment. So unless and until there is coupling, I would really find it difficult that we will be able to get any significant growth in collective segment, which is the DEM and the RTM segment. But other than that, there has been a good growth in the 10 segment, and we hope to increase that further. So we think we will be able to grow this segment on the HPX, which is 10.
Sir, there were certain reports that 4 of the PSU shareholders, which includes NTPC, Power Grid, PFC, NHPC, they're all classified as promoters of the company. And this was reported in the Pink Paper some time back, that they all want to bring down their stake. They no longer want to be classified as promoters. They want to log out of the promoter role. Is there any truth? Have you had any conversation with any of these 4 PSUs?
Actually, I mean, it is for the promoters to take a call as to what suits them. But for me, and the communication I have been sending to my promoters also, that on a investment of about 18 crore rupees, we, during the past around 18 years, given them a dividend income of 80 crore rupees, and the share prices have gone up from 10 rupees to currently 185 rupees. So it is a good return. Their investment has yielded them good return. It is up to them as to what they want to do with the equity. But as of now, I have no official confirmation that they are planning any serious move to exit. They are still our promoter, and I hope they remain so.
All right, Mr. Jhawar, thank you so much for sparing time and joining in today. Wish you good luck for the rest of the year as well. The management there of PTC India on the road ahead for the company. Take a short break. On the other side, all things commodities with Manisha Gupta.
carefully.
Welcome back. Shifting focus now to the commodity space, and Manisha is now joining in to focus on another commodity that is neither here nor there in the recent times, and that's gold, Manisha.
Well, yes, but you can't say here and there because it's trading well above $3,300 an ounce. It has seen some profit taking, yes, and that is after the EU 50% tariff put by US has been deferred from 1st of June to 9th of July. But barring that, everything else clearly has been supportive for gold. Is the reason you're looking at it trading not too far away from its all-time highs. Well, actually, Citi, as well as Bank of America, Saxo Bank, all of them who have spoken on the channel in the last couple of days do say that near-term, yes, cyclical bearishness, but structural bullishness is what they are still looking at in case of gold prices. Well, there are too many supportive factors. One, the US dollar index trading at a one-month lows below 99 has been a supportive factor. And then there are plenty geopolitical tensions as well, especially in the Middle East. The US is also talking about more sanctions on Russia. Russia has done the biggest aerial attack till time on Ukraine, and those also have led to some premium into the markets. Having said that, it really is going to be about the US Fed meeting minutes, which get released tomorrow. Then you have the US PCE data that comes in on Friday as well. So ahead of those both important numbers, you could be looking at some choppiness into the markets, yes, but majorly 3,100 to 3,500 as a range seems to be holding now for the gold prices.
Thank you very much for that. Let's get in another corporate conversation. Sanathan Textiles reported a muted growth in Q4. EBITDA and profit declined on a year-on-year basis. Margins came under pressure. Sameer Dattani, the executive director of the company, is now with us on the show. Thank you very much, Sameer, for joining in. First, if you could explain what were the headwinds that the company faced in Q4 because of which we've seen a hit on your profitability.
No, I'll just correct you here. Our EBITDA on a quarter-on-quarter basis has improved. The Q3 EBITDA was about 58 crores, while the Q4 EBITDA is 68 crores. And
we were actually looking at it, Sameer, sorry to interrupt, on a year-on-year basis where the revenues are down 3%, EBITDA down 13-14%, and profits down 16%.
EBITDA
year-on-year.
Yes, EBITDA on a year-on-year is also up. The EBITDA last year was 227 crores versus this year 263 crores.
But that's now talking about FY24 and FY25. We were specifically talking about Q4 versus Q4 of last year.
Okay. I think a fair way to look at it is at an annualized level because, the business will have different cycles through different quarters. But at an annualized level, we have had an improvement of EBITDA of almost 16% on a year-on-year basis. So we've had a good year, how we're looking at it, because PAT has improved and so has the EBITDA. And the last quarter, the Q4, our EBITDA margin has also firmed up, showing a clear sign of better demand and firming up of margins for us.
Sameer, good morning. Thank you for joining in. So even if you take a year-on-year basis for the fourth quarter as well, the margins were slightly narrower. But even then, what are the kind of growth targets now that you are envisaging for the full year, if you want to say for the annualized basis for FY26? Have you set any top line and margin targets for the year?
So Hormas, this year we'll be starting up a new greenfield facility. It's starting up in Punjab where we'll be more than doubling our polyester capacity. So the current revenue for this year is around 3,000 crores, whereas next year, FY26, we are estimating a revenue of between 45 to 4,800 crore rupees, because we should get about 3/4 of this new facility production.
So 45 to 4,800 crores from the current about 3,000 crores is what you're trying to say.
That's
right. For FY26, right. Okay, so now that you've gone into FY26 with the way you are, with the Punjab plant, are you on track to commission it this quarter?
Yes, we're looking at commissioning in the end of June this quarter.
End of June. And how much revenue does that bring to you?
So we are hoping to get at least 3 quarters, and in terms of capacity, it's going to double our polyester capacity. Our current capacity is about 2 lakh tons, whereas the new facility will be a capacity of 250,000 tons on an annualized level. And current revenue for this is 3,000 crores. And from the new facility for the first year, since we won't get the full year, we are hoping to add revenue of at least 1,500 to 1,800 crores.
So organic growth, if you strip out the extra capacity which is coming on stream, what would the organic growth look like? And what about the margins, from the new facility and on a consolidated basis? How should we look at that for the full year?
So as far as the current facility is concerned, we are sweating our asset fully. So at the current facility level, I think 3,000 crores is the fair expected revenue that we can look at on a year-on-year basis, maybe a % here or there. Because in manufacturing, honestly, the amount of capacity that you have does determine your revenue. And we've been using our capacity consistently over the last 4 years at more than 95-96% capacity utilization. As far as the new facility is concerned, we're definitely seeing an improvement of margins. We have a lower OPEX cost, plus we're going closer to the customer. So we hope to be the preferred choice of supplier for our customers in North India, who we've been dealing it for more than a decade now. And lower OPEX costs and some other benefits that we have there should add to our EBITDA margins.
Right. You know, Samir, the last time you spoke to us in April, you had mentioned that demand in India has been fairly robust over the last 2 quarters. Has that continued in this quarter as well? And you had also mentioned that you're looking to increase your share of exports. Does that happen this year from 5%, say, to around 7 to 8%?
So the demand has been robust, and that's very visible in our EBITDA margins. The EBITDA margin in Q3 was about 7.8%, whereas in Q4 it's firmed up to 9.2%. And with the same kind of revenue, the increase of margins is only because of the robust demand. As far as exports is concerned, we are surely seeing a lot of tailwinds, you know, with the FTA that we have with the United Kingdom. Also, all the tariff advantage that the textile industry is seeing between US and India should help improve exports in the coming year for sure.
Do you think margins, Samir, can hit double digit this year?
Yes, we are very hopeful to have double-digit margin this year, yes. We are quite there, close to 9.2.
You're close, yeah.
In the last quarter, so we are very hopeful.
And what about debt? Samir, you had mentioned that once all the plants and the repayments and all of that is done, your debt will stand at around 1,100 crores. Do you expect to bring that down further into FY26 as the year ends?
No, FY26, we won't be able to bring it down. We will be in the range of 1,100, 1,200 crores. But moving ahead with the repayments that are scheduled, we should be lowering it in the years to come.
So in FY27, where do you see that number?
I think at about 1,900 to 1,000 crores. Our peak debt should be around 1,200, which will be more towards this year and the beginning of next year.
All right, Samir, thank you so much for sparing time joining us today. Wish you good luck for the rest of the year as well. Management there of Sanathan Textiles on the road ahead. Take a short break. On the other side, we discuss market technicals. Apurva Sheth of Samco Securities joins in for a quick chart check. The markets have recovered significantly from the lows of the day. Stay tuned.
Welcome back. Banks are staging quite a recovery. The Nifty Bank, which was down more than 500 points, is down about 80 odd points. There's been a swift up move in banks. Look at that. Starting about 11 o'clock. ICICI Bank trimming its losses. Axis Bank also now just down close to about 0.5%. HDFC Bank has seen buying from the lows, and that's helping the Nifty also pick up close to about 100 points from when we started the show. When we started the show, the Nifty was sub 24,800. Now it's above 24,900. And there is also contribution from other names. Pull up a Trend, for instance. Trend is up nearly about, I think, 0.6% is the gain on Trend. There you have it. Reliance Industries, L&T. It's not a sharp spike as you're seeing in some of the banking names, but they are ticking higher. Apurva Sheth from Samco Securities is now with us for a quick technical check on the market. Apurva, this last hour surge in Nifty Bank, what have you made of it? Does it open up a trade? And what will the stock calls be?
So the last hour surge, I would say that doesn't open up a trade opportunity in Bank Nifty or any other indices. So for the last 1 month, most of the indices are trading range bound. So for Nifty has been trading in the range of 24,000 to 25,000. And over the last 15 days, the range has been from 24,500 to 25,000. So the index has not made any major move. And apart from that, the mid caps have bounce back. So probably a month ago, nearly 50% of the mid-cap stocks, NSE 500 stocks were trading below their 50-day moving average. Now, nearly 90% of the CNX 500 stocks are trading above their 50-day moving average. So the catch-up rally has happened, and now it seems that there should be some consolidation or correction even in the mid-caps as well. So we have been, the top two picks that we have been recommending are, one is a short trade. So first is Ambuja Cement. Would like to go short on the stock with a stop loss of 575 with a target of 540. And another trade will be CAMS. So CAMS will be a long trade with a stop loss of 3850 and a target of 4200 and 4400.
Apurva, thank you so much for sparing time and joining us today with your views on the index and on specific stocks as well. There's a commonality in these charts that you just mentioned. All of them have seen a spike towards starting 11 o'clock and then have seen a bit of a consolidation. See the Nifty as well. The Nifty Bank has had a similar spike. Reliance Industries has seen a similar spike. And most of these large banks who had seen, whose charts Rima spoke of, be it ICICI, be it HDFC, all of them have seen a similar spike towards that 11 o'clock mark and have continued to move higher from those levels. The Nifty now almost in the green, nearing that mark of 24,900 as we speak. So good recovery seen on the index. Take a short break, but just as we do that, we are excited to unveil our brand new global business news channel, the all new CNBC TV18 Prime, bringing to you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. You can tune in to CNBC TV18 Prime at 12 noon for the Global Reset and for the Global Lens at 8:30 p.m. Into the green is the Nifty as we speak, back above the mark of 25,000. So a swift recovery seen on the benchmark index in the last 30 minutes. And on to a CNBC-TV18 exclusive now. GQG's Rajiv Jain remains overweight on India. He spoke to CNBC-TV18's Prashant Nair about the latest India bets and where they see value in the Indian stock markets. Here's a slice of that conversation.
Already this year, this calendar year, put in about $2 billion new money to work in India, right?
Yes, yes.
Just to sort of, for our viewers, you bought into Bharti in a big way. I think that's a newer bet, Rajiv. And I think one name which we discussed in a very different context the last time we spoke, HDFC Bank. I remember you telling me that you've been, you held that stock for years. I mean, long back, and then of course you didn't own it for a long period of time. You didn't have it last year. This is in that sense a new addition. You want to talk to us about that, Rajiv?
Yes. So HDFC Bank, we thought was going through a sort of integration transition period as such between the two, HDFC and HDFC Bank. So since last September or thereabouts, last quarter last year till first quarter, we put almost $2 billion in HDFC Bank. And Bharti we started buying early last year, and then we've doubled down again this year. We've added a little bit to some of the other names too, nothing meaningful, but they're like a few $100 million here and there, nothing meaningful. So these are the two big positions, the other ones we quite like. I mean, you have public information on that. So because we're still very bullish on the utilities / infra type assets, we still like real estate. So, and what's interesting, we feel this time around is that seems like, and for good reason, the rally seems to be led far more by large cap than mid cap. Mid cap are fine, but the valuation is less supported than a large cap. And large caps are now transitioning from, they've digested, last few years for different reasons. And a couple other names, by the way, we just started, we recently initiated, so we are active, we can't talk about those. Again, large cap. So we feel that the large cap space looks fairly interesting, actually.
And the way the portfolio here in India is constructed, it's still, I mean, the thrust is still industrials, infrastructure. I mean, if you were to sort of look at it by weightage, would that be correct?
Yeah, so if you look at it, it's not exactly precise, but banks is a big exposure, as you know, with now 3, ICICI, HDFC, and State Bank of India, so all 3, they are pretty meaningful. And then you get the infrastructure / utilities, because one thing I found fascinating is that utilities globally tend to be defensive. For some reason, these stocks are less defensive. I mean, I don't know why, but they're less defensive in India, but they are far more predictable growth because the rollout is happening. And that's probably half of our book. When I say utilities, infra combined. And then you get then you get 2 staples. I mean, ITC and Patanjali, right. And then rest is sort of, mixed match of some smaller positions.
Your thoughts on IT services and pharma?
So IT services has been in a crosshair, nothing to do with tariff, but much more around just the natural cycle, because there was a big ramp up during COVID. And which is why we have been cautious that we thought that the markets were too optimistic. And not just, when I say this, by the way, it's not just Indian IT service, I'm talking global IT services space as such. And there was a lull, and you're still sort of digesting the spike of growth that you saw during COVID and just after COVID. But thereafter, the AI-led, there's a fear of disruption AI, which has sort of impacted multiples, particularly last few months, last 6-9 months. And recently, I would say the tariff fear has impacted some of these names. But I think if you look at historically, changing technology creates more friction, and IT services has been a winner, not loser. So I think the outlook is far less worse. We don't have exposure, by the way, just to be clear, but the outlook, we were fairly cautious maybe 2.5 years ago in this space. But I think the outlook is improving because there's far more pessimism. Numbers have come off now, but the disruption risk is what people are fearful of. And that's a call you have to make, whether they'll be disrupted or not. The pharma side,
yes.
Look, pharma side, I think it's very name by name. I think US, a lot of the generic stuff will not shift to US, but there will be some shifted. Like Novartis has already announced that they will manufacture within 5 years, 100% of the needs will be met by manufacturing in US. Okay, but then they're still going to have stuff for other countries produced for other markets. But that's one company. So we feel that some companies would be winners still in this environment because, as you said, the cost difference still enormous. We do have one exposure, Sun Pharma, which we own for a long time now, and look, we haven't done anything. So we feel that I think it's wait and watch.
I got that. You know, the other space which has attracted a lot of attention lately is defense. And it's a relatively newer sector in that sense. Lots of companies now listed. And global defense spending is at an all-time high. I think as that Stockholm Peace report, I mean, the report which came out a few weeks ago showed. In India here, of course, there's a lot of focus on, you know, making in India what we were importing so far. And there are targets for 2028, 2030. Have you looked at the space, Rajiv?
Look, we looked at the space we used to own before years ago, but I mean, look, we've completely missed it. And I think the recent events in the India-Pakistan, I think the defense industry has a tremendous headroom. So one cannot be but bullish. Our issue is that I mean, we tend to be conservative, so the valuation and so on and so forth. But if you take a 5-10-year view, there's tremendous headroom.
And you can catch excerpts of this conversation with Rajiv Jain all day today on CNBC-TV18. Okay, the Nifty is back in the green, as we pointed out, and above the 25,000 mark. One level to watch will be yesterday's intraday high, which is 25,079. The Nifty is now flitting between the red and the green line, but there's been a remarkable more than 200-point recovery from the lows. It's been a swift recovery just in the last 30 minutes or so from about 11 o'clock. 25,079 would be yesterday's high, will be the immediate hurdle for the markets to cross. And remember, it's also the expiry. Get into a break. On the other side, market fundamentals with Jyoti Vardhan Jayapuria from Valentis Advisors joins in.
Welcome back. Now, as India electrifies faster than ever, from AI-ready data centers to renewable energy and industrial expansion, the demand for transformers is surging. But can supply keep up? Or are we looking at a bottleneck in one of the most crucial links of the power chain? Vamakshi is here with more details on this.
Transformers are the real power players, crucial component of our electricity grid, who ensures that power is transmitted at just the right strength. No surprise then that the transformer market for Indian players is expected to grow at a CAGR of 23% to 39,000 crore rupees by FY27, driven by 16% CAGR in the domestic market and a massive 42% CAGR in exports. But here's the problem. With demand growing so rapidly, supply is struggling to catch up. Why is that so? It is on account of a few factors, which includes the shortage of critical raw materials and lack of manufacturing capacity.
There is a huge shortage in the extra high voltage transformers because
some manufacturing capacities are not there, and other than that, there are a lot of hindrances, or there are a lot of issues with raw material that has to be fed to these transformer factories. So raw material is becoming a larger issue than manufacturing capacities of the transformer manufacturers. Raw materials that are in shortage are CRGO, which is not made in India. Then copper is an issue. Copper in terms of specifically CTC wires that are used in a transformer or a reactor.
So how bad is this shortage? Well, experts believe the demand-supply mismatch is severe and is here to stay. Lead times have been stretched, especially in the global markets, where there is as much as a 3-year wait period.
If I say about our EHV transformers, our manufacturing capacity for EHV transformers is close to about 17 transformers a month. And I am only able to manufacture, let's say, 11 to 12 transformers a month. And this is because of the short supply of raw material to TLR. We have been trying, but if you look at it globally, nobody has expanded, neither the RIP bushing manufacturers, neither the CTC manufacturers, nobody has expanded. They didn't foresee this kind of need for transformers. CRGO, we are also having an issue because a lot of this CRGO is also going into motor building for electric cars.
What industry participants have been forecasting is close to about 20-25% mismatches in demand supply between transformer capacities and demand as on date. And this is after pricing and moderation in demand coming in from the short cycle industrial sector customers. Globally, export capacity and demand supply mismatches they translate into almost 3 years of wait period for transformer requirements for applications such as renewables.
Because of this demand-supply mismatch, the prices of transformers have soared, and so have the margins for most transformer players. For instance, for volt-amp transformers, the operating margin expanded from 14% in FY20 to around 18% in FY25. CG Power 2 saw its overall margin expand from 5% in FY20 to 13% in FY25. So the big question is, for how long will this demand-supply gap persist? How long can these high margins sustain? Well, the demand-supply gap should ideally start narrowing as the raw material shortage gets addressed and as companies ramp up their manufacturing capabilities.
It will narrow down. It will help Indian manufacturers a lot in terms of increasing their capacity.
Okay.
There is going to be a demand-supply gap of close to about 1 lakh MVA per annum.
The next 12 months, we will slowly start to see the demand-supply equation evening out. Until then, companies will continue to enjoy better margins in this business.
As far as valuations are concerned, most companies have seen their multiples come off from recent highs seen in 2024 on account of slowdown in government capex accompanied with a broad-based sell-off in the market. On an average, valuations have corrected over 50% from their recent peak in the second half of 2024. But as investors, I'm sure you're asking, how much is really baked into the price and what should we buy?
Volt-amp followed by Trill is something that we look at because they are specifically manufacturing transformers, whereas Hitachi, GE, as well as Siemens, ABB, or even Schneider, to that matter, they are multi-product companies. So if one product is doing well, other product may or may not do well. That's how things would be. But the more skew would be towards names like Hitachi, GE, and Siemens Energy.
Almost everything is baked in the price. Valuations had topped up a quarter back, and definitely after the recent correction, there is some breather. Valuations continue to remain on the higher end of the band. So most transformer companies today trade still 30 times plus. From the stocks that we cover, CG Power has been among a preferred name. They are doubling capacity and looking for export market also, which was not a part of their portfolio earlier. So that is our top pick in the space.
So what's the takeaway? The transformer industry is booming, but supply shortages are creating challenges. With major investments and new capacity additions, we might see some relief in 2 to 3 years. But one thing is clear, the world is electrifying and transformers will remain critical to this transformation.
Well, and after that electrifying update from Vamakshi, we'll take a short break here on Trading Hour. But just as we do that, here's some good news for our viewers. India's business news leader is now just a click away, and that is, of course, CNBC TV18's all-new app, where you get breaking news, instant articles and financial world updates right at your fingertips. You can download the app from the App Store or the Google Play Store, or even scan the QR code that comes up on your screen to download the app. Take a short break. Back on the other side. Stay tuned.
Investing.
Well, it is the day of expiry, so it is the day of being choppy as well. 50 points lower back on the Nifty now, below that 24,950 mark as we speak. 70 points lower now on the index, in fact. So the bounce that we saw in the last few minutes of trade is now getting sold into. It'll be interesting to see what the final tick comes up to on the index. But Jyotivardhan Jaipuria from Valentis Advisors is now joining in with his top sectoral ideas and his views on the markets as well. Jyoti, good morning. Thank you for joining in. What do you make of this earnings season so far, where if there was a lot of fear that this would also end up being as bad as the third quarter was, but it does appear to be, it may not have been as bad as what the street was fearing.
Yeah, you're right. So, we started the earnings season with very low expectations. So that was a good thing. Because the expectations were low, earnings have actually been better than what the street was expecting. And so it's not like, I would not call it a spectacular earnings season. At the same time, it's not been a disappointing earnings season. On the margin, earnings have, surprised positively. And I think, as we move into the first half of FY26, hopefully we'll see a recovery coming. And this is like the start of some earnings pullback, which we see. We are thinking FY26 should be like a 11 to 12% sort of earning growth for the year.
So far, for the companies that you track, what's been the earnings growth in Q4?
The Nifty earnings growth is roughly coming around 6%, and there's still some companies to come. Some of the small caps which we have in our portfolio, they've been growing at closer to 13%. But those are very select bunch of people, so it's not like a broad base probably representation.
In fact, you've been advocating that even though small caps are not cheap relative to the large caps, it makes sense to buy into the correction. That's been the strategy. So today, what percentage of one's portfolio should be in small caps? And can you share some small cap ideas or themes with us?
Yeah, so Deepa, it all depends on the risk appetite of the person. So, I don't want to say this is what a percentage should be, but what you have to remember is this will be a very volatile segment. It's not exactly a cheap segment even today. So it's not like you're getting in and there's blood on the street. So you should have some allocation to small cap today, because that's where I think over the next 3 years, a bigger earnings growth will come. And so over the 3 years, they'll drive it. At the same time, it will be a very volatile segment. So essentially what you should do is use dips to buy small cap rather than this. And there are like a lot of interesting opportunities we can find in the small cap, which probably, within the engineering space, there are a lot more opportunities in the small cap and the mid cap than you get really in the large cap, because there are niche engineering things right from pipes to transformers to, a lot of other smaller equipment which will do well. There are a lot of ancillaries to the consumer companies which do well, including the auto ancillaries and other people who supply to consumer companies, which you get in the small cap companies. So they trade much cheaper than what the consumer companies trade. And because they supply to not just one, but 3, 4 of these larger players, then you tend to, hedge yourself against somebody gaining market share, somebody losing market share. So I think, there are a lot of niche opportunities which you get in mid and small cap, which probably are not there in the large cap, which one can look at.
If you are asked at this juncture, Jyoti, where are you going to put your money to work, where would you do so? And are there specific segments that you would want to avoid at this point of time?
So, for us, it is where is the risk, where's the reward, and essentially where is too much optimism. We tend to be very, very value conscious. So for us, banks has been one area which we have been investing in, and we continue to invest and like in the space. The other area which we've been nibbling at is the cement sector. Seasonally, they don't do well in the monsoon. So that's really the time to build your position in the cement sector. We think once the monsoons goes away, then probably, cement prices will go up, and the sector's got consolidated quite a bit. The third area we've been focusing a bit on has been the chemical space. So chemicals is something which has got beaten down a lot. The way we see the macro, there was a lot of, destocking happening from at the dealer level. That destocking is now behind us. And so we think that cement volumes will start to pick up and the pricing environment will remain more stable. It's a sector which is still not very, very cheap, but here there are a lot of niche and especially more mid-cap and small-cap companies which have a niche segment where, there's volume growth which is coming and there's pricing environment which is turning better. So these are 3 segments we are looking at. We continue to like the pharma segment, though, there's some concern on what, the US does, what Trump does on the tariffs over there. But that's a segment, again, on every dip which we want to really participate in.
In pharma, would you go with CDMO? That seems to be the favorite now for most.
Yeah, so, we've been very early in the CDMO. We continue to like it. Valuations are no longer cheap over there. But I think, the growth is going to be really tremendous. So probably, most companies in the CDMO will probably double earnings over the next 3 years, unless something really changes on that pharma environment in the US, where, a lot of tariffs come or they put some trade barriers. Otherwise, I think, most companies will probably at least double earnings over the next 3 years. So you have to buy that growth, and we continue to like it.
You mentioned metals in one of your previous answers, Jyoti. There has been fair amount of resilience that China has shown despite the tariffs that have been imposed by the US administration. The industrial profit data that came in this morning was fairly good. Does metals remain a tactical play here? Because there are too many moving parts surrounding the global economy here. So do you stay with this as a tactical play, or do you still find value here?
No, so see, metals, frankly, cement is the place we like, which is more domestic. Metals is very global. So for us, the worry is that the global environment is not great, and, global economy is probably going to slow down this year. So to that extent, we are not very excited about metal as a space. There will be tactical opportunities here because, these things really move quite a bit. So anytime that China really starts to show some growth in the economy, there'll be some tactical plays. But otherwise, metals are something which we generally avoid as a house. We don't really participate in it too much unless we get it at really beaten down valuations, in which case, we think it's good to buy and hold till the cycle, starts to do well.
One final question from mine, Jyoti. You mentioned banks as well, right? But just before I get to that, there have been two themes that have been the talking point in the recent past. Defense has been one of them. And in line with defense, railway stocks have also moved higher after seeing the kind of correction that they had. So a lot of these defense names are at record highs again, be it the shipbuilding companies or names like HAL, which is not at a record high but has recovered substantially from the lows. What do you do in spaces like defense and in railways as well?
So, defense is something which over the course of next 5 years, 10 years, probably all these companies will become much bigger than where they are today. But, given where the current valuation is and given the optimism today is something which, does not fit in our framework. At these valuations, we don't feel comfortable buying it because for us, we want a margin of safety. So, if something goes wrong here, just remember there's practically one buyer only, which is the government of India. And, if orders get deferred or the implementation gets deferred or, companies take time to implement, then, you suddenly start seeing share price corrections and they can be quite volatile. So we prefer buying a lot of these when, there's less optimism around it and the valuations are a little more cheaper.
But so you mean you would wait for a correction before you buy into these defense names, right, Jyoti?
Yeah, I would wait for the correction.
All right, Jyoti, thank you so much for sparing time and joining us today. Looking forward to having you more often on the platform. Jyoti Vardhan Jaipuria there of Valentis Advisors, by the way, continues to remain as choppy can be. At one point we were down 80, now we are down 50. So the bounce, the swings continue on the index, considering the fact that it is the Sensex monthly expiry as well. Olectra Greentech, still the top loser on the Nifty 500, but 6% lower on the stock. And giving it good company is Brainbee Solutions. That too is now down 6% at the lowest point of the day. The top two losers on the Nifty 500. Sagility continues to remain in a 5% lower circuit as well. The OFS opened for non-retail investors today and will open for retail investors in tomorrow's trading session. So a lower circuit for Sagility. Take your leave on this edition of Trading Hour. From Rima, me and the team that put this show together, thank you so much for watching. Halftime report on the other side.
After two sessions of strong gains, stocks consolidate amid global geopolitical uncertainties. IT and financials drag even as realty and industrials eke out gains.
Interglobe Aviation co-founder Rakesh Gangwal sells another 5.7% on Indigo Airlines parent for nearly 12,000 crore rupees. This is the sixth large chunk sold since 2022 via a block and leaves him with under 8% in the carrier.
The promoters of PG Electroplast sell 5.6% stake via block deals, while the parent of Sagility India offers up to 15% equity at a base price of 38 rupees per share to meet the minimum public shareholding norm.
Rajiv Jain, chairman and CIO of GQG Partners, tells CNBC Prime India is the part of the solution in Trump's ambition to rewire global manufacturing. He remains bullish on India and recently added Bharti Airtel and HDFC Bank to his portfolio. You're watching us here on Halftime Report. Good afternoon. I'm Mangalam Malu. With me, Ekta Batra. We started by giving up some of the gains that we saw in yesterday's trading session. Went to the lower end of the range at which the Nifty was seeking support, took support from there, and now we've recovered from those lows. Still about 70 points below yesterday's close, but the good part is the Nifty Bank is mildly in the green, as is the mid-cap index, telling you that this is just a consolidatory phase ahead of the May series expiry. Hi, Ekta.
Hi, Mangalam. Yes, absolutely. So taking a little bit of a breather for the markets at this point in time as we wind down earnings season as well. So we have the Nifty, which is just about lower by around 44 odd points, and the Bank Nifty, which is higher by around 45 odd points. So it's a mixed day, you'd have to say, in terms of the indices, but largely you'd have to say that it's consolidatory in nature. Lot of stocks in focus. So earnings today, we have LIC, Hindustan Copper, NMDC, which are in focus in terms of numbers coming out, and a lot of stocks which are buzzing around either in the back of news as well as numbers. So I'm just going to name a few. KC International, which is buzzing in today's trading session. We have Schneider Electric, which is higher today as well. So that stock should come up for you. And Orchid Pharma, which is under pressure in today's trading session. So a lot happening in the broader markets in terms of specific stocks. But let's, in fact, kick off the show with another company. RateGain has slipped over 8% after the company's FY26 guidance on both growth and margins disappointed. Rima's here with more.
The company's conference call was yesterday, and they're guiding for a 6 to 8% revenue growth for FY26. This is sharply lower than the 12.5% growth that they had in the prior years. And before that, the company was growing at 50-60%. So this is the lowest revenue growth since FY21, its listing. Secondly, even the margin guidance, 15 to 17%, is a sharp drop-off compared to the 21.5% margins that they had in the prior year. And the company said this is on account of increased marketing expenditure to expand into APAC and Middle East. Now, analysts believe what to watch will be any sort of M&A action. The company has been scouting for M&A. So far, they've held back, citing very high valuations. But now analysts believe that considering the growth is slowing down for the company and they have cash of 1290 crore rupees, perhaps an acquisition is going to be imminent. And that's going to be the next trigger to watch. Today, Phillip Capital has downgraded the stock to neutral. Back to you.
Okay, all right, Rima. Thanks very much for that. So that's on RateGain, which is under pressure. Electra Green also is in focus as the Maharashtra government has cancelled the company's e-bus tender worth around nearly 10,000 crores. Hormuz is here with more details on that.
It was a negative development indeed for Electra Green Tech, and the news developments came in from the Maharashtra Transport Minister Pratap Sarnaik, who wrote on his social media account on X that he has ordered officials to cancel the tender that was awarded to Electra Green Tech for these 5,150 electric buses. Of course, he didn't name the company in his post, but it is Electra Green Tech that had received this order from the MSRTC back in 2023. Now, Sarnaik also mentioned that the company has failed to adhere to the delivery timelines that were given for these electric buses. The MSRTC also gave them a revised timeline, according to what the minister said, to deliver 1,000 buses at least by the 22nd of May. But none of those buses were delivered within that timeline by the company. And as a result, the minister has instructed officials to cancel the tender that was awarded to the company. Now, Electra Green Tech had announced in July of 23 that the consortium that it had with Heavy Transport Private Limited has won this LOI from the state government, and the order was valued close to 10,000 crores for a 12-year period. And EVI was supposed to procure those buses from Electra and deliver it over a 24-month period, which is until July of 2025. And Electra, all through this duration of the contract, was supposed to provide operations and maintenance services as well. So as a result of which, now between July of 23, when the company won this order, and until February of 24, the stock gained more than 130%, hit a record high of over 2,200 rupees. And since then, till date, the stock is down almost 45% from those levels. So a negative development indeed for Electra, the stock among the top losers on the Nifty 500 today.
Take that point. Hormas, thanks a lot for that. From the highs, the stock has seen a big gash, as he pointed out. But a couple of other stocks which are under pressure today, both down about 5%. And we had alerted viewers about this in top 10 this morning as well, with Blue Dart and Brainbees. If you look at Blue Dart, the overall revenue growth was just 7%, but that had a bearing on its operational performance. The margins came off by nearly 200 basis points, and that's reflected in a big cut that we saw in the net profit as well, from 77 crores down to around 55 crores. The important part here, the company is blaming, or rather, speaking about this in regard to the weakness that we're seeing in macro environments. They're saying that the last 1 year had a lot of challenges: geopolitical uncertainty, macroeconomic volatility, and sectoral challenges. So it's attributing its underperformance to the overall weakness that we're seeing in the macros. On Brainbees, however, the problem is that the international business isn't firing as well. So on a reported basis, the margins have come off from 2% to about 0.8%. But remember, the company in its own calculation adds the other income part and also has taken off some of the one-offs, and they are saying that the EBITDA, actually the adjusted EBITDA, has grown by 20%. Be that as it may, the India business is the one which is doing well. We have the India business revenue growing higher. We have a mild improvement in the India EBITDA margins as well. But the international verticals of the company, that include the likes of Global Bees and the international business, has seen both a revenue and an EBITDA decline, or rather widening of the EBITDA loss. So that's something which is weakened, and as a result of which the stock is down about 5.5%.
Okay, all right. Thanks very much for that. Well, let's get another stock in. Goldman Sachs has in fact initiated coverage on Varun Beverages. The brokerage believes that the company has multiple drivers to outperform. Nimish is here with more.
Hi, Kaina. This is interesting because if you look at the Varun Beverages stock price in the last few months, it's been underperforming on concerns of competition. But it's an interesting report. Goldman has initiated a buy on Varun Beverage with a target price of 600. And they believe that there are multiple triggers for the stock to outperform in the fast-growing, ready-to-drink market. In fact, Goldman believes that Varun is going to gain market share in some of the fast-growing segments like energy drink as well as hydration. The biggest concern was the new entrant Campa Cola, but BofA believes that their scenario analysis suggests that it's not going to be disruptive for Varun Beverages in terms of growth. So that's the key view there. In fact, they see opportunity in the international business, and BofA expects that profitability for the South Africa business is going to improve over the next few years, and they expect the EBITDA margins to improve from 10% to 17% by 27. Valuation-wise, it's at 40 times on FY27 EPS and below the median versus the peers. So that's the reason why initiating buy on Varun Beverage with a target price of 600 by Goldman Sachs.
Right, that is about Varun Beverages, higher in today's trading session, rather outperforming all the other stocks that we're seeing as well. But tell you what, we're very excited to unveil our brand new global business news channel. It's called the all-new CNBC-TV18 Prime. This brings you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset and Global Lens at 8:30 p.m. weeknights. Well, interesting consolidation is what we're seeing in the frontline indices, and as you see the advance decline lines come up for you, the advances have begun to outnumber the decliners. So for most part of the day, we had the crisscross lines fairly, in favor of declines, and now they have intersected, and we have around 1,400 stocks which are advancing for about 1,100 stocks which are declining. And that brings us perfectly up to speed with what the F&O setup for the day is. The indices are off lows. We have the Nifty, which is now just about 40 points lower. At one point, it was about 200 points lower. We have the Nifty Bank, which is in the green, and we have the mid-cap index, which is firmly in the green as well. And if you look at yesterday's high and today's low, that tells you about what the street is feeling about the range. Yesterday's high on the Nifty was 25,079. And today's low was 24,737. We've been talking about this broad range of 24,750 at the lower level to about 25,100 at the higher level. That's what the Nifty is doing. And for the Nifty Bank, the range is slightly broader. We have 55,000 at the lower level, which is the 20-day moving average. And as we move towards 56,000, which is the previous all-time high of the Nifty Bank, we begin to see some supply. Today's recovery has been led by some of these index heavyweights, and the intraday charts also would tell you the story. Reliance is still lower, ICICI Bank is still lower, but we've seen recovery from lows. HDFC Bank has moved into the green, and we're also seeing some purchase in names like Bharti Airtel and ITC. Both of them are fair weights on the frontline index. As far as the Nifty is concerned, 24,800 now seems to be a bit of a fulcrum for the expiry tomorrow, where a day after tomorrow, that is. 150 rupees in premium for the 24,850 put, and we have the 24,800 call, which too comes up for you about 300 rupees in terms of premium. What does this tell you? Well, it just confirms the range. We have 24,650 at the lower level as a support, and on the way up, 25,100 and thereabouts, it will be the supply, and that's what is something that we can see through the 24,900 call as well. So we're likely to be in a range, not moving around too much beyond this 500-point range that we're seeing on the Nifty, and that's exactly what the street has positioned itself for.
Okay, all right. We'll take a short break on that note, but up next, we'll connect with the management of Afcon's Infra to discuss their Q4 performance. Stay tuned. Welcome back. Well, quiet day for the frontline indices, but just watch out for IndusInd Bank, which is showing an up move. So that stock is up around 3% Asian Paints, Adani Enterprises, State Bank of India. All of these stocks are showing some amount of traction, but IndusInd is really leading the way with around a 3% gain. On the downside, Ultratech, NTPC, Grasim, HDFC Life, All of these stocks are down anywhere between 1% to close to 2% at this point. But let's get talking to one particular company. Afcon's Infra reported what was a muted said. Revenue and EBITDA margins came under pressure, but the company expects to deliver consistent, sustained top-line growth while maintaining a sturdy margin profile. That's the FY26 guidance. To discuss this, we have with us Mr. Srinivasan, who's the MD at the company, here to talk about the numbers. Mr. Srinivasan, welcome to the show. Well, for FY25, you had indicated, a top line which would be flat to slightly positive. You've missed it. It's fallen 4%, your revenues. What led to this decline, and what's taking place? Is there a slower execution?
Good afternoon. And as you had rightly stated, we had explained flat. And as against that, we had a 4.6% decline. Predominantly, it has to do with the two particular segments. One is due to the geopolitical situation. Bangladesh, there was a significant reduction of, say, about 600 crores in terms of turnover. Few months work could not happen there. And similarly, in Jal Jeevan Mission, there have been delays in terms of payment, and which resulted in our inability to do the work when multiple months payments are not forthcoming. There was a slowdown. That was another impact. Both put together, we had a significant drop of 4.6%. I must say, over a period of last 10 years, on our internal guidance, this is the second year after for COVID year was the first year. This is the second year on which we missed our guidance.
So in that case, just a two-part question, Mr. Srinivasan. What is it that you are targeting for FY26? Has the situation improved a little bit? And what is your order inflow and L1 position guidance?
In terms of our order inflow for the last year, it was around 16,000 crores, which was one of the highest in the history of Afcons. Apart from that, we have 10,600 crores of L1 jobs, which again conversion got delayed. We are in the process. We are hopeful of getting this in Q1. And apart from that, we are expecting to book an additional 20 to 25,000 crores of order book in the current year. So 10,600 crores of L1, which will get converted hopefully in the first quarter, plus 20 to 25,000 crore is our fresh order book. So taking together about 30 to 35,000 crore is the order book guidance for the current year.
New growth, we didn't get that because you said that you saw a decline last year.
In terms of revenue, we will have 20 to 25% growth.
Okay, 20 to 25.
From the previous year, 20 to 25%. While our long-term CAGR could be at 15%, and current year it could be 20 to 25% growth over the previous year.
Okay, 20 to 25% growth
Yes.
over the previous year. This L1 of around 10,600 odd crores, does it include any orders from the Middle East that you're bidding for?
No, all these are domestic.
Is there a large Middle East order that you're L1 on separately?
No, we are currently bidding. It is not we are L1 or anything. There's a large Middle Eastern order where we are already pre-qualified and we are bidding.
When you say large, what is it? What is the size? What is the nature of the project? When do you get to know?
It's a Dubai municipality project. It is something which it could be around $5+ billion, where we are the majority holder, where we are not the leaders. We have taken a local company as the leader. We have a 47% stake over that.
So that means
it's a
that
joint venture.
So this would be a near $2.5 billion project for you if you win it. You are in the bidding stage. Do you have any sense on the timelines of this? By when will you get to know whether you are L1 here? By when does it close?
While the Dubai government talks about Q3 of the current financial year, I would personally feel Q4 of the current year.
Q4 of the current year.
So it takes its time.
And this 25,000 crore order inflow guidance that you have given is not contingent on you winning this order, right?
You are right.
So basically this year you get 35,000 crores of orders. You have a 30,000 crore order book already. And if this were to materialize, this would add another $2.5 billion to your order book, which roughly equates to, roughly equates to about 20,000 crores.
Yes.
This could be a game changer, you said. So what would be the potential revenue addition that you could see? How many companies are already bidding for this order?
No, here they're going through a concessioner route, and we are not the concessioners. We are only the EPC contractors. There are 3 bidders who are pre-qualified as concessioner for 2 packages. So out of that, whichever concessioner wins, we are tied up with 1 concessioner. So that concessioner, if he wins, the job will come to us.
So it's a multi-year order.
Yes.
So when will the revenue start accruing, and what do you think it could take your P&L to?
I think it's too premature to comment where we have not even submitted the bid.
Right. Typically in orders like this, what is the kind of margin that you enjoy? Let's put it that way. If you were
Typically,
to win,
our guidance has always been 11+% EBITDA. That is what we have always gated. And it would continue to be like that.
And this order is pretty much in that range itself, right?
It could be. If we get the order, we are in the bidding stage, that we must remember.
Correct.
Mr. Srinivasan, just we're not trying to, veer the street in a certain direction by your commentary, etc. But what is your hit rate in orders like this in the past been? Because it is a game changer. Chances are that it might not happen as well, right?
Correct.
What is your personal expectation from this? What does, what kind of inkling does one get?
No, typically in very, very focused high value jobs, our hit ratio is in the region of about 40 to 50%. So on the otherwise, typical our hit ratio over last several years is about 25%. Therefore, I am not in a position to clearly say how it stands, because being a big order, there will be a lot of focus by many. Therefore, till such time we get it in hand, we can say nothing about it.
You've executed orders like this before?
Not of this size, but when we were at a smaller scale, we had looked at some bigger project like $500 million, $600 million, $700 million, all these, we are either executing or executed.
Okay. And when do you get to know about this order win? The entire...
Last quarter of the current financial year.
By Q4 of FY26.
Yes.
And do you have the capacity as a company to actually execute 30,000 crores in India as well as a potential $5 billion order win in Dubai? Do you have that capacity as a company, or do you need to increase your capacity, which we will probably do in the next 3 quarters?
And if you look at it on an average last 20 years, if you look at it, we have a CAGR of about 16 to 18%. So on a consistent basis, we have been consolidating our base and improving thereupon. Therefore, we believe as needed, the organization can scale up. Of course, there is need for consolidating the base and then strengthening the whole organizational setup. And we will do it as needed. That we have consistently improved. Otherwise, probably we are the only company to have about 16 to 18% CAGR over a 20-year time frame. No other company from India can really boast of that kind of setup.
We understand that point and we take on board all that you are speaking about. But you started this conversation by saying that there were some pressures when it came to them releasing some sort of money, right? On the one hand, you are winning a lot of orders and you are focusing on executing them. But on the other, clients are not, as easy with parting with their money to you. Is there a pressure on working capital, and because of you winning so many orders, do you think you'll have to take a little more loans?
That's a temporary phenomena what we find. As we said, there were 2 major events last year. One is Bangladesh, another is Jal Jeevan Mission. And we typically in our projects, we have never faced receivable issues. But last year was an exception where everywhere by March, all payments get cleared.
Right.
But last year, it was not cleared for some reason or the other. And it was an exceptional year. It is not a norm. The norm is typically we get payments on time, and we have a robust risk management framework which takes care of all these payment related issues right at the beginning. Therefore,
so what are your receivables right now?
Our receivables right now is in the region of about 64 days or so, out of which 30+ days is in the region of normal this thing, our monthly billing, which comes in the next month.
Okay. All right, Mr. Srinivasan, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Afcon's infra. Let's see, it's probably going to be a momentous year for the company if in case they do get that order worth around $5 billion that they are bidding for for the Dubai municipality. It's via JB where they have around 47%. The stock is up around 1% today, but if you look at it on a year-to-date basis, it's been an underperformer, down over close to 20% this year. We'll take a short break, but Sameet Chavan will join in to tell us some of his trading strategies.
Welcome back. Recovery from the lows is what we've seen, but at the same time, supply at the higher levels as well, all along pointing towards consolidation. As you see, from the highs, Nifty is down about 100 points today, but from the lows, it's higher as well. Sameet Chavan joins in now. Sameet, we've been talking about this 24,750 to 25,050 to 25,100 sort of range on the frontline index. Do you concur with that range for the next couple of days? And if yes, what are your trading strategies likely to be?
In fact, this range has broadened a bit, wherein on the higher side, we are clearly seeing, supply coming in around 25,100, 25,200. And on the low side, there's a strong support around, 24,500. So till the time, Nifty does not breach below 24,500 on a closing basis, there is no reason to worry for. So clearly, it's a, buy around the support levels and sell around the, important resistance levels. That's kind of strategy one should adapt in such kind of market. At least momentum traders should. Directional traders, should keep a close eye on 24,500 on a closing basis till the time it is not breached. One should continue with a positive bias. As long as the individual stock ideas are concerned, we like Tata Chemical. After a long time, it seems that the stock is likely to come out of its, recent slumber phase. It has already traversed its 89-day exponential moving average, and the kind of volume participation that we have been seeing since the last few days, it suggests that the stock is likely to do well over the next few trading sessions. We like first target of 955 as a trader. One can buy with a stop around around 868. And as a disclosure, we have recommended this to our clients as well. The second buy would be on Container Corp. On the daily time frame charts, we can clearly see a higher highs, higher lows. The volume participation has increased in last 6 to 7 trading sessions. So we expect the stock heading towards 790 over the next few days. As a trader, one should keep a stop around 728.
Okay, all right, Samit. We're going to leave it on that note. Thanks very much for joining in. So those are some technical calls. But let's move on. International mutual funds are delivering some of the best returns right now. But most Indian investors can't ride the wave. Sources tell CNBC-TV18 that discussions are underway between RBI, SEBI and fund houses to raise the cap on overseas investments. The limit was breached 2 years ago, locking Indian MF investors out of this huge opportunity. Shivani Bajaj gets you more on this story. Shivani.
International funds have delivered the kind of returns investors chase, double-digit global exposure and also portfolio diversification. But Indian investors have largely missed it out. Even as international mutual funds surge ahead, most Indian fund houses remain barred from accepting fresh inflows into the global scheme. The reason? A regulatory cap. Indian mutual funds can only invest up to $7 billion overseas, while ETFs are limited to $1 billion. That cap was hit in early 2022 and it hasn't budged since. Now, sources tell CNBC-TV18 that RBI, SEBI and fund houses are in continuous discussions about raising these limits. And this discussion is coming at a time when global funds are not just recovering, but outperforming their benchmarks. In April 2025 alone, international mutual funds delivered average returns of 8.51%, making them the top performing category according to Value Research. Zoom out to the last 12 months and the rally looks even stronger. Look at some of the funds. Mirai Asset Hang Seng Tech ETF FOF up 61%. Mirai Asset's another fund. NYSE FANG Plus ETF is up 41%. Another fund, Nippon India ETF Hang Seng Bees is up 32%. Invesco's India Global Consumer Trends FOF is up 25%. But it's not just about the past year. Even in the first quarter of 2025, international funds comfortably beat the broader Indian market. Look at some of the numbers. DSP World Gold Fund 31% and its benchmark has delivered 37% globally. Mirai Asset's Hang Seng Tech ETF FOF is up 25%. Similarly, ICICI Pru's Strategic Metal and Energy FOF is up 21%. And Nippon India ETF Hang Seng Bees is up 15%. So all of these funds, including those investing in Brazil, look at HSBC Brazil Fund, 15.12% in a quarter, beating the benchmark. Compare all of this to BSE 500 TRI, which posted minus 4.39% over the same quarter. So the opportunity is clear. Despite delivering some of the strongest returns in the market, most of these funds remain close to Indian investors. Now, why are the fund houses wanting a cap revision? This cap was last revised in 2008. Mutual fund industry AUM has grown 10x since that time. Investor appetite for global exposure is rising, and global themes from AI to clean energy to precious metals are gaining traction. For now, fund houses are waiting on the RBI to signal a change, because while the world's markets open up, Indian investors remain in a regulatory lockdown, and the cost of missing out is growing with every quarter. Back to you.
All right, with that, we'll slip into a short break. Come back at you more of the markets and stock-specific action on the other side.
Welcome back. Well, there is some amount of pressure which is seeping into the markets now. So the Nifty is down around 141 odd points, down 0.5%. We have the Sensex, which has lost over 500 odd points. So there's a sudden decline which has taken place in the markets just in the past couple of minutes. If you want to just talk about, you know, a couple of the losers at this point in time, there is exaggerated losses which have come in to a couple of the frontline stocks which have already been on a losing streak. So Ultratech Cement is now down over 2 odd %. NTPC is down around 1.6%. Grasim, BPCL, JSW Steel, all of these stocks are down anywhere between 1% to close to 2 odd %. Joining the list has to be a couple of stocks from the auto space. So Eicher Motors, for example, has slipped into the red. Bharti Airtel, Apollo Hospitals, all of these stocks are now trading in the red as we speak. So just watch out for it, because the mid-cap index also looks quite precarious at this point in time. Just about higher by around 80 odd points. Seems like it's going to probably slip into the red as we speak. But on our new show, The Global Reset on CNBC-TV18 Prime, our colleague Prashant Nair caught up with Rajiv Jain of GQG Partners, which is the largest foreign institutional investor in India. Rajiv believes India isn't a proxy play, it is the real deal. Also adds that the foreign flow drought may break if large caps lead the way. Here's a slice of that conversation.
See, if you look at Vietnam, Vietnam obviously is playing the same playbook that has worked very well for East Asia in general. So Japan was the first one after the Second World War, then Korea, Taiwan, Singapore, Malaysia to a little bit till late 90s, early 2000s, till China came along, and obviously China. And India and Vietnam more recently. I think India is slightly different. While India is trying to get the manufacturing side, and I think they have succeeded in a quite remarkable manner, by the way. It's quite remarkable how fast they've been able to, with the right policy mix, to attract manufacturing base, because that helped China tremendously to incentivize and attract these large sophisticated manufacturers. I do feel that India is part of the solution from a US context. Particularly if you look at Vietnam. Vietnam has kind of become they do a lot on their own, but it's also become a transshipment hub, which the US Trade Representative talked about a number of times, which is why we feel that Vietnam would not be sort of scot-free because it is a big transshipment hub. And hence if you look at the 46% that was announced, was higher than a lot of other countries. Second thing is Vietnam also a big current account surplus. So our framework is as following. We feel that we have to look at countries that have that don't have huge current account surpluses. Countries that have huge surpluses with the US are far more vulnerable. And Vietnam fits the bill, so does Korea and Taiwan. India doesn't have a huge surplus, which means it also shows that it's a huge domestic economy. So we feel from our vantage point, India should be a net beneficiary. There'll be hiccups. There'll be 2 steps forward, 1 step back. But I think direction is clear. India would be on the positive side. Actually, Brazil would be, and Indonesia would be too, versus, let's say, Vietnam or others.
So it's quite interesting. You're saying you've already this year, this calendar year, put in about $2 billion new money to work in India, right?
Yes.
And just to sort of, for our viewers, you bought into Bharti in a big way. I think that's a newer bet, Rajiv. And I think one name which we discussed in a very different context the last time we spoke, HDFC Bank. I remember you telling me that you've been, you held that stock for years. I mean, long back. And then, of course, you didn't own it for a long period of time. You didn't have it last year. This is, in that sense, a new addition. You want to talk to us about that, Rajiv?
Yes, so HDFC Bank, we thought was going through a sort of integration transition period as such between the two, HDFC and HDFC Bank. So since last September or thereabouts, last quarter last year till first quarter, we put almost $2 billion in HDFC Bank. And Bharti we started buying early last year, and then we've doubled down again this year. We've added a little bit to some of the other names too, nothing meaningful, but they're like a few $100 million here and there, nothing meaningful. So these are the 2 big positions. The other ones we quite like. I mean, you have public information on that. So because we're still very bullish on the utility/infra type assets, we still like real estate. So and what's interesting, we feel this time around is that seems like, and for good reason, the rally seems to be led far more by large cap than mid cap. Mid cap are fine, but the valuation is less supported than a large cap, and large caps are now transitioning from they've digested last few years for different reasons. And a couple other names, by the way, we just started, we recently initiated, so we are active, we can't talk about those. Again, large cap. So we feel that the large cap space looks fairly interesting, actually.
Just one question, Rajiv. You know, since the top last year on the Nifty in September, late September, I mean, foreigners sold about $25 billion worth of stock. And of course, they've turned buyers now. I mean, my question is, what was that? Was that just purely driven by valuations? I mean, was it some other considerations at play, money moving out of EMs into DMs, that kind of thing? And do you think now flows will be much steadier here, foreign flows, in your opinion?
So look, I mean, nobody knows for sure, right? Because there are tens of thousands of investors, so who knows? In my opinion, there's one aspect which may be impacting more flows. So if you look at global emerging markets as such, that asset class in general has been under tremendous pressure. So we are kind of a little bit odd that we are generally seeing inflows. Most of the emerging market shops are seeing outflows. Okay. They are the most obvious buyers of India. If you look at global managers, global funds, again, we have exposure in global also. Most of the folks do not have that much exposure. So you kind of have a scenario where the emerging market managers are struggling. Look, if you look at EM indices, the indices have not gone anywhere, broad EM, emerging market indices, for 12, 13 years now. I mean, they peaked in 2010, 11, depending which market look at. And so the biggest buyers have no longer buyers. In fact, they're sellers because they're seeing own redemption their own side. If you look at global manager, they're not engaged. And I think that is part of the issue. So you have kind of in a no man's territory. And that might change, by the way. So if large cap do well, I think foreign money should come back. Again, look, from our perspective, it's neither here nor there. It's sort of an interesting statistic more than anything. But I think my feeling is that if large cap begin to do well, you will see more traction, more inflow than not.
Interesting conversation. We'll get you excerpts of that all day today on CNBC TV 18. With that, what we'll do is take a short break. On the other side, Manisha Gupta joins in with Peter Maguire, CEO, Trading.com. Stay with us. Welcome back. You're watching us here on Halftime Report. Yesterday, even as the markets were going higher, we were pointing out that the India VIX is rising, which told you that there is volatility which is on the cards. And today as well, as we recovered from the lows, what moved higher was the India VIX. As we speak, closer to 19, telling you that, rallies are not sustainable, but at the, same time, low level, we are seeing some purchase. So between this range, we will see the market move on and off. A couple of mid-caps doing a lot better. We have CCL Products, which has spiked up once again, taking this month's gain on the stock to about 46%. So an 8% up move is what we've seen on CCL Products. Good numbers coming in, but higher coffee prices means better revenues. But they, again, have a fixed EBITDA that they get per unit of coffee that they make and supply to all the global brands. But speaking about coffee, speaking about commodities, we have Manisha with us. Manisha, coffee.
Oh, well, yes. After this show, Mangalam, for sure. But right now, we are also joined by Peter McGuire. He's CEO at trading.com. Peter, hi. We're talking about coffee, which the prices have been surging, and so have been the coffee shares I've been looking at. But what has also seen some better moves clearly has been platinum within the overall precious metals. So gold, after that all-time high, seems to be trading in a range. Silver prices, do try to break from that recent range that we've created, but haven't been able to do that. Platinum, in the meanwhile, has done quite well. How are you looking at overall precious metals right now? Would you say that now we're getting stuck in a range? A major trigger is perhaps what the market is waiting for.
Well, good afternoon, Manisha. I mean, there's so many components that make up the storyline as far as gold and precious over this year. We're nearly at the end of 5 months in. We've seen a dramatic move to the upside, and now it's taking a little bit of that heat has come out. There's no doubt. I mean, when you're seeing platinum's been nearly to the point of parabolic over the last probably the last, say, 4 to 5 weeks, really strong growth. And that, I think, has hit everyone by a little bit of a surprise. That's where a lot of smart money has really traded, certainly on the futures of platinum. So at the moment, I think that it will continue to have that nice uplift, but one's got to be very mindful. What's happening as far as bond rates, what's happening as far as US dollar, and the talk of tariff, which certainly hasn't been put to bed at all.
Most people, including Trump, seem to be believing that weaker dollar perhaps is better for an economy there. We're trading below 99 at this point in time. What's your sense on the dollar index, and how are you looking at the other crosses?
Well, it's 99, Manisha. I think, do we see a rate cut in this quarter? And I don't know whether that will materialise, considering we've only a month to go until the end of June. So it's going to be a summer rate cut if that's where Fed Chair Powell decides that's what he wants to see. So you would think that there would be a fair bit of that softness as far as US dollar, one would think, would continue, maybe a 98, 98.20 handle. And it seems to be in a downdraft at the moment. So that's where the focus is, what's happening as far as US dollar, and are we going to see some further sell-off, as far as bond rates rising and so on.
Peter, how have you also seen the euro? Because with this tariff on and tariff off and deferred tariff, the euro also has been quite volatile.
Absolutely. I mean, when you think about it, Manisha, we're nearly at 114. So there's every chance you could see a 115 handle, I think, by the end of the week. Maybe a little bit bullish, but I certainly think 114 is going to be taken out very quickly. So the overall momentum is going to be stronger euro. That's where all the focus is. We understand the storyline that Saturday our time was, we were going to see a 1st of June kickoff as far as tariffs of 50%. Now, that's been pushed back to the 9th of July, as we know. We understand Ursula von der Leyen, her thoughts and processes, and it's all about negotiation. So let's see if they can stack a deal together. And but I think there's going to be a lot of volatility between now and that point.
Peter, sell dollar is one trade that we understand. What do you see another pair trade with that? Is it going to be buy euro, Australian dollar? We've seen some moves come back in Japanese yen as well. So what are you looking at, the cross-currency trade there?
Well, yen's a nice one. I mean, you've got to be conscious, but I'm certainly concerned as far as what's happening there on the Japanese front as far as bond yields, Manisha. If you're looking at it as a currency trade, I think anything against the US dollar, keeping a close eye. Swiss franc's been a great trade. The Aussie's had a big run up already. It's up from 58 to 64.5, nearly, that 65 sort of, we're knocking on the door. So I'm more focused as far as euro. I want to see what happens, and I think that's where, and don't take your eyes off the pound as far as pound dollar. So, yeah, there's still plenty of enjoyment and plenty of dollars to be made out of currency trading at the moment.
Sure is. Peter, how are you also looking at the base metal prices right now? Because here, yet again, it is about geopolitical tensions. We've seen inventory rise. Electrification is a demand that we will continue to see demand coming in from. Within the metal space, are you picking up a strong trade right now?
Well, Manisha, when you're looking at copper, it's back at 9,600 on the LME, and that's been bid up strongly. So all of those industrial metals are nice. I got iron ore running at 100. So there's no spark there. If it was 130, 140, it'd be a different matter. But keep a close eye on some of those base metals, or the industrial metals, I should say. And there's probably every chance you could see 10,000 for copper over this summer period. So, yeah, I think that's where the general momentum is. More bullish than bearish.
All right. Peter, you've been a regular visitor for many years for many of these OPEC meetings. Now, there's another one coming in. And the dates tend to change very quickly, right? The 8 OPEC plus members are meeting on 31st, and the rest of the OPEC and allies are meeting on 1st of June. So there's just plenty of meetings there and statements that continue to come in. How are you looking at the production increase and your sense on July output?
Well, Manisha, I take on board, I want to put my mind back to 2 weeks ago when President Trump spent considerable time in Saudi and then with the UAE and just across the water from you guys and then into Doha. So the MBS situation is going to be, I think, more increased. They're really concerned as far as compliance from some of those smaller producers. And the overall theme is going to be get the production up. I feel as though you're going to see a continued softness as far as crude prices if there's no geopolitical, outliers that come to play. But yeah, the overall momentum at the moment is going to be more bearish than bullish, I think, for the energy sector.
That goes for gas as well, where we're not looking at too much of demand right now. But going forward, it's going to be about the Atlantic hurricane season. And then, of course, inventory increase before winter sets in. So how soon do you see that happen? And where do you see natural gas prices, let's say, for the next couple of months and then for the second half?
Well, you know as well as I do. I mean, when you're thinking about the hurricane season, that's probably, we're still about a month and a half to 2 months from that really starting to kick off. And it doesn't get its full steam until really September. I think that's the middle of the season. So I'm conscious as far as nat gas. I feel as though, again, if you see something ratchet up as far as hurricanes and all of those Mother Nature impacts, you're going to see volatility. But at the present time, I wouldn't be surprised to see that nat gas price just take a little bit more softness to the downside, and that's the overall theme. I'm keeping an eye on what's happening at OPEC, Manisha. I mean, we're in a very different world now than what we were going back 3 weeks ago, considering the I think a unification between MBS and President Trump.
That point, the unification between MBS and Trump. Thank you, Peter, for joining in and always, giving us a great amount of insights. What we'll do is we'll wrap up on this edition of Halftime Report today. Come back on the other hand, on the other side, rather, we have Business Lunch taking all the market action forward.
After 2 sessions of strong gains, stocks consolidate amid global geopolitical uncertainties. IT and financials drag, even as realty and industrials eke out gains. Interglobe Aviation co-founder Rakesh Gangwal sells another 5.7% in Indigo Airlines parent for near 12,000 crore rupees. This is the 6th largest chunk sold since 2022 via block deals and leaves him with under 8% in the carrier. The promoters of PG Electroplast sell 5.6% via block deals, while the parent of Sagility India offers up to 15% equity at a base price of Rs 38 per share to meet the minimum public holding norm. Rajiv Jain, chairman and CIO of GQG Partners, tells CNBC Prime India that India is a part of the solution in Trump's ambition to rewire global manufacturing. He remains bullish on India and recently added Bharti Airtel and HDFC Bank to his portfolio. Hello, good afternoon. You've tuned into Business Lunch, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in, as always. And like in the headlines I mentioned as well, last couple of days we saw a bit of a gain coming in for the markets, but today that doesn't seem to be the story. As of now, Nifty is trading in the red as well. So yes, Nifty trading at 24,805 is what we're watching out for. Went up in the green. We saw a sudden spike up there, and then again it's fallen down. As of now, down 0.8% in today's trading session. Nifty Bank, that is also seeing a bit of a red coming in on the screen today as well. So nothing exciting happening on the Nifty Bank front. As of now, down 0.3%. Now the broader end of the market today, what we're seeing, the mid and the small cap, some bit of a green is coming in there, some bit of a respite, at least on the broader end of the market. Mid cap holding on to gains of almost just near 0.1%. Small cap is 0.2% of gain. That's also off slight bit from the day's highest point. IT autos continues to be the big drag coming in for the market. So that's in terms of the sectors and how the market setup is looking like today. But a stock that we're keeping an eye out on today is Indigo. Now, why? Rakesh Gangwal, as a part of his planned equity sale in Indigo, sold another chunk of his stake today, with nearly 6% equity being exchanged in a deal worth 12,000 crore rupees. Nimesh is here to tell us how the Gangwal family's stake sale strategy has played out until now. Nimesh, over to you.
Well, who says that it's difficult to make money in an aviation stock, and who says that, when a promoter sells, it's negative? Both these logics were defied by Gangwal family. So, in fact, in the last 3 years, since September of 2022, the Gangwal family has sold stake in Indigo and has raised 40,000 crores. That is $4.7 billion. That's the number. $4.7 billion is what Rakesh Gangwal has already raised by selling majority of the stake in Indigo in the last 3 years. So that's the number, 40,000 crores, which is equivalent to $4.7 billion. If you look at the history of the Gangwal family, they started selling stake from 2020 to September after the big rift with the other promoters. So they were the co-promoters in Indigo for a very long period of time. So currently they own still 7.8% after today's block deal as well, which is equivalent to 16,000 crores. So if you add to that 40,000 crore, they will raise more than 55,000 crores as and when they sell the remaining stake as well. But it's been a good history of the Gangwal family selling stake in Indigo since September of 2022. So this was the first block. It happened at an average price of 1927. And at that point in time, they sold a small stake and raised close to 2,400 crores, nearly 2,500 crores, which was on September 11, 2022. So that was the first block which the Gangwal family sold into. And after that, there has been a periodical 5 months or 150 days of lockup, and they've sold further. Next block came in February of 2023. Again, they sold 4% stake and raised at an average price of 1882, and they raised close to 3,000 crores. This was the only block which happened at discount to the previous block. So that was the second block that happened in 2023. Another 150 days, and there was another block. That was in August of 2023. They sold another close to 4% stake and raised close to 4,238 crores at an average price of 2,454. So again, a premium to the last block that they did in 2023. The next block came exactly after 150 days of lockup. That was in March of 2024. Again, the Gangwal family sold 5.8% stake in the company at an average price of 2,342 and raised 7,300, almost 7,300 crores. That was again a big block that they did in March of 2024. Again, 150 days of cool-off, and they saw a next block coming in August 29th, 2024. And that point in time, the combined holding that they sold was close to 5.8% stake, and they raised 10,700 crores from that block as well at an average price of 4,759 per share. So that again was in last year. Now, after another 5 months of lockup, post the earnings of this quarter as well, they've sold another 5.7% stake via block deal. And there they've raised close to 11,928 crores. So that's close to $2 billion that they've raised by selling stake in the fresh sale as well. And this has happened at an average price of 5,250. I'm giving these prices because if you look at the trend of what I've showed, every block has happened at a 10 to 15, 20, 30% premium to the previous block deals. Now, as I said, they still own close to 7.5% stake, which is worth 16,000 crores. So even at this price, if they sell out, they will raise close to 56,000 crores by selling out their entire stake in Indigo. So this has been a fascinating journey, and what an investor he has been, periodically selling out at a premium in Indigo.
Absolutely, Nimesh. This is very interesting in terms of over the years how they've sold stake as well, and they've actually made money. Like you started the link also, why do you believe that aviation stocks don't make you money? This is a story that's defying that as well. So thank you so much for that, Nimesh. But let's move on to some of these other stocks that are in focus today as well, which are buzzing in trade. Vamakshi is here to list down the stocks for us. Afternoon, Vamakshi.
Good afternoon, Mani. Let me first start off with India Pesticides. The stock is seeing a very sharp uptick after the company reported its numbers. The revenue saw an uptick of almost 64%. The margins have improved from 3% to 15%, and resultantly, the company's net profit is seeing an uptick of almost 22 times. That explains the kind of move that we're seeing on this counter. Bayer Crop Science is another stock from the agrochemical space that is doing quite well. Revenue seeing an uptick of almost 32%, driven by strong performance in spring corn and double-digit liquidation growth in the crop protection portfolio. The margins too have improved here to 16.3%, and the net profit has seen a good surge of almost 50%. Schneider Electric is the next counter we're watching out for. The stock has seen a good uptick this time around. Revenue saw an uptick of almost 24%. This is the highest revenue growth that we've seen since the third quarter of FY24. The margins are down by almost 75 basis points to 14.8%, but the net profit has come in much higher. Keep in mind that in the base quarter there was some tax-related adjustments that did impact the net profit that time around, and that is why we're seeing a very sharp spike in the net profit. Brainbees, on the other hand, reported a rather weak set of numbers. Revenue was up almost 16%, but the company's margins shrunk to only 0.8%, and they've in fact managed to report a loss of almost 111 crore rupees. This is much wider as compared to the loss that they reported in the same quarter last year. Keep an eye out on Electra Green Tech lastly, because the Maharashtra government has cancelled orders of e-buses worth almost 10,000 crores. It doesn't bode well for the stock.
Okay, Vamakshi, thank you so much for that. Keep an eye out on all the stocks that are buzzing in trade on the back of news flows. But earlier today, we had Sridhar Shivaram, who is of Enam Holdings, in our studio. He spoke about the policy expectation from the RBI, the state of Indian markets, as well as his top picks. Listen in.
So we are entering a phase, I would say a golden phase of inflation. I mean, next 9 months, we could see average of 2.5–3% inflation. RBI is going to significantly bring down the inflation forecast when they announce their policy on June 5th. When they announce, obviously, there'll be more credibility, but we are entering a phase. So what will happen is we could see a 50 basis points rate cut in June itself. I mean, these are, my and our predictions. We could go wrong, but based on the numbers that we are seeing, this is how we are seeing. We need support globally. If Fed doesn't cut interest rates, there's only that much that India can cut. If we get support globally, we could see 100 basis points of rate cut. Could be in a golden phase, at least for the next 9 months in terms of inflation, which is what people look at. I mean, and inflation directly affects stock markets. If this plays out well, then what I'm saying that in the next 6 months or 9 months could be a consolidation phase, which can then build into the next bull market. I mean, earnings have to follow through. So you take baby steps right now and build your portfolio for what comes in the next 9 months. We are very bullish on the power equipment space. So if you see, it's a global theme actually. So if you see India will possibly double its solar and possibly double its wind, we may add 60, 70 gigawatts of even thermal. When you get so much of power which comes into the system, it has to be evacuated. So I think the entire value chain will play out. So if you think our markets will give 15% CAGR returns, say over a longer period, obviously it's cyclical, you cannot predict on a year-to-year basis, and you think that at least 10% volume growth, then the mutual funds and the wealth advisors, if you plot them ahead, say if you look at them for today's earnings, it will look expensive, but if you plot say 5 years ahead, then it starts to look interesting.
Okay, on that note, we're going to sip into a very short break. But before we sip into the break, we are excited to unveil our brand new global business news channel, the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset and Global Lens at 8:30 p.m. Welcome back to Business Lunch on CNBC TV18. Now let's move on. And international mutual funds are delivering some of the best returns right now, but most Indian investors can't ride the wave. Sources tell CNBC TV18 that discussions are underway between RBI, SEBI and fund houses to raise the cap on overseas investments. The limit was breached 2 years ago, locking Indian mutual fund investors out of a huge opportunity that came in from international mutual funds. Let's go across to Shivani is joining in with us to give us more on this story. Shivani.
International funds have delivered the kind of returns investors chase, double-digit global exposure and also portfolio diversification. But Indian investors have largely missed it out. Even as international mutual funds surge ahead, most Indian fund houses remain barred from accepting fresh inflows into the global scheme. The reason? A regulatory cap. Indian mutual funds can only invest up to $7 billion overseas, while ETFs are limited to $1 billion. That cap was hit in early 2022 and it hasn't budged since. Now, sources tell CNBC TV18 that RBI, SEBI and fund houses are in continuous discussions about raising these limits. And this discussion is coming at a time when global funds are not just recovering, but outperforming their benchmarks. In April 2025 alone, international mutual funds delivered average returns of 8.51%, making them the top performing category according to Value Research. Zoom out to the last 12 months and the rally looks even stronger. Look at some of the funds. Mirai Asset, Hang Seng Tech ETF, FOF up 61%. Mirai Asset's another fund, NYSE FANG Plus ETF is up 41%. Another fund, Nippon India ETF Hang Seng Bees is up 32%. Invesco's India Global Consumer Trends FOF is up 25%. But it's not just about the past year. Even in the first quarter of 2025, international funds comfortably beat the broader Indian market. Look at some of the numbers. DSP World Gold Fund 31% and its benchmark has delivered 37% globally. Mirai Asset's Hang Seng Tech ETF FOF is up 25%. Similarly, ICICI Pru's Strategic Metal and Energy FOF is up 21%. And Nippon India ETF Hang Seng Bees is up 15%. So all of these funds, including those investing in Brazil, look at HSBC Brazil Fund, 15.12% in a quarter, beating the benchmark. Compare all of this to BSE 500 TRI, which posted minus 4.39% over the same quarter. So the opportunity is clear. Despite delivering some of the strongest returns in the market, most of these funds remain close to Indian investors. Now, why are the fund houses wanting a cap revision? This cap was last revised in 2008. Mutual fund industry AUM has grown 10x since that time. Investor appetite for global exposure is rising, and global themes from AI to clean energy to precious metals are gaining traction. For now, fund houses are waiting on the RBI to signal a change, because while the world's markets open up, Indian investors remain in a regulatory lockdown, and the cost of missing out is growing with every quarter. Back to you.
Okay, Shivani, thank you so much for that. But let's move on. And while speaking at an event in Berlin, Germany, European Central Bank's Christine Lagarde believes that euro could become a viable alternative to the US dollar. Listen in.
The ongoing changes create the opening for a global euro moment. And this is a prime opportunity for Europe to take greater control of its own destiny. But let's not fool ourselves. It is not a privilege that will be bestowed upon us because of who we are, what we stand for, and the values we uphold. It will have to be earned together. Any change in the international order that leads to lower world trade or fragmentation into economic blocs will be detrimental to our economy. Sad. Yes, but with the right policy responses, there could also be opportunities. The changing landscape could open the door for the euro to play a greater international role.
And earlier, we also spoke to Ole Hansen of Saxo Bank on a host of issues impacting the commodity space, including the weakening US dollar. Here's what he had to say on the state of the greenback.
It just looks like the trajectory for the dollar points to lower. It hasn't really got many friends. A lot of people would like to see it, including Trump, would like to see it lower, but obviously in an organized and well-functioning manner. Not we have a panic style situation, but the world as we see it right now points to the need for a weaker dollar in the coming months and years, and I think that will happen over time. We just recently saw how there was a quick move in the opposite direction, and that's clearly what will happen when the bets against the dollar becomes as one-sided as they have been for a while, with an overwhelming speculative interest to be short. That does create these periods of volatility. But I think overall the direction for the dollar is towards lower prices in the coming years.
On that note, we're going to slip into a very short break. On the other side, Kerala declares an emergency as major oil spills are feared after a Liberian cargo ship sank off the Kerala coast. Welcome back to Business Lunch on CNBC-TV18. Now, moving on to some national news updates. The state of Kerala has announced a statewide emergency after the Liberian container ship carrying around 640 containers, including 13 hazardous cargo, capsized and sank off the state's coast. CNN News 18's Neetu brings us the latest on this issue.
About 40 containers from the Liberian vessel, which has sunk on May 24th, has reached the coastal areas of Kerala, especially in Kollam, Alappuzha and Thiruvananthapuram districts. 34 of these containers has reached various parts of the Kollam coast. Now, till last night, the authorities were informing that in whatever containers that had shown up, most of it were empty, or in other containers which had products, it was mostly paper rolls and stuff like that. But this morning, they have noticed certain packages which has come in wrapping, like in white sacks, which is kept there. So they are ascertaining what is inside this that is happening. More containers are expected, more stuff is expected to show up across the coast of Kerala in the next couple of days. That is what the authorities are telling us that they are expecting. But at the same time, they are also saying that the people of the state should be very careful, especially in the coastal areas of the state, because people shouldn't go near, because there are some hazardous material in this vessel which has sunk. So that is something which is of great concern. The warning to the people is that they should stay away, at least 200 meters away from these kinds of products. They shouldn't go near it. They shouldn't touch it. At the same time, another concern is the oil spill that has been noted. And from the spot where the ship has sunk, it was moving in the northwest direction. So this is mostly towards the southern parts of the state, the coastal area. So these are the major concerns that have been raised. The remnants that has been found here, the company has appointed another company to salvage this and to do the environment protection. So that is being done at the moment. But how are these containers going to be taken back from here by road? It doesn't really look possible, because the coastal area, the roads are small. So bringing in big trucks and things to lift this will be difficult. So it will be mostly by sea that they will be taking away these remnants.
Thank you so much for the update there. But moving on, Foreign Secretary Vikram Misri and Deputy National Security Advisor Pawan Kapoor will start their three-day visit to the US today. This is a follow-up to Prime Minister Narendra Modi's visit to Washington in February, when both the countries jointly launched the India-US Compact for the 21st century. The visit also comes weeks after President Trump claimed credit for brokering the India-Pakistan ceasefire in early May. The delegation is expected to clear the air on a number of issues related to Operation Sindoor, to state India's stand on terrorism emanating from Pakistan, and also to take the bilateral ties forward. And with that, we are absolutely out of time on this edition of Business Lunch on CNBC TV18. Thank you so much for tuning in. As of now, Nifty just managing to hold on to gains, holding on to the 24,800 mark, down 0.8%. Keep an eye out on that. Up next, your Midcap Radar.
Good afternoon and welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I am Bamakshi Thoria and with me is Vivek Iyer. Well, Vivek, the screen is looking starkly different as compared to what we had seen yesterday. Much like the weather outside, the markets do look a little bit gloomy as of now, but the midcap end of the market is doing relatively better.
That's right. Good afternoon. It's been a very, very volatile trading session. Midcaps holding out above the flat line just for the time being. We don't know whether by the end of the session that will hold out or not. We have quite a lot lined up for the show. A management interaction as well lined up a little later on. But let's start off with the top headlines. After 2 sessions of strong gains, stocks consolidate amid global geopolitical uncertainties. IT and FMCG and autos drag, even as realty and PSU banks eke out gains. Midcaps fare better.
Interglobe Aviation co-founder Rakesh Gangwal sells another 5.7% stake in Indigo Airlines, the parent, for nearly 12,000 crore rupees. This is the 6th largest chunk sold since 2022 via block deals, and that leaves him with under 8% in the carrier. On the other hand, the promoters of PG Electroplast sell 5.6% stake via block deals, while the parent of Sagility India offers up to 15% equity at a base price of 38 rupees per share to meet the minimum public holding norms.
Rate gain dips over 8% as growth and margin guidance for FY26 disappoints. Projected revenue growth of 6 to 8% in FY26 is likely to result in rate gain's weakest growth year since its listing in December 2021.
Meanwhile, Olectra Greentech trades under pressure as the Maharashtra government cancels the company's e-bus tender worth nearly 10,000 crore rupees as it fails to supply 5,150 leased electric buses within the stipulated timeline.
Schneider Electric gains on the back of Q4 numbers. The company reports its highest year-on-year revenue growth and sees a sharp profit net profit too jumps on a year-on-year basis. Welcome to Midcap Radar. Well, as you can see on your screen, the whole host of results that have just been declared. Naukri or Info Edge just declared its results around 10 minutes back. That particular stock near the day's lowest point, it appears to have missed what the street was anticipating, especially in terms of EBITDA as well as profitability. And as you can see on the bottom of your screen, Shriram Properties has declared its Q4 results as well. Revenues higher by 35%, profitability to more than doubling on a year-on-year basis. And that stock at the day's highest points jumping over almost 10% in the intraday session. But a whole host of other stocks is what Hormaz has on his radar. He's standing by the wall with the list of the top stocks that are moving around in the broad end of the markets.
Well, extreme reactions on both sides of the spectrum when it comes to earnings. Shriram Properties at the highest point of the day, 10% higher. Not so for Info Edge. But of course, the day has been such, right? We've seen both ends of the spectrum for the markets have tested the highs of the day, have tested the lows of the day as well. And some of the losers in the broader markets, you see Sumitomo Chemicals at 5.5% lower. ACE reporting earnings is down 4%. And Emcure Pharma, after 3 days of very solid gains, is seeing some bit of profit booking in today's trading session. Other than Info Edge and Shriram Properties, look at the earnings reactions here. Bayer Crop, the top gainer on the Nifty 500, 12% higher. Brainbees is extending its losses now down to the lows of the day, as is Blue Dart. But Schneider Electric is holding on to some gains of around 4.5%. Some other newsmakers, Olectra Greentech just issued a clarification saying that the company has not received any such order cancellation notice yet in the SPV that they have formed for the execution of this order. Sagility, of course, with the OFS is in a lower circuit, and GE Vernova continuing to build on to the gains that we saw in yesterday's trading session, although off the highs of the day. Volume stocks doing well on the volumes front. ITI 9.5% higher, of course, little float here, but CCL Products doing well for itself, and Credit Access Grameen at one point was up 9%, still holding on to gains of around 4% on strong volumes. And lastly, some other names that are bucking the trend in today's session. Look at AWL Agri, the erstwhile Adani Wilmar is now up 5%. LG Equipment's at the highs of the day, as is Garden Reach Shipbuilders trading with gains of between 3 to 4%. Back to you guys.
Well, thank you so much for that, Hormaz. And you pointed out GE Vernova. There has been a follow-up gain after the company reported a good set of numbers yesterday. But in fact, the stock has managed to hit its all-time high today. A couple of other industrial counters as well in focus. Hitachi Energy is also seeing some positive rub-off. The stock is also surging high, and so is Triveni Turbines. Cummins, keep in mind, the company is expected to report its numbers tomorrow. So we'll be watching out for the kind of numbers that come through from the company. The stock also up in trade today. today, up almost 1%. But it's a good time to welcome Shrikant Chauhan for a technical check on the market. Good afternoon to you, Shrikant. This is Vamakshi joining in. Well, it was a good session yesterday, but the market seemed to be taking a bit of a breather. What is your take on the Nifty as well as the Nifty Bank?
Good afternoon, Vamakshi. Good afternoon, Vivek. See, like Nifty, it's stuck in the range. It is failing to cross the level of 25,100, which it has made in the current upward rally. And on the downside, 24,450 is acting as a major support for the market. And currently, if we see the market, then we are at the equilibrium level. So, and also if we consider the India's volatility index, then that is also around 18.50. So most of the time, whenever we see such type of, I'm going to say, unusual sort of activity in India's volatility index, we see some more fluctuation within the range. And then the strategy should be to buy on dips. So today in the morning, we saw some recovery, but again, it failed at 25,000. So now the next strategy should be to look for adding position only if the market falls back to the levels of 24,500. Otherwise, it is better to buy some stocks to take some, I'm going to say, trading position in this market.
So which are the stocks, Shrikant, that one should look at?
So in that space, we would like to go with some PSU banks or with those banks where there is clarity in terms of their overall trend of last 10 days. IDFC First Bank looks good at current levels, which is currently trading at 67.68. If we consider its technical formation, then it is consolidating, but and in fact, it has been consolidating since last 4-5 days. Based on its formation, I'm expecting stock to move towards 72 or 73 in the near term. And in the long run, maybe again 80, 85 sort of levels we can see. So at this level, IDFC First Bank looks good. The other stock on which we are bullish is from the metal space, and that is Hindustan Zinc. That is also, I think, it is currently forming a bullish consolidation formation. It is above its upward barrier at 453. And based on its formation, the stock is heading for the levels of 475. That is the view based on technicals. So 475 should be the immediate target for Hindustan Zinc. In the long run, maybe 500. And we can keep stop loss around 440 for the same.
Well, thank you so much for that, Shrikant, keeping an eye out on IDFC First Bank as well as Hindustan Zinc. But before we slip into a short break, we're excited to unveil our brand new global business news channel, the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset and Global Lens at 8:30 p.m. Welcome back. You're watching Midcap Radar on CNBC TV18. Let's put the spotlight on Action Construction Equipment. The company is down in trade after the company reported its Q4 numbers. The company has missed their revenue guidance for FY25 marginally. To discuss this and more, we now are being joined by Saurabh Agarwal, who is the Executive Director at the company. Good afternoon to you, Mr. Agarwal. You had guided for 15% year-on-year growth in the top line in FY25, while you've posted a revenue growth of somewhere around 14%, which is much lower as compared to your guidance. So what has led to the miss this time around?
Nothing much. We missed it by about a percentage. When the year started, we were hopeful that we should be able to do something around 15 to 20%. But I think after the second quarter, and especially after the election results, we toned it down rather from a 15 to 20% to 15%. And yes, unfortunately, we missed it by about a percentage. So we are a little upwards of 14%. But I think that's how life is.
Sure, and this 14% to 15% revenue growth, that guidance that you've given for FY26 is much slower as compared to what you've done in the previous years, wherein you've grown by almost 30%. So why is this moderation in growth coming through?
See, the overall scenario seems to be a little, out of place with respect to whether it's geopolitics, whether it is, let's say the export potential out of going out of the country, and also keeping in mind that the manufacturing is also a big, customer segment for us. So looking at the holistic picture, and especially, the quarter one, which has started, is a little subdued. And primarily because, there has been a transition from BS3, BS4 emission norms to BS5, and the costs and pricing for customers have increased. So, there is a little delay in ordering. So because of a weak Q1, which we feel can be weak. So the entire year is going to be affected. So that's why we are pegging it around 14-15%. But I still feel that, again, end of quarter two is the right time to be able to, precisely know what is going to happen in the year.
Understood that, Saurabh. So for H1, you're anticipating a slightly muted execution trend, which is what is leading you to give a slightly subdued guidance of 14 to 15%. End of H1, you expected to get revised higher, if we've got that right. Give us a sense of execution trends on ground. You've said that there is a bit of a slowdown. Also, is there any issues in terms of raw material availability? That's also something that folks across the industry have highlighted. And what is the EBITDA margin that you're penciling in for FY26?
There are no execution issues. And there are no supply chain or any other issues of any type. It's just that there is slowness in the market, and especially after this altercation which has happened between India and Pakistan. So the things have, they've come to some sort of a, let's say, more slowness, or let's say to some sort of a standstill, especially in the last 10-15 days, started to improve now. And with respect to our margins, I think our margin profile between 17 to 18% is what I think we should be able to maintain, if not increase it. That's what we are looking at.
All right. And, out of the 14 to 15% growth that you've guided for, how much of it would come through volumes?
See, what we have currently planned and projected, I think about 7-8% is going to come through price increase. And I think about another 7-8% is going to come through volumes. The volumes can be more than this. And that's why, we'll have to wait till end of quarter two to figure out.
How would each of your, end user equipments do, cranes, material handling, how would they grow in FY26?
See, we have two main segments. One is crane, metal handling and construction equipment. And the other is agri. Agri is about 7% of our business. So we are looking at a 14-15% on both ends. And within cranes, construction equipment and metal handling, we feel that in this year, maybe the metal handling and the construction equipment will be slightly faster than cranes within that segment. But on the whole, I think both our main segments will grow at about 14-15%.
Okay. Sort of, in your presentation, you've also highlighted a large win that you've got as from the Ministry of Defence, close to 420 crores worth of an order coming in there. Any visibility on further order wins you're expecting from there, given that this is expected to be a high spend year? And number two, exports currently 8 to 10% of the total pie. What is the kind of growth you're penciling in there?
Yeah, this government order, this Indian defense order, is one of our largest. in any sense, whether, this is our largest order. And obviously, we got getting it from the Indian defense, really makes us feel very proud. We've been working on this last 2-3 years and gone through the entire process. So, hopefully we'll be starting execution Q3 onwards, and we have a 3-year time frame to finish this. But we'll try and do this a little bit in this year and most of it in the next year. So that's how it, and obviously our total order book with respect to defense is close to 485 crores. So, some more part of the defense orders, other orders will also get executed in this year. And it's a continuous process. It keeps on happening. Yes, this is a big one that has come across. And yes, in the export sector, we definitely look at, doing a 10% plus with respect to contribution from the export. Last year was really not great for us with respect to export, but I'm sure we will pick up again.
Sure, and you also have a JV with Kato. So the production was expected to start in the second half of this year. So is this largely on track? And when this does happen, what is the kind of revenue contribution as well as the margin potential that you're expecting?
Yeah, hopefully we should be able to start sometime in Q3, Q4. No, sorry, Q2, Q3. Sorry. And the immediate revenue potential will be close to about 400 crores, which can be achieved in 1 or 2 years once we start. And over a slightly longer period, this can easily expect 800 to 1,000 crores.
Okay. Saurabh, another question that across the industry, what we are getting is newer emission norms this time around. Are they impacting your product mix, your sales mix in any sort of manner? Has there been a certain element of pre-buying already that has occurred, especially as far as the value chain is concerned? And do you enjoy higher margins given the fact that you would have had to take price hikes?
There was definitely some pre-buying starting from December. Putting a percentage to it could be around maybe 10-12%. Okay. That is also another reason for a slightly weaker start to this year. And we have taken price hikes according to our input cost increase because of the BS5 engines and the electronics. And it is prominent to note that, engines below 50 horsepower, which is about 60% of our production with respect to equipment using that, the price increase is much steeper. Is about 12 to 13% range. So that is where the dilemma between the buyers. It takes 1 or 2 months to settle down. So hopefully everything should evolve well going forward in the next month and definitely July onwards. Yes, we have one thing in mind that the first half is traditionally slow for us, and then with monsoons and everything coming in, and second half is much bigger for us. It's about 55-60% of our revenue. So hopefully it has played out like that in the last 30 years and it will again.
Sure. And if you can just help me with your capacity utilization levels, what were they at? What is the capex that you're planning for FY26 and what segment would it largely be towards?
Yeah, our capacity utilization, we expanded our capacity in the last year and some of it was put in place in Q4. So keeping that in mind, for the last quarter, we were at about 70% capacity utilization, blended with respect to our cranes and construction equipment metal handling business. And with respect to capex, I think last year we did close to 144 crores and most of it going towards expansion and modernization. And we also bought some land for future expansion. And for the current year, we have a plan of close to 300 to 350 crores, out of which about 100 crores is planned for modernization and upgradation. And we are starting to build a new plant for our tower cranes, especially, with a total investment of about 250 crores approximately. So about 100 crores of that will be spent in this year. And yes, the balance of the land for which we have already signed contracts and agreements, so that will be executed. So we will close about 150 crores. We're going for lands which we are procuring for future expansion.
Right. Thank you so much, Saurabh, for joining us, giving us a sense of how exactly business is panning out. H1 slightly subdued, but we expect a strong pickup H2 onwards. Thank you once again and wish you all the best for FY26. Well, as we now slip into a short break, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen. Welcome back to Mid-Cap Radar. Well, two stocks from the broad end of the markets that are seeing some pressure after their Q4 results are Brainbees Solutions and Blue Dart. Mangalam joins in with the details.
Well, if you look at Blue Dart, the company has been a victim of the underlying macroeconomic problems, and that's what they've been attributing their weakness in performance to. If you look at the revenues, they grew by about 6-7%, but we did see a decline in their EBITDA, and margins came off by about 200 basis points, and that's reflected on their net profit as well, which has fallen all the way from 77 crores to 55 crores. The management has attributed this to three major reasons. One is geopolitical uncertainty, the sectoral challenges, as well as the weakness that we're seeing in macroeconomic situations as well. They do believe that the next year they have cautious optimism basis the kind of external challenges that they face right now. But the street is awaiting improvement in numbers, and as a result of which Blue Dart is lower today. The other one, Brainbees Solutions, revenue growth, no problem. It's the operational performance which has actually had the street to worry, and the net loss also increased from 43 crores all the way up to 111 crores. Though on its old calculations, the company said that their EBITDA has grown by about 20%. So they've taken the one-offs away, and at the same time, they've also added the other income aspect to it, which implies that their EBITDA for the fourth quarter has been close to around 100 crores. Importantly, the India business, which is doing well, which has seen some margin expansion as well, is supporting the overall numbers. But the international business and the Brainbees business has actually seen a widening in their EBITDA losses. So the international business, for instance, has seen their EBITDA loss increase from 25 crores to about 30 crores. And you look at the Brainbees business as well, that has, the Global Bees business rather, that has also seen an EBITDA increase, the widening of the EBITDA loss from close to 25 crores to around 25 crores itself, despite revenues growing by about 100 crores. So all said and done, weakness in performance, the operational performance comes in for both Blue Dart and Brainbees. Both these stocks understandably lower today.
Well, thank you so much for that, Mangalam. A soft quarter from both Blue Dart as well as Brainbees. But now let's also look at one stock that is surging higher in trade today. In our special segment, Midcap Spotlight, Ria will focus on Apollo Microsystems and tell us why the stock is up 11% in trade today. Good afternoon, Ria.
Well, yes, Apollo Microsystems has been trading higher in today's session on the back of some very strong commentary from the management in yesterday's earnings call. Now, remember, even last week, the company had reported a very healthy set of numbers for Q4 with the revenue going up by around 19% over the previous year. And we also saw an EBITDA margin expansion of around 100 basis points in this quarter. The order book is also very strong at rupees 615 crores. Now, coming to what the management has said yesterday, going forward, they're expecting a revenue CAGR of around 45 to 50% over the next 2 years. But this is X of the recent acquisition of Ideal Explosives. But if you factor in the contributions from the recently acquired company, the revenue growth is expected to double in FY26 itself. In terms of margins, operating margins are expected to improve in the first half of FY26, but going into the second half of the fiscal year and into FY27 as well, the margins are expected to moderate a little bit owing to the ongoing and the planned capital investments being undertaken by the company. In terms of the order book, that is expected to triple by FY26. So from the current rupees 615 crore levels, they expected to go up to approximately rupees 1800 crores. They've also got some huge orders on the anvil. They're expecting orders related to QRSAM from Bharat Dynamics within the next 2 quarters itself, and they're also expecting some orders for subsystems for Project Kusha. Now, apart from this, working capital cycle days are also expected to reduce by around 100 to 120 days from FY27 onwards from the current 423 levels. And apart from this, the company also plans to use the proposed preferential fundraise of rupees 816 crores for working capital and for R&D expenses going ahead. So on the back of this very strong commentary coming in from the management, the stock was up over 15% and 1 point in the session today.
Well, thank you so much for that, Ria, for giving us a perspective on Apollo Microsystems. The stock is up and away in trading session today. But, when we look at the markets for now, the Nifty is still managing to hold above the 24,800 mark. The mid-cap index is relatively doing better, flip-flopping between the green and the red. But that's all we have on this edition of Mid-Cap Radar. MF Corner when we return.
Hello, good afternoon. You've tuned into MF Corner on CNBC TV18. I'm Vinny Motiwala. Thank you so much for tuning in as always. Now, today we talk about income plus arbitrage fund of funds. And this is what we'll be discussing because this has been picking up pace. What does it actually mean? What are these funds? For a layman, income plus arbitrage fund of funds invest mainly in arbitrage as well as debt mutual fund. So, you should have both as a separate fund or just income plus arbitrage fund. What should your strategy be as a mutual fund investor? That is what we're going to be discussing in this edition of MF Corner. And today to discuss that, we have Gaurav Parija of Bandhan Mutual Fund joining in with us to talk to us about that. Gaurav, good afternoon. Thank you so much for joining in with us on the show. And, you know, this is such an interesting topic because it's picked up pace right now. Income plus arbitrage fund of funds. Firstly, if you could start by telling us what is it exactly and how does it differ from maybe a traditional debt mutual fund or an arbitrage fund? How is it different here?
Firstly, good afternoon, Vinny, and thanks for having us on the show. As the name suggests, I think the income plus arbitrage fund of fund is a strategy which invests into two different funds, the underlying funds being debt fund and the arbitrage fund. And it's wrapped as a fund of funds. The broad difference between this and the other categories is that a debt fund typically would invest directly into, depending on the type of fund, into corporate bonds, government securities, money market instruments, whereas an arbitrage fund takes exposure to the futures markets, basically buys cash and sells futures to capture the opportunities. What the income plus arbitrage does is very conveniently wraps both of them into one simple structure. By putting a certain percentage in a debt fund and the residual in an arbitrage fund so that the investor need not toggle between these two categories of funds.
Okay, so that's the basic difference that we have coming in here in terms of what is income plus arbitrage fund, debt funds as well as arbitrage fund. Income plus fund is just combining both of them, so it becomes easy for an investor as well. So in terms of how does the asset allocation typically work for these income plus arbitrage fund of funds? What is the amount of debt? What is the amount of arbitrage here? What is it versus in terms of a debt fund will be pure debt fund and arbitrage strategies? How is it different in terms of asset allocation?
It's a very nice question. I think the genesis of this strategy came through the tax amendments in July in 2024. And that gave birth to this category to classify or to qualify for this income plus arbitrage. The typical allocation is you need to have investment in arbitrage funds greater than 35%, with the residual in debt funds being around 65%. And that's broadly the strategy. The underlying debt funds is left to each fund manager's choice. Some have it open-end that they could go across all debt fund categories. Some are limited to one particular set of funds. And that's how it broadly differs in terms of asset allocation. So to sum up, arbitrage funds would be more than 35%. The residual will go into fixed income funds.
Okay, so arbitrage will be 35%, the rest will be in terms of fixed income. And this is for income plus arbitrage funds. Gaurav, what are the main advantages of investing in income plus arbitrage fund of funds compared to maybe firstly a fixed deposit and also then if you could compare it to pure debt mutual funds also? What are both the benefits and risks if you could highlight for both these parts?
So let me break this into three parts. First, from a tax efficiency perspective, second, from a risk perspective, and lastly, from a return perspective. Now, from a tax perspective, I think, like I stated, there was this change in the last finance bill, which allowed a certain categories of funds which invest more than 35% in debt and less than 65% in debt to qualify and get a long-term capital gains benefit of 12.5% if you held these funds for more than 2 years. Now, this compares very favorably with a debt mutual fund, which is taxed at the marginal rate of an investor, which is the slab rate, or a fixed deposit, which is also taxed both from a long-term and short-term perspective at full taxation. And this is where I think these funds provide a significant edge over the other two categories in that if you hold for 2 years, you get a tax benefit in the long-term category for 12.5%. So that's a big starting point and a big differentiator in this fund over the others. From a risk perspective, I don't think there is significant difference in risk because if you have to look at a traditional fixed deposit, depending on the underlying quality of paper, it could be very low risk if you play the government securities or the AAA. In most debt funds, again, depending on the underlying paper we buy or the duration we play, the risk on is different. So if you buy a high quality AAA oriented fund with a low duration, the risk is minimal. Now, if you come to income plus arbitrage, given that the underlying is fixed income, there is an element of both credit and duration risk, but most, if you play it in the lower duration bucket, the risk is minimized. And from an arbitrage, while it appears in the equity category, these are completely hedged positions. So from a risk perspective, these are low to moderate. Now, from a return potential, I think the big differentiator, like I mentioned in the first point, is through from a tax differential.
Okay. Gaurav, why should I look at an arbitrage fund right now? If I'm getting a mix now of an income plus arbitrage fund, a fund which is a debt fund as well as an arbitrage fund, then what is the point of an arbitrage fund now?
So I think arbitrage funds have a different positioning. If you're looking to park money between 6 months to, let's say, 24, 36 months, arbitrage is a good strategy to buy. Income plus arbitrage is what we are saying is filling the position of a core fixed income holding, which post the taxation 2 years back was losing favor because everything was getting taxed at a full investor's slab rate. This category has given a fresh birth of life from an investor who's looking at a core fixed income allocation, albeit with a little sleeve of arbitrage coming through. And this is where I think there is a big difference between arbitrage. Also, if you were to look at past history of arbitrage funds, there are at times when returns from arbitrage funds have come below the fixed income fund rates. And that's why a combination of both makes it a great proposition.
So how much should I have in my overall portfolio if an investor is looking? One, how much should your allocation go to an income plus arbitrage fund? Is there a percent that one should look at right now and versus an arbitrage fund and a debt fund as well?
Sadly, Vinny, there is no straight answer. It all depends on your asset allocation, your risk profile, what is your goal you're investing for and all of that. I don't think there's a straight jacketed answer I can give that for every 100 rupees you need to put 15 to 20 rupees in income plus arbitrage. It all depends on what is the investment purpose, what is the risk tolerance and all of that.
Okay. And for which type of investor profiles are these funds the most suitable? Are there any specific goals or risk appetite that an investor should watch out for, that if this is their risk appetite, maybe this is the best category that they could look at? If you could, break it down for us here.
So again, there is no particular investor type. I think the point we want to emphasize is that fixed income should be a critical part of your overall portfolio. I think fixed income plays a very important part in a client's portfolio because it's counter-cyclical in nature. Now, given that, we can break fixed income into 3 buckets. One is the liquid bucket, one is a core bucket, and one is a satellite bucket. And what this fund tries to fulfill is the core bucket of any fixed income investor. In that, it tries to give you very stable returns with very limited amount of what we call interest rate risk. And again, depending on what you're investing for, what is your end goal, this is where the fund fits in very well. So it could be for a very aggressive investor looking to park money for 2 to 3 years, great option. For a very conservative investor who is saying, look, I don't want to play too much on equity, but want a significant portion in fixed income, this will fulfill the aspiration of that investor as well. So it plays across investor types. It has to be seen as a core holding and a substitute for traditional fixed deposits in the core bucket.
Okay, and how much of a data point, is there any data point which is available in terms of returns versus an other fund that you can compare to in terms for overall income plus arbitrage fund? Have we seen any outperformance coming in here?
Over arbitrage, yes, there are definitely pockets, like I mentioned, where this fund has outperformed. The data points are very simple. If you were to take any of the underlying debt funds which the fund invests and the arbitrage, and given that these categories have been in existence for quite a long period, there are enough and more data points which come through on a backtesting method. And there are clear pockets of outperformance of this strategy compared to arbitrage or fixed income in standalone cases as a combination.
Okay. Gaurav, in a normally a low market volatility time that you see, does this fund actually sustain in terms of returns over arbitrage strategy? Is that something that is seen in the past?
So again, there are pockets, like I said, very difficult to guess the future as to what will play out for this fund to outperform. Each fund has a different positioning and a different place in a client's portfolio. clearly, we don't think this is a arbitrage or income plus arbitrage. For the way I would play it, it is income plus arbitrage and arbitrage, depending on the underlying investment tenure and the risk profile. So I don't think we should be looking at a plain substitute of arbitrage. Each of them have their own pros and cons, and you have to look at what you're investing for and look at this strategy from that perspective.
Gaurav, I just want to try to understand from the fund management side point of view as well, right? Because how does fund of fund structure work in terms of the practice as well? Does the fund only invest in house schemes, as well as what is the process of selecting also, right? Because then it's a fund of fund. So how does that also work? And as a parameter, I'm going to put in one more question. As a parameter for investors, how should we be selecting, in terms of the income plus arbitrage funds?
So again, very interesting question. If you look at the various income plus arbitrage fund of funds in the market, fund houses have been running multiple strategies. So there are fund houses which predominantly invest in their own funds, like us. There are fund houses who've chosen to invest in other fund houses as well. The primary objective of the way we've structured it is, if you look at how investors have reacted to fixed income funds in the past, while India typically has a lot of money in fixed income, most investors in India clearly don't understand the concept of volatility, which comes from interest rate risk in fixed income. So what we are trying to address here is, can we give a strategy which in a way tries to negate the volatility of a fixed income investor and give him the stability of return? Hence, for us, the underlying choice of a fund is something which I mentioned earlier, is a fund which meets the core allocation of a fixed income investor. Now, what is the definition of a core allocation? Is that any fund which has the ability to control credit and has the ability to control duration is what we believe is a substitute for a traditional fixed deposit. And that's what we've tried to assess. Again, every fund house has their own investment objectives. Some play it within their fund houses, and some have chosen to also go outside of their fund house.
Okay. Sure. And is there a checkbox that I should look at as an investor? I just want to know that. What are the points? How do we judge this fund? Is this historical data point? What are we watching out for when we are picking out income plus arbitrage fund as an investor?
So at the cost of being repetitive and to an extent being biased, I think investors, when they look at income plus arbitrage, are trying to fulfill what we call, again, the core allocation of traditional fixed deposit. So if you have been a fixed deposit investor, what have you chosen a fixed deposit? Because A, it gives you some stability of return, and B, it has a limited duration, and hence the volatility, underlying volatility is limited. Now, if you have to replace a fixed income mutual fund, the mutual fund should be able to display both the characteristics in that it invests in high quality paper, and B, it limits the volatility the fund has due to interest rate risk. So for you, the tick box should be, is the underlying fixed income fund meeting both these characteristics? Or is the underlying debt fund being so wide and open that it could have an element of volatility kicking in? And whether you are able to fathom that volatility or not. And that's what the tick box is all about.
Okay, Gaurav, thank you so much for that. So that is what we spoke about in terms of income plus arbitrage fund of funds. But on that note, we're going to slip into a very short break, viewers. Then we'll talk about more in terms of asset allocation. How does all this play in your strategy as well? So don't go anywhere. Welcome back to Mutual Fund Corner on CNBC TV18, and we still have with us Gaurav Parija of Bandhan Mutual Fund, and now we're going to be discussing a bit more in terms of good asset allocation in mutual funds. You have so many options. Gaurav, we spoke about a newer option which has started trending right now. Now, every time you have something that is increasing in terms of space and pace, right? You had sectoral funds that were there last year. A lot of investors jumped into it. Then you had income plus arbitrage funds that is coming in, index funds that is there as an option as well. What is the asset allocation, and why is it important to consider it according to your goals as well, right? Because just allocating to different funds is not making strategy. Goal is also going to be important for me. So if you could take us through all of that.
So thanks, Vinny. I think boring as it might sound, you have to ask any one of us in the financial markets, if there is one secret sauce to creating wealth in the long run, it is asset allocation. So what is asset allocation? Very simply, each investor has multiple assets they can buy into. One is equities. Within equities, you have international equity, you have domestic equity. Within domestic, you have large cap, mid cap, small cap. Then you have fixed income. You have traditional fixed income. You have multitude of debt funds. You have commodity-based funds, sectoral funds, thematic funds, real estate. Now, if you are to look at multiple reports, there's a fascinating table which looks like a periodic table in chemistry, which shows that depending on underlying market cycles, economic cycles, asset classes move in give very different returns over periods of time. And hence, it is important, depending on your underlying risk profile, the reason you're investing for, to choose an asset allocation. In fact, there's a very fascinating study which was done in the US by Brinson Board and Hood and Bribauer, which asked people what was the reason they could create so much wealth. And surprisingly, 92% of the attribution of wealth came from the fact that these investors got their asset allocation right, as against their ability to time the markets or pick the right stocks or funds. And hence, I think it's very, very critical to look at asset allocation. I think many a time when we discuss this, many people are put off by the fact that it is so boring. It's not something which is very, very exciting. But like most pundits will say, if you are in investing, it should be boring. And hence, if you get your asset allocation right to your underlying goal, that pretty much will ensure whether you end up having a great portfolio or not.
Absolutely, Gaurav. But, there's a rule also, right? 100 minus your age is what you should invest. Is that also a factor that comes into play? How should investors actually decide the right amount also of allocation, right? It's just that if I'm investing a very small amount and then expecting a good return and expecting to become and create that wealth, that also won't work, right? So risk, age, the amount of investment, how important is that?
So let me try to give a very layman perspective of what asset allocation should look like. Let's for one moment assume that I have to go from point A to point B. And in my case, point A is my office and point B is your studio. My choice of vehicle would be I could pretty much walk down or at best take a cab to reach your studio. But let's flip it for a moment and say point B now moves to the United States of America. For clearly, my choice of transportation has to be very different if I need to reach it quickly. In the same manner, asset allocation cannot have one color to be pasted saying, oh, if you are in the age group of 25, your asset allocation should be 100 minus 25, or if you are 75, it should be 100 minus 75. Because I think a lot of the dependence on asset allocation depends on what is the end goal. For example, if I am a person in the age group of 25 but want to buy a house 2 years down the line, irrespective of whether I'm a very aggressive investor or I have a long multitude years to live, for the underlying goal, I need to be far more conservative than my traditional risk profile. So I think asset allocation combines a risk profile of the investor. Most importantly, it also looks at the tenure of the investor and then breaks it down as to which asset class you should go in. There is no static rule which says 100 minus age is what you should be doing from an asset allocation. That's a very broad way to look at it, but you need to cut and slice depending on your goal.
Absolutely. Depending on your goal and how fast you want to reach that destination is going to be important. If you want to fly faster, then I'm sure you need to invest a more amount of money as well coming in. But yes, that's depending all on your goal. But how often should asset allocation actually be reviewed? Given that, it's such an uncertain time right now, I want to understand that how important is rebalancing also in terms of your portfolio?
See, I think there you can have a broad rule. Typically, over the last 25, 30 years, I have looked at it at every 6-month window. Some people do it annually, some people do it quarterly. I think more important than the review frequency is your ability to stick to your asset allocation. I think as human beings, we typically have the emotions of fear and greed. Sometimes when a particular asset class in your portfolio tends to do well, you tend to start greedy and start overweighting that asset class, and vice versa. Many a time when markets move very sharply, you tend to either panic or tend to revisit the asset allocation. I think that's where the critical issue is. It is don't overdo it. I think many investors try to look at asset allocation on a daily basis. It's like you plant a tree, and if you look at it, it's not going to grow every day. So it's a good practice to do it once in 6 months. And that should be more than sufficient for you to maintain the asset allocation. Okay. Obviously, if there are times when markets really crack, then you might want to revisit it. But that's very few occasions when that will happen.
Okay, very few occasions where that will happen. Can you share an example of how asset allocation has actually helped investors manage volatility during, market downturns, upturns? What is it, and how this is actually important? Because sometimes people just think that it's not that important. And I just wanted to explain them with an example of how this has worked.
And a great way to look at how asset allocation works is actually to look at a category of funds which is called multi-asset allocation funds. And if you are to take the example of multi-asset allocation funds, and if you are to look at period 1st February to, let's say, 26 September 2024, when markets were doing very well, the Nifty 500 typically returned around 25%, and the underlying multi-asset funds returned around 20%. So in a way, it was able to capture most of the bull market returns. On the flip side, when the markets did correct and Nifty 500 from 27 September till end of November fell by close to 8%, most of the multi-asset allocation funds protected the downside and fell by 4%. Do remember, in your investment journey, it's not only important to capture the bull market, but it's very important to protect the downside. And that's what a typical asset allocation does. And a great example of that playing itself out is the multi-asset allocation funds, which has done that journey over the last year.
Okay, absolutely. That's an important way to judge also in terms of how you can view this as well in terms of asset allocation and how it's going as well. But are there any common mistakes that you would highlight in terms of asset allocation and how an investor should avoid them? A quick one.
3-4 of them. Like I mentioned, typical tendencies to chase performance, which is called recency bias. So if you are an investor, let's say in September 24, equities looked very good and everything was hunky-dory, and you tended to have more allocation in equity. And hence you overweighted, and then lo and behold, the markets took a turn, and then we got napping. Secondly, I think many people have the other bias, which is called overconfidence bias, believing that they have an ability to handle risk more than what they believe they have. And hence they tend to ignore their risk tolerance. Third, many people start with a great intention of doing asset allocation, but never ever rebalance. So it's all in paper, but never executed, because there is could be a feeling of complacency. And lastly, I think over concentration. A good asset allocation plan, depending on the underlying goal, should be well balanced and not overweighted in an asset class which an investor believes he likes.
Okay, Gaurav, thank you so much, for joining with us today on the show, helping our viewers understand the income plus cost arbitrage fund of fund, as well as how they should be allocating their money and all these funds and options that are available for them in the industry. So thank you so much, Gaurav, for joining in with us. And viewers, thank you so much for tuning in as always. With that, we'll wind up this edition of Mutual Fund Corner. Thank you from myself as well as the team who put this show together. But don't go anywhere. Up next, we have Closing Bell.
headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV18 Motilal Oswal studio.
Hang Seng absolutely at the flat line, as is the Taiwanese index as well.
We found support of the 20-day moving average. Immediate resistance is 25,116. 24,966 is where the Nifty is at, 0.14% lower. The Nifty Bank is down about 0.19.
This is a year where we're going to see these ups and downs. It's going to be more a sideways. It could be range bound.
We do see almost close to a lakh crore worth of shortfall on the direct taxes. Now, to counter that, this 60,000 crore approximately, which is the higher than budgeted number on the dividend, is a good cushion.
I think it's a whole combination of tariff, non-tariff, taxes to make US more competitive.
The Nifty, Sensex down close to about 0.9%. The Nifty is at that 24,773. The Sensex is at 81,400.
Since September of 2022, the Galwan family has sold stake in Indigo and has raised 40,000 crores. That is $4.7 billion.
Very, very volatile trading session. Mid caps holding out above the flat line just for the time being. We don't know whether by the end of the session that will hold out or not.
Okay, that is a day so far, and what a day it is turning out to be. And, you know, you'd be hard-pressed to find explanations for each 250-point move, because we were down 250, then the market came up 250, then it lost 300, and now I think we're at almost at the day's lowest point. This is closing bell. We'll try and make sense of what's happening, and we'll, of course, look at individual stocks as well, which I think is easier to do rather than the indices. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi, Reema and Nigel from the newsroom floor. Guys, afternoon.
Hi, afternoon. You would think that today's expiry, right? Today's the Thursday, the monthly expiry, given the kind of volatility that we've seen. But it's at least good to see, you know, mid-caps, small caps relatively outperforming. The small cap index is in the green, by the way.
Yeah, that's true. But I am completely with Prashant. It's baffling to say the least. I mean, we are the rank underperformers today. Most global markets are up. US futures are up between 1% to as much as 1.5%, 2%, depending on which index you're looking at. And for us, it's been a down day for the better part of it. There was a recovery, but even that recovery has gotten sold into. And the large cap selling is all encompassing. It's not one or two stocks. It's everywhere. So let's see. FII flows, we go back to watching that, I guess.
The cat and the mice analogy that we were talking about.
Cat, mice, everyone's at work today. So the cat is also back. But yeah, quite something, Nigel.
Yeah, there could be an element of expiry, though, playing out, you know, the weekly expiry that we have on the Sensex. So that could be a factor in play. And we know that on Tuesdays, you know, the Sensex is actually the dominating factor. So maybe that there's an element of expiry as well. Going by the swift moves, down 250 points, then we moved into the green. I don't think we're yet finished. Last 50 minutes promises to be an absolute cracker, just going by the data points on the screen. So let's see how that goes.
Okay, well, you know, just a quick look at, you know, what is doing. Actually, advanced decline is slightly negative. Reema said the small cap index is in the green. Yeah, I mean, it's absolutely, yeah, it's 6 points down. I mean, was in the green. So it's kind of flattish, which is interesting. And let's just look at the mid-cap index as well, which is also absolutely flat. But, you know, you got about 1,500 stocks which are lower and about 1,240, 1,250 stocks which are higher at this point. Lots of names moving around. I think we'll get to some of these in just a bit. But Sachidaran Notekar is with us from Trade Bulls with what he'd wanted to do in terms of trading indices and then stocks. Sachidaran, good to have you with us here. What do you recommend?
Good afternoon, Prashant. I think it's a day of consolidation. We've already seen, you know, two big swings during the day itself. But looking at the data, it is certain that the Nifty may drift lower towards that 24,600 kind of a support, where its 20-day exponential moving average is also placed. So probably it may again find some demand near to that, you know, support base, and that's why I think it's a good idea to, you know, be on the buy and declines, you know, strategy. So going forward, we may see some further slippages, but I think an ideal level could be somewhere close to around 24,630, 600, wherein some long positions can be deployed. On the higher side, a directional up move may only trigger once the Nifty starts, trending above that 24,940 mark. So I think this is a broad range that we are looking from a consolidation point of view, wherein the Nifty is not looking, that weak. So probably this consolidation could be healthy going forward, and that's why I think buying near that support could be an ideal trading strategy. When we look at stocks, there are two stocks which are on our radar. Both are on the buying side. The first one is Chambal Fertilizer. Now, if you look at the overall data set, this particular expiry has been very significant for this particular counter. It has been trending lower, forming a lower top, low bottom sequence. But last 3 trading sessions, it has managed to sustain near that support zone of around 600. What we have observed is that for consecutive sessions, we have seen a bullish hammer formation, which is an indication of immediate support. So we are expecting a rebound back towards 625, and that's why we are recommending building long positions in Chambal Fertilizer. The stop loss for the trade can be placed at around 582 on a closing basis. The other stock on our radar has been Cholamandalam Finance. Now, again, if you look at the overall structure, the stock has been sustaining and trending well above its 5-day exponential moving average. It has again, given a fresh breakout from a consolidation range recently. So we are expecting that this particular outperformance may continue towards 1720, and that's why we are recommending building long positions here, keeping a stop loss at 1620.
Got that. Thank you very much for that. Last week, on Friday, the low on the Nifty was 24,614. But the more recent low was 24,462. So broadly, at least on the way down, this 24,500 is held on as a support, and we're still gyrating and oscillating within this trading range. But let's talk about individual stocks, the big movers today, and Sagility on the way down because the promoters have launched a very large offer for sale. They're looking to sell 15% equity. This is to meet the minimum public shareholding norms. Vinny joins in with more details. Vinny.
Hi, afternoon. So yes, promoter of Sagility, that Sagility BV, is looking to sell around 7.39% via an OFS. It's a 2-day. One is today and the other part is going to be tomorrow. Via OFS, they'll be looking to sell the stake. There's an option to oversubscribe 7.62%. So overall, that comes up to around 15%, 15.02% in terms of equity. Now, the floor price for this was set as around 38 rupees per share, which was at a discount of around 13% to yesterday's closing price. So because of that, also, obviously, we're seeing a decline coming in. Now, Sagility BV, as on March 2025, was holding 82.39% stake. So they have to bring down that minimum public shareholding norm as well. So 75% around that mark is what they're looking to bring it down to. Sagility obviously is a technology-based healthcare service provider. They mainly are in the US markets. They focus on the payer space as well as the health insurance space. And when you're looking at it in terms of numbers that recently came in from Sagility, not that great, but the outlook what they gave for FY26 was something that that investors should keep an eye out on as well in terms of confident in maintaining their margins. They've given a margin guidance of around 24 to 25% for FY26. They expect low to mid-teens growth in constant currency terms as well. And debt repayment is also expected to be done and completed by FY27. So that will be interesting. And one fact that you should keep an eye out on in terms is the valuation. The company listed in November 2024. And now, in terms of the valuation gap that you're seeing, peak valuation was 60 times. Currently, it is trading somewhere around at 23 times in terms of PE. So that is important to watch out for, that we've already seen that fall coming in from peak PE as well. Outlook seems interesting. This OFS is mainly only to meet that public shareholding norm this time that we're seeing.
Thank you very much for that. 32 rupees was, I think, the issue price on Sagility. But let's talk about Interglobe Aviation. Rakesh Gangwal, as a part of his planned equity sale in Indigo, sold another chunk of his stake today, with nearly 6% equity changing hands in a deal valued at 12,000 crore rupees. Nimesh is here with a timeline of Gangwal's family stake sale and the strategy they've adopted. Nimesh.
I remember before I talk about the timelines, who say that it's difficult to make money in an aviation stock, or for that matter, who says that when the promoter is selling is perceived to be negative for the stock price? And I'll tell you why I'm saying this. Ganwal actually family has defied that logic of promoter selling and aviation not making money for you. Ever since they had a split with the other co-promoters, since September 2022, they've been selling stake periodically and systematically in Indigo. And since then, they've raised 40,000 crores by selling stake. That is equivalent to $4.7 billion that they've raised since September of 2022. It's not done yet. Even after today's block deal, they still own close to 7.8% stake in the company, which at the current price is valued at almost 16,000 crores, and they have 150 days of lockup, so they can't sell for another 5 months at least. But still, even at current market price, that's valued 16,000 crores. So 40 plus 16 would mean 56,000 crores is what they can raise, or they can potentially raise from Indigo. So that's the math. Now, if you look at the history of the stake sale that they've done, it's kind of a systematic withdrawal plan that the Ganwals have opted for in Indigo. The first block happened in September of 2022. They sold close to 4%, 3.5-4% stake, and at that point in time, they raised close to 2,400 crores. The average stake sale price was 1927. So that was the first block that they did in 2022. After that, there was a 150-day lockup. So the next block happened in 2023, close to August or something. That's when they sold the next chunk. I think it will come on the screen. In 2023, they sold the further stake. Feb of 17, 2023. They sold another 4% stake exactly after 150-day lockup. That was the price at 1882. So marginal discount to the first block price. This was the only deal when there was a marginal discount to the previous block. And there they raised close to 3,000 crores. So that was the another block. Immediately after that, in August 2023, they sold another close to 4% stake. And that happened at 24.54 per share. So virtually a 38, 35, 36% premium to the previous block price. There they raised close to 4,200 odd crore rupees in that particular block. Then the next block happened in 2024. March 11, 2024, another 5.8% stake sold. They raised close to 7,300 crores. And that again price happened at 2342. Another 40% premium to the previous block price. So again, they did a smart thing of timing it nicely. Again, after a 150-day lockup in August 29, they sold further 5.8% stake, and they raised close to 10,707 crores. So that was another block. And finally, now today they sold another 5.7% stake, which is May 27. 5.7% stake sold. 12,000 crores is what they've raised, and this deal happened at 50 to 50. So from 1150, the first block, to 50 to 50, that's the kind of rally the promoters have enjoyed and timed it very nicely. So a good deal from a Ganwal's point of view. They still own, as I said, 7.8% equity, which is worth 16,000 crores. So already 40,000 crores in the pocket, and they can raise another 16,000 crores in the future by selling stake. But right now, there is a 150-day lockup for the Ganwals to finally sell out.
Wow, what a story, Nimesh. Thanks so much. Beautifully put. And absolutely, who says you can't make money in aviation? Whoever said that probably didn't know about Interglobe.
So again, the other point is, Surveeb, it doesn't happen overnight, right? They've built this airline for 20 years. And finally, you can actually... So what is interesting is, I was just looking at the data. Today's block deal of 11,000 crores is virtually equivalent to the current market cap of SpiceJet. So with just 5.5% stake, you can buy out a rival airline if he wishes to.
That also gives hope to people who are holding SpiceJet.
Absolutely.
That's the other thing. Usually, Nimesh, we talk about buyer's remorse. Australia, and then, but here they should be seller's remorse.
But I guess, what I liked about it is that the fact that it's been systematically done every 150 days, you come and sell. And again, it was not always at a higher level. There was one instance where they sold at a lower price as well. And they had the discipline, right?
I just looked at so that date that you put, Feb 2023, when they sold. So the Indigo stock from then to now, 1850 was the price back then. It's now 5,300. It's up 85%. 85%. The index, so it's not as if it's not the market. Index is up 40% in that same time period. So of course, there's been massive outperformance in the stock, which I think adds to the point that throughout this selling, the stock has continued to.
So again, the learning for me is, if the promoter is selling for a specific purpose, if it's a forced selling, one should not take it very negatively. Generally it pays off if you buy into when the promoter is selling. If it's a forced selling, like for instance, there is an OFS for coming to 75%. It's a kind of a forced selling by a promoter. That is when I think investors do get a chance to participate big time into a stock.
And investors have. I was just checking their shareholding. In September of 2022, which is when the stake sales started, the FI holding was 18%. It now stands at 25%. And the DII holding has gone up from 7.7 to about 20.5%.
That is all, whatever the Ganwal sold is largely been
lapped up by the FIs and the DIs. Thank you very much for putting the spotlight on Interglobe Aviation and the block deals that we've seen. Prakash, were you buying Interglobe Aviation over the last 3 years?
Well, I've been quite positive on this, Rima. It's been such a wealth creator in spite of all the odds that are stacked against the sector. But then, Indigo has enjoyed a unique position, which has only got stronger by the day. Shortage of aircraft for other players, much more diluted operations for any veritable competition that could have come from Akasa and Spice. So I think it's kind of flown high just because of the situation. Now, whether you buy it at 50 to 100 and still expect to make money, the question is how long are you willing to wait? And there will be some air pockets it will go through, and that's the time to buy. But definitely, it's a story that I don't see any abatement in terms of the growth. So definitely a positive thing. The promoter stake sale does leave the company with just one promoter, but that hopefully is in a good situation of sorts, because at least decision making won't get impeded given the conflict that was earlier there between the Gangwal and the other Bhatia family. So that kind of eases out a lot of issues, but you should buy it at lower levels if you really want to continue making some decent money.
Okay, that's the story of Interglobe Aviation. By the way, I'm looking at some more stocks which have been in news flow today because of either news or earnings. PG Electroplast is the other one, where promoters have been selling stake. That stock is down about 0.7% right now, not too much. Interglobe, we have discussed. Agility obviously is down 5% because of that, chunk of equity that's in the market because of regulatory reasons that OFS is happening. And then, of course, rate gain is a big casualty of the day. Prakash, hi. Let me talk about the stocks that are down because of either earnings or news. And let me ask you whether there is any reason to buy the dip. So whether it's rate gain or Sagility, let me throw in a Brainbees as well, First Cry. Stocks down about 6% on earnings. Any of these mid-caps fit your bill?
Good afternoon, Subhi. So two of them do. I don't track First Cry as much. But if you look at rate gain, while the numbers might seem disappointing, there's a very different growth trajectory that this company is following. Their growth impulse is more inorganic. They've raised money at a very, very decent valuation, the QIP. And they're still sitting on that cash. It hasn't been deployed. They've done one acquisition which has been absolutely stunning in terms of what it can contribute for the price they paid. Till they get another equally compelling opportunity to acquire, I don't think they'll deploy money, is what they've indicated in the calls. So I think it's a very, very sound, judicious management at work. There are lots of things that are working in their favor. This is something which they're going through the adolescence of the business, where they will emerge much more stronger given competitive intensity, margin pressure, whatever you call. But I don't think you need to be disappointed from a longer-term perspective. Yeah, I mean, these numbers, probably there was expectation which was built in because the stock had run up, but that's not happened. But it's an opportunity to buy. The same thing goes for Sagility. As Dimesh said, the compulsion is to pare down, exposure, and you're getting the stock at probably multiples which are far lower than what a company like this would deserve. And remember, though 38 was the floor, you still have the stock trading above that, which means there are enough takers for the business. So very, very good opportunity. I've been very positive on this. It's rallied, of course, and now it's come off from the peak of 60 times P multiples and all that. But this is a business that's fairly resilient as compared to BFSI and a lot of the AI impacted verticals. Healthcare generally, by and large, is bound to continue earning revenues for most companies.
All right, Prakash, I wanted your view on Eternal, and the stock is in focus this week because global indices, they'll rebalance the indices, which will result in some passive outflows. But the question is, will the domestic funds lap up most of it? Let me explain this. Now, foreign portfolio investment limit, that was reduced from 75% to around 49.5%. Because of this change, it's triggered a potential sell-off by global indices or a rebalance by them. So global index providers like FTSE as well as MSCI, they have reduced Eternal's weightage in their indices. This is what is likely to lead to potential passive outflows. Now, because of this, there'll be a total of roughly around $820 million worth of outflows for this week itself, of which around $300 million of passive selling is expected today. This is as per Nuvama alternate and quantitative research estimates. The question, though, is will the domestic money support the stock, since the DI holding in the company itself is close to around 24%, of which you have the active mutual funds that hold roughly around 14% stake, while the passive mutual funds hold around 5% stake in the company. Remember, the active mutual fund industry itself is sitting on solid liquidity. So it'll be interesting to see whether or not there is some deployment into the stock, given the liquidity, given the kind of holding that they have. The company, remember, did a QIP in November 2024, and at that point of time, the stock price was around 250 rupees. So currently, it is close to around 10% lower than that QIP price. Interesting times ahead. Supply is due. The question is, will the domestic money lap it up? Prakash, I wanted your view. I was going through this note that came in from Nuvama Alternate Research, and they were saying that maybe around 215, 220, they believe there's a good amount of support. What's your view on the stock? This passive selling could be absorbed. Yesterday, you saw the stock was down close to around 4.5%, but today it's more or less stable. Your take?
So, Nigel, I really don't have any empirical data to support what kind of the mood DIs are in terms of lapping up this huge bulge of liquidity. But from a fundamental perspective, probably you are staring at a bottom or some sort of a floor in terms of where things could go. We've seen hyper competition build up and then kind of abate a lot, and then now Zomato's probably got some of the things working in its favor. Especially, forget the food delivery part, the Blinkit part is likely to kind of continue getting more and more efficient as they grow scale. There are lots of geographies that remain untapped in India. Between Instamart and Blinkit, there's still enough and more to kind of leverage on, and they can keep on trying the new ones out. So there will be growth for sure. See, the DI mood is something which is difficult to anticipate. If everybody decides, then the stock gets support, right? But if just few of them decide, they might not see any price and volume impact on that. Like, to give you an example, look at Jio Finance. Jio Financial Services in the last 1 month has done almost 25%. Everybody had the right mood to buy it, arbitrage funds, active funds, everybody's locked into that. And just in over a period of a month's time, it's done so well. So my whole thing is that it will depend on finally how they end up acting rather than anticipating how they act. But fundamentally, I think that there's quite a bit of support at these levels. You may not go wrong buying at 220, 225 levels.
Okay, that's got that point. Market's still down about 200 point at this juncture, still about a 1% cut coming through. Prakash, finally, Jio Financial, the winner on the Nifty today. I think the excitement is growing as they will be launching more services soon, mutual funds, etc. Your thoughts?
No, very, very positive. In fact, you might be a tad late to buy it. Beginning of this series, I remember it was in that 230 zones. So, it's done exceedingly well. It's more from bottom fishing perspective. I think what the market sensed was that you've seen thanks to the Feb March meltdown. This was a stock that got impacted, but there was no reason for it to be negatively impacted. You had tariffs as a key trigger. You had geopolitical risk as key triggers, but this has got completely resilient from that. And some of the services that they launch of scale, given technology, the way technology is kind of evolving so rapidly, means they'll be able to do it very, very efficiently in a cost-efficient way. So from that perspective, there's lots to come. Maybe it could kind of start announcing some of these things that have been in the pipeline in the works for some time. And that's when the revenue buildup will be more visible for all of us to kind of pencil in. But from an opportunity perspective, book value perspective, I think it definitely makes sense to have it in your portfolio. But as I said, it's moved up a bit. If you see some profit taking, see it at 250 levels, then you have a very good deal for yourself.
Okay, all right, got that. Thank you very much for that comprehensive point of view on all the stocks that we've discussed today. You have a good rest of the afternoon. We will move on now to a CNBC TV18 exclusive. Prashant caught up with GQG's Rajiv Jain, and Rajiv remains quite confident on India. In fact, he's still overweight on the equity market here, and also discusses GQG's latest India bets.
You bought into Bharti in a big way. I think that's a newer bet, Rajiv. And I think one name which we discussed in a very different context the last time we spoke, HDFC Bank. I remember you telling me that you've been, you held that stock for years. I mean, long back. And then, of course, you didn't own it for a long period of time. You didn't have it last year. This is, in that sense, a new addition. You want to talk to us about that, Rajiv?
Yes, so HDFC Bank, we thought was going through a sort of integration transition period as such between the two, HDFC and HDFC Bank. So since last September or thereabouts, last quarter last year till first quarter, we put almost $2 billion in HDFC Bank. And Bharti we started buying early last year, and then we've doubled down again this year. We've added a little bit to some of the other names too. Nothing meaningful, but they're like a few $100 million here and there. Nothing meaningful.
Okay, well, that is Rajiv Jain of GQG. You can watch excerpts of this conversation with Rajiv Jain all day today, only on CNBC TV18. Well, before we slip into a quick commercial break here, we're also excited to unveil our brand new global business news channel, the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global business shifts and their impact on India, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset and at 8:30 in the evening for the Global Lens. Okay, welcome back. 200 points lower on the Nifty. 24,800 is where we are at this point in time. It's very, very stock specific. And there's enough moving on both sides of the equation. Deepak Shenoy is with us, founder at Capital Mind. He's joining us now to take some questions. Deepak, great to have you with us here. Thank you for joining us. You know, we'll put out the LIC expectations with Yash in just a bit, but it's a name that I think we've spoken about in the past and a name that you still own, Deepak.
We still do in the PMS, yes. Thanks.
What's the... By the way, life insurance companies have gotten a real boost over the last couple of months. Stocks are significantly higher. LIC, I'm not very sure, though. The private guys have all done quite well. What's the prognosis here, Deepak?
So I think in the longer term, the idea on LIC has largely been that it's relatively undervalued compared to the private insurance pack. One of the good things about it is it's changed its accounting standards in the to become more oriented towards how private insurers value themselves or value their earnings. And more of the earnings have started to accrue to shareholders. Now, in the last quarter, this is the Q4 of FY25, the results are still due. But I think one of the things that they have done very interestingly is that, they have this mix of participating and non-participating policies. Non-participating is where a large amount of the private insurers play, whether it is term plans or money-back policies and so on. These are non-participating policies. You get a fixed kind of a return or a certain type of insurance, and you get your money. If you, in a term plan, if you, for instance, don't die and the policy matures, you don't get anything back. So the money entirely, which has been kept for the risk, goes as profit to the insurance company if you don't, if you don't die in that period. Versus participating policies are where the profits made on the investments made by the insurance company are effectively participated in by the policyholders. The participating policies, the profit that is taken out is usually roughly 10% of those profits accrue to the shareholders of the insurance company. The rest goes to the policyholders of the insurance company. And LIC was earlier not sharing anything at all to the shareholders because there were no shareholders. There was only the government. And now it has slowly inched that up from 0% to 10%. This year, the last quarter will contain the participating policies profit, which is usually why LIC's last quarter profits are usually much higher. So we believe this year it should come to a full year of above 45,000 crores. So a big profit is expected in the last quarter. And hopefully that will mean, something of the order of either corporate expansion or dividends. One of the two, I think both of them will come from LIC as an announcement. They have said that they will announce the dividend numbers as well. So I think that will, positively shape how benefits accrue to shareholders. And I think that benefit has been increasing over the last few years, and perhaps this year and the next year is when those benefits will reach true accounting standards in that sense, and therefore true shareholder value. That is why we like that space. Though the insurance space has been struggling for a while because of a lot of rule changes and a lot of tax negatives that have come in, but I think those have also settled in to a large extent. I believe still India is underinsured, so there will be a lot more growth of the overall industry, and LIC has a lion's share of that market. But also the fact that they're moving more into non-participating policies, they're increasing their take rate from participating policies, and the general growth of the industry should augur well for the organization going forward. I've said this in the past, but we are interested, so very biased on that respect. The share hasn't done quite as optimistically as I am, perhaps, but it's a matter of time, I feel.
Deepak, we've spoken in the past about how consumer habits have started changing, and travel is right on top of that, and that puts the spotlight on hotels and airline stocks. So Nimesh was just telling us how Interglobe Aviation, despite so many successive promoter stake sales, the stock continues to rise and rise. The stock has doubled in the last 3 years. You've looked at Interglobe Aviation at this price. I mean, first, is it a part of your portfolio, any disclosure? And at this price, is it attractive?
It's not in our portfolios at the moment. I don't know, maybe it's part of a technical one which I'm not aware of, but I think more or less one of the problems with Interglobe has been that it has been very linked to the crude prices. So earlier when crude prices used to rise a lot, Interglobe used to, Indigo used to lose a lot of money. So you'd end up with this massive quarter of some 2,000 crores of losses and so on. And then some others. Now, I think they have a little bit of changes in some of their, perhaps their ground handling pieces and some of the other things that are coming. And their promoter stake sale is the second big thing because the promoters have been consistently selling. But this is not new. Even during the IPO, the promoters took out a ton of the cash that was in the company as dividends, and then they issued more shares in the IPO. I think that was when it actually came out. So I don't think that's necessarily a bad thing. Overall, the company will be more broadly owned. And right now, there is no meaningful competition other than Air India. Which is or Indian, which is essentially your the core of your competition. Akasa is relatively small, and the other competitors have gone out of business. So until there is another competitor, I think this company will do well. But as we've seen in the airline industry in the past, there will always be some billionaire who will come and start an airline and cut into your margins. So you shouldn't overvalue these companies too much. Because it has resulted in the past in sadness, and I think it might surprise us negatively also. We don't own it, although we like the space. We just feel that somehow airlines as an industry will grow, but almost nobody seems to be able to make any meaningful long-term profits in this space.
Okay, so still not quite convinced about aviation. All right, take your caution on board as well. Deepak, hi, afternoon. GE Vernova, KC International, power, T&D space. We spoke to KC this morning. They were sounding quite optimistic about this year. GE Vernova, we know what the stock's been doing. Off and on, it goes into these big bursts, right? And even after this result. Then there's also Hitachi Energy, of course, those HVDC orders. Do you like anything in this space?
Yeah, we've liked Power India, Hitachi's. We used to, I think we participated from the time they demerged from ABB. The stock listed at 900 rupees in during COVID, actually, around 2000, and now it's at, I don't know, 17,000. So it is quite a remarkable run from that time, despite economic profits not meaningfully having yet been demonstrated in the firm's books. We did exit from it a little bit earlier this year, but we've gotten into more players in the T&D space. I think the idea of the T&D space will actually do really well. HVDC is useful because much of the renewable power produced can be moved in HVDC formats much better, and DC does not lend itself to easy transmission. That's why you convert everything to AC and then transmit it, right? So losses tend to be bigger. So the equipment required is more sophisticated when you want to high voltage DC, and what is really what a 12-volt DC can do is probably something that you'll need a much higher voltage on an AC network to do in the first place. So efficiency metrics are slightly different. I think this is a very good space to be in general in the transmission space. I'm not so interested right now in generation, but transmission and distribution tends to be, so equipment manufacturers, EPC players, some of the EPC players in this area, and people who benefit directly from the transmission part of the ecosystem, I think are where India's near-term future will lie. We should get more generation in the next few years, and perhaps 4 or 5 years later is when generation will start doing well.
Okay, so till then, play the transmission, guys. Got that point. Good conversation. Thanks so much for all the perspective. Deepak, you have a good rest of the day, and we look forward to the next conversation soon. Thank you very much. All right, we do have to take a very quick break on that note. Come back on the other side, and then we'll have Nimesh back with the D-Street chatter of the day, and then some final trading ideas with our technical expert as well.
Welcome back. Well, the headline index is still down 170 points or thereabouts, but we've recovered close to 100 points from the time we started off the show. And keep in mind, the mid-cap index is now up close to around 100 points. That said, it's around 3 p.m., so let's get a Nimesh to give us a sense about what he's picking up in D-Street Chatter. Nimesh, what are the flows picture looking like?
Well, actually, while the Nifty is down 170 points, I won't read too much into it. It's largely because today we have the Sensex expiry, so it adds to the volatility. And of course, this week we have the monthly expiry as well. So next 2 days could be quite volatile. And in that sense, the institutional data may not be too much to read into, so to speak. And today's number will also look larger because of the two large blocks, right? But having said that, outside of blocks as well, I understand there is buying interest, there are buy flows. So X of blocks as well, you might have slightly a positive number from the FIs. That's a broad feedback. I guess from a buying point of view, the PSU, selective buying in PSUs continue even in today's market. So again, Concor is up 3% today. There are a lot of individual stocks which are buzzing, and there's a bit of interest as well from large institutions. I guess barring the overall flows, the trend of block deals is likely to continue. So as in when the earnings season is coming to an end, you might see a good pickup in blocks and OFS in the days to come, simply because there's so much of liquidity in the system, and I guess that's what will get matched with this kind of supply which is coming in. So X of blocks for today, I can say there is buying interest from large institutions.
Okay, all right, that's good to hear. Then Nimesh, what about individual stocks? What are you picking up?
Well, so in terms of individual names, the first stock on my list is Inox Wind. After a long time, some sense of buying interest is back in that stock. I understand one leading family office has been active buyer in the last couple of days, so that's the reason why that's buzzing in trade today. The second stock is ITC. I spoke about ITC hotels yesterday, expecting a large block. Now there is a very strong indication of a very large block in ITC itself. And again, no speculations there. There is a big rumor going around that maybe BAT will further sell stake. The only issue is, internally I checked as well, and the feedback is, last time the parent did clarify, or BAT did clarify in the investor call that they won't fall below 25%, and they won't just little over 25%. So need to see whether they're open to diluting beyond 25 as well. So that's ITC under pressure today. The third stock is Max Healthcare. A bit of buying interest is back in that name as well post earnings. Again, there are buy flows is what I understand from a flow perspective. And the last one is Indus Tower. The stock is not down. In fact, it's up 0.5%. But I understand there is a very large offer bid from a leading FI investor. So maybe there could be a block or something, but at least there is an offer in Indus Tower at current levels.
Thank you very much for that. Let's get to the market technicals then. The Nifty is down 160 points below that 24,850 mark. Sachidanand Utekar from Trade Bulls is now with us for a few BTST calls. What would you recommend?
Well, I think we have seen a strong recovery again. 24,700 support has acted well, and we have seen a probable closing towards 24,830. So we are expecting this momentum to continue towards 24,940 in tomorrow's session, and that's why both the recommendations are on the long side. The first one being Canara Bank. If you look at the last 5 trading sessions, the stock has been very steady. It has been maintaining its closing above its 5-day exponential moving average. It looks like a bullish flag in action, and we may see a breakout soon, which may push the stock towards 116 kind of a zone. So we are recommending building long positions here, keeping a stop loss at 106 on closing basis for a target of around 116. The other stock which has come on my radar is Laurus Lab. Throughout this particular expiry, the stock was trending lower, but if you look at the options data, the 600 support looks very strong. On the daily scale, we are seeing multiple averages converging near that 605 mark. So we are expecting a recovery in this particular stock, which may push the stock back to 640 kind of a range. So from a trading perspective, the target should be placed at 616. Stop loss should be placed at 590 on closing basis, and fresh longs can be deployed in Laurus Lab.
Okay, all right. Thanks very much for that. Well, Apollo Microsystems is in focus post their fourth quarter numbers. Stock, of course, is doing very well. Ria is here with more. Ria.
Well, yes, Apollo Microsystems has been trading higher in today's session on the back of some very strong commentary from the management in yesterday's earnings call. Now, remember, even last week, the company had reported a very healthy set of numbers for Q4 with the revenue going up by around 19% over the previous year. And we also saw an EBITDA margin expansion of around 100 basis points in this quarter. The order book is also very strong at rupees 615 crores. Now, coming to what the management has said yesterday, going forward, they're expecting a revenue CAGR of around 45 to 50% over the next 2 years. But this is X of the recent acquisition of Ideal Explosives. But if you factor in the contributions from the recently acquired company, the revenue growth is expected to double in FY26 itself. In terms of margins, operating margins are expected to improve in the first half of FY26, but going into the second half of the fiscal year and into FY27 as well, the margins are expected to moderate a little bit owing to the ongoing and the planned capital investments being undertaken by the company. In terms of the order book, that is expected to triple by FY26. So from the current rupees 615 crore levels, they expected to go up to approximately rupees 1800 crores. They've also got some huge orders on the anvil. They're expecting orders related to QRSAM from Bharat Dynamics within the next 2 quarters itself, and they're also expecting some orders for subsystems for Project Kusha. Now, apart from this, working capital cycle days are also expected to reduce by around 100 to 120 days from FY27 onwards from the current 423 levels. And apart from this, the company also plans to use the proposed preferential fundraise of rupees 816 crores for working capital and for R&D expenses going ahead. So on the back of this very strong commentary coming in from the management, the stock was up over 15% and 1 point in the session today.
Absolutely. Really, the other one is Cosmo First, right? I mean, there were numbers, but the stock has really gone berserk. Tell us what's happening here.
Well, yes, Cosmo First has definitely been in focus. The stock is up over 60% since reporting its results last week. Even just in less than 2 months, the stock is up over 100%. So let's take a look at what has been aiding this rally. Firstly, in terms of the Q4 numbers, the revenue has gone up by around 16% over the previous year. The net profit has also jumped up by over 80% over the previous year. But if you look at it on a sequential basis, the net profit has actually declined by around 10% compared to a sequential revenue growth of around 6.5%. Going forward, the company has said that the capex that they've undertaken over the last 3 years is going to lead to a very significant ramp up in both revenue and profitability over the next 2 to 3 years. For FY26, the revenue is expected between rupees 3,500 to rupees 4,000 crores. In fact, the new BOPP line of the company, which is expected to start operations in Q1 of FY26, will also lead to a capacity expansion by 40%, and this is the key business segment of the company. Now, another reason for the recent stock move can be attributed to the fact that there was a fire at the plant of the competitor Jindal Polyfilms, which is why the plant operations have been disrupted on a temporary basis and which could lead to some increased demand for Cosmo First. So overall, even though the outlook is quite positive and the results have been strong, largely strong for Cosmo First, there are some things that we need to be cautious of on this front. Firstly, the long-term borrowings of the company have increased to over rupees 1,000 crores compared to rupees 680 crores in FY24. The net cash flow has also decreased to about rupees 166 crores versus 245 crores in FY24. The 3-year revenue CAGR is also at -2%. And lastly, the stock is also under the ASM1 category at the moment.
Thank you very much for that. Let's talk about LIC. LIC will be reporting numbers later today. Yash joins in with the expectations.
Well, Rima, from LIC, as far as Q4 is concerned, the print is expected to be weak this time around. We are expecting a contraction on all important fronts. So if you speak about the new business premium in the Q4, CNBC-TV18 poll expects a contraction of about 11%. The number that we're looking at is 68,714 crore rupees. The total AP, we are expecting that to reduce by about 13% at about 16,826 crore rupees. Retail AP could see a bigger contraction at about 36% down at 11,020 crore rupees. Value of new business again 22% lower at 3,185 crore rupees. Importantly, margins are expected to contract this time around, but that is of course also because in the Q4 last year the company saw its best margins at 21.1%, but this time around they could reduce by about 220 basis points at 18.93%. These are the numbers. Of course, the expectation is weak, but also the stock is down about 30% nearly from its 52-week high. Any surprise on these numbers and specifically on the margins could lead to a re-rating as far as the stock is concerned.
Okay, all right. Got that, Yash. Thank you very much for the update over there. We'll keep that in mind. Let's move on. We have Jay Bala of Cash the Chaos joining in. Jay, great to have you on. Thanks so much for being with us. Today is a bit of a strange day for at least the bulls here, because the market was cruising along till yesterday, and today global cues are good, and yet we've got the sell-off. But overall, what sense do you make? I remember it was your India visit when we were talking in the studio. You had turned positive on the Indian market after a long, long time. Still retaining that view?
Yeah, hi, Surabhi. That's the view for the medium term. The 29,000 objective that I have for the Nifty, that still remains intact from a 6 to 12 months perspective. In the near term, although the market is quite ambivalent, a number of possibilities are there. But if the Nifty can hold 24,462 and take out 25,116, we could see an upside acceleration come through for the market. But that is not obvious for me either. So I would prefer the market to drop somewhere closer to 24,000 and then take out the May high of 25,116. But the medium-term picture remains the same. It's bullish for the markets. The same goes for the global picture too. As long as S&P can hold above 55.95 and the Dow Jones can hold above 4,700, there's a more immediate possibility of market accelerating higher. But in the event the market were to drop below 55.95 on the S&P or 4,700 on the Dow Jones, we could see a slightly deeper pullback and then resume higher. Anyway, the broader point for the Indian markets as well as for the global markets, it's buy on dips.
Okay, all right. Hi, Jay. Good to see you this afternoon yet again. Since the market could be in a bit of a band, but you're maintaining a bullish stance on it, what about individual stocks? Give us a couple of ideas.
And I like the one I convincingly like is Schneider Electric. It comes from the capital goods space. I've been pointing out that I'm positive on the capital goods space. Schneider Electric has a stop loss of about 540, and today's print of intraday high was a spike high of somewhere close to 708, I think. And that's sending a message that the decline from the July highs is a corrective decline. So the markets are likely to take out the all-time highs sometimes in, say, a few weeks to several weeks time frame. But 540 as a stop loss is essential. There's a hesitant bullish call on Credit Access Grameen because the volumes are quite low and the stock gets quite choppy. That's the reason why I'm hesitant. So your position sizing should be appropriate, so slightly lower than your usual allocation. As long as the stock can hold about 924, I remain bullish on the stock, and you can take this as a short-term call rather than a medium-term call.
Okay, all right. Got that. Jay, we'll just come back to you. Need to take a very quick break. As we take the break, let's quickly remind our viewers the good news that's come in. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. You can get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app from the Apple Store or from Google Play. You can even scan the QR code on your screen.
Welcome back. Well, a few stocks actually are moving very, very well. Jio Financial Services, what a beautiful move actually. You know, in the month of April as well as March, when Reliance Industries was making a bounce back, actually Jio Financial was paling in comparison in terms of its move. But now if you look at it, if you pull up a last 1 month chart of Jio Financial as well as Reliance Industries, in fact, for the last month or so, Jio Financial has actually outperformed the big boy Reliance Industries from where it gets majority of its value. So it seems there's a bit of a catch-up that's taking place on that particular counter. Jay Bala is still with us. Jay, I want to ask you about a couple of other important global triggers from an India market perspective. The dollar index, that's slipping on a day-to-day basis, and that dollar dominance seems to be fading away. Where do you see that one headed?
Yeah, the dollar for the short term has got a protection at the 96.5, 95.5 levels. And in fact, the recent low it registered at about 97 and change. That may not get taken out in the very short term. The dollar could bounce to somewhere close to 104 before coming back to test the medium to long term support at 96.5, 95.5. So in the very near term, it's bullish, but the medium term trend seems to be lower. But the medium-term trend is put to test around 96.5 and 95.5. I anticipate a sizable rally post the next low that goes below the 97 low. So, so it's a bit of volatility in the medium term, and the short term is very slightly bullish.
All right, 96.5. Got that. Jay, what about Brent crude prices? That as well is showing a lot of weakness. It can't get past that $67 per barrel mark as well. Where is that one headed? You have mentioned in the past it could be a little subdued. I think it has a near-term support before bursting away. Near-term, where is it headed?
Yeah, crude has got a short-term resistance. The fluctuations in NYMEX crude is more obvious than the Brent one. So I'm choosing the NYMEX as my benchmark for the moment. If it does cross 65.12, I think that will give rise to a complex correction. That's the more probable scenario I'm anticipating to happen. I expect both varieties of crude to rise from here on. But 65.12 is important to be taken out on the NYMEX crude. Once that's taken out, I anticipate a complex rise to somewhere close to $78. So short-term bullishness prevailing for both varieties of Brent. But the more important thing is, the main clue I took for the markets to turn bullish is from Bitcoin. Bitcoin has clocked fresh record highs. That's signaling that animal spirits are back in the market. And the short term could see some pullback for Bitcoin somewhere close to 95K to 93K, but further higher highs are due. And that, in essence, tells us the animal spirits are back, and that will also bring higher highs for equity markets.
Okay, got that point. By the way, just going back and looking at some of these power stocks, power equipment makers. Both Hitachi and GE Vernova, can't take your eyes off them because they're back to their winning ways, between 5 and 7% higher. Just had a fundamental view coming in from Deepak Shenoy on this. In the morning, we had Sridhar Sivaraman, who was saying that he's quite positive on the power space as well. GE Vernova, by the way, in the last 1 month, we're talking just the month of May, has put on 41%, 42% gain. And it's taken out its all-time high as well. This is what we're talking about. Look at that, 50% up. On the stock, and that's why they say that this is a stock picker's market. Jay, I don't know if you've seen these stocks on the charts in India, power stocks, transmission, distribution, grid operators, etc. I mean, hectic price action. Any advice here?
Yeah, GE Vernova in particular has got more upsides to work with, and it's got a pullback due, but the momentum is quite strong on the upsides. I won't be surprised if the stock were to clock 3,000 in a few weeks' time. But first, there could be a pullback that fills the gap somewhere about 1960 to 1900, and then takes out to much higher levels. I'm not too confident about the Hitachi stock, but even that's the momentum isn't as strong as it is in GE Vernova. But so prefer GE Vernova over Hitachi. No, and if these I don't track the BSE capital goods index so closely, but these can be components of the capital goods space. So it's no surprise that they are moving vertically.
Anything in the large cap space? Any trades that you would recommend?
I'm monitoring the real estate space very closely, and interesting price patterns prevailing. The Nifty Realty Index, there is an inverse head and shoulders breakout, and DLF is looking quite attractive. And I would rather wait for a pullback to come through in DLF and even Oberoi and Godrej, they're also forming good basing patterns. Right for the moment, the markets are stuck because there is no new triggers coming from fresh sectors. So probably I will anticipate something to happen in the real estate sector. If that happens, that will have a knock-on effect on banking as well as cement stocks. So watch out for something to happen in the real estate space. That's what the charts are pointing out.
No, absolutely. And Jay, hold on. We're going to come back to you as we, let me just quickly wrap out things. 160 points down on the Nifty, 24,837. So over 1,000 points in terms of this volatility that you can see on your screen. Down, up, down, and a little bit up again. So big moves, at least on the Nifty. But even, you know, with the 160 point cut, it doesn't feel like a particularly bad day because of the amount of stuff which has happened as far as broader markets are concerned. So a really long list of volume-led gainers is what we had coming through once again. I mean, actually on the Nifty, there's not very much at all. You know, Geo Finance, and I think there was IndusInd Bank. Those are the only two names which had any meaningful gains. Otherwise, everything else less than 1% up. And on the downside, again, I mean, you know, it was just that lots of stuff was down, but nothing meaningfully. Ultratech was the only 2% plus kind of a loss. Whereas, if you look at the broader market, you know, it's pretty exciting stuff. Bayer Crop 10%, Apollo Micro 12%, Camlin Fine, GT&D, Hitachi, Aventil, Cosmo First another 6%, Premier Explosives, Minda Corp, Centum, Nibe, Sequent Scientific, Tega Industries, Jyoti Structures, Suvain Life Sciences, Exicom 10%. So vibrant, really. Shankara Bilcon another 5.5% odd. Advanced Enzymes about 6.5% odd. So lots and lots of activity really coming through as far as the broader market is concerned. Of course, there were losers as well, and some of them backed by volumes. But you know, as I said, nothing really very negative, or it was just a down day. That's it. So 24,840 is where the Nifty is now finally closed at. I think what we're going to do is we're going to wrap up things on this edition of Closing Bell. From all of us here, it's goodbye. Thank you very much for staying with us. But don't go anywhere. Markets forward. We'll pick up on all the action in just a bit on the other side.
Volatile day of trade ahead of monthly expiry. Nifty and Sensex see cuts of over 0.5%. The Nifty falls below 24,900. Broader markets outperform, however. The blue chips and mid caps end in the green.
Interglobal Aviation co-founder Rakesh Gangwal sells another 5.7% in Indigo Airlines parent for near 12,000 crore rupees. This is the sixth large chunk sold since 2022 via block deals and leaves him with under 8% in the carrier.
Rajiv Jain, chairman and CIO of GQG Partners, tells CNBC-TV18 Prime that India is part of the solution in Trump's ambition to rewire global manufacturing. He remains bullish on India and recently added Bharti Airtel and HDFC Bank to his portfolio. Hello and welcome. You're watching us here on a fresh new edition of Markets Forward. This is your go-to show where we aim to get you all the key points to gear up for the next trading day while we recap today's trading day as well. I'm Mangla Malu, with me, Vinny Motiwala. Hi, Vinny. It was a day of consolidation. There was volatility. The mid-cap index did well, but we are meandering in this range of 24,800 at the lower level, 24,750 if you had to broaden it out, and at the upper level on the Nifty. As we cross that 25,100 mark, we see some supply. So it's that 250 point, 350 point band either side of 25,000 that we're seeing the markets consolidate.
Absolutely. And today, actually, we're snapping that two-day gaining streak. So I did think that maybe would that momentum sustain? But yes, it has not sustained today. As of now, what Nifty closed at 24,800. Like Mangal was mentioning, that range that we saw it in, mid and small cap, that's seen an outperformance. Like you can see, advance decline ratio also, we're seeing a bit in the favor of advances, but not much of an excitement there. Still managing to hold on to gains on that front. So mid cap, 0.1% of gain, small cap similarly 0.1% of gain. What didn't do well today was the IT pack as well as in terms of the FMCG. Those were the top sectoral losers that came in today's trading session. But yes, that's how the market setup is looking like. But in the next 20 odd minutes, we have an exciting lineup for you all. And what we have in store for you all today, we'll start the day with the top movers and shakers of the day with Hormas, who's there on the wall. Then we have a flurry of stake sales on D Street today. Interglobal Aviation, that slipped after co-founder Rakesh Gangwal offloaded another 5.7% stake in the company. Shares of PG Electroplus and Sigility were also in focus today. Stay tuned in as we bring you all the details and more on these individual stocks. Last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. But first up, let's go across to Hormas, who's waiting by on the big wall to take us through the top stock movers of the day. Hormas.
A final few days where we talk about earnings reactions, and of course you can't not talk about them till they are ongoing, and TTK Prestige was one of those results that came in during market hours just before the close of trade. At one point the stock was down 8% but still recovered to end around 6% lower because of the net loss that it reported this quarter. Brainbees was another earnings reaction. Info Edge, the numbers were a miss on expectations as well. Blue Dart was an earnings reaction as well, and on the flip side, the good reaction that came in was Bayer Crop, ending as the top gainer on the Nifty 500 in today's trading session. There were a lot of other newsmakers as well. Sagility was one of them. The OFS starting today for the non-retail, a lower circuit for that stock. Olectra Greentech, despite the management clarification, ending 6.5% lower. GE Vernova building on to those gains that it saw in yesterday's trade. Interglobal Aviation, of course, on account of the block deal, and RateGain, the accident of the day today after the disappointing FY26 guidance, ending 10% lower. Stocks that did well on the back of volumes, and ITI was one such mover today. Of course, does not have significant float in the market, but 10% higher on that stock. Minda Corp did well, as did AWL Agri, the erstwhile Adani Wilmar. And lastly, some of the other losers within the broader markets, considering the fact that the texture of the market was that, look at Sumitomo Chemicals ending 6% lower, GIC and Emcure after 3 days of real solid gains, seeing some bit of profit booking in today's trading session. Back to you guys.
Right, Hormas, thanks a lot for that. Let's welcome Jay Bala of CashAchaos.com and Sudeep Bandyopadhyay, Group Chairman at IndiTrade Capital as well. Sudeep, let's start with Interglobe Aviation. That's been, the story of the day. The Gangwals cashing out. If you could, give us a sense over a period of time, is this an opportunity for one to buy?
Well, I think, Indigo is uniquely positioned with not really any competition coming in the near future. Air India is getting its act together, but I think it'll take some time. So they are in a unique position in aviation industry today, where they are commanding a leading market share and, fantastic route connectivity. Their problem with the old Pratt & Whitney engines also to an extent is getting resolved. And I think for the next, at least short to medium term, they're in a very, very strong wicket. Now, the question is, whether investors should buy or not. I'm a little careful about aviation industry. I think fortunes change very fast and very quick. ATF prices are at all-time low. And of course, this is a great time with travel tourism picking up. But things can change very fast. And globally, aviation industry has been extremely volatile historically, if you look back at history for the last 50, 100 years. So I'm careful at this kind of valuation where Indigo is currently quoting. But medium to short term, I think there is absolutely no problem in Indigo. But from a long-term investor's point of view, I think one needs to be a little careful at this valuation.
Bit careful at these valuations is what you're saying, but Interglobe Aviation today saw a fall of around 2%, right? And this is, like we were mentioning before as well, co-founder Rakesh Vangal sold around another 5.7% stake in the airline for nearly 12,000 crore rupees. Remember, this is the sixth large chunk sold since 2022 via block deals and leaves him with an under 8% stake in the company. Nimesh is joining in with us to give us details on this front. Nimesh, over to you.
Vinny, who says that aviation doesn't make you money, or for that matter, when the promoter sells, one should not buy? Ganwal has actually sold and actually proved the logic wrong in terms of not making money in aviation. So since 2022, the Ganwal family has consistently sold stake in Interglobe, and they've managed to raise 40,000 crores, which is equivalent to $4.7 billion that they've raised by selling stakes in September of 2022. But that's not done yet. They still own 7.8% stake after today's block deal, which at the current price is valued at 16,000 crores. But do remember, there is a 150-day lockup for the promoters now. So for next 5 months, the Ganwal can't take further stake in Interglobe. But if you look at the history of the stake sale, that's very fascinating. The first block deal started in September of 2022 when they started selling stake. A small stake that they sold in September 2022 and raised close to 2,400 crores. And the average price was 1927. That's the price at which the first time the Ganwal sold stake. After that, there was a 150-day lockup. So the next block happened in Feb 17 of 2023. That they sold at a marginal discount to the previous block. That is at 1882. That time they sold 4% stake and raised close to 3,000 crores. But after that, it's been a fascinating journey in terms of stake sale. The next block happened in 2023 of August. That's when they sold nearly 4% stake. And that price was 2454, a nearly 30% premium to the last block. And there they raised close to 4,300 crores. So that was in August of 2023. The next block happened after 150 days, which was in March of 2024. That is when the Ganwal family sold 5.8% stake. And that deal happened at 3242, another 40% premium from the last block. And that is when they raised 7,000 crores. The next block happened in August of 2024. Another 5.8% stake sold. 10,000 crore is what they raised, and that to at 47.59 rupees per share. And finally, today's block that happened, wherein they sold 5.7% stake. This is today of 2025. 5.7% stake sold, almost 12,000 crores raised at a price of 50 to 50. So from a first block of 1850 to this block of 50 to 50, they've actually, it's been 85% higher than the first block, and consistently they've been selling stake. The good part is, while they've raised money for 40,000 crores, they're still sitting on equity worth 16,000 crores, which they can sell over the next 5 months after the lockup gets over.
Absolutely. This is really defying. You've mentioned it through the day as well, that who cannot make money in aviation. Clearly, he's proving it wrong right now. So that's very interesting. Thank you so much for that, Nimesh. But let's move on and talk about some of these other block deals that happened today as well. One is PG Electroplast is what we're talking about. Now, staying on that news, the promoter of PG Electroplast, they sold around 5.6% stake via block deals, raising 1,177 crore rupees. The floor price for the transaction was set at around 740 rupees per share. Now, following the sale, the promoters will hold a little over 49% in the company, and this remaining stake will be under a 180-day lock-in period. Meanwhile, Sagility, there's an offer for sale that happened over there. The stock fell 5%, over 5%, and hit lower circuit as well after its parent company is looking to sell stake in is looking to sell stake mainly via an OFS is what they're going through. It started today, so there is a 2-day period, 27 and 28, retail and non-retail investors. There's a follow-up offer also, 7% is for some... that what they'll be looking to say and then sell, and there's an oversubscription of around 7 other percent. So overall it'll take it to 15%. The base price for that is around 38 rupees per share. This is mainly because they want to bring down their shareholding, which is around 80% right now, 82%, bring it down to the minimum public shareholding that they have of 75%, which is the norm. So that's what they would want to bring it down to, and that is why this OFS is going to be taking place. So Mangalam, we had a lot that's happening in block deals, OFS today as well.
Absolutely. As we come towards the end of the result season, post the silent period for all these promoters ends as well, then we see them pair their stake. But let's welcome Jay as well on the show. Jay, we've been talking fundamentals for a bit right now. What does promoters selling, resuming tell you about the mood of the overall market? What do you feel about the Nifty right now? I remember you turning bullish and everyone was very, very surprised. You still hold that, right?
Yeah, of course, Mangalam. The markets react in an endogenous way. They don't care about exogenous factors. And where the promoters sell and where the promoters buy are also a function of market psychology. And right now, particularly talking about Indigo, this might be not the case to like what it was before. It might be a case to follow the promoters now. The Interglobe stock has completed a very important price structure from 1500 to 5600, possibly a significant top and correction potential for the stock to somewhere close to 3700, but pending confirmation. As far as the broader market goes, when Nifty goes, I think as long as Nifty can hold 24,462, and if it were to take out 25,116, there could be acceleration to the higher side, much to the surprise of a lot of participants, including me. I'm anticipating a short-term pullback to somewhere close to 23,825 or about 24,000 ballpark, and then go back to higher levels. From a 6 to 12 months perspective, I'm bullish on the markets. Anticipate Nifty to hit record highs to somewhere close to 29,000 mark.
All right, 29,000 mark by when?
From a 6 to 12 months perspective, time is always approximate. Take the price levels as the guideline. Time, keep it very, very approximate. I say 6, so from the end of year to middle of next year.
Take that point. Let's get chatting about another stock today. Even though the mid-cap index did well with the frontliners, taking a bit of a backseat, consolidating, we had one share which was falling, and that is Olectra Green Tech. After the Maharashtra government has cancelled the company's electric bus order over missed delivery deadlines. Remember, this was one of the bigger movers from the lows and from the highs as well, has seen a correction of almost, 30-35%. Hormas joins in to tell us the entire story. Hormas.
Start off with the context first up, right? Late last evening, the Maharashtra's Transport Minister Pratap Sarnaik also wrote on his social media handle X that he has ordered officials to cancel the contract that was given to Olectra Green Tech for 5150 electric buses that was supposed to be delivered to the MSRTC. And they had also, the tweet also mentioned that there was a revised timeline that was given to the company for delivering 1,000 buses by the 22nd of May. But no such delivery took place within that prescribed timeline, and as a result of which the company had announced that the minister had instructed officials to cancel the order. Now, Olectra Green Tech had won the order back in July of 2023. That order was close to around 10,000 crore rupees, and there was in consortium with EV Trans Private Limited. Now, EV Trans was supposed to procure the buses from Olectra and deliver it over a 24-month period, which is by July of 2025. And it had failed to do so. Now, the company had issued a clarification earlier this afternoon, and they mentioned that EV Trans is executing the contract in an SPV with Olectra, and in this SPV, Olectra has only 1% stake, and the rest is with EV Trans, which is 99%, and they have not received any such order, which is of cancellation of the order. They have not received any such order as of now. So the contract execution continues to remain in process, is what Olectra Green Tech clarified earlier to the exchange changes. But despite this, the stock ended 6.5% lower. It's been a big mover, but from the top that it made in February of 2024, the stock is down almost 45%.
Okay, Hormaz, thank you so much for that. Important to keep an eye out on Olectra Green Tech, I beg your pardon. Sandeep, what's your view coming in on Olectra Green Tech as well? Are there any fundamentals you're keeping an eye out on? At one point of time, viewers, investors really made a lot of profit on this one, and then that fall came in. Now these concerns come in around this front. Is that something one should really worry a lot more on that concern?
Well, Vinny, I think investors will have to be careful about what they're buying. When you're buying into these kind of emerging technology, companies, you have to be prepared for volatility and uncertainties. You make money somewhere, and maybe you will lose money somewhere when you are buying into these kind of new age technology companies. Now, we can't comment on the specifics of this, order cancellation and what kind of impact it will have on this SPV and consequently on Olectra. But the fact remains that the timelines are not getting met, and government extending the timeline again and again, and in spite of that, things not happening does reflect poorly on the company, definitely. And we have to be careful and cognizant of these kind of issues which are emerging with a lot of these new age technology and manufacturing companies in particular. We have seen the situation as far as customer complaints are concerned in Ola Electric as well. There are innumerable customer complaints on these two-wheelers which Ola is producing. And now we are finding this Olectra Green Tech's electric buses. There are challenges in delivery. So it's better to be careful. And that's what I would say. Definitely not recommend a buy at this stage because the valuation has come down.
What's your thesis on the overall EV theme? Do you think it's avoidable because the growth rate isn't as estimated earlier? And secondly, the ones which are growing also are facing these issues. Even globally, Tesla was overtaken by BYD. So would you back ICE right now if at all you had to have any exposure to the auto sector?
Mangalam, I've been talking about this for last 1.5 to 2 years, is that if I have to buy something, I will buy rather Auto Anc because ancillaries are completely flexible. They are catering to EV as well as ICE. And that is the best place to be in. And some of the auto ancillary companies, fortunately, Indian auto ancillary companies are integrated with the global OEMs. So that's the best place to be in. So you don't get into this debate vis-a-vis, EV vis-a-vis ICE. But having said that, definitely, EV is one segment where one has to be extremely careful because we are just seeing the trailer. You don't know who is going to. Let's look at four-wheelers. Now, everybody is producing or claiming to be producing. But when these things will come to the market, who will be the leader? God only can tell. No one can recommend that.
All right, when everyone is, selling gold, you go ahead and sell. When everyone is buying gold, you go ahead and sell shovels. That's the old saying.
Absolutely, Mangalam. But let's shift focus now to another stock that is in focus that was slipping in trade today, and that was RateGain. It fell as much as 10%, and this is coming after the company's FY26 guidance on both growth and margin was a disappointment. Rima is joining in with us to give us the details on this front. Rima.
Company's conference call was yesterday, and they're guiding for a 6 to 8% revenue growth for FY26. This is sharply lower than the 12.5% growth that they had in the prior years. And before that, the company was growing at 50-60%. So this is the lowest revenue growth since FY21, its listing. Secondly, even the margin guidance, 15 to 17%, is a sharp drop-off compared to the 21.5% margins that they had in the prior year. And the company said this is on account of increased marketing expenditure to expand into APAC and Middle East. Now, analysts believe what to watch will be any sort of M&A action. The company has been scouting for M&A. So far, they've held back, citing very high valuations. But now analysts believe that considering the growth is slowing down for the company and they have cash of 1290 crore rupees, perhaps an acquisition is going to be imminent. So that's going to be the next trigger to watch. Today, Phillip Capital has downgraded the stock to neutral. Back to you.
Right. Jay, do you like RateGain? Do you like any of the travel tech names?
Last time the stock came on my buy list was in May 2023, and the stock is still above that level. It had a terrific run from there on, but looking at the price structure, I would anticipate a final low come through below the April 7th low, or it could even, clock a double bottom here. But, the stock looks like it's got a final low to come through, and the record highs it saw about 800 plus mark, 875 and 800 mark. That's got one more higher high to come through in the medium to long term. So, watch out for the next low. That might be an interesting low for an investor. That might be a mark of a significant reversal to come through for the medium term.
Okay, Jay, thank you so much for your view coming in there on Read Gain. And Jay, as well as Sudeep, thank you so much for joining in with us on the show as well today. But on that note, we're going to slip into a very short break. But before we go into the break, we'll leave you with the commentary from Rajiv Jain, chairman of GQG Partner, on his top picks. That's a CNBC TV18 Prime exclusive. Listen in.
Yes, so HDFC Bank, we thought was going through a sort of integration transition period as such between the two, HDFC and HDFC Bank. So since last September or thereabouts, last quarter last year till first quarter, we put almost $2 billion in HDFC Bank. And Bharti we started buying early last year, and then we've doubled down again this year. We've added a little bit to some of the other names too. Nothing meaningful, but they're like a few $100 million here and there. Nothing meaningful. So these are the two big positions. The other ones we quite like. I mean, you have public information on that. So because we're still very bullish on the utilities/infra type assets, we still like real estate. So and what's interesting, we feel this time around is that seems like, and for good reason, the rally seems to be led far more by large cap than mid cap. Mid cap are fine, but the valuation is less supported than a large cap, and large caps are now transitioning from, they've digested last few years for different reasons. And a couple other names, by the way, we just started, we recently initiated, so we were active, we can't talk about those. Again, large cap. So we feel that the large cap space looks fairly interesting, actually.
Okay. And the way the portfolio here in India is constructed, it's still, I mean, the thrust is still industrials, infrastructure. I mean, if you were to sort of look at it by weightage, would that be correct?
Yeah, so if you look at it, it's not exactly precise, but banks is a big exposure, as you know, with now 3, ICICI, HDFC, and State Bank of India, so all 3, they're pretty meaningful. And then you get the infrastructure/utilities, because one thing I found fascinating is that utilities globally tend to be defensive. For some reason, these stocks are less defensive. I mean, I don't know why, but they're less defensive in India, but they are far more predictable growth because the rollout is happening, and that's probably half of our book. When I say utilities, infra combined, and then you get then you get 2 staples. I mean, ITC and Patanjali, right. And then rest is sort of mixed match of some smaller positions. Welcome back to Markets Forward on CNBC TV18. Now let's take a look at the key corporate voices we had on our shows today. First up is Casey International. The management aims to generate around 1,500 crore rupees from their water business in FY26. Adds the miss in the full year revenue guidance was on account of delay in receivables from state government. Further, it expects margins to remain in the range of 8 to 8.5% this year.
We also had Afcons Infra. The revenue saw a significant decline due to geopolitical tensions. For second year in a row, the company missed its guidance, added that revenue growth will be in the range of 20 to 25% for FY26, while they're awaiting a near $2.5 billion order confirmation from the Dubai Municipality Corporation.
Last but not the least, Jyoti CNC, the management expects to maintain the growth trajectory in FY26 with margin guidance in the range of 25 to 27% and adds it will grow top line by 35 to 40% in FY26.
And with that, we've come to an end on this edition of Market Forward. But before we wrap, let's get you some key market events to watch out for. Vamakshi joins in with the details.
Well, Mangalam, the earnings season still continues. Thankfully, we're at the fag end of it, but we'll be keeping an eye out on a couple of counters that will be reporting numbers tomorrow. This list includes Cummins India, IRCTC as well as SAIL. Apart from that, there's a new listing that will take place tomorrow. That is Belrise Industries. We'll be watching out for that one as well. Some stocks also go ex-dividend tomorrow. This includes, some FMCG names like ITC as well as Colgate. And lastly, as far as some economic cues are concerned, we'll be keeping an eye out on India's industrial production data. RBI will be auctioning nearly 19,000 crores in treasury bills. The FOMC meeting minutes will also be out tomorrow. And lastly, OPEC and non-OPEC ministerial meeting is also scheduled for tomorrow.
Okay, Vamakshi, thank you so much for that. But with that, we'll wrap up this edition of Markets Forward on CNBC-TV18. Thank you so much for tuning in. Up next, you'll get more news and updates, so don't go anywhere. Thank you so much.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty decline after volatile session to end at the low point of the day. IT and FMCG stocks lead the fall. Mid-caps buck the trend with the index ending in the green. Private sector's contribution to investments made for the creation of new assets dips to its lowest level in 11 years. Data from FY24 shows government's share of the pie has been inching higher, while the household sector's share has been broadly stable. Indigo co-founder Rakesh Gangwal sells another 5.7% stake in the airline for nearly 12,000 crore rupees, trims his holdings to less than 8%. This is the sixth stake sale in the last 3 years, and the Gangwal family has amassed around 40,000 crore rupees so far. Income Tax Department sends notices to several non-resident Indians and companies who claimed benefits under tax treaties with tax havens like Singapore, Mauritius and Cyprus. Sources say the taxman suspects some may have set up shell companies in an attempt at treaty shopping. The world's top electric vehicle makers are in the slow lane. Tesla sales plunged 49% in Europe due to Elon Musk's political involvement and rising competition. Shares of Chinese EV giant BYD declined for the second day after reports of heightened regulatory scrutiny by Beijing. US President Trump steps up the attack on Harvard University, threatens to take away $3 billion in grants and distribute it to trade schools across the US. Harvard is already locked in a legal battle with the Trump administration over federal funding. Over 80 people reportedly killed across Gaza in the last 24 hours as Israeli bombing continues. Hamas claims to have agreed to a US ceasefire proposal, but Israel rejects the claims. Nearly 54,000 Palestinians have been killed so far in Gaza, according to officials. At least 40 containers have washed ashore in Kerala after a ship sinks off the coast. Navy and the Coast Guard race to contain a potential oil spill. The public has been warned not to go near the containers as it could contain hazardous chemicals. Also on the show, international mutual funds are having a ball, but Indian investors remain locked out due as the overseas investments limit has been breached. Sources tell CNBC-TV18 that discussions are underway to consider a hike in the investment cap. All right, let's start with the day's market action. Market declined after a volatile session, with Nifty ending below the 24,900 mark. Mid-cap index continued to outperform. IT, FMCG and auto sector snapped the two-day gaining streak. All right, from equities to commodities, gold prices declined more than 2% today. This as a stronger dollar made greenback-priced gold more expensive for overseas buyers. USA's softened stand towards the European Union also curbed safe haven demand for the yellow metal. Well, Indigo co-founder Rakesh Gangwal has sold another 5.7% in the parent company Interglobe Aviation for nearly 12,000 crore rupees. Gangwal has trimmed his stake in the carrier to under 8%. This is the sixth time since 2022 that Rakesh Gangwal or his family trust have sold stake in the airline via a block deal. Nimesh Shah is here with more on this. Nimesh.
Who says that aviation doesn't make you money, or for that matter, when the promoter sells, one should not buy? Gangwal has actually sold and actually proved the logic wrong in terms of not making money in aviation. So since 2022, the Gangwal family has consistently sold stake in Interglobe, and they've managed to raise 40,000 crores, which is equivalent to $4.7 billion that they've raised by selling stakes in September of 2022. But that's not done yet. They still own 7.8% stake after today's block deal, which at the current price is valued at 16,000 crores. But do remember, there is a 150-day lockup for the promoters now. So for next 5 months, the Gangwal can't take further stake in Interglobe. But if you look at the history of the stake sale, that's very fascinating. The first block deal started in September of 2022 when they started selling stake. A small stake that they sold in September 2022 and raised close to 2,400 crores. And the average price was 1927. That's the price at which the first time the Gangwal sold stake. After that, there was a 150-day lockup. So the next block happened in Feb 17 of 2023. That they sold at a marginal discount to the previous block. That is at 1882. That time they sold 4% stake and raised close to 3,000 crores. But after that, it's been a fascinating journey in terms of stake sale. The next block happened in 2023 of August. That's when they sold nearly 4% stake. And that price was 2454, a nearly 30% premium to the last block. And there they raised close to 4,300 crores. So that was in August of 2023. The next block happened after 150 days, which was in March of 2024. that is when the Ganwal family sold 5.8% stake, and that deal happened at 3,242. Another 40% premium from the last block, and that is when they raised 7,000 crores. The next block happened in August of 2024. Another 5.8% stake sold. 10,000 crore is what they raised, and that to at 47.59 rupees per share. And finally, today's block that happened, wherein they sold 5.7% stake. This is today of 2025. 5.7% stake sold, almost 12,000 crores raised at a price of 50 to 50. So from a first block of 1850 to this block of 50 to 50, they've actually, it's been 85% higher than the first block, and consistently they've been selling stake. The good part is, while they've raised money for 40,000 crores, they're still sitting on equity worth 16,000 crores, which they can sell over the next 5 months after the lockup gets over.
Right. Thank you, Nimesh, for that. The other big story this evening, private sector's contribution to investments made for the creation of new assets has dipped to its lowest level in 11 years. Now, data from FY24 shows government's share of the pie has been inching higher, while the household sector's share has been broadly stable. Now, Sapna is here with us. Sapna.
That's right. So if you look at the latest numbers that have been brought out by the Ministry of Statistics, it tells a very different kind of a story in terms of the private sector investments, and that's basically captured by the gross fixed capital formation, which in other words means their investments for capital creation. Having said that, FY24 was around 32.4%, their share in the overall capital formation, and this was probably an 11-year low, or rather it is an 11-year low as far as the data indicates. Way back in FY16, this has shot up to its peak of around 40-odd%, slightly over 40-odd%, and in comparison to FY13, the level was around 34%, it was slightly higher than that. So net 11-year low in terms of the contribution to gross fixed capital formation by the private sector. That's one. Second, as you have rightly pointed out, yes, investments by the government, both centre and the state governments, as well as the public sector units, that has really gone up, so to speak. They've kind of tried to fill up this gap. So if you look at FY24, both combined together, their contribution to gross fixed capital formation is actually over 25%. Let's break it up very quickly. Government share is around over 13-odd%. FY24, that's also over 2 percentage points up in comparison to FY23. Plus, if you compare to FY13, that's a remarkable improvement. Basically, that was around over 10-odd% way back in FY13. Now we're looking at a number which is easily over 13%. Similarly, in terms of the public sector units, around 11.8% is what they clocked in terms of their contribution to gross fixed capital formation. FY24, it is also higher year on year, that is FY23 in comparison. Plus, if you look at FY13, yes, again an improvement, that was around 10.2% at that point in time. Similarly, now if you come to the household sector, here again, that has basically stood the test of time, so to say, though of course it shows a tapering in terms of the contribution. So FY24, the level is lower than what it was in FY23 by around, I think, 1 odd percentage point. Plus, if you look at it in comparison to FY13 also, that level was around 43.7% in terms of their contribution to, investments that basically create assets. So it has tapered somewhat, but still it has stood the test of time. It continues to be the largest contributor to gross fixed capital formation, 41% consistent share in terms of the overall pie, at least in the last few odd years. So basically, to sum up, we can say that the private sector investments, they seem to be indicating that they're kind of retreating to a decade low. That's one. Second, public sector and government, both state and centre, have stepped in. Last but not the least, the household sector is very much there at over 41% contribution in terms of the capital formation. However, its share is also kind of tapering.
Right, thank you, Sapna, for that update. Moving on, shares of Bharat Dynamics rose in trade after a money control report said that the government would procure 500 anti-tank guided missiles worth between 2,000 to 3,000 crore rupees from the company. The acquisition will be aimed at boosting India's armoured warfare capabilities. The acquisition will equip the defence sector's T-90 tanks with advanced missile systems. Now, Defence Minister Rajnath Singh has approved the execution model for the Advanced Medium Combat Aircraft. The Aeronautical Development Agency will lead the project in collaboration with private sector entities. The Defence Ministry has said that participants can submit bids individually or through joint ventures. The AMCA project is India's only 5th-generation fighter jet program. The National Company Law Tribunal has deferred the liquidation proceedings for Bhushan Power and Steel till August. This comes a day after the Supreme Court directed a status quo on the matter. The top court's move will allow JSW Steel to file a review petition in court. Remember, earlier this month, the top court had rejected JSW Steel's resolution plan for Bhushan Power and directed NCLT to initiate liquidation proceedings against BPSL. Well, Assam's government has ramped up efforts to attract high-tech manufacturing industries in electronics and semiconductors. Speaking with CNBC-TV18's Ashmit Kumar, Chief Minister Hemant Biswa Sarma said that the state government has offered PLI benefits in addition to the centre's programs.
Whatever subsidy PLI you will get from Government of India, we will provide you additional 60%. Suppose you have been able to take 100 rupees from Government of India, Assam will provide you 60 rupees more. Apart from that, we will give you free land in Ratan Tata Electronics City near Guwahati. We will give you other tax incentive. And I think we want to provide a good ecosystem because ultimately the idea is to see that we do not spend foreign exchange where actually we can save. So that's the national goal, and we are trying to align with the national aspiration.
Shares of electric bus manufacturer Electra Green Tech fell in trade. This after Maharashtra Transport Minister Pratap Sarnaik directed officials to cancel the tender order awarded to the company for failing to meet delivery timelines. Without naming the company, Sarnaik posted on X saying that the company has been inactive in supplying over 5,000 leased buses. In response, Electra clarified that the order is currently under execution by its special purpose vehicle. The Income Tax Department has sent notices to several non-residents and companies who claimed benefits under tax treaties with tax havens. Sources tell CNBC-TV18 that the taxman suspects some may have set up shell companies in an attempt at treaty shopping. Timsy Jaipuria has more. Timsy, tell us more about the details that the department has sought.
Well, that's right. The Income Tax Department is understood to have sent notices to several non-resident Indians and entities based out of Singapore, Cyprus, Mauritius and other such tax havens who have claimed benefits under the tax treaties. Sources have shared that the Income Tax Department is suspecting treaty shopping by these non-resident individuals and entities using tax residency certificates from tax havens to file lower taxes. The Income Tax Department notices have cited that these tax residency certificates from tax havens alone are not enough as a proof to claim treaty benefits under DTAs. Also, these foreign companies must substantiate commercial rationale for investment in India to claim tax treaty benefits. The tax department has also questioned that the tax residency determined by these factors like control over investors, decision-making authority, economic substance, and not just these residency certificates. The tax department suspects that intermediate holding companies in tax havens may be shell companies set up to avoid paying higher taxes, and thus these entities and individuals must answer key questions such as who is the real beneficiary of the Indian investments made by these intermediate holding companies set up in tax havens, what is the commercial rationale for setting up these intermediate holding companies in tax havens, who are the key decision makers at these companies, what is the board composition, employee strength, premises occupied for business purposes, nature of business of these intermediate holding companies in tax havens, and much more. Now, to be seen is how these notices are able to find peace with the investments and these NRIs and non-resident entities, along with the tax outgo that the tax department has to manage. Back to you.
Thank you, Timsy. For that, Foreign Secretary Vikram Misri will visit the United States from the 27th to the 29th of May. Misri is expected to meet senior officials from the Trump administration. This visit comes amid President Trump's comments on mediating a ceasefire between India and Pakistan after Operation Sindoor. The Trump administration has cautioned Indian students studying in the United States against skipping classes or dropping out of their program without informing their respective school. The US Embassy in India, in an advisory post on X, said that visas of students who resort to such actions could be revoked and they may be rendered ineligible for further visas. Now, Indians account for close to 30% of the international student community in the United States. And staying with the updates on Donald Trump, the US president has threatened to redirect $3 billion in grants from Harvard University to trade schools across the country. In a fresh salvo, Trump slammed the Ivy League school for allegedly delaying the release of foreign student records. The attack comes after his administration moved to block Harvard from enrolling foreign students for allegedly promoting left propaganda. The European Central Bank President Christine Lagarde has hinted that the euro could become a viable alternative to the dollar. During a speech in Berlin, she said that the declining trust in the US economic policies could open the door for the euro to play a greater role internationally.
The ongoing changes create the opening for a global euro moment. And this is a prime opportunity for Europe to take greater control of its own destiny. With the right policy responses, there could also be opportunities. The changing landscape could open the door for the euro to play a greater international role.
Well, Japan has lost its position as the world's top creditor nation to Germany after 34 years. This as Germany's stronger pace of asset growth in 2024 overshadowed Japan's record surge in net external assets. Germany's rise to the top is mainly due to its strong trade performance. China followed in third place with $3.5 trillion in new assets. Shares of Chinese electric vehicle giant fell with the BYD registering losses for a second straight day. This owing to mounting concerns over regulatory scrutiny from Beijing. BYD's steep discounts across several models also stoked fears of a renewed price war in China's EV market. European sales of Tesla vehicles plunged for the second straight month in April. This as the US electric car maker continues to face reputational damage regionally and rising competition. Tesla sales fell 49% compared to last year in the region, according to the European Automobile Manufacturers Association. The Musk-owned EV giant's sales tanked nearly 40% year-on-year between January and April. Private lender HSBC Bank has laid off over 20 analysts as the firm plans to restructure its investment banking businesses. As per a Bloomberg report, the cuts will be primarily made in its Europe division. The restructuring will also include leadership changes within research divisions. Right, time for a short break. Coming up next, international mutual funds are having a ball, but Indian investors remain locked out as overseas investment limit has been breached. Details when we return. Welcome back. At least 40 containers have washed ashore in Kerala after a ship sank off the coast. Navy and the Coast Guard raced to contain a potential oil spill. The public has been warned not to go near the containers as it could contain hazardous chemicals. Defense officials have said that efforts are currently underway to respond to the oil spill. They added that the situation is currently managed and under close observation. Officials confirmed that as of 1:30 p.m. today, no oil has made its way to the shores of Kerala. Market regulator SEBI has granted final approval to Jio BlackRock Mutual Fund to begin its operations. The entity is a joint venture between Jio Financial Services and BlackRock. SEBI also approved Jio BlackRock Asset Management as the AMC for the mutual fund. The joint venture was first announced in July 2023. Israeli forces have killed over 80 Palestinians across Gaza in the last 24 hours. Reports suggested that Hamas has agreed to a ceasefire proposal. However, Israeli officials have rejected the claims. Officials have also denied that the proposal was put forth by the US, adding that the Israeli government would accept it. Meanwhile, a World Health Organization spokesperson has said that everyone is suffering in Gaza as hospitals have run out of medical supplies as Israeli blockade continues. And from one war-torn region to another, Ukrainian President Zelensky has said that Russian forces launched over 900 drones against Ukraine in 3 days. In a video message posted on X, Zelensky said there is no military logic behind this. He added that the attacks were a clear political choice of Russia and the choice to keep waging war. The Kremlin has responded to Donald Trump's remarks after he called Russian President Putin crazy. Now, Kremlin spokesperson thanked Trump for his work in mediating negotiations with Ukraine, however, stated that it's an important moment which is connected to an emotional overload of everyone involved. Trump's comments came after Russia launched 355 drones against Ukraine, killing 10 people. And speaking of Ukraine, Germany and Western allies have lifted restrictions on Kiev to fire long-range missiles into Russia for the first time. This comes after Russia has been constantly bombarding the region with drones. German Chancellor said that this move will help Ukraine defend itself against Russia. In response, the Kremlin has said that the decision is dangerous and is detrimental to reaching a peace agreement. At least 50 people have been injured after a car rammed into a crowd of Liverpool fans during the team's victory parade. The police have arrested a 53-year-old man who was believed to be the driver of the vehicle. Prime Minister Keir Starmer said that the whole country stands with Liverpool after this horrific incident. International mutual funds are delivering some of the best returns right now, but most Indian investors can't ride that wave. Sources tell CNBC-TV18 that discussions are underway between the RBI, SEBI and fund houses to raise the cap on overseas investments. The limit was breached 2 years ago, locking Indian MF investors out of the huge opportunity. Shivani Bajaj gets you more on this story.
International funds have delivered the kind of returns investors chase, double-digit global exposure and also portfolio diversification. But Indian investors have largely missed it out. Even as international mutual funds surge ahead, most Indian fund houses remain barred from accepting fresh inflows into the global scheme. The reason? A regulatory cap. Indian mutual funds can only invest up to $7 billion overseas, while ETFs are limited to $1 billion. That cap was hit in early 2022 and it hasn't budged since. Now, sources tell CNBC-TV18 that RBI, SEBI and fund houses are in continuous discussions about raising these limits. And this discussion is coming at a time when global funds are not just recovering, but outperforming their benchmarks. In April 2025 alone, international mutual funds delivered average returns of 8.51%, making them the top performing category according to Value Research. Zoom out to the last 12 months and the rally looks even stronger. Look at some of the funds. Mirai Asset Hang Seng Tech ETF FOF up 61%. Mirai Asset's another fund, NYSE FANG Plus ETF is up 41%. Another fund, Nippon India ETF Hang Seng Bees, is up 32%. Invesco's India Global Consumer Trends FOF is up 25%. But it's not just about the past year. Even in the first quarter of 2025, international funds comfortably beat the broader Indian market. Look at some of the numbers. DSP World Gold Fund 31%, and its benchmark has delivered 37% globally. Mirai Assets Hang Seng Tech ETF FOF is up 25%. Similarly, ICICI Pru Strategic Metal and Energy FOF is up 21%. And Nippon India ETF Hang Seng Bees is up 15%. So all of these funds, including those investing in Brazil, look at HSBC Brazil Fund, 15.12% in a quarter, beating the benchmark. Compare all of this to BSE 500 TRI, which posted minus 4.39% over the same quarter. So the opportunity is clear. Despite delivering some of the strongest returns in the market, most of these funds remain close to Indian investors. Now, why are the fund houses wanting a cap revision? This cap was last revised in 2008. Mutual fund industry AUM has grown 10x since that time. Investor appetite for global exposure is rising, and global themes from AI to clean energy to precious metals are gaining traction. For now, fund houses are waiting on the RBI to signal a change, because while the world's markets open up, Indian investors remain in a regulatory lockdown, and the cost of missing out is growing with every quarter. Back to you.
Thank you, Shivani, for that. With that is a wrap on this edition of Business 360. News and updates continue right here on CNBC-TV18.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. Well, India is the fastest growing market for a natural diamond in the world, and that's why De Beers Group is betting big on the country. De Beers is also leveraging blockchain technology to test diamonds and underpin consumer confidence. Joining us on the show is Al Cook. He's Global CEO, De Beers Group. Thank you for being with us, Al. And first of all, the last couple of years haven't been so strong when it comes to prices or demand for the diamond markets. How's 2025 shaping up for natural diamonds?
What we're seeing in 2025 is stabilization of the diamond markets, which is quite remarkable considering the volatility across the world. And what we've seen so far this year is some growth, particularly in the United States, in fashion jewelry, some small declines in bridal jewelry. Overall, US independent jewelers showed around about 8% increase year on year in April. So some signs of growth, but it's going to be a long, slow recovery for the diamond markets.
Al, it could be a slow, long recovery for the global markets, but what are your plans in India, especially with Forever Mark? And how are you also dealing with marketing campaigns and collaboration, especially with the Indian partners?
So our plans in India are really exciting. We are launching our new retail brand called Forever Mark, and that will be launching in Mumbai and Delhi and expanding to more than 100 stores after that. We're also increasing our investment in our Institute of Diamonds here in India, because this is the world's best place, the best technology at telling the difference between real diamonds, natural diamonds, and synthetic diamonds and fakes. So we're investing in India in that. We're also investing in marketing in India. We know that India is somewhere that has been in love with diamonds for thousands of years. And as a new aspirational middle class of Indians comes forward with the growth in India's economy, we want to create their desire and reinforce their desire to wear diamond jewelry.
Sure that. And also give us your sense on Indian diamond jewelry demand growth itself, because we do understand that the penetration is anywhere between 11 to 20%. What has been your own calculation?
We see at the moment that India's demand for natural diamonds is just under $10 billion per year. Over the next few years, we see that growing double digits with the potential to double by the year 2030. And that's really driven by the booming economy of India and by the rise of a middle class who aspire to own and to wear beautiful diamond jewelry. Traditionally, India has been a place where people buy gold for jewelry, but now we see more and more people, particularly to celebrate milestones beyond weddings and beyond marriage, they want to buy diamond jewelry. So we're very confident in the growth of the Indian market.
That's about India, but what also has been the demand and market size like in the bigger markets like China, US, where we do see a lot of tariff concerns right now. Also, how do you look at the Middle East? Because that is a market that seemed to be growing in the last couple of years.
In 2021 and 2022, during COVID, we had record growth in diamond demand, and then that fell off in 2023 and 2024. In 2025, we're seeing different trends in different countries. So in the United States, we're seeing broad stability, some growth, but broad stability. In Europe, the same kind of trend. In China, we see continued decline in demand, really driven by some challenges in Chinese economic growth. In India and the Middle East, we see growing demand, particularly in India, which is the fastest growing center of demand on planet Earth. So we're really excited about the growth in India.
Al, you mentioned about the lab-grown diamonds earlier, and that did make a disruption in last couple of years in 23-24, where we were hit by a slowdown in the global markets, the weak Chinese demand, and then the lab-grown diamonds as well. In the last year or so, would you say that the markets have settled now? There is more awareness and people have an understanding of both the varieties?
What we see on lab-grown diamonds is that the prices have really split. So today, you can buy 20 lab-grown diamonds for the price of one natural diamond. They're truly very, very different products. So what that means is people buy a lab-grown diamond if they want something cheap, if they want something fun, if they want something fashionable, and they buy a natural diamond because it's rare, because it's unique, and because they want to really commemorate and celebrate the most important moments in their life. So we see lab-grown and natural as really two different products. And when Indians look at those, they're very conscious that the two different products, lab-grown and natural, have very different values and a very different spirit about them. The Indian consumer is very discerning and really understands the difference between high-quality gold and low-quality gold. They really understand the difference between natural diamonds and lab-grown diamonds.
Well, that is very well understood, Al. But do you see any, if at all, impact of tariffs on diamond and diamond jewelry in the global markets, and any impact of that for the Indian markets then?
So, natural diamonds are not found in the United States, and they never will be, because the natural diamonds never formed in the United States. So there are no United States diamond mining jobs to protect. So we believe that the United States will exempt diamonds from tariffs, because in effect, the only effect of diamond tariffs is to increase diamond prices for US consumers. We know that Americans love diamonds, and we know that the United States government is very focused on what's best for the American citizens. So we're very confident that diamonds will be exempted from tariffs. We're also very pleased and very impressed by the leadership that the Indian government has shown in their negotiations with the United States on tariffs, led by Commerce Minister Goyal. And his strategy of engaging with the United States is proving very successful. So we're very confident that he will create a United States-India tariff deal that also reduces and removes tariffs from diamonds.
Also, the Kimberley process meeting has just recently concluded. What do you take away from that?
So the Kimberley process is very important. It's really given consumers around the world confidence that their diamond will never be a source of conflict, and that's absolutely vital. Now, the world has developed a lot since the Kimberley process was formed, so we need to expand the definition of conflict and of conflict diamonds to make sure that we really focus consumers on buying ethical diamonds. We in De Beers want to go beyond this, and we want to produce the most ethical, responsible and sustainable diamonds on planet Earth. We're very proud of the countries that our diamonds come from and the way that we produce and recover those diamonds. So we're working with an organization called CIBJO that is really setting very high standards for responsibility, ethics and sustainability, and we're going to seek to make our diamonds the most responsible, sustainable and ethical on planet Earth.
And we'll wind down this conversation with one final question, and this one is on diamond traceability. We do understand that a lot of use of blockchain is now done in diamonds for traceability, especially given the fact that we're looking at so many sanctions and Russia clearly basically out of the market as well.
Consumers around the world want to know where their diamonds are from. So we in De Beers have developed a new blockchain technology called Tracer, which tracks a diamond all the way from the place that it was mined to the shop and the store where it's bought. So customers can now buy diamonds with confidence that they know where a diamond is from. Now, in political terms, that's also important for governments, because they can choose where their diamonds are from and where their diamonds are not from. And we're working together with the G7 to ensure that De Beers diamonds meet all the requirements for import into G7 countries.
Well, amazing work being done when it comes to diamonds there, Al Cook. Thank you so much for joining in. He's the global CEO at De Beers, and tells us that 2025 seems better than what we did in 23 and 24 in sense of demand as well as prices. Well, let's now shift focus from diamonds to precious metals, and gold prices are trading off its all-time highs of $3,500 per ounce. This is after the US President Donald Trump joining us has talked about tariffs there. Joining us now to talk about the outlook for gold is Harshal Barot. He's Senior Consultant, Metal Focus. Harshal, hi, thank you so much for joining in. And we've seen some profit taking, and we seem to be holding around those levels right now. Would you say that it would need a more bigger trigger for the gold prices to go either ways from here?
Yeah, definitely. I think, Manisha, because some of the short-term triggers in the market, I think they've already been factored in terms of tariffs. I think the global markets are still in a waiting game. Because we are in a period where one day they are announced, the next day, they are recalled or paused. So I think until July, when a lot of these deadlines are due, I think we could see more of a sideways movement as far as the gold price is concerned. But given that there is still so much uncertainty around all these negotiations, there is still so much uncertainty about the US fiscal outlook. I don't think the rationale for holding gold has changed much. So, short-term profit taking aside, I think the overall picture still looks very, very positive.
Harshal, what is the sense from Metal Focus now, your in-house view on where the gold prices could be by the end of this year or the next?
So we still see gold prices making new highs. So we are looking at $3,800 to $4,000 levels for the gold price in the next 10 to 12 months going ahead. As I said, going ahead, even the US rate cut story will turn supportive for gold as we go ahead, and the true impact of tariffs on the US economy and the global economy will also become visible, further down the line. So I think all these factors will continue to support the diversification argument as far as gold is concerned. So we are definitely bullish, at least from a one-year perspective.
For the Indian markets, Harshal, we usually see an import of around 700 to 800 tons. That has been a norm, plus minus some. What is the expectation for this year with the all-time high prices, slowdown concerns, weaker retail buying? Are you tinkering with that number?
No, definitely. I think we could definitely have a sort of negative impact on demand if the prices stay higher, which we expect. So as you rightly said, the average Indian imports, consumption, I would say, is anywhere around, if I talk about jewelry consumption, it's around, close to 600 tons. Investment demand is, anywhere between 150 to 250 tons annually. So what we are seeing over the last year or so is that even the jewelry demand in India is falling because of the high price, but investment demand has been holding very strong. So we think a similar story is likely to play out this year as well. In absolute terms, definitely consumption could be down by anywhere between 5 to 10% compared to last year. But I think given the price, that will not be a very bad outcome.
Harshal, how would you look at the Indian buying this time around? Because we do understand that a major part, and this is something that we've spoken earlier as well, it's not so much to do with rural India now. The urban India seems to be buying more gold, would you say?
Yes, definitely. I think if you look at the price itself, gold is basically out of reach for a lot of Indian consumers at these price levels. And if you look at average rural incomes, definitely I think there is going to be pressure as far as rural consumption is concerned. And if you look at commentary also, from some of the jewelry companies, they also keep saying that, it's the middle and upper middle class which is driving gold consumption at the moment. So I think that's definitely a factor to watch out for going ahead as well. But again, as I said, jewelry demand could definitely be impacted also because of the fact that we are seeing a lot of shifts towards lower carats in jewelry. So typically the 22 carat plain gold segment is shifting to 18 carat plain, and the 18 carat studded is shifting towards 14 carat studded. So we are definitely seeing that as well happening in the market.
Harshal, also, what is your sense with silver there? What is the kind of import that we can anticipate for this year now?
So silver demand, I think, last year for a couple of months, it was way above average because of the India-UAE SEPA, and some of the flows came in because of those reasons. This year, I think we see more of a normalization in silver demand playing out. Some of the factors that we see in gold in terms of pressure on weights of the jewelry and articles that are sold that are visible in silver as well. We are increasingly seeing, silver articles and silverware being made in lower weights than they were typically because of the high price. So definitely that's going to be a pressure on volumes per se. But I think even the investment sentiment in silver, like with gold, is positive. So even though we may see silver jewelry and silverware demand suffer this year, I think silver investment will still remain resilient.
Harshal, while we talk about gold as in sense of imports, which happen between 700 to 800 tons, silver really has been volatile in sense of import numbers as well. 3,000 tons some year and 7,000 and then 8,000 plus as well. Is there any number that you guys have put out for this year as an estimate?
I think we would stick to the average that we have over the last few years, close to around 5,000 tons. 3,000 was an extreme low and 10,000 was, I think, on the extreme side, very high. So we think we would be somewhere in the middle of those two numbers the same.
Harshal, when it comes to jewelry buying, and most of the jewelers tell us that the first quarter of this calendar year wasn't so great, and this quarter yet again has started slightly on a weaker note. You've talked about 5 to 10% of a discount in sense of volumes. this first half clearly would have a bigger hit. Second half, do you expect those numbers to start picking up?
Yes, I think our expectation is that we will see in the second half of this year. Typically, what we've seen, over the last 2 or 3 years is that we see this concentrated phases of demand emerging in the market. So second half of the year has a lot of festivals and, more concentration of weddings in India as well. So I think some of the deficit of the first half would be offset in the second half, and we expect, consumers to return to buying.
Okay.
This quarter, again, as I said, it's a seasonally weak period. June, July, typically you don't see too much weddings happening in India as well. So, yeah.
So before we let you go, a final quick answer on silver, price estimates there?
Silver, if I talk from a slightly longer term perspective, next 2 to 3 years, we are definitely seeing, prices close to $40 being achieved easily. As I think it's being discussed very widely over the last couple of years that the market is in a deficit. So, as those deficits start playing out in the physical market, some of the inventories that are already there across the global market, once they start to come down and we see an actual physical deficit playing out, that's when the real price rally in silver will begin.
Fair point that. Harshal, thank you as always for joining in. So gold and silver prices both quite bullish on the higher side. The demand may suffer in sense of volume, but not in sense of value. And that is a positive one going forward for the markets. Well, on that note, it's time for a short break, but don't go anywhere. We have a special guest from AP Moller Maersk joining us on the other side of this short break. Welcome back, and joining us on the show now is Bhavik Mota. He's Director Head of Ocean Products South Asia at Maersk. Bhavik, hi, thank you so much for joining in. And the first quarter numbers are on the higher side, export and import, both of these. Where do you see the maximum growth coming in from?
Thanks, Manisha. Thanks for having us. So if you look at from an India export perspective, the growth over last year, same quarter is 19% on exports and around 9% on imports. But you have to take these things in perspective. Let's not forget last quarter, 2024, we had Red Sea crisis, so the volumes were quite subdued. And also this year, we had an enhanced capacity into Europe and North America. So when you see this kind of a growth, it's a combination of volumes normalizing and also the added capacity that we have. Also, if you see from a growth perspective, it's around the 3 key segments, if I may call that. It's the retail lifestyle, it's the auto, and it's the refrigerated cargo, which is basically showing us the growth. And also from a markets perspective, it's mainly the US, the Europe, and the Middle East, which are showing phenomenal growth for us.
So just coming back to those numbers, how would you look at India vis-a-vis the rest of the world?
I think India is well poised in that sense. We are seeing uncertainty around the world. The trade tensions are only going up. From a relative positioning perspective, I think we are better off compared to many emerging economy around us. But of course, the major dynamics are still very fluid. So we see how it evolves. But what we are seeing is a good traction on volume. So if you look at US as one of our biggest trading partner, we have seen some very good growth in the retail and lifestyle segments, and even from an auto perspective, we have seen good growth coming from, US as our trading partner. So we are a bit of insulated from the global uncertainty, also given our strong domestic consumption story that we have. So I think we have a relatively better poise, but let's see what happens after July. All eyes on
those
that.
90 days get done. That exactly was my next question, really. So when you look at tariffs, we've seen a lot of concerns, slowdown concerns as well come in from US. China is yet another story. How are you as a company preparing or strategizing for that?
No, absolutely important, right? So when these tariffs came in, I think from global perspective, I think for us, China suffered the most, right? Because of the massive tariff increase that were there. So we saw sudden pause. And all of a sudden, last few weeks, our capacity was open by almost 30-40%. Okay. And then what happens is because of uncertainty, you start redeploying the capacity to ensure you're not sailing the ships empty. Thanks to the pause of 90 days, which is given kind of short-term stability to the business, short-term predictability to the customers, and we are already seeing a spike in the bookings and the cargo moving from China. When you look at India from that perspective, I think we are well positioned, as I said, in the global trade landscape compared to a lot of other global economies that we have. But US being the largest trade partner, I think a comprehensive trade agreement is super important to enhance the stability, strengthen the bilateral commerce, and also provide a bit more predictability for the businesses on both sides.
Bhavik, I remember the last time I met you guys at JNPT, there was a talk about a lot of investment pledge capacity as well and tie-ups too. So from then to now, what is the kind of progress that we've seen?
Absolutely. So I'm sure you remember we launched the Gemini network in Q1. It's our East-West network. It was designed on the premise of bringing reliability, agility, and flexibility to the network. The new capacity deployment for India, I think, means three things. It basically meant enhanced coverage for our customers into Europe and US, better planning and predictability, and last but not the least, better control over the entire supply chain, so to say. So this for us is just not a new network, but it will help us navigate complexity, reduce uncertainty, and help customers grow with confidence. We already at 90% reliability, which was designed a year ago when we were conceptualizing Gemini. The good news is this week we also have all the ships implemented into Gemini, so we 100% phased in, and all of the results for the ships are about 90%, including the shuttles in the short run that we are having. Okay. So for India, it means better reliability for our customers doing business into Europe and US. We're already seeing an increasing appetite and want to do more business with us on this network.
How is also the collaborations within the Indian partners?
It's quite good. It's with HAPAG. So far so good. We have the similar mindset. That was one of the main fundamental reason that we see the customer the same way, we see the network the same way, and we want to run the operation the same way. And that's why the kind of collaboration, operational collaboration that we have with them. And so far so good because when like-minded people come along, and then you make it happen.
Would you, the way the world seems to be right now, Bhavik, there's a lot changing with India, Pakistan, and then with what's happening with Turkey and Azerbaijan and Afghanistan and Shabar Port. I mean, there's just so much happening. Yes. How are you dealing with it all? I'm not even talking about Russia, Ukraine, Israel, and that side of the world.
I think, the key is, how fast we can respond. I think the black swan events, which used to happen once in a while, I think they have become more norm than the exceptions. So the reason you have to build your entire network has to be built on, agility and flexibility so that you can kind of isolate the problems. So yes, it does create a lot of nuisance. It creates a lot of rework. It creates a lot of operational cost and so on and so forth. It's not easy, but the whole focus is how do we ensure that our customers are getting solutions. If there is a contingency somewhere, what is that alternative that we can provide so that they can run their supply chain very smoothly, they can meet their requirements and demands across the globe very smoothly. But yeah, it's not easy, and
it's not.
Always be on your toes.
I'm sure. Bhavik, also, so going forward from here then, you talked about sectors which have done well for you in first quarter.
Yes.
Is that an aberration there, or this has been a pattern going forward? What sectors are you looking at with more interest? And also, what are your plans now within India for 2025?
Yes. So the sectors, as I said, retail lifestyle will, of course, is the sector we want to focus. US, Europe are our key markets that we are seeing. We are also seeing increasing requirement in East, which is Australia and Japan, double-digit growth. Of course, albeit it's coming on a smaller base. The second sector is automotive. Both domestic sales in Q1 as well as the exports have been on the rise. We expect that rise to continue. An interesting part is it's not the usual US and Europe market. It's more of Latin America and Africa. So Latin America is coming up big time. In fact, we have doubled our volumes into Latin America. So we expect that to continue. Europe is going to be a bit more cautious on automobile, with the rising costs and also stiff competition coming from the Chinese EV manufacturers. So US and Europe bit subdued. Latin America, Africa, we see a massive growth coming in. And last but not the least, the refrigerated cargo, meat exports, phenomenal growth, 26% year on year on reefer volumes, both combination of ease down government policies, opening trade across the world. We'll also see massive exports of pharmaceutical and shrimps into North America. Pharmaceutical also saw a good 50% growth compared to what we had used to seeing. And of course, the onions and the usual fruits and vegetables that goes in. Apart from this, three key segments, retail, lifestyle, automotive, and refrigerated cargo, we see a good rise in specialty chemicals. We see a good rise in project cargo and also commodities in general that move out of India. So the outlook for 2025, while the world is still uncertain and there is a lot of trade tensions around us, we're confident that India should deliver the plan that we have in place, given both the capacity enhancement into Europe, US, given that we are kind of insulated or in a better place compared to other emerging economy. Fingers crossed, things are looking good.
All right. On that high note, Bhavik Mota, thank you so much for joining in. And well, it does look on a positive number when we look at the numbers in sense of exports, imports, shipping, and the kind of work that is being done on the sector within India as well. With that, that's all the time that we have on the show. Thank you for watching.
Hello and welcome to News Centre. I'm Parikshit Luthra. Days after Operation Sindoor, the Indian government is beefing up its arsenal. Defence Minister Rajnath Singh has approved the execution model for the Advanced Medium Combat Aircraft. The Aeronautical Development Agency will lead the project in collaboration with the private sector. The Defence Ministry has said that participants can submit bids individually or through joint ventures. The AMCA project is India's only fifth-generation fighter jet program. That's not all. The government also plans to procure 500 anti-tank guided missiles worth up to 3,000 crore rupees from Bharat Dynamics. The acquisition will equip the defence sector's T-90 tanks with advanced missile systems. The Defence Acquisition Council has cleared proposals to acquire weapons worth 54,000 crore rupees in March this year in an attempt to increase the combat potential. But let's focus on the Advanced Medium Combat Aircraft program. Last year, the cabinet had approved this program for a fifth-generation fighter development. And joining us now to talk about this execution model is former Defence Secretary Mohan Kumar and also former Vice Chief of the Indian Air Force, Air Marshal Anil Khosla. Thank you very much, gentlemen, for joining us. Air Marshal Khosla, if I can begin with you. Last year, the cabinet had approved a plan to build a fifth-generation fighter. This was a 2035 roadmap that we had approved. How does this execution model that has now been approved, which will also involve the private sector, foreign participation is also allowed, how will this give an impetus to our efforts to build a fifth-generation fighter?
Yeah, Parikshit, very valid question, and AMCA is very, very essential for our Indian Air Force and Defence Forces. And if you see the world powers, we are lagging a bit as far as the generation of aircraft and the technology of aviation fighter aircraft and other aircraft is concerned. And this step will definitely give a boost and impetus to the whole project. It's a fundamental rule that if something is not working, you need to give a catalyst, you need to give a boost, and that boost has to come from outside. And in this case, it will, foster more inclusive growth and bring efficiency in our development framework. So private industries, whether they come independently or joint venture or through consortium, it will really pull in resources of the private sector along with the public sector, and a larger pool of resources as well as skill will be induced into the whole ecosystem. And, the expertise, innovation, resource optimization, all this will, give a boost to the project. It will streamline manufacturing processes. It will improve the delivery timelines in case we have a parallel parallel production lines in private as well as the public sector. And, and it's also merit-based approach. So it will be competitive in nature. So obviously everyone will have to pull their weight and, put in their best. So I feel that this is a good step, and it will give a real boost to the whole ecosystem and the production timeline as well.
Right. Mr. Mohan Kumar, to get you in at this stage, what is the current progress that India has made with its AMCA program so far? Where are we? And is there an urgent need to prepone timelines? We were looking at a 2035 roadmap. It could take about 10 years to develop such an aircraft, induct it into the Air Force. Do we have so much of time looking at the current geopolitical challenges?
Good evening, Parikshit. Thank you for having me on the program. Yeah, your question is very valid, because this program has been hanging fire for a long time. My feeling is that the delay has already been to the extent of, say, maybe more than a decade, or even more than that, because it was actively considered a decade ago, and still it is in the conceptual stage. And so we need to move fast, because you look at the threat perceptions in the subcontinent. China has already developed the J-20, J-35, and then another one is in the advanced stages of prototype production. And China means automatically goes to Pakistan, and probably it has already gone. And so it's imperative that India speeds up and accelerates the production of the advanced medium combat aircraft. As quickly as possible so that we can outstrength this matched. Otherwise, it is going to give not going to have a level playing field. When it comes to using an advanced fifth generation aircraft. So the timelines are now, it's going to take 10 years from what I have read in the news. It's going to take nearly 10 years. It's not till 2035 that we are going to see the real manufacture of this aircraft. So I do not know what kind of possibility there is for accelerating the production of this aircraft, because there are so many constraints. The design stage, for instance, there is a design which has been displayed by AMCA. This was displayed at the Aero India, the last Aero India. I do not know at what stage the design is pending, because you have got an external design that is already there, which has been shown. But there are a lot of other things which goes into design. Because you have to involve the private sector partners, they have to get the specifications. So it involves complex design processes. I don't know how much time the ADA is going to take to finalize all those design details. So that is a very critical point. Then after that, the private sector comes in. So there's of course there's a little hope that they will live up to the expectation. But then,
okay, Mr. Mohan Kumar, I'm going to come back to you. You raised a very important point that yes, an external design is ready. It was showcased at Aero India, but I think the engine will be very, very critical. How fast can we either develop an engine on our own or get it from a foreign player? M. Marshal Khosla, if I can get you in at this point, we're looking at a situation where there are reports that China may speed up or expedite deliveries of J-35s, stealth fighters, fifth-generation fighters to Pakistan. China has already developed a J-36 or a sixth-generation fighter, which is in advanced stages of testing as well. What are the options for India to develop and meet its own targets of having a fifth-generation fighter as soon as possible? What are the options on how to speed up the process?
Yeah, Parikshit, you rightly brought out, China has already flown sixth-generation prototypes, two of them, as news reported about a couple of months back. And obviously, they are producing the fifth-generation aircraft at a very rapid rate. Already news is about 200, 300 aircraft. And after this Op Sindoor, if you saw the news, China has said that they may supply Pakistan on a fast track by August this year. The fifth-generation aircraft and at a subsidized rate. Now, how far that is true and how far it will fructify, we'll have to see. But you have to prepare for the worst-case scenario. So, Pakistan having a Chinese fifth-generation aircraft and the China flying fifth-generation and sixth-generation aircraft, our situation becomes very critical. And we need to, by whatever means, we need to accelerate our production and our capability development. Ultimately, Atmanirbharta, self-reliance is the ultimate solution. But we should keep in mind the minimum deterrence value. That is, our capability should not go down so that, the deterrence doesn't work. So for that, in case we cannot meet our domestic production, then we need to acquire outside. So in this case, the 114 aircraft, which the Air Force has been, the MRFA aircraft project, which has been languishing, I think a situation will come, then maybe we'll have to procure from outside while supporting Atmanirbharta fully and implementing all the possible options and every possible means to accelerate that.
Marshal Khosla, looking at the current options that are there available globally with our allies, who do you think would possibly be the best for India to partner on such a program to deliver such fighters, either through a joint venture or through acquisitions as soon as possible?
Yeah, so it's not an easy question to answer. Obviously the choices are only three. That is, China is out. I mean, China is one of the producers. That leaves USA and Russia. Russia, we have already gone out of the joint venture which we initiated earlier for 257, and we came out of that project due to various reasons. And going back to, I don't know what will be the cost benefit analysis now. And American aircraft also has got its developmental issues, plus timelines also, I'm not sure because 20 odd countries are flying, and their preference will be to give to NATO, EU, or the partners first before giving it to India. And then there's a cost factor, technology of transfer, the effect on our indigenous project. So in my mind, this question is not easy to answer. The answer lies in whatever means we need to spend money and get this capability, and whatever deal comes out best. That means a transfer of technology comes in, and also it does not affect our indigenous program while being cost effective. I think that is the way we need to go. There's no clear-cut answer.
All right, my final question to Mr. Mohan Kumar. Mr. Mohan Kumar, at a government level, how much do we need to increase our spending? How much do we need to expedite procedures to make sure that our aspirations, our needs for fifth-generation fighters are met in the shortest possible period?
Well, I think now the ball is in the court of ADE and its mechanism. How they are going to produce, because it has been given to them, and the model of production has also been approved by the government. So it's now up to ADE to develop whatever is it. Then it's only up to government to give financial support whenever possible, whenever it's required, without any delay. And usually, these financial support also sometimes take delay, sometimes gets delayed because of questions and counter questions and all those things. But we have to have a streamlined process of, monitoring is very closely, because I think there should be a very aggressive monitoring of this program from the government side, with the services and other agencies, involved in it, coming together and monitoring it on a periodic basis. And that's the only way we can take this forward and accelerate this program. The other issues are, the one point which I really wanted to make is the manufacture of this aircraft also there. One of the major issues, we are talking about self-reliance. Now, self-reliance is an issue which government will have to address, because self-reliance alone is not going to happen, because self-reliance means, actually fast production, import of some materials, because we need import critical parts like engines and other things. So long as, we are not able to produce our own engine in the country. So the parallel process is that there should be a mission mode approach for production of the aero engine, which is meant for AMCA.
Mission mode
I think
production for aero engines. We've run out of time, sir. But thank you very much for joining us on the program, and I'd like to thank Air Marshal Khosla as well. Clearly, there's a lot that needs to be done, and as fast as possible. We're taking a break, but coming up on the other side, international mutual funds are having a ball, but Indian investors remain locked out due to overseas investment limits. That and much more when we are back on the program. Assam government has ramped up efforts to attract high-tech manufacturing industries in electronics and semiconductors. Speaking to CNBC-TV18's Ashmit Kumar, Chief Minister Himanta Biswa Sarma said the state government has offered PLI benefits in addition to the centre's programs.
Government of India has set up a 22,000 crore PLI specifically targeting this sector. So, followed by that, few states has also announced their own scheme. Assam has also announced our own scheme last week. What we have said that whatever subsidy PLI you will get from Government of India, we will provide you additional 60%. Suppose you have been able to take 100 rupees from Government of India, Assam will provide you 60 rupees more. Apart from that, we will give you free land in Ratan Tata Electronics City near Guwahati. We'll give you other tax incentive. And I think we want to provide a good ecosystem because ultimately the idea is to see that we do not spend foreign exchange where actually we can save. So that's the national goal and we are trying to align with the national aspiration.
Wonderful, sir. When we heard the first OSAT announcement by Tatas in Assam, that took a lot of people by surprise. Let's talk going forward. Can you give us a sense what the outlay for this new outreach is, what the eligibility criteria is, what the disbursement criteria is for companies that want to participate?
Basically, we have conducted Advantage Assam 2.0, where industry leaders were present. Honorable Prime Minister gave a lot of time. And after that, we are getting very good traction. People are inquiring, people are coming. I can give you a small statistics. Post Advantage Assam, 11 top hotel brand has signed agreement with us to set up their hotels in Guwahati, right from Marriott, Taj, Radisson. So that's the kind of traction we are getting in last 4 to 5 months. We have set aside rupees 25,000 crores for the purpose of providing PLIs and capital incentive. And that is working for us. So in this case, so far as electronic component manufacturing and semiconductor, we are creating very simple structure. If you are getting your approval done at the Government of India level, we will not put a second layer of scrutiny. So we will not scrutinize anything. You just give us a proof of Government of India's disbursement. Within 7 days, we will give our disbursement. So we have kept it very, very simple.
International mutual funds are delivering some of the best returns right now, but most Indian investors can't ride the wave. Sources tell CNBC-TV18 that discussions are underway between RBI, SEBI and fund houses to raise the cap on overseas investments. The limit was breached 2 years ago, locking Indian MF investors out of the huge opportunity. Shivani Bazas gets you more.
International funds have delivered the kind of returns investors chase, double-digit global exposure and also portfolio diversification. But Indian investors have largely missed it out. Even as international mutual funds surge ahead, most Indian fund houses remain barred from accepting fresh inflows into the global scheme. The reason? A regulatory cap. Indian mutual funds can only invest up to $7 billion overseas, while ETFs are limited to $1 billion. That cap was hit in early 2022 and it hasn't budged since. Now, sources tell CNBC-TV18 that RBI, SEBI and fund houses are in continuous discussions about raising these limits. And this discussion is coming at a time when global funds are not just recovering, but outperforming their benchmarks. In April 2025 alone, international mutual funds delivered average returns of 8.51%, making them the top performing category according to Value Research. Zoom out to the last 12 months and the rally looks even stronger. Look at some of the funds. Mirai Asset Hang Seng Tech ETF FOF up 61%. Mirai Assets, another fund, NYSE FANG Plus ETF is up 41%. Another fund, Nippon India ETF Hang Seng Bees is up 32%. Invesco's India Global Consumer Trends FOF is up 25%. But it's not just about the past year. Even in the first quarter of 2025, international funds comfortably beat the broader Indian market. Look at some of the numbers. DSP World Gold Fund 31% and its benchmark has delivered 37% globally. Mirai Assets Hang Seng Tech ETF FOF is up 25%.
trend. Similarly, ICICI Pru's strategic metal and energy FOF is up 21%, and Nippon India ETF Hang Seng Bees is up 15%. So all of these funds, including those investing in Brazil, look at HSBC Brazil Fund, 15.12% in a quarter, beating the benchmark. Compare all of this to BSE 500 TRI, which posted minus 4.39% over the same quarter. So the opportunity is clear. Despite delivering some of the strongest returns in the market, most of these funds remain close to Indian investors. Now, why are the fund houses wanting a cap revision? This cap was last revised in 2008. Mutual fund industry AUM has grown 10x since that time. Investor appetite for global exposure is rising, and global themes from AI to clean energy to precious metals are gaining traction. For now, fund houses are waiting on the RBI to signal a change, because while the world's markets open up, Indian investors remain in a regulatory lockdown, and the cost of missing out is growing with every quarter. Back to you.
The other big story we are tracking, private sector's contribution to investments made for the creation of new assets has dipped to its lowest level in 11 years. Data from FY24 shows government's share of the pie has been inching higher, while the household sector's share has been broadly stable. Sapna is here with the data.
India's private sector investment appears to have lost some steam. According to the Ministry of Statistics, the contribution of private non-financial corporations in gross fixed capital formation, or GFCF, which are basically investments for creating assets and can be seen by the green line, declined to 32.4% in FY24, which is a 300 basis points drop year on year, and an 800 basis points drop since FY16, when the share of private investments had peaked at slightly over 40%. Perhaps more significantly, it is also the lowest level in 11 years since FY13, when the private sector share was over 34%. So while private sector momentum has weakened, the government has been stepping up. The centre and state share in capital formation, depicted by the red line, was over 13% in FY24, almost 200 basis points higher year on year. It is also an improvement from FY13, when their share was just over 10%. The rise in government investment is further reinforced by public sector enterprises. Public non-financial corporations' contribution in capital formation, depicted by the yellow line, was at 11.8% in FY24, over 200 basis points higher than FY23. This is also above the FY13 level of 10.5% and probably in line with the government's push to public sector-led capital expenditure. Contribution by the household sector, meanwhile, remains broadly stable and is depicted by the green line. In FY24, households accounted for 41.7% of the gross fixed capital formation, lower than FY23. The sector is also off its high of a 43.7% share in FY13, as private investments took some of that space in the earlier years, as is depicted in the bar graphs, in the line graphs. But, however, households still continue to dominate as the largest contributor in capital formation, with a consistent share of over 41% at least in the last 3 years. To sum up, government data is probably signaling a change in investment landscape, with private sector's share investments retreating to a decade low, while government and public sector units are stepping up, and households maintain their dominant, though slightly tapering share. As India navigates its investment-led growth narrative, these shifts are crucial to understand the drivers of capital formation and the implications for long-term growth.
With that, it's a wrap on this edition of News Centre. More news and updates continue right here.
you didn't want to do anything with the jewelry business, but yet in 2005, both of you decided that it sparked the fire within. What happened there?
Aditi's always loved jewelry. I grew up watching my dad in wholesale gemstones, and I always thought it was a sleepy, antiquated business, so never really wanted to get in. Kind of crazy story. Ratan Tata came to speak to campus for us, and I introduced myself and I said, I'm such a big fan, and we had a 3-hour conversation, and he's like, why don't you visit Tanishq?
What made you focus on the gemstone side of the story?
I think it really making our customer the true north. So when we introduced the good, better, best heirloom, no one else had done that before.
You believe that this is the Kodak moment for the diamond industry. Why do you say that?
Federal Trade Commission in the US said a lab-grown diamond is a diamond. They're chemically, physically, optically identical.
Okay.
You can get a lab-grown diamond for 90 to 95% cheaper.
What's the India plan?
We've started 6 months ago with an alpha launch. We've way surpassed our expectations so far. India is roughly 22% of the world's jewelry market. I think by 2030, I think we get past 1,000 crores.
Hello and welcome to the Young Turks Reloaded podcast. I'm Shireen Bhan. Entrepreneurship is about creative destruction. It's about creating new categories, but it's also about reinventing existing categories. My guests today are attempting to do that in the gems and jewelry business. They started Angara, which quite literally means the fire within, a company started in 2005 to cater to the online jewelry market in the US. Today, they've got revenue of over $100 million and the aspiration of touching $1 billion by 2030. They've just launched in India and they're hoping to make India a big part of their global growth plan. To talk to us about bringing color back into the jewelry business, as well as the disruption that we are seeing in the gems and jewelry business because of the growth and the rapid rise of lab-grown diamonds, Ankur and Aditi Daga join me on the podcast today. Ankur and Aditi, many thanks for joining us here on the Young Turks podcast. It's great to have you join us on the program. But, I want to start with the two of you. Both of your families have been in the gems and jewelry business for centuries. In your case, centuries. In your case, how long?
Decades.
Decades, okay. And you didn't want to do anything with the jewelry business, but yet in 2005, both of you decided that it sparked the fire within. What happened there?
Yeah, so I think both of our stories are slightly different there. Aditi's always loved jewelry. I grew up watching my dad in wholesale gemstones, and I always thought it was a sleepy, antiquated business, so never really wanted to get in. But life, of course, comes full circle. So my first brush with jewelry was in college. Kind of crazy story. Ratan Tata came to speak to campus for us.
Right.
And
this is Wharton.
This is at Wharton, correct. And then he just mentioned that he's going on a train to New York. So I went to the train station, tried to catch him there. And I introduced myself and I said, I'm such a big fan, but I just want to let you know that when I go from Delhi to Jaipur, I'm behind a Tata truck. And the exhaust is coming straight into our car and I fall sick. And so if you can fix that, that would be great. And we had a couple of minutes of conversation. He said, give me your details. And so when he got back to India, he then wrote me a letter saying, next time you come to Bombay, I would love to meet you there, which is insane. So go to Bombay, and we had a 3-hour conversation. And he's like, why don't you visit Tanishq? Tell me what you think. And that was my first brush with jewelry retail. And I said, wow, this is amazing. This is organized retail. I'm seeing what they're trying to do. Thereafter, I happened to join McKinsey after undergrad. And fortuitously, my first project my longest project was with McKinsey, with Tanishq in India. And so I said, I clearly see this way to organize jewelry retail, and that's the future for me. So life ends up coming full circle.
So Tanishq inspired the Angara story.
That's right.
And what did you think when he decided that this was what he wanted to do?
The next time he says, I'm never doing something, I'm going to bet against it, because he said I'm never coming into the jewelry industry before. So yeah, I learned my lesson.
And you never considered getting into the jewelry business either.
I didn't initially, but I don't know. I always had a love for jewelry, and I don't know when I fell in love with it first. Whether it's, going as a child to the temples and you see the deities adorned, and it's glowing, everything's glowing, and it looks so beautiful, and kind of I fell in love without knowing, or like seeing my mom kind of decked up in the holidays, and I'm one of 4 sisters, so like always waiting for us, that if there's an occasion, we're going to take something from her jewelry box and wear it, and hearing, seeing my father design so passionately, or my grandfather hearing his stories for their legacy, seeing him sit with the karigars and really kind of making sure that the jewelry is perfect for that custom piece, nahi usko wapas todo, make it again because the customer wants it this way, it doesn't sit properly, and that attention to detail,
old school.
it was in my head, I guess at some point. And then his charming brothers, at the front and sales, but they weren't selling, they were building lifelong relationships, it felt like. And then it felt like this treasure trove, and like, how do we scale this? Somewhere at the back of my mind, it was there. And then kind of when we met fortuitously and wanted to start something together, we kind of put all those pieces together.
And the two of you actually met and got married when you were 22, and that was an arranged thing.
That's right.
Yes.
Yeah.
And so you didn't know each other at all.
No, not at
previously.
all. Nope.
So what was that? What was that like when you first met Aditi?
Yeah, so we were introduced, as you mentioned, and it took me 2 months to figure out, can someone be so perfect? So I was like, kuch to gadbad hai. And what you see is what you get. But I think what I ended up doing is I used all my karma points from my previous lives, went all in, and luckily she said yes, and I'm super thankful for that.
And so you have grown together. I mean, 22 and then setting up a company together and watching it grow into a $100 million enterprise today with the aspiration of $1 billion in sales by 2030. You've kind of built this together. What's that been like?
I mean, it's been an amazing journey. Like you said, we grew up together. So we went to grad school together. Then we started this together. All those points of disappointment and, shared experiences. We love doing things together, but we also find time to pursue our passions independently. And I think that's the key, that we grow independently and together.
I'll get to the passions in just a second, but let's talk about starting up. So in a way, the gems and jewelry business has been in your blood, but actually starting up, that experience, and I want to go back to 2005, the decision to bootstrap, not get any venture money on board, that's because you saw a friend of yours go through a bad experience, I believe.
That's right. Yeah. One of my best friends raised a lot of industry capital or venture capital at that time. And everything for him went right for the first 4 years. But the markets in 08, 09 turned and everything changed. All of a sudden, he was able to sell the company. The board took him out of that position. And I never wanted to go through that. Ours is a 50-year journey. It's not like a 5 years, let's build it, let's sell it type of play. And so venture capital, 5 to 10 years fund cycles versus what we were trying to do was completely different. And honestly, I would have been fired in the first 2 years if there was a VC funding us. I did everything wrong. So graduated in 05. We raised some amount of industry capital at the onset. We hired a lot of very good people without product market fit. So we had huge burn, but very little in terms of sales. We were trying to do everything. We were trying to do diamonds, color stones, all sorts of product categories, which was trying to attack too much with limited amounts of capital. And the people that we hired, even though they were amazing, a lot of ex-De Beers of MH, very senior talent, but we were a startup with no revenue. So it was not the right person at the right time. And so I went through 90% of our capital very quickly. We were 4 months away from running out of cash. And we would have gone under in that case. Luckily, a few things happened. One is we shifted all of our operations from New York to India. And our operating cost structure went down by 90%. We focused all in on colored gemstones. And all of a sudden, things started taking off. And our team there and in India, we were all in. We were 24/7. We lived it. This was our life. And the only thing that we're thinking about is how do we make the company survive? And that focus that resulted from that, even till today, we're trying to be as focused as possible, but we have PTSD from that time, right? So that's why no further capital raises. We will grow it on our own. We will reinvest capital, and we'll get to $1 billion without any external funding.
I'll talk about the PTSD in just a second, but many of the decisions that you were forced to take, shifting operations to India or doubling down on the colored gemstone side of the business, were perhaps not conscious decisions as much as you were forced to take them because of your circumstances. As you look back today, I mean, that was probably the biggest bet that you made, which has taken the company from where it was, which was on the brink of not being able to make it to where it is today. So as you look back, what made you focus on the gemstone side of the story?
So I think it really making our customer the true north. I think that was the key. Customers would call us and say, we love the design, but can you give us a bigger carat weight, or can you give us a higher quality? And we said, there's something to this when enough customers started calling in. So when we introduced the good, better, best heirloom, no one else had done that before. So we pioneered in introducing different qualities, different sizes, different metals all together. And so no matter who the customer was, you could get exactly what you wanted, provided you liked that design sensibility. And that's really helped us take off.
I'll talk about personalization as well, but going back to that difficult period, the first 5 years of the business where, you were still figuring things out. Selling jewelry online to start with is a difficult proposition because trust has been so crucial as part of this transaction. And it's taken a while, even in India. I mean, in India, it's taken a long time for people to get used to the idea of e-commerce to start with. But what was that like? I mean, when you put the business plan together, how concerned were you about the acceptability of this?
Yes, so the numbers on the business plan or in the Excel sheet were actually super exciting. But in reality, so what was happening is 2% of jewelry in the US was sold online back in 2005, but it was growing at 50% per year. So we're like, oh, this is amazing. We always wanted to be a color stone oriented company. And kind of the backstory there is that these families been in the business for 300 years. And 300 years ago, it was all about color. Right. So for hundreds of years, color was the majority of studded jewelry. And we said, can we bring that back? And my parents were in wholesale gemstones also. So I kind of saw it happening. And I was like, there's an opportunity here.
Why do you think we lost on the color side of the story?
So De Beers and A Diamond is Forever was the single most brilliant marketing campaign of all time. So in 1947, they launched 75 years ago, roughly, with the idea of A Diamond is Forever, with a 2-month salary for an engagement ring. That's how you show your love. This idea, the singular idea of perfection. So a D flawless, which is colorless and flawless, is what we should all aspire to. And that's the ultimate idea of success. And all of a sudden, color stones went from majority of the industry to 10%. And in that process, can we revive that? Can we bring the industry back to that? It was much easier said than done.
Right.
And so if e-commerce is 2%, if color stones are 10%, so that's 0.2% of the market.
Yeah.
That's what we were dealing with. And we had to create the entire category, which was a gargantuan task. And it took us a lot of time and effort and luck to get out.
Well, luck is crucial, but what were the key ingredients, the key levers that you decided to play on to take on the De Beers of the world and, in a sense, reclaim share?
I think there was a lot of education involved, as Ankur said, and no one knew about the different qualities of gemstones that were available. So, for example, in India, when you say opal, people could be selling Ethiopian opal, which has a beautiful color play to begin with, but as you begin to wash your hands, it loses it over time. Versus a higher quality Australian opal, which is the one that should be sold because that's what lasts for a lifetime, or as long as as it can. And I feel like those things are critical, educating the customer about the different qualities. And, I have a background in education. So it's really about scaffolding. On every page, it's like, okay, what information does the customer need? What's a rollover telling them that this quality exists in this space? What does good mean? What does better mean?
Yeah.
And I think that was key. Education was really key. And in the e-commerce space, reviews are pivotal.
Yes.
So really building that trust over time, it took a lot of time and effort, to do that for the customer.
So when do you believe you felt that you had been able to survive this storm and then you could put together a plan to thrive and scale the business?
Yeah, so 2010 was a turning point. We were cash flow positive in 2010, and that's when we also jumped back into color stones. And because the business started taking off, we said, you know what? we have something here. And what was fascinating for us is the awareness initially was so low. So even if you go to Tiffany and Fifth Avenue, right, the largest retail store in the US, you would only see 3 to 5 sapphire rings. So, and citrine, peridot, amethyst, those were not even there. So we had to first show customers that, hey, this is the entire world
This
of
exists.
gemstone
Yeah.
jewelry. And back then, Google and search engines in general were the primary way to get traffic. So somebody had to actually type in sapphire engagement ring for us to show up. So building awareness, I think, was step one. But what was interesting is we were the only ones in that market. So because there was no competition, the cost per clicks were very low. And the economics started working, and we started growing very quickly as a result of that, thankfully.
Let's talk about 2025. I mean, what we're seeing in the jewelry market worldwide today is this big takeoff as far as lab-grown diamonds are concerned.
Yeah.
And now, people are asking the question on what actually happens to a company like De Beers. In fact, you believe that this is the Kodak moment for the diamond industry. Why do you say that?
So I'll give you some data that we're seeing live. So De Beers is interesting because it was 6.6 billion in revenue in 2022. It halved. 2024 was 3.3 billion. In a high fixed cost business, it's just very difficult to survive in that. But the reason that happened is in 2018, the FTC, so Federal Trade Commission in the US, said a lab-grown diamond is a diamond. They're chemically, physically, optically identical.
Okay.
So all of a sudden, it legitimized the entire industry for everyone. And now, you fast forward 7 years, you can get a lab-grown diamond for 90 to 95% cheaper.
Yeah.
And it's chemically, physically, optically identical. So the whole use case that for natural diamonds...
So if it's identical, then what's the difference then? If it's certified as being identical.
Yeah, so one comes out of the earth,
Yeah.
one is grown in a
Yeah.
lab. So the interesting thing is, so historically, diamonds, the way De Beers created that whole industry, there were two primary reasons you would buy diamonds. So one is financial flex. If you're wearing a 1 carat, 2 carat, 3 carat solitaire, it says something about your socioeconomic status.
Yeah.
Right? The other is it's an inflation hedge. It outperforms inflation by 2 to 3% per annum. So it's a great investment while you get to wear it. Now with lab grown, the financial flex goes away because it's 90 to 95% cheaper and no one can tell if you're wearing natural or lab.
Right.
And the investment case goes away because diamonds have gone down in price anywhere from 40 to 45% in the last 3 years.
So it's not a safe haven bet.
No longer.
No
It
longer.
used to be historically.
Yeah.
Last 10 years, that's not the case. Almost every other asset class has outperformed. Sensex obviously has. Gold has performed better than that. Gemstones have performed better than that. So because both of the primary use cases are gone, it's going to be very difficult for natural diamonds. You'll have like a Tiffany, Graf, Harry Winston, and 20% of the market will survive, but everything else, in our opinion, is going to be left.
So you believe this is irreversible, the change that we're seeing today?
It's a better product.
But you can afford to be agnostic because it's still 20% of your business is between lab grown as well as natural diamonds at this point in time, and the bread and butter continues to be gemstones for you. But do you see this changing? Do you see yourself shifting more towards lab grown if you believe that that's going to be the market that's seeing this kind of explosive growth?
Yeah, so the lab grown, so the color stone market in India is very interesting. So 2% of India's market is color gemstone based. That's it. But
and given the history of India, why do you think that's the case? Again, a lack of choice, especially on the organized side?
So it's choice and it's education both. And this idea of Indians look at jewelry as an investment. That's the primary use case, right? And in that, there was never this idea that gemstones would hold value, whereas diamonds were perceived to hold value. So I think that's fundamental to it. 90% of the market is gold jewelry, 10% is diamond studded, and then 2% is... But what's really interesting is if you look at Sotheby's, Christie's, Phillips auctions world over, color stones are way outperforming. They're 2 to 3 times the high estimates for all of the auctions, right? So as an asset class, they're starting to take off. And I think as soon as people start realizing that, and diamonds, so if you look at kind of appreciation, diamonds have lost value over the last 10 years. Sensex has gone up by 11%, gold by 14%, gemstones anywhere from 15 to 21% per annum. As soon as people start understanding that, I think the market starts to turn. There's already an affinity. So we were surprised at how savvy the Indian customer already is. We're selling aquamarine, citrine, sapphire, emerald, ruby, with a lot less need for education than we had in the US.
Okay.
So like you were saying, the market already knows the Maharaja Patiala wore color, the Nizam wore color.
Yeah.
It's been a part of our culture for centuries. But there is a slight need for re-education now, which is part of our objective.
And just to add to that, I think it's really interesting how in colored gemstones, it's the opposite of diamonds, where 80% in India want natural color. And I think this is natural affinity, the astrologer told him to wear this. And, things like that, and color is such a big part of our DNA,
Yes.
where, the energy that comes from natural gemstones is very attached to the Indian DNA as well.
So you've got lab-grown diamonds taking off, but you've also got a preference as far as natural gemstones, colored
Absolutely.
gemstones are concerned. So both running on parallel tracks. But let's talk about India, because it's taken you a while to get here, to launch operations here. You finally decided to launch in India. What's the India plan?
So we've started 6 months ago with an alpha launch. We've way surpassed our expectations so far. So we've done 10 crores in revenue thus far with minimal marketing. We're already profitable in India. India is roughly 22% of the world's jewelry market. I think by let's say 2030, I think we get past 1,000 crores. And I think it grows from there. So we're super excited about the market. It's ripe for color right now. Just some rough numbers just to kind of show India versus the world. 400 billion is the overall market size for jewelry.
Right.
India's 85 billion, as is the US. What's insane about that is the US GDP is $30 trillion.
Yes.
India's GDP is 4.3 trillion.
Yeah.
Right? It's 7 times more valuable here. 2% of India's GDP is jewelry, and is growing at 10 to 15% a year. This is, in my opinion, the most exciting gemstone or jewelry market in the world, and it will be for the decades to come. So we're super bullish. We're excited. Yeah.
So clearly the headroom for growth is what you're betting on as far as India is concerned. But what have been some of the initial learnings? You said you launched in India 6 months ago. What have been some of the initial learnings of having launched in India?
That the e-commerce customer is very savvy in India and they're very mature. So our average order value is over 50,000 rupees, which is really high for jewelry online. Like Ankur mentioned, that the Indian customer is very sophisticated in terms of knowing about color. There's been less education. They've leaned towards blue stones a lot, which is surprising to me. That has been a key learning. And then the lab versus natural in diamonds, that 80% want lab. And on the color side, like I mentioned, 80% want natural color. I think those have been the key learnings.
We've had a couple of startups here in India do online jewelry. And of course, you talked about Tanishq, we had Carrot Lane. And I believe you have a personal link to Mithun Sacheti at Carrot Lane, and he managed to sell that business
brilliant job.
to Titan. But how do you see the evolution of the e-commerce market, and specifically the jewelry market? What surprised you about the way that it's going in India?
I think, so what's idiosyncratic about India versus the US, I think India will go very much the way of the US. This is still today a offline market. So even the e-commerce players that you're talking about, most of their sales happen offline. I think that will start to change. I think people are much more comfortable. We're talking about Zepto, for example. They're just much more comfortable ordering online, buying online.
Yeah, difference between a coffee and a 50,000 piece of jewelry.
That's right. And in that 50,000 rupee piece, I think, so it's interesting. 3 fundamental differences are happening for us in India versus the rest of the world. One is 80% of the customers that have called in are saying, "Aapka store kahan par hai?" Right? And that doesn't happen anywhere else in the world.
Aapka store kahan pe hoga?
Yes. Or kahan par hai? Right? So they're already thinking we have offline retail.
But are you going to do offline retail?
So our first store worldwide will be in Jaipur.
In Jaipur?
Yeah.
That's home.
That's
quite literally for you.
That's great for both of us.
So we're super excited about that. But we're going we're completely customer-led in terms of what's needed. Our store experience, I think, will be fundamentally different than what you see here at a Tanishq or Carrot Lane or Bluestone or so. There'll be much more experience centers. Everything we do is bespoke. So if you order right now, the piece will be built after you order.
Okay. Every single piece is done that way.
Every piece is bespoke. And let's say you're a ring size 5. It will be made in that. So kind of the manufacturing process for us, we're completely vertically integrated end to end.
Right.
Except for mining, we kind of do everything else.
Yeah.
So we cut and polish gemstones, we cast jewelry, we manufacture jewelry, we retail over the web. So that piece, kind of the life cycle of that piece is really interesting. So if you order now, let's say it's a ring size 5, it's a 3-stone sapphire ring. It will be cast, it will take 8 hours to cast it.
Okay.
Then we'll hand pick the diamonds and color stones. We'll set that. We will then polish, rhodium, QC thoroughly, and then ship out. So by the time you wake up tomorrow morning, it's already on a flight somewhere to you. But that whole 6-month process from 300 years ago, we've compressed down to 24 hours.
How do you do that? How do you compress what took 6 months to 24 hours?
We had to vertically integrate. So we started with manufacturing jewelry. Then we went into product development and design. Then we started cutting and polishing gemstones. And so we'll buy rough all over the world. We'll go to Western Australia for opal. We'll go to Thailand for ruby and sapphire. A lot of gemstones are cut and polished in Jaipur. So we have that as well. And so we'll source...
manufacturing is all here?
So manufacturing, we have a center in Thailand, a center in Los Angeles, and a center in Jaipur. And so we have now offices all over the world. We have supply coming from all over the world. Everything is centralized. Depending on where the customer is, we will make everything in-house. But then it gives us the ability to really cater to whatever the customer wants, which is back to our original mission. It took us a lot of time and effort to do it. But now we feel like the experience is what it should have been from the get-go, which is you could have whatever you want. And I'll give you kind of an example of ring size. So most jewelers across the world will stock in a ring size 6.5. And let's say if you're a ring size 5, they will modify and resize. Now the problem is structural integrity is harmed and the shape of the ring is harmed. But it's convenient because they have inventory. Right? And they want to sell that inventory. For us, we're making it from scratch, so we'll do it right the first time. We have 40 different gemstones, multiple qualities, shapes, sizes, budgets. To do all of that in one physical store is very hard. But what our customer is looking for is, are you guys legit? Do you actually exist? If a problem happens with the product, can I come in and return it? And that's where I think the experience center concept for us will be key. This is our quality. You compare our quality to the best in the world, a Tiffany or Harry Winston or so forth, and we'll be up there. These are the natural gemstones. We'll have an example of a ruby, sapphire, tanzanite, so forth, and all of the various qualities we offer. And we'll have an example of lab also. And then you tell us what you're envisioning, what the design is, and we'll craft it and ship it to you, which is a fundamentally different model than anything else.
So it's already personalized, but are we now heading into an era of even more personalization or hyper-personalization, if I can use that term, especially with the AI tools that are now available? I mean, how much of that is already being incorporated into plans for you?
Yeah, so it's a fundamental part of what we're trying to do. So the original mission is to bring the industry back to its roots. AI will make that possible. So we're developing something as a chatbot right now where it's like you're sitting in front of your jeweler. And you would say, hey, I'm dreaming of a pendant that's a 5-carat sapphire pendant, or I met my fiance in Venice, and so I want that to be a part of the ring. And in real time, the piece will be created and priced out, and you could choose the gemstones as part of that process. So we're super excited about that.
And you can change anything along the process as well. So it is hyper-personal.
And so, you know, are we starting to see results already of this? I mean, is this already in execution?
It's still in testing phase right now, but we're excited to launch it pretty soon.
But to be able to do this at scale, I mean, what are your concerns? Because it's great as an idea. I mean, everybody would want as customized a solution as possible, especially when we're talking about jewelry, because it's not just about the piece, but it's also the emotion linked to it. But to be able to scale that, what are some of the challenges?
I think making sure that, and that's why we're in testing phase right now, that all the details are there. You know, we don't want to miss anything, and I think that's critical.
So I think for us, a couple of things. So there's a front end, which is easy to do. The back end is the structural integrity of the piece needs to be maintained. It needs to look and feel right. But then the back end is the key. We have 40 different gemstones, all shapes, sizes. And if we don't have it, we can cut and polish it for you in that permutation. So tying all of that together is going to be key to providing that type of experience.
I have a little backstory on that. I'd once sketched something of a design on a paper, and Ankur very sweetly for my birthday took that paper and got it made into a jewelry piece. Now, it was just a sketch, right? It was something in my head. And it didn't have the structural integrity, so it didn't sit well at all. And that example is really stuck in our head too, that, you know, you can dream of something if you scribble something on paper or you're thinking, but to really make sure that it sits well in the customer, you know, we want to make sure that experience is truly complete.
So will you say no, this doesn't work? I mean, if somebody were to send you a design that,
I think
will you turn it down?
We will actually suggest
a variation,
modifications.
Of that. Okay, but you know, as you look at the opportunities today, and everyone's talking about the need to be phygital, I mean, you know, there is, of course, all of this online retail that's going on. But how do you look at this omni-channel or phygital, you know, proposition that most people are looking at this point in time?
So I think that the question is, why are they looking for offline here where that doesn't matter in the rest of the world? And I think a part of it is trust. They want to make sure you're there. At least in our initial feedback, that's what we've heard. They don't necessarily need to buy the product right there, because it is a big purchase. It's not one of those things like we're talking about Zepto. It's not a Coke can. This is a 50,000 rupee piece of jewelry. So they're willing to wait, is our hypothesis so far. But they just need to make sure we're legit. And whatever they're buying, they need to be able to see what it will look like, most likely. And as we progress, we'll see if that hypothesis is correct, and we'll modify accordingly. But our strong hunch is that's how it's gonna play out. So we're building flexibility in. So we have Jaipur as a factory, Thailand as a factory, LA as a factory. We're sourcing from all over the world. We're also selling all over the world. We're over-indexing on investing 4 more centers than we need to make sure we never disappoint the customer. Once we lose that trust, that relationship ends.
The complexity of dealing with tariffs, supply chain disruptions, what have the last few weeks meant for you?
It's a challenge, but we don't expect this to slow down anytime soon. The level of complexity will only increase. Uncertainty will only increase. We just have to be ready for it. We're selling all over the world. Our supply chains all over the world. So in this year alone, we're launching in India. We're also launching in all 6 GCC countries. We're launching in Japan. So we're taking on a lot at once, but the core is the same. And as long as we can maintain that core, Aditi talks about these 3 pillars. So color, customization, and exceptional quality and exceptional value. As long as we can maintain that, we'll make it work. We'll figure it out.
And it's interesting because you talked about gold prices and things like gold prices are not in your control, or what happens to diamond prices not in your control because, you know, it's a global supply demand and of course market shifts impacting prices. How do you then ensure that without losing money that you can actually, you know, deliver to the customer at a price point that continues to be attractive, that continues to be affordable? I mean, how much room is there for you to be able to absorb the kind of price shocks that we are currently seeing?
So I can give a couple of examples of what we did to work around the tariffs to some extent. So one is, so April 5th, there was a 10% tariff kicking in.
Yeah.
We shipped all of our inventory worldwide to LA before that.
Okay.
Luckily, it can travel by air, so it's easy to do, to beat the time for tariffs. We can also cast.
It's really a race against time, wasn't it?
It was. And we didn't have a lot of heads up, as nobody else did either.
Yes.
So, and we can cast in LA as well.
Okay.
So if you make the entire piece in LA, we don't need to worry about tariffs. So that's where the flexibility comes in. We're able to adjust to whatever it takes. And importing gemstones into the country before the tariffs kicked in, that was a 0% import duty or tariff.
But does it not increase costs for you to be able to do all of that in LA versus being able to do it in Thailand or India, or, you know?
It does. Yeah, but we have to,
So
it's a cost
going
benefit.
to eat into your margins?
It will.
Yeah.
It will. And
significantly.
Crazily enough, we have not passed that increase to customers yet. Because we're anticipating that there's going to be an agreement. We don't know when, but there will be an agreement. So if we revise prices, we may need to revise it back. And that will cause turbulence for the customer. And so we're absorbing it for now, because everything we're importing now, we are paying a duty on. And there was really a double whammy. So gold prices went up 15% in the last month.
Yeah.
Same time the tariffs kicked in.
Yeah.
So everything for us is 25% more expensive than it was in the past. We can absorb it now, and we're going to need to figure it out fairly quickly, as is everybody else in the US.
Yeah. And we just don't know as far as the tariffs are concerned. That's the big, I mean, you know, dealing with uncertainty and as business owners, how do you cope with that? I mean, there isn't a playbook that teaches you, and you can only control what you can control. So is there a focus right now on efficiency and squeezing out costs, on, you know, what is the focus to be able to cope with this uncertain, volatile environment where you're also dealing with input costs going up so significantly?
So to be honest, it's an advantage for us.
Really?
So we're vertically integrated.
Yeah.
So we capture margin all across the supply chain.
Okay.
Right? So tariffs will affect everyone, but we can absorb it a little bit better. Our profit margins are also the highest in the industry because we're vertically integrated. So we have a little bit of buffer there, and we can actually be aggressive on pricing when no one else can. So we're trying to think of it more as an opportunity than a threat. At the same time, the stuff we can't control, we don't worry about.
And neither can anyone else.
Yeah,
too,
yeah,
right? So
absolutely.
we're on a level playing field.
Yeah. So let's talk about growth, and let's talk about expansion from here, and what the priorities are going to be. You talked about the India launch, your GCC, Japan coming up as well.
Yeah.
So, you know, your hands are full. It's going to be a busy next few years, I would imagine. What's the investment pipeline looking like for you at this point?
So as CEO, my job now is as a capital allocator. And the capital for us is not inventory, it's people. Our ability to scale and to grow is directly correlated with our ability to find the best in the world at whatever it is. And that's hard. You know, any key role, it takes me probably 6 months to hire that person after 15 interviews. And if we can find the right people, we can grow very quickly. And, you know, because we're not public, because we don't have a board, we don't worry about quarterly projections. We know what our 5-year plan is, our 15-year plan is. We don't worry about the short term. It will happen when it's supposed to happen. We're very aggressive, but we want to get it right, because the cost of getting it wrong, we've been through before. We don't want to go through that again.
So what is the 5-year, 15-year plan? Let's start with the 5 years. What is the 5-year plan?
I think we get to $1 billion in revenue.
By 2030?
By 2030. I think we get to $10 billion by 2040.
By 2040?
Yeah, and at that point, we're only 2% of the jewelry industry. And if you look at category killers for everything else, Google has 70% of search, for example.
Yeah.
Or Microsoft has 70% of enterprise software.
Yeah.
Loosely speaking, right? So 2% doesn't feel all that hard from that perspective, but easier said than done. And I think at that time, and even when we get to $1 billion, our profit margins, given our profit margins, will probably be one of the most profitable jewelry retailers in the world. But we'll also be better than anyone else at delivering value to the customer. That's how we're thinking about it. And that being said, putting stuff on Excel is pretty easy to do.
Yes,
Actually
that's the
delivering
easy part. That's the easy
We
part.
joke about it. He thinks in Excel, I think in PowerPoint.
And then the two converge in real life. In real life. But is it getting, as part of this 5, 10, 15-year plan, is a listing, a possibility? Is that something that you would want to consider or are considering at all?
There are all possibilities.
I mean, we have no immediate impetus to do it.
Yeah.
I know you have a rule as far as experimentation within the company is concerned.
Yeah.
So $10,000, if it works, it works, and if it doesn't, then you pull the plug on it.
Yeah. That's to be agnostic to who comes up with the idea, whether it's mine, Ankur's, or anyone in the company. And it's basically to keep it fair, and then so you don't get emotionally attached to the idea.
Right.
And that way, if it works with the 10,000, we'll scale it. We'll put more money into it. But if it doesn't,
but is there a time limit as well? There is clearly a $10,000 limit, but is there a time limit as well?
Absolutely, but depending on the project, it varies a little bit, but it's a short time frame. It's a very tight time frame, though.
And what have you had success stories coming out of this challenge, so to speak?
For customer service, we did. I had this one experience where I went to a Fifth Avenue jeweler, for a milestone event, and I was like, okay, I'm so excited about this purchase, and this is about like 2007 or 8 or so, and they didn't have my size, so they shipped me the piece.
Right.
And it was, I was so disappointed with that experience because I thought there was less care put into it. It was just shipped. So, one of the ideas that we used the $10,000 on was, what do we want the customer unboxing experience to look like? And does it truly wow the customer? Does it bring them joy?
Yeah.
And over 30% of our reviews ended up coming on the unboxing experience. So clearly we knew that was a winner. So we invested more and more into that category. So that sense of joy that they had when they ordered it, we try to amplify that even more when they unbox it. It has to be equally joyful for them that way. So that was a clear winner, and I certainly have had many that were not winners, but it was a great way to use that rule out.
So speaking of rules, you have a rule as far as innovation is concerned, where you set aside $10,000 for whoever wants to experiment with an idea. But the two of you have a rule, and it's the 30-minute rule. Take me through that.
So Ankur's far better at compartmentalizing than I am.
Really?
Because I guess, as women, particularly I feel for myself that I wear so many hats that I could talk about work now, then I could talk about it 2 hours later, and I could just come and discuss something with him. So we said, you know what, to keep sanity and truly be present for each other, we have 30 minutes a day contiguously that we can only talk about work. And that's kind of helped, maintain our relationship, and I think even improve upon it.
Funnily enough, our favorite professor in grad school knew both of us, and he said, you guys should never work together.
This is Harvard, where the two of you went together. Yeah.
And he said we should never work together.
Really? Why did he say that?
So statistically, when couples start something, it doesn't work out for the marriage. And the reason I think is, and I think what he meant was, there's so much stress.
Yeah.
And there's so much uncertainty, and you're managing a family, and you have two people that don't have a steady income stream. And so generally what happens is, even if the company succeeds, the marriage may not.
Yeah.
And we had to set a lot of boundaries to make sure that doesn't happen to us.
Speaking of getting there, going back to what's happening as far as the industry is concerned, and the shifts that we're seeing, the US market and India, and of course you gave us some of the numbers to explain how they're similar in many ways at this point in time. But on the entrepreneurial side, do you believe India is far more entrepreneurial in the gems and in the organized gems and jewelry space today than the US?
Oh, by an order of magnitude at least. 35 lab-grown startups that are funded here. There's like 2 in the US in the last 5 years.
Why do you believe that's the case?
I think the Carrot Lane exit created the entire ecosystem. It validated it. Mithun did the hard work. He built the primary demand for e-commerce. Now, there's people that say, you know what, that was been done before, we could do the same. And we think it's awesome. This is how it should be. This is super exciting. I think it's great what's happening here. The energy is unreal. This is Silicon Valley on steroids, I feel.
But would you consider looking at partnering with people here, or anything interesting that you might want to consider picking up?
Maybe we want to get it right. That's and we don't want to rush that decision per se, but never say never. So Aditi's taught me never to say never. So we'll see.
What else have you taught him, Aditi?
He said, I'm never going into jewelry. I'm never going to live in
Englewood Cliffs, where we live.
in the suburbs and little things like that. But I got my data points along the way.
Yeah, that's a separate Excel sheet altogether.
Absolutely.
With a PowerPoint presentation. But what have been some of the key lessons for you as entrepreneurs of building this business out, of building it profitably, ensuring that it retains its global flavor as well, dealing with the kind of volatility? What have been some of the big lessons that you would like to share with people who are now looking at getting into, whether it's the gems and jewelry business or business in general? What would you tell them?
So as an entrepreneur, one of the big mistakes we made is we didn't worry about product market fit. The idea is get to product market fit with as little capital expended as possible. That is, I think, number one. Second is, for us, our true north has always been the customer. That's been right. When it was not the case before that pivot, we used to get so many more things wrong. But if you just listen to the customer, they'll tell you what is needed. I think third is follow first principles. So there's a playbook in India now, which is you raise capital and you build as quickly as you can. You project 100 stores, 1,000 stores, whatever. I'm worried that people are not thinking about the right customer experience to the extent they can. Certain people certainly are. But as an industry overall, that's what's going to determine success. And that long-term thinking, I think, is key. Whereas if you're already planning for an exit and you're pre-seed, hey, maybe the priorities...
Yeah, then you build differently. You build differently. Yeah.
Correct.
Yeah.
And we've made so many mistakes on the way. I would imagine most other startups will as well. Just be ready for that. This is a grueling, grit-based, very hard journey you're going to embark on. Make sure you're clear on what the mission is and just look at that. And it's kind of like Swami Vivekananda. Take one thing, make it your life, dream it, think it, sleep it. If you don't do that, you're going to fail. At least that's what we've been through.
I think also don't wait for the product to be perfect. Perfect it along the way, because there's always room for improvement. And I think pivot and pivot fast. I think those two things we were slower at initially and really put us on the brink of failure till we learned the hard way.
So today, as you learn to, or you have learned to pivot fast, what's the most important muscle, institutional muscle, that you've had to develop to be able to do that?
I think agility, but in the mind, that accept new ideas, don't put it down before you've really thought it through.
Don't say no.
Don't say no. Don't say no. Absolutely.
So has that been the big learning for you?
Yeah, I think we try to behave like water. We will go wherever the stream is taking us. Try not to push back. We're not fixed to any ideas. We've been wrong enough that we know that we're not right all the time. And in my case, I'm probably wrong more than I am right. So it's fine.
What's the mission now that you've set for Angara? What's the mission that you've set for yourselves? Besides the numbers, of course, the numbers will play out as and when they do play out. But what's the larger mission? What do you hope to accomplish from here on?
If we can get the industry back to its roots, how jewelry was supposed to be bought, rather than when retail stores came, the salesperson is pitching you what they have in the store. It's not what you want. We're trying to get back to that, and we're trying to get back to color. Those are, I think, the two principal things that we're thinking about.
And I think as we grow, I think maintain that soul. The soul of jewelry, of course, but even as entrepreneurs, continue to learn and evolve. The business is doing great, thank God. But I think growing in this industry, beyond the industry, and passing that on to future entrepreneurs.
Well, it's been an absolute pleasure speaking with the two of you. We wish you the very best of luck with Angara for your plans in India, but also the next 5, 10, 15 years. And we look forward to hearing much more from you about how the industry transforms itself, as well as your plans on reclaiming what you believe the industry should be, going back to its roots. But thanks very much, and look forward to seeing a lot more of you back here.
Thank you so much for having us.
Thank you. It's been a pleasure.
Well, with that, it is time for us to wrap up this edition of the Young Turks podcast. From all of us here on the team for now, goodbye and many thanks for watching.
Hello and welcome to Startup Street. I'm Arundhati Ramnan and with me is Ritu Singh. These are the top headlines from the startup world. Citycart, a fashion retailer, has raised 538 crore rupees in Series B funding round, co-led by TPG Newquest and A91 Partners. Investcorp, an early backer of Citycart, has made a full exit while India SME Fund continues to hold a minority stake.
Premium travel luggage and accessories brand Yumi has backed 25 crore rupees in a Series A equity funding round that was led by marquee investor Ashish Kacholia and others. The capital will be deployed to scale Yumi's retail presence across India, build a stronger team and ramp up marketing.
Frinks AI, a deep tech startup, has raised $5.4 million in a pre-Series A round led by Prime Venture Partners, bringing its total funding to $6.25 million. The company is building next-generation vision AI systems that help manufacturers automate and elevate quality control on their production lines.
Quick commerce platform Instamart has dropped parent Swiggy from its name in a strategic move that is aimed at carving a standalone brand identity. This comes days after rival Zomato, which owns Blinkit, rebranded itself as Eternal on the stock exchanges.
The world's top electric vehicle makers are in the slow lane. Tesla sales plunged 49% in Europe due to Elon Musk's political involvement and rising competition. Shares of Chinese EV giant BYD declined for the second day after reports of heightened regulatory scrutiny by Beijing.
Well, those are the headlines that we're tracking for you today on Startup Street. Now, in what's growing today, fintech unicorn Cred has secured $75 million in a Series G funding round that will be led by its existing backers, we've understood from sources. Now, GIC is going to lead this latest round along with Sofina and RTP Global. Founder Kunal Shah, we understand, is also expected to participate with a $20 million check through his VC firm, QED Innovation Labs. However, this latest round comes at a 45% valuation cut compared to Cred's last round in June of 2022, and this will value the fintech at $3.5 billion. Cred, however, did not comment on CNBC-TV18's story. So we'll move on from there. And what else is brewing today? Fleetx, which is a Gurugram-based logistics SaaS platform that has raised 113 crores in a Series C funding round that was led by IndiaMart and BNext. The company, which claims to have crossed more than 100 crores in annual recurring revenues and is nearing profitability, is eyeing a public listing in the coming 2 years. Fleetx currently serves more than 2,000 businesses across sectors like manufacturing, mining, FMCG, and cement. Now we're joined by Vineet Sharma, who's the co-founder and CEO of Fleetx, to understand the significance of this round and growth plans ahead. Vineet, thanks very much for your time here today on CNBC-TV18. And let's start with that fundraise. What will this 113 crore Series C round mean for this stage of your journey? How will you be deploying the money that you've raised?
Yeah, thanks for having me on the show. So we have raised 113 crore in our Series C round from our existing investors who have shown the faith in our journey and the product and the customers we have got so far. And they are very bullish on the future as well, right? We are going to deploy this money for the product innovations and the expansion of our product, which is one of our strengths as well. And then we are also going to invest in scaling our GTM as well, right? Primarily, we have majority of the revenue coming from Indian enterprises. So we are going to double down on our GTM to reach more and more enterprises in India.
Well, Vineet, your statement says you're close to profitability. What is that figure at? And can you give us a clear timeline as to when you're going to become fully profitable, on a year level?
So we have been focusing on our EBITDA numbers since last 2 years, and that has come down from minus 95% in FY23 to minus 29% in FY25. And we have doubled our revenue as well in those 2 years. So we have taken an aim that we will be profitable in this year. So FY26 is what we are looking at in terms of profitability.
Okay, FY26 is when Fleetx is going to be profitable. You also say, you were talking about your revenues crossing 100 crores in ARR. How much of that is coming from enterprise versus mid-market customers? And, what is the sort of trajectory you expect going ahead in the next 2 years, which are going to be crucial for the company?
So we are very bullish on our enterprise segment as well as mid-market. Mid-market is more predictable and it is more, you can say, scalable in terms of sales and GTM. Enterprise is more kind of a land and expand strategy for us, which is growing very fast. Which is growing very fast in last 2 years for us. So as of now, the current split is somewhere around 50% in both the segment. But we anticipate that in the coming 2 years, enterprise will grow much faster.
So as that happens in the next 2 years, are you confident you will be IPO ready, as you say? And for you to get there, could you specify the kind of milestones you're targeting, to achieve before you're going public?
Yeah, so obviously one of the most important parameter for going public, what we believe is the profitability. We are very focused on our capital efficiency and growing sustainably. So we are focusing currently on keeping the growth momentum, as well as, you can say, keeping our capital efficiency checked, right? So in terms of milestone, we are looking at doubling our revenue in next 18 to 24 months while become profitable.
Vineet, a lot of players are entering this space. What would you say finally, if I were to ask you, your real differentiator is? Is it your tech, integration, pricing, or even the customer relationships you've built?
So I think I'll say the product is the differentiator for us, right? We are one of the unique player who is providing end-to-end platform for, you can say, the likes of cement companies, FMCG, chemical, even the transportation and logistics to manage their logistic and physical operations. So right there, from telematics to workflows to AI and analytics, we are providing end-to-end solution rather than, you can say, integrating, you can say, different solution to solve a challenge. We are helping them with one single platform to manage end-to-end logistic operations.
All right, Vineet, we'll leave it at that. Thanks very much for joining us today. It's been a pleasure speaking with you. Thanks very much.
Thank you. Thank you.
From one fundraise to another, India's obsession with speed is now reshaping fashion. Bengaluru-based startup Slick has raised $10 million in Series A funding round led by Nexus Venture Partners with participation from Lightspeed. Now, the platform, which promises curated fashion delivered in just 60 minutes, plans to use the capital to expand into new lifestyle categories, roll out instant returns, and deepen its reach across India's metros. As quick commerce extends beyond groceries, Slick is betting big on impulse-driven fashion. Joining us now to discuss this further is Akshay Gulati, the co-founder and CEO of Slick. Akshay, thank you so much for taking time out and being here with us on Startup Street. Q-commerce has traditionally been dominated by groceries and essentials, right? What makes fashion the next frontier in this space, and what are the operational challenges that you face while sort of doing fashion, in a time-bound manner? Take us through what you have on offer.
I think in any distribution cycle, for that matter, it doesn't matter whether it's GT, e-commerce, or quick commerce. I think two kinds of startups have fundamentally emerged. One is vertical and second is horizontal. While the larger players today in quick commerce, by the name of Zepto, Blinkit, Instamart, etc., focus on turning into horizontal players, I think Slick is hell-bent in turning into a vertical leader in fashion and lifestyle. And that's one category wherein absolutely no innovation has been done in the last 10 years in terms of serviceability. So Slick is supremely focused in terms of solving for serviceability for forward and return delivery in fashion and lifestyle space. And we think that's going to be the biggest differentiator for us at the moment. In terms of challenges, I think in a high width category like fashion, nobody's ever thought of building dark stores, keeping in inventory. That's a model very unheard of. Fashion and lifestyle operates on a model called dropship, and we're operating on a dark store model, which is completely unheard of. And that's the biggest challenge we're trying to overcome and trying to prove to the industry in front of.
So dark stores is the challenge that you're currently facing. But, congratulations on the $10 million that you've raised. If you could sort of walk us through how this funding will be deployed, what are your top 3 priorities over the next 12 months?
I think our primary focus in terms of, investment of the cash we've raised is going to be around supply. We intend to unlock a lot more categories in fashion and lifestyle and not just stick to apparel. We intend to unlock a lot more international and national brands for our customers. Second is pin code growth. We intend to enter more cities and discover more pin codes within Bangalore itself. So increasing the number of our dark stores rapidly. And third, I would say, is demand generation, which is going to be a critical part of our business.
Sure, and you've also found, strong traction with urban impulse-driven shoppers, right? If you could take us through where you're seeing the most demand and, what's next? More PIN codes, more cities, or deeper penetration in the metros?
I think it goes both hand in hand. I think in a business like in a marketplace or a business, supply and demand gen has to go hand in hand. So as you focus more and more in terms of increasing selection and better pricing products, you also have to focus in terms of increasing outreach for brands and unlock more PIN codes. And as you unlock more PIN codes, new customers, one of them goes haywire and the business gets shaken up. So we have to sort of focus on both and balance it out.
Sure. And, I know it's only been like less than a year of operations right now, but if you could sort of take us through, are you seeing any revenues? What are you clocking? And how will you see this evolve as you sort of expand into newer categories? Do you think fashion can be profitable at QCOM speeds?
I think out of all categories, fashion has the most amount of probability in terms of turning profitable, primarily because of extremely high AOVs, right? Currently, at this moment, we're seeing AOVs upwards of 2,000 rupees in a single basket. Our AOVs are upwards of 2,000, because of which we're able to enable quite a lot of net revenue at an order level, which allows us to unlock profitability, at scale whenever we feel like, and we're able to consume the heaviest of the costs like our CAC, logistics fees, etc., pretty much easily compared to any other category. So I don't think I worry about profitability in this category a lot. And in general, if you look at the existing marketplaces as well, this hasn't been a big challenge, right? Unlike grocery or any other category for that matter. In terms of our growth, we've been able to grow 2x month on month since the inception of this business, which sort of showcases extremely good traction, and our repeats have been super high, which sort of interests our investors more and more.
Right. And, speaking about that, so then what does your backend look like? You spoke about dark stores. So how are you sourcing your fashion SKUs, and how do you ensure inventory agility across cities in a quick commerce model?
I think we are a supremely, and I think we've, mentioned this before quite a few times, that we're a supremely curated, we operate on a supremely curated inventory model, which basically means that we don't onboard anything and everything from any set of brand we partner with. We onboard the top 20-30% selection, for which we use AI on the back end in terms of understanding which styles might be relevant to our customers and which might not be. And we try and track its success metrics as much as possible, right? Which allows the platform to have extremely amazing sell-through rates. These brands want to put in more and more inventory on Slick day by day.
Sure. And, so many more questions to ask you, but we're completely out of time. Thank you so much for joining us on the show today, and we wish you all the best on this journey going forward.
Thank you very much.
On that note, it is time for us to head into a short break. But coming up next, ice cream brand Hoko scoops up 10 million in its Series B round. We put the company on the hot seat to find out more. Stay tuned.
Welcome back. You're watching Startup Street. Now, Ahmedabad-based premium ice cream brand Hoco has announced a $10 million raise as part of its Series B round that was co-led by the Chona family office along with Source VC. Now, with premiumization and new age consumer trends reshaping the food and beverage category, Hoco claims to be building the next generation dairy and dessert brand. Joining us now is Ankit Chona, who is a promoter of the company, to talk about this round, the roadmap, and what it takes to really build a modern legacy brand in a very, very crowded market. Also with me is my colleague, Arundhati. Ankit, welcome to Startup Street. Thanks very much for your time here. Tell us about this $10 million tranche in your Series B round. Is the full $20 million round committed already? And can you break down the expected use in terms of proceeds?
Sure. So, well, thanks for having me. So this is actually going to be between a $20 and $25 million round that we're going to do. So the first tranche is coming now because we've started the expansion for the next year. And after that, we will take it forward and raise the next tranche over the next 3 to 6 months. And the idea is that we're going to use most of this capital for the fund expanding our capacity and entering new markets.
Right. Hi, Ankit. Arundhati stepping in here. From a growth standpoint, right, what markets are you prioritizing next? And how are you sort of approaching this geographic expansion in a segment with strong regional competition?
Sure. So, we are currently in Gujarat, Maharashtra, Rajasthan, NCR, and very, very small parts of Madhya Pradesh. So the plan is to now go deeper into all these territories. We're pretty much in 100% of Gujarat. We're going to go deeper into Madhya Pradesh. We're going to expand into all of Uttar Pradesh, and then we will also go in certain parts of South India, mainly Telangana. We might do Goa. So we're figuring it out right now because we first have to build up our capacity. Expanding geographies is the easy part. It's actually building the capacity that we're struggling with right now because this summer has been quite brutal for us as far as reaching our demand. We quadrupled capacity over last year, but we've still not even been able to keep up with demand.
All right, Ankit, let me ask you then, since the demand is so large and you're struggling to keep up with capacity, what does the current production look like across your brands? I mean, I'm talking about Hoco, Hoover, Holly, all of them. And how much will this new round enable you to scale capacity by in terms of volumes and even SKUs?
So SKUs is never really a very big challenge, but as far as our overall capacity, currently we're at about 1.3 lakh liters of ice cream per day. Last year we were at about 35,000 liters of ice cream per day, and with this new investment, we want to scale up to 2.5 lakh liters. So we want to double from where we are currently at, and it's a race against time right now because and that's why we had to prepone our fundraise as well because. The kind of green shoots and tailwinds we are seeing, we wanted to start the capex a lot earlier. So, and that's what we're doing right now. We've already, we've acquired additional land next to our current facility, and we're also starting construction in the north to feed the north market as well. So we'll have 2 plants hopefully before next summer.
Sure, and if you can sort of speak to how your distribution mix is evolving, what's the share that's coming from Q-commerce, D2C, offline retail, and what's the margin profile across these channels?
So the margin is pretty much even. Obviously, in quick commerce, there's a slightly higher margin that needs to be shared with the channels, and therefore the product mix also differs a little bit. But currently, we are at 80% is coming from offline and 20% is coming from quick commerce. Ice cream, there isn't too much of, or rather there is zero D2C that happens because you can't really do your own distribution. So it's 80-20 right now. And I think with the way the trend is going, we will be at 70-30 next year. So, the growth of quick commerce is probably double that of general trade and modern trade right now.
Well, Ankit, let me step back and ask you a broader question. As someone, of course, who's been in this space for a very long time, you have more over almost 13 years. And then, of course, for the last 7-8 years, you've been here. This premium ice cream space is really heating up. Both domestic and global players are expanding. What is really your differentiation strategy today? I mean, apart from price point, flavors, distribution, what exactly are you focusing on?
So, well, first of all, I've been with Hoco. We've only been in the market for about this is our second summer. So, And with this whole, onset of quick commerce, even I feel like a true startup, because even I'm learning how to sell ice creams on quick commerce and all. But I think overall, see, premiumization is happening across the world, and ice cream is no different. What we are seeing different is that, other than people are willing to experiment, people are looking at healthier options, people are looking at, different form factors. So, for example, this summer we launched this one ice cream called Amchi, which is actually a mango ice cream shaped like a mango, looks like a mango, and obviously tastes like a mango. And and it is packed in a, in it's almost like a tamper-proof kind of packing that we've done. And we have been blown away by the demand that we've seen. It's probably 10x of what we can manufacture right now, and we are really struggling with it. So, and the same thing goes with another category of cones. Everybody does the regular cones, which are, priced anywhere between 20 and 50, 60 rupees. But we came out with this ball top cone, which is called the O cone, because it looks like an O on the top. And, again, it's priced at 90 rupees a cone, which is probably one of the more expensive cones in the market. And again, the demand has been incredible. So, it's a fully automated process we follow on that, but even then we can't keep up with demand. And it's interestingly, it is selling both on quick commerce and in general trade as well. So, usually we always feel that quick commerce is, where you can have more premium products. But this, in our case, it's, both these segments where we are seeing these kind of products grow quite rapidly. And obviously, we also launched Huber and Holly, which is an ultra premium ice cream brand, which has some very interesting flavor profiles such as Amarana cherry and Sicilian pistachio and salted caramel popcorn. So, it's all about people who are willing to experiment, people are willing to try new ice creams. And I think customers are giving it a fair shot and are willing to do that, try new products as well.
Sure. All right, Ankit, we're completely out of time, but thank you so much for joining us on Startup Street today.
Pleasure.
Moving on, AI is changing how online sellers do business, from product photos to marketing. One startup aiming to be at the center of this shift is Photo.ai, which just raised $2.7 million with backing from InfoEdge and already has over 3 million users. My colleague Aishwarya Anand spoke with co-founder Venus Duria to learn how they plan to scale and compete with giants like Adobe and Canva. Take a look.
Venus, my first question to you is that you've recently raised $2.7 million in your seed funding, and you've gotten some big investors, including InfoEdge, on the cap table. Help me understand, where are you planning to allocate those funds?
We raised that capital to complete our co-pilot and agents that we are building for commerce and online sellers. And we are using it for research and building our AI team along with the development part. And once it got developed, and we'll use the remaining capital for the GTM, where we want to target early sellers in the commerce and marketplaces for our scale.
With over 3 million signups before even your official launch, what strategies today have you put in place to convert them into active paying customers?
Okay. So apparently we how we got 3 million sign-up first, I'll talk about that. I mean, we definitely need a lot of data, and for that, and we launched a lot of free tools in the market, and these tools are helping different companies to do different tasks. For example, AI product photography is one of our model, which help you to do the photography, and it's pretty agnostic in nature, which you can use it for any kind of product to create your photographs. And second is a tool like Upscaler. If you have a pixelated image, you can upscale it. Third, we got a tool like as basic as background remover, and which also helping us to gain a lot of data, which is helping us as a data set to make our own model for the graphics.
Correct.
So that's one of the reason. And now within those 3 million sign up, there are a certain percentage which is hobbies and casual users who are using it to create the images for their personal use. But the remaining is ICP, which is coming for their use. These are the set of people who are photo editors, designers, and marketeers.
You're also working in a space where there are legacy players already. Whether it's Canva, whether it's Adobe, they're also bringing in AI. So how do you differentiate yourself?
Adobe and Canva are built in very horizontal way. Anybody can use them for their design purposes, but we are building in a very vertical focused marketplace and specifically building for the commerce use case. I mean, it's solving the workflow now. For example, we get integrated with the Shopify or Amazon of the system, where a seller can pull all their content up and can generate the command basis on that. We also do the brand training basis on what kind of content you typically generate. We understand that language as well. And third, like we are mostly, I mean, completing a workflow in such a way. For example, As a seller, first you want to do the product photography, we are automating that. Then you launch your product to a marketplace like Amazon on your own website, we are automating that content. Then you want to do the advertisement, you create ads, we are automating that content. Then after that you want to do the product marketing. Now users are already there, you want to do the notification, you want to do the email, blogs, we are automating that. So in that sense, we are picking from how a seller start from the scratch and keep moving ahead in his journey, and what kind of asset he need during that journey, and how we can use the integration within those systems where he do not need to worry about having different designers. And also the bandwidth is also a challenge. Using this platform like Adobe, you're not able to create multiple campaigns, and multiple campaigns are needed to do the A/B testing to increase your CTR or the ROS for your advertisement or your product listing. And for that, I guess you need a environment where you can create thousands of assets in different design, in different languages, in different sizes. This environment Canva and Adobe currently do not support.
Okay, all right. Give me a sense of how many customers do you currently have on the platform, and how are you priced for them?
Right now we have two different models. One is three different models actually. One is for small sellers who are using it, small sellers and small teams. We typically sell them at $20 per month, and then we have an enterprise plan as well. And second is APIs. We charge them on number of API hits and number of consumage basically they are doing on our platform. And second is stateway model, like for small seller, they typically come and sign up and start using a platform immediately. So right now, the percentage wise, it would be 60-70% users and revenue coming from the B2C users, and 30-40% coming from the B2B side.
On that note, we're going to wrap up this edition of Startup Street. From Arundhati Needs a goodbye, but stay with us. More news and updates will continue on the other side.
The Gates Foundation, one of the largest charitable foundations in the world, is marking its 25th anniversary. Now, the Silver Jubilee comes with a big commitment. Bill Gates is pledging to give away, in his words, virtually all of his wealth over the next 20 years, which means the foundation plans to spend $200 billion over the next 2 decades. Now, this accelerated timeline has meant a change to the foundation's charter, which had stated that the organization would sunset 20 years after the death of Bill Gates. The last big change to the foundation had come in 2021, when Bill and Melinda Gates announced their divorce. Melinda Gates resigned as co-chair in 2024, which left Bill Gates as the sole chairman of the Gates Foundation. Now, from combating infectious diseases to agriculture research and reproductive health, the Gates Foundation has been at the forefront of solving some of the biggest issues in the world today. And joining me now to discuss the foundation's future and his pledge to give away virtually all of his wealth is the man himself, Bill Gates. Bill, many thanks for joining us on CNBC-TV18. And let me start by congratulating you on 25 years at the Gates Foundation. But Bill, why this decision to set yourself a new deadline of 20 years to give away virtually all of your wealth? What has prompted this decision? Why this change from the original position?
Well, looking back on these 25 years, it's amazing what we've been able to accomplish. Together with partners, the one statistic of cutting the number of children who die every year in half has been phenomenal to be part of that. And so as I was thinking about that, I decided that we should essentially double down and spend all the rest of the money I'm lucky enough to have through the foundation on these causes over the next 20 years. And that'll allow us to be very aggressive, make some fantastic progress, and we'll have real clarity. A lot of resources for 20 years, and then others can step in with whatever we haven't been able to finish off.
If I may, Bill, is this decision to accelerate or speed up the giving that you're doing linked to the overall environment that we're currently seeing, where there is a retreat from multilateral institutions, from multilateral arrangements, from development aid? How much of this acceleration perhaps is also linked to the change in the environment as we see it today?
Now, this decision was made before all of these reductions were clear to us. I would say in the short run, it means the work we do is going to be challenged. Although I expect every year we'll have progress in India and some of the countries we work in. In Africa right now, these cuts to the aid budgets, the debt situation, some of the instability means the next 4 or 5 years will be difficult. But over the time period that all my money will be given, I still expect to see pretty incredible progress. So in the short run, I am very disappointed that aid generosity is down. But with the innovations in the pipeline, with, I think, going to people and saying that those aid budgets should come back to some degree, I'm super excited about what we can achieve in these next 20 years.
Bill, you talked about doubling down on the significant resources that you've already committed. $100 billion was the previous amount that you did over the last 25 years in spending. You're doubling down on that, $200 billion between now and 2045. So help me understand, these are big numbers. Prioritize for me how you intend to use this money and what are you hoping to achieve in terms of impact?
Well, the first 25 years, we got childhood deaths down from 10 million to under 5 million a year. And we also took the two other diseases, HIV and tuberculosis, and the deaths were cut substantially for both of those. We also came up with ways to save mothers who are giving birth. And so we're really putting most of the resources into the global health work. We hope to be able to cut the number of children who die more than in half again, and also to make dramatic reductions in all infectious disease. We need to finish our polio eradication. Still a lot of hard work left there, and we also think some other eradications, guinea worm, malaria, a number of diseases could be taken all the way to zero. And so by having, for the next 20 years, over $200 billion in resources, double what we spent in the first 25 years, we'll be able to partner with, scientists, and we have a great partnership with the Indian government to help them achieve their ambitious health goals. And, this field, the field of global health, will be able to perform miracles, and our resources will be a meaningful part of that.
You know, Bill, you spoke about the ability to deliver miracles. What have been some of the hardest fought battles over the last 25 years? You talked about some of the important outcomes, especially on the global health front, that you've been able to achieve. What's been the hardest part of making those a reality? Resource is one thing. Execution is another thing altogether. What's been the tough part on the execution front?
Yeah, so for the foundation, we both work on the R&D side, so like creating new vaccines. And so, with Serum, a great Indian partner, a meningitis vaccine was one of the first new ones the foundation did. Later, a rotavirus vaccine that was very low cost, a pneumococcus vaccine, then with other partners like Bharat, a rotavirus vaccine that also brought prices down. So it's the vaccine work, both in the R&D and the delivery, is probably at the top of the list of the impact that we've had. Vaccines, you need to keep them refrigerated. You need to make them cheaper. You need to convince mothers to bring their children in. So, there are plenty of challenges just in that one area.
Bill, you talk about India. Now, you've been spending a fair amount of your time here in India. And of course, the foundation has been working in India for a good part of the last 25 years. Let me ask you about what excites you about what's happening in India today. How important is India going to be for the Gates Foundation over the next 20 years?
Well, certainly India's a very, very important place for us. It's our biggest overseas office, and it plays two big roles. One is that the Indian government has very aggressive goals for improving health, and so we get to partner and try out the latest advances in medicine, and that we've seen great results from that. But the actual creation, the R&D of the new tools, whether it's diagnostics, vaccines, drugs, new seeds to help farmers, or ways of taking AI and helping with health and agriculture as well as education. India is going to be a place where there's so many smart people, so much desire to see these improvements that will pioneer a lot of things first in India, and the brilliant work there will then benefit the entire world. Paradigmatic of that is the work in digital finance, where Aadhaar and the ability to pay digitally, India really did an amazing job on that, and now we work with the Indian government to make that available to all countries.
But Bill, you've been spending more and more time here in India and doing lots of fun, interesting things, not just linked to the foundation, but even outside of the work that the foundation is doing. What about being in India, about making the connections here in India, the people that you're spending your time with inspire you today? I mean, is this a new romance with India that started over the last few years?
No, I've always been fascinated by India, and of course Microsoft has had a fantastic relationship in terms of the huge development offices that we have in India, as well as amazing people like Satya Nadella that have come and made huge contributions to the company. And so as I moved from Microsoft to the foundation, I took that understanding of the great talent that's there with me. And so, I get to India on a regular basis and get to meet with the partners there. The majority of the world's vaccines by volume are made in India. We've had, so many important partnerships with that, and that's really growing. The quality of research in India, its desire to go even beyond vaccines with the tools that are provided, it's very timely. And, part of that is Prime Minister Modi's been very generous at sharing with me his goals, and so we can talk about how the foundation helps with that.
You know, Bill, you've referenced vaccines, and I want to ask you this in the context of the last conversation you and I had, which was in September in New York last year. Now, there you had talked about being a salesman for Gavi, the Global Vaccine Alliance, in its quest to raise funds. You've been central to Gavi's ambition and aspiration of providing affordable vaccines to the world. At this juncture, with the very real possibility of funding drying up, specifically from the US, how concerned would you be about Gavi's future?
Well, I'm very, very concerned. It would be tragic if Gavi weren't able to raise as much or more money for this next 5 years as it's had for the last 5 years. And yet, it's pretty clear that we're going to see a reduction. You know, I continue to talk to all the governments about the impact. You know, there's nothing more amazing than making sure all the children of the world have these miraculous vaccines. So we'll see what we're able to raise, but it's looking tough. You know, I'd say the next 5 years, the whole aid picture, whether it's Gavi or Global Fund, are going to mean that we might go backwards a little bit before we resume the progress we've seen since the turn of the century. And that's just a mistake, and I'll be speaking out very loudly, try to get the U.S. back in, try to get others to maintain or even increase, in some cases, their giving.
But do you feel confident or optimistic about that? You said you're going to try and draw people back to the table. But at this point, with the global retreat that we are seeing, especially from development goals, Bill, how much of a slide back do you believe we should be prepared for? Are we set for?
Well, we have two forces. One is the power of innovation, that is new tools, whether that's new drugs, new vaccines. We have AI to even help with the delivery, to talk to patients and give them advice about care seeking, things like the ultrasound that'll help figure out about the whether a pregnancy needs special care. So the innovation side is, if anything, going faster than ever. The generosity on resources for the delivery side, the next 5 years are going to be tough. And that might mean some of our statistics that have been improving, we might have a period where they'll get somewhat worse, particularly in Africa. And that's tragic. That shouldn't happen. If you look at the full time frame that all my money will be given over, I'd say we will be much better off by the end of that than we are right now, despite this period where the aid budgets are really going to hurt our work, particularly, as you said, things like Gavi and Global Fund not being fully funded.
Well, we are going to head into a break and continue our conversation with Bill Gates on his big pledge to spend $200 billion as part of the Gates Foundation over the next 20 years. Welcome back. You're watching the CNBC-TV18 exclusive. We're in conversation with Bill Gates on the big pledge of accelerating the spending being done by the Gates Foundation, $200 billion over the next 20 years. You know, Bill, the last 25 years, the Gates Foundation has worked very closely with Warren Buffett. He's been instrumental in the $100 billion that you've spent in the journey so far. Is there a disappointment that he isn't going to be a co-traveler, a fellow traveler over the next 20 years for you at the foundation?
Well, I'll certainly be very sad not to have Warren's regular advice. I mean, Warren is so wise, so generous. He's been a great friend to me. His example as a philanthropist, I think, has influenced many people besides myself. As you say, he's a huge contributor to the foundation. His family is very committed to the causes the Gates Foundation works on, and so they'll continue to be, his children will be great partners of ours. in many of these areas. But no, it'll be tragic if Warren's not around. He's 94. I hope he lives this whole 20 years. But he might not.
Well, speaking of milestones, it's 25 for the Gates Foundation, it's 50 for Microsoft, and it will soon be 70 for you in October. As you look back and reflect on the many milestones that you've achieved personally and in your careers, if you had a chance of a do-over, would there be anything that you'd change, anything that you'd do differently?
Well, I'd be very reluctant to go back and change things since I've been so unbelievably lucky. My parents, who I got all my values from, and they made sure I got a great education. I've had amazing friends like Paul Allen, who helped found Microsoft, Steve Ballmer, who allowed Microsoft to be so successful, and now an unbelievable number of great partnerships at the foundation with the incredible team there, and partners all over the world. So. I'm the luckiest person in terms of what I've been able to be involved in. So yeah, I've made plenty of things that I've had to learn and do better, but I don't think I'd want to risk going back and making any changes.
Well, speaking of wanting to do better, you're no stranger to criticism, and it's been constant, but perhaps post-COVID even more so. Questions about the influence that organizations like yours build on decisions that have been taken. Many call it the tyranny of the unelected. How do you now respond to that criticism, Bill, and how do you believe the foundation should learn and position itself over the next 20 years to take some of that feedback and criticism on board in some constructive way?
Well, I think the agenda of saving children's lives, and making sure they're well nourished so that their brains and bodies fully develop, fortunately, that's not a super controversial agenda. All the governments we work with, including India, have goals to reduce those deaths, and so we're able to work together. Vaccines themselves, we test them to make sure they're incredibly safe, and so there is some controversy about those. But for example, with polio, there's not a single kid in India who's been paralyzed since 2011, when the final case, which was tragic, was taken care of, and so we get pretty strong support for the work we're doing. Sometimes seed technologies or contraception, we have to make sure we're communicating well about those things. I wish there were more people involved in, critiquing what we're doing in malaria and TB and HIV. Some of the work we do can actually be pretty lonely because it doesn't get the attention, the resources or the number of people engaged. So, I'd love somebody to criticize our TB drugs or vaccines or diagnostics and, share their ideas, because TB is back to being the world's biggest killer, and there's just so few people funding the work there that we wish there were more.
You talked about TB, malaria, and you're hoping that we see breakthroughs on both those fronts. But outside of health, the innovations on energy, the R&D work that's happening on Alzheimer's, I know that there's been a large part of your mind space and as well as your resources that have occupied these areas in the last few years. What are you most optimistic about, both on energy, specifically nuclear energy, and the work that's happening on things like Alzheimer's, the tuberculosis vaccine, etc.?
Well, if I had to pick one, I'd say, getting to the bottom of malnutrition and really solving that might get to the top of the list. It's a tough competition because we've got a HIV vaccine, a TB vaccine that you mentioned, a malaria vaccine, all very important. I also support new energy innovation. I do that through for-profit investments, including, for example, TerraPower, that's working on new lower-cost nuclear reactors. And so climate change, avoiding the worst of that, and getting cheaper energy is important. But I'd say the malnutrition would be at the top of the list.
Well, it's clear that you're definitely not retiring anytime soon, Bill. What keeps you going? I know pickleball is definitely not going to be something that's going to occupy a lot of your time outside of the foundation's work. But what keeps Bill Gates going today?
Well, I'm very lucky. I love reading. I love, traveling. I have great sisters and friends, and I love tracking the innovation, meeting people who are out in the field doing the tough work. So it's fascinating, and even though we'll have setbacks overall, the possibility of what we can achieve in these next 20 years keeps me going, makes me want to travel and work hard.
And the possibilities that you alluded to, what we're seeing on the AI front at this point in time, but for AI to really address the world's real challenges, healthcare, finding solutions to the many access deficits that exist, what are we talking about? Are we 5-10 years out before we start to see an inflection point on some of these big, real transformational challenges?
Well, there's no doubt in the next 5 years it'll be pretty radical, both in terms of how we discover new things, where the AI will help, and even healthcare delivery, where the patient will be able to talk with the AI and share everything that's going on with them and how they should interact with the health system. And so, no, that's near term. We have a lot of partners who are doing pilots even this next year.
Well, you've been part of the private sector and, of course, then moved to the development world. If I were to ask you for your message to the private sector in the current volatile environment that we're in, to other philanthropic organizations as well, organizations that you're perhaps partnering with or you're hoping to partner with in the future, what would your message be to them? What would your message be to governments today? You said you want to ensure that your voice is heard. What would you tell governments around the world today as we perhaps face what could loosely be called a leadership recession?
Well, the value of helping other people is pretty strong in all the world's religions. And so, that should extend to the poorest, those most in need. And so the idea that we're having less money to buy vaccines for the world's children is a bit of a surprise. And my advice is, hey, let's reverse that and accelerate the progress we've seen, which we should all be so proud of.
Well, Bill, with that, thanks very much for joining us here on the Global Dialogue today. Thanks very much for giving us a roadmap of where the Gates Foundation is headed. It's going to be an accelerated timeline for you to spend $200 billion over the next 20 years. It's a significant amount of money and, of course, a big change as far as the foundation's charter is concerned. Bill Gates, always a pleasure. Many thanks for joining us here. We will take a break. There's a lot more coming up. Don't go anywhere. We're back in a moment with more. The Gates Foundation, one of the largest charitable foundations in the world, is marking its 25th anniversary. Now, the Silver Jubilee comes with a big commitment. Bill Gates is pledging to give away, in his words, virtually all of his wealth over the next 20 years, which means the foundation plans to spend $200 billion over the next 2 decades. Now, this accelerated timeline has meant a change to the foundation's charter, which had stated that the organization would sunset 20 years after the death of Bill Gates. The last big change to the foundation had come in 2021, when Bill and Melinda Gates announced their divorce. Melinda Gates resigned as co-chair in 2024, which left Bill Gates as the sole chairman of the Gates Foundation. Now, from combating infectious diseases to agriculture research and reproductive health, the Gates Foundation has been at the forefront of solving some of the biggest issues in the world today. And joining me now to discuss the foundation's future and his pledge to give away virtually all of his wealth is the man himself, Bill Gates. Bill, many thanks for joining us on CNBC-TV18. And